here we go. In case you guys didn't see by the runtime of this video, yes, you are seeing that correct, over 10 plus hours long. This is absolutely everything. This is the only video you will ever need to learn quarterly theory, whether that's from the complete beginning, whether that's looking to become more advanced and profitable. This is the video. All the concepts, all the models, the psychology used, prop firms used, indicators used, everything all in one video. Save this video. I want you guys to be taking notes throughout the whole entire of the video. If you make it to the end as well, I do have a surprise for you all. But with that being said, there's timestamps in the description down below. If you do want to skip parts, there's the foundation, advanced concepts, models, psychology, etc., etc. Check those out in the description if you do want to check out specific parts of the video. With that being said, this video is years and years of knowledge compressed into 10 hours. And this is what has allowed me to become a full-time trader, generate tens of thousands of dollars from this market, as well as also generating my students most likely over hundreds of thousands of dollars in payouts as well, and millions of dollars in funded capital. So with that being said, let's go ahead, grab some popcorn, grab your notepad, and jump straight into this absolute best video I have ever made. Let's get it, guys. Quarterly theory, complete A to Z guide. Inside of this video, we're going to be covering absolutely everything A to Z, beginner to advanced quarterly theory. This video is the absolute framework behind my whole entire trading strategy, and without understanding this video, you will not understand the concepts and the models in which I teach. I of course need to give a huge shout out to Trader Day, the creator and founder of this theory. Without him, none of this would be possible. However, I have personally spent thousands of hours mastering and trading this theory as well. So without wasting time, let's jump straight into it. So, introduction to quarterly theory, QT. QT focuses specifically on the time element of trading, the most important factor. Without time, we are trading blindly. Blending QT, which is time, with ICT, which is price, will lead to enhanced precision. So QT specifically focuses on that time element, whereas ICT focuses more on the concepts, the price element of trading. So if you combine them both, you will unlock a new lens on how you view the markets, and you will understand why and when specific concepts work and they don't work. Time must be divided into quarters for the best interpretation of market cycles. QT eliminates uncertainty by providing clear, time-based reference points to guide your trade entries. So with QT, you're never going to be trading blindly. You're always going to have a specific time in which you look for your entries, in which you look for liquidity sweeps. That is what makes QT so powerful. You're not just given a load of concepts, you're actually given the exact time and market conditions in which you should be trading them. Next, we have the time cycles. So this is splitting everything into quarters, into 4. So the yearly cycle is comprised of 4 quarters, each quarter being 3 months. So from quarter 1 being January, February, March, Q2 being April, May, June, Q3 being July, August, September, Q4 being October, November, December. The monthly cycle is comprised of 4 quarters, each quarter being 1 week. The first full week of a new month is Q1. The following week, the second week, is Q2. The third week is Q3. And the final week is Q4. If a new month starts, but the week begins within the previous month, we class this week as a time distortion week, and the week that follows the time distortion quarter then begins as Q1. You can also look at the time cycles, the quarters, as candles. Each candle represents 1 quarter. 1 daily candle is 1 quarter of the weekly cycle. 1 weekly candle is a quarter of the monthly cycle, and so on. The weekly cycle is comprised of 4 quarters. Each quarter is 1 day, Monday being Q1, Tuesday being Q2, Wednesday being Q3, and Thursday being Q4. Friday, of course, is not a quarter, and it serves its own unique purpose. This purpose is more times than not to return back inside of the weekly range. The daily cycle is comprised of 4 quarters. Each quarter is 6 hours, aligning with the 4 trading sessions of the day. So we have the Asia session, which is Q1, beginning at 6 p.m. and ending at midnight. We have the London session, which is Q2, beginning at midnight and ending at 6 a.m. We have the New York AM session, which is Q3, beginning at 6 a.m, lasting until 12 p.m. And we have the New York PM session, which is Q4, starting at 12 p.m. and ending at 6 p.m. We then have the session cycles, which is comprised of 4 quarters. Each quarter is 90 minutes long. In order to find your session cycle, split each daily cycle quarter into 4. So for example, the New York AM session divided into 4 will give us Q1 starting at 6 a.m. until 7:30 a.m, Q2 starting at 7:30 a.m. until 9 a.m, and Q3 starting at 9 a.m. until 10:30 a.m, and finally Q4 starting at 10:30 a.m. until 12 p.m. Next, we have the quarter functions. Each quarter serves a specific purpose. Using if-then logic, we can anticipate what the following quarter is most likely to do. So for example, if Q1 consolidates, then Q2 will most likely manipulate. If Q2 manipulates, then Q3 will most likely distribute. If Q3 distributes, then Q4 will likely be a continuation or a reversal. So we have a quick quiz for you guys watching. If Q2 consolidates, what will Q3 most likely do? Make sure to drop the answer in the comments down below. And if you check the description, the first line will be the application, the waitlist to apply for my one-to-one mentorship. So if you guys would like to be taught by me one-to-one, make sure to apply to the waitlist. Back to the video. Next, we have the true opens. Specific opens within price which serve as time-based premium and discount. They can be used to gauge high probability stop hunts and Judas swings. True opens are the opening price of Q2 in every cycle. High probability PD rays will overlap with true opens. So if you take a look at the example to the right, essentially if we're coming into a new cycle with a bullish bias, we want to see price dip down below the true open and take some liquidity to then begin moving towards our draw on liquidity. So this is then when we combine the quarters. Let's say for example Q1 accumulates, we can then anticipate Q2, the opening price, to form that true open, and then within Q2 to dip down below Q1's lows, taking sell side liquidity to then begin distributing within the following quarter towards our draw on liquidity. True opens are very, very important to factor into your trading. If we are below a true open, this means we are at a discount, more likely to have that reversal. And if we are above a true open, this means we are at a premium, more likely to have that reversal lower. Now finally, we have the quarterly theory cheat sheet. So within quarterly theory, we have 2 main cycle functions. However, they are not limited to only AMDX or XAMD, but these are the most prominent ones. So AMDX consists of Q1 being accumulation, Q2 being manipulation, Q3 being distribution, and Q4 offering that reversal or continuation. XAMD consists of Q1 being a continuation or reversal, Q2 is accumulation, Q3 manipulation, and Q4 distribution. So if you take a look at the example to the right, you can see this is a clear-cut example of an AMDX cycle function. You can see that first quarter is offering consolidation, accumulating price within a tight range. Then the following quarter, because we know that Q1 accumulated, we can anticipate will create that manipulation. You can then see during Q2, price pushes above Q1's highs while also being above that true open, forming that smart money reversal. Price then begins to break down, aggressively trading towards the downside, forming a gap that overlaps with the true open. This is then when Q2 becomes tradable. After the manipulation, the stop hunt has formed. You can then begin to look at entering any PD array that forms after that manipulation. Q3, the following quarter, after manipulation has occurred, we can anticipate Q3 to give us that distribution towards our draw on liquidity. Same thing as after the manipulation has occurred, any PD array that forms will most likely offer a very nice entry to get you in line with that order flow. Q4, the final quarter, because we know that Q3 distributed, we can then anticipate Q4 to either continue lower within that direction or offer a reversal. If we're going to see a reversal occur, we need to see Q3 lows round below and then aggressive displacement to the upside, breaking above a swing high that's formed inside of Q3. And then once we see a PD array appear, you can then begin to look to enter inside of that PD array. However, if we was to form a continuation, price will break below Q3's lows and continue aggressively displacing to the downside. Another thing to note as well is if Q3 delivers to a high time frame key level, be it a previous low or a previous PD array, then Q4 will more likely than not reverse. Within a manipulation quarter, you can enter once the smart money reversal has occurred. Within a distribution quarter, you can of course enter once you have clearly identified that Q2 was manipulation. And during a continuation or reversal quarter, as they often occur at the very start of a cycle or at the very end, you'll more likely than not get pretty lackluster price action. However, sometimes they can offer very, very nice moves. And then within an accumulation quarter, it's better to just stay sidelined, let that quarter play out, and then wait for the manipulation to occur within the following quarter.
Yo, what is going on, guys? Welcome to the very first episode of the Quarterly Theory Bootcamp, episode 1. I do plan on doing many episodes, so the more episodes you guys want to see, let me know in the comments down below what topics you would like me to cover inside of the bootcamps. I've already got probably around about 15 video ideas, and essentially the goal of this bootcamp is to take you guys from zero to extremely knowledgeable in quarterly theory. Of course, I was a student of Day in his 2024 mentorship. I took thousands and thousands of notes. Let me just show you guys real quick. As you guys can see, Day QT mentorship 2024. The word count at the bottom, 30,000 words. Okay, and I'll quickly scroll through it just so you guys, okay, you can see that. Okay, so I was a student of Day, so I do know what I'm talking about. I got the concepts firsthand from Day. Of course, everything I am going to be speaking about, for the most part, was created by Day, Trader Day, so shout out to him. And yeah, with that being said, guys, let's just go ahead and jump straight into it. Not really going to be editing these type of videos, just really raw, just explaining everything how it should be, showing you guys examples on the charts, and yeah, showing you guys a few graphics, pictures, examples before we get into the charts, so you know exactly what we are talking about. So, first episode, quarterly theory, time cycles and quarters, right? Everything based upon quarterly theory stems upon this, right? So with this in mind, what we do is essentially divide everything into quarters. So every single piece of time, every single candle can be divided into 4, and this is what we do to get the best analysis of each quarter and of the higher time frame candle that we are trading. So for example, a daily candle can be divided into 4, and then we can view each of those quarters, and each of those quarters has its own function, right? So here's a little screenshot here first. Feel free to screenshot this, take note of this, okay? The quarters have names: quarter 1, quarter 2, quarter 3, quarter 4, or Q1, Q2, Q3, Q4, whatever you would like to call it. So we have endless cycles, but I've just wrote down the main ones that you're going to be focusing on, and not even these ones here are the main ones. These are like super high time frame, but they're just good to know anyway, just so you guys can get the concept inside of your head. So firstly, quadrennial cycle. This is viewed on the 1 month time frame. Keep in mind, each cycle must be viewed on its correct specific time frame. Like, you can't view, for example, the weekly cycle on like the 5-minute chart. It just doesn't work, right? Each chart, each cycle, each quarter should be viewed upon its correct time frame. So the quadrennial cycle is essentially each year being 1 quarter. Okay, so the cycle is comprised of 4 years, and each year is 1 singular quarter. The way that this works here, the way that this works here is every single election year. So US election year. So for example, we had 2024 last year was when Trump got elected. That would be our quarter 2. So that's the way that we find out which quarter we are trading within for the quadrennial cycle. So because 2024 was the election year, that means the previous quarter, the last year, was the start of the cycle. So Q1 was 2023, Q2 was 2024, Q3 was 2025, and Q4, I may have missaid one of those, but Q4 is 2026, as you guys can see right there, okay? So right now, the current year that we're trading within is Q3 2025, okay? Now for the yearly cycle, this is essentially each cycle, the name that it has in front of it is the higher time frame candle. So the yearly cycle would be more or less like the yearly candle that we're trying to capture, dividing it into quarters, okay? And this is viewed on the weekly time frame, and this is, divide the whole entire year, so 12 months by 4. So 3 months, 3 months, 3 months, and 3 months, okay? Quarter 1, quarter 2, quarter 3, quarter 4. So January to March, so January, February, and March are all Q1. As soon as we start April, we have April, May, June, all Q2. And then as soon as we start July, we have July, August, September, that's it, as Q3. And then as soon as we start October, we have October, November, December as Q4, okay? So currently, for a little quiz for you guys, which quarter are we trading within for the yearly cycle right now, guys? I give you 1, 2, 3. The answer is Q3, but it's soon to be Q4 because we're a couple of days away from October. As soon as October starts, the very first day, that means we are trading within Q4, which is that final quarter of the year. And think in terms of higher time frame candle. What does a higher time frame or any candle do towards the end of the candle? It creates that wick, okay, which we'll be diving into deeper very shortly. But just think, what's Q4 mainly used for? Okay, creating that wick of the higher time frame candle, right? Then we have the quarterly cycle. Now this is actually a very strange one. I wouldn't even excuse me, I wouldn't even sort of dive into it or recommend you guys to check it out. To be honest, essentially what it is the one between the yearly cycle and the monthly cycle. And what it is each yearly cycle quarter, so January all the way to March, divide that 3 months into 4. It's very tricky. It's gives you 3.25 weeks each quarter. So we'll briefly go over this one. Again, I wouldn't even recommend diving into this one. It doesn't really have too much use. But that's how you would get each quarter essentially. So January, the first 3.25 weeks of January will be quarter 1. The second will be quarter 2, so on and so forth, okay? We'll sort of go past that one though. We're not really ever going to be using that one or needing it. That one is though. Viewing the daily time frame, again, that's kind of tricky. Some people say 6 hours, some people say daily. They didn't really mention it too well, so do what you want with that one. These now are the main ones I look at, and I look at these every single day. I don't really look at these. For indices trading as well, you don't really need these. It's more for forex and other markets like that. So monthly cycle, very, very important. This is essentially, like I said, the higher time frame monthly candle viewed on the 4-hour time frame. And each week of the month, you guys know, each month is comprised of 4 weeks, okay? So the very first week of each month is Q1, quarter 1. Second week is Q2. Third week is Q3. Fourth week is Q4, okay? Again, think in terms of monthly candle. What usually happens at the start of the monthly candle, or any candle in general, we'll put in that wick. Quarter 2, quarter 3 will be the bulk of that candle body most of the time, not always. And we'll dive into that as well, knowing when it is going to be the bulk of the candle and when it isn't. And then Q4 is the wick of that candle pulling back into the range ever so slightly, okay? So, yeah, very, very important one to look at. Weekly cycle then is the weekly candle viewed on the 1-hour time frame. And again, very simple, Monday being Q1, Tuesday being Q2, Wednesday being Q3, Thursday being Q4. Excuse me, guys. Bit of a cough. So yeah, and then Friday, you're probably wondering why Friday isn't there. Obviously, there's 4 days there already, so there's 4 quarters. There can't be a 5th one, because that would be fifths, not quarters, right? So Friday actually holds its own function, and generally speaking, what that is to pull back into the weekly range or towards the true week open, which again, we will dive into later on. So yeah, with that in mind, we can still treat Friday as if it is like a regular quarter, but these are the main days that we want to be focused on, and that's why you'll sometimes find that Friday isn't actually as high probability, okay? Now we have the daily cycle. Again, super, super important. This is probably my favorite one, to be honest. And yeah, viewed on the 15-minute time frame, again, it's essentially capturing that whole entire daily candle. So if you can have an idea of what the daily candle is going to do, we can then use these quarters to really help us and find the best entries intraday. And the same goes for all the other cycles. If you've got a good idea where the weekly candle's going to go, you're then viewing for one of these quarters to manipulate opposing that. So if you're bullish on the weekly candle, you're then looking for one of these quarters to manipulate and then the following to distribute. And that's how you can really gauge price action on that deeper level. So daily cycle is the day split into 4, each quarter being 6 hours long. So Asia is that first quarter 1. So from 6 p.m. until midnight is the whole entire of Asia range. This is for indices. I know that forex opens at 5, I think it is. So you can do 5 till midnight will be Asia session. And then London opens up at midnight until 6 a.m. Again, that second 6 hours of the day. New York AM then opens up at 6 a.m. until 12 p.m. until the afternoon. And then the afternoon session, PM, opens up at 12 p.m. and then runs all the way until the day closes, which I think on indices it's around like 4:30 or something like that. But essentially from 12 till 6 p.m. is the whole entire of the PM session. So yeah, let me get rid of this taskbar. There we go. And then pull this back up. Again, I'm not really going to cut these videos, guys. It's just going to be super raw. So if you see a few things, just ignore it, okay? And yeah, so hopefully that does make sense for the daily cycle. Again, 6 hours each quarter, viewed on the 15-minute time frame, okay? So 90-minute cycles. This is now when we're going to go a little bit deeper. And my Discord is doing this. I know exactly how to fix this. And that should now be fixed. I apologize. So now the 90-minute cycle is going to go a little bit deeper. But the way that this works, guys, if you haven't already clocked on, is each cycle that is above us, you divide one of those quarters into 4 to get the cycle below. Okay, so the weekly cycle is comprised of 4 quarters, each day being 1 quarter. And the way that we get these 4 quarters of the daily cycle, the cycle below, is dividing one of these quarters into 4. Okay, so Monday Q1, if we divide that quarter into 4, we'll get, obviously, you know, a whole entire day is 24 hours. Divide that into 4, we'll get 4 6-hour sessions, which is these sessions here. 6 hours, 6 hours, 6 hours, 6 hours, okay? So we essentially do the same thing for the daily cycle down to the 90-minute cycle. So Asia is Q1 of the daily cycle, and it's 6 hours long. Divide that by 4, what do you get? You get 4 90-minute quarters, and then we can, you know, give those names as well. So the first quarter is Q1, second quarter is Q2, third quarter is Q3. Wow, this is getting tricky. Fourth quarter is Q4. That's it, okay? So Asia session, like I said, begins at 18:00, 6 p.m. and ends at midnight, okay? So divide from 6 p.m. till midnight into 4. You'll get 4 90-minute quarters. So 6 p.m. till 7:30 p.m. is Q1. 7:30 p.m. till 9 p.m. is Q2. 9 p.m. till 10:30 p.m. is Q3. 10:30 p.m. till midnight is Q4. And the same, like, all of this is fractal, right? All of this is fractal. So if we're bullish on the daily candle, we're using the daily cycle each quarter to know what the upcoming quarter is likely to do, to know when the manipulation has occurred for the day, right? So if we're bullish on the daily candle, we may expect London Q2 to trade lower, manipulate lower, right, for the daily cycle. So that then means we can utilize London's 90-minute cycle to actually potentially capture the manipulation of the day. So instead of trading that bullish daily candle higher, which I would recommend, by the way, you can get into the manipulation moves, which is opposing that daily candle. So if you think, for example, the daily candle is going to go lower into maybe a daily fair value gap first, you can still capture that move utilizing the 90-minute cycles, right? So if Asia accumulated, maybe you'd be expecting London Q2 to manipulate. So then you'd be looking at the London 90-minute cycles viewed on the 5-minute time frame for then manipulation of Q2. So manipulation higher to then manipulate lower on the bigger picture, on the bigger side of things. And then you can get into a short using the 90-minute cycle. And then, yeah, that's how you would sort of utilize that, right? Also, let me pull this up just for a slight moment, just because my webcam is blocking it. As you guys can see, those are the remaining quarters. I'm not going to read every single one of them out, but you guys know how it works now. If you want to feel free to screenshot that, you can go ahead and do so. But yeah, those are the timings. So screenshot that. There you go. Look through it. Again, while watching these bootcamp episodes, I'd really recommend to have a notepad and a pen, write down all the notes, use Notion, whatever you would like to do, because this is going to be very, very important. And you always want to look back upon your notes whenever you got any free time before you go to bed. And also feel free to watch these videos as many times as you need to understand the concepts, and don't move on to the next bootcamp episode without understanding the current one, okay? So the plan also is to upload sort of maybe 1-2, if I have time, bootcamp episodes per week. I don't want to rush every single one out every single day, 1, 2, 3, 4. I want you guys to really understand the information first before we move on to the next video, okay? And by the end of the year, if you watch all the bootcamp episodes, you'll be able to start 2026 with a fresh new set of trading skills, and you'll be ready to absolutely crush it within 2026. Can't promise that, but I can tell you guys, if you put in the work using these videos, you will definitely be at that level for sure, because I did it. I am proof of that, okay? So, excuse me. So, wow, that is a really annoying cough. So, now for the microcycle, again, it's just dividing each 90-minute cycle quarter into 4. So, you know, when I say this, I don't mean the whole Q1, Q2, Q3, Q4 into 4. No, I mean each specific quarter into 4. So, pick any 90-minute quarter. So, for example, Q1 here is 6 p.m. till 7:30 p.m. That specific time window, 6 till 7:30 p.m. is 90 minutes. Then divide that into 4. And then you'll get the microcycle quarters of the Q1 of the 90-minute cycle. Yes, I know it sounds confusing, but we will jump into the chart soon, and it will all make a lot more sense. So this one, for example, would be 6 p.m. The first quarter of the micro would start at 6 p.m. It would end at 6, like 22 or 23. This is technically supposed to be viewed on the 30-second, because you can see the half minute, but you can still get away with viewing it on the 1 minute. It really doesn't make too much difference, and it's a lot easier as well than the 30-second. It can be quite fast. So yeah, 6 till 6:23, let's say, and then from 6:23, it'll be another 22.5 minutes. So then it'll end at, I'm not very good at math, but 23, 43, then it'll be like 46, so we go to like 6:46, then that will begin, and then it'll go from 46, another 22.5 minutes, etc., etc., and the final 22.5 minute quarters will get you to 7:30, okay? Again, you don't need to be using this one. I like to use it for 1 minute entries, because I enter in the actual 1 minute or the 15-second chart, because you can then get a nanocycle, which is each microcycle quarter divided into 4, because understanding the fractability, excuse me, understanding the fractability of time, you can literally go as low as the 15-second, right? All you've got to do is know what one cycle quarter higher is gonna do. Like if I'm expecting the first 22.5 minute of the microcycle Q1 to be manipulation lower, for example, I can then utilize the one cycle lower, the nano, to look for manipulation higher on the nano, to then trade the distribution lower for this quarter here being, you know, if I'm expecting this quarter to trade lower, then I can get into that move utilizing the nanocycle. Same works here as well. Like, let's just pick a random day. Like, say we're expecting Tuesday Q2 to trade lower. We're then looking for manipulation in one of these quarters higher to then take price lower, okay? That's what we're doing. That's how you can trade the manipulation of the higher time frame manipulation leg, basically. Now, one more thing that I do want to show you guys here is a little screenshot, a little cheat sheet that I put together for you guys for quarterly theory, okay? So let me make sure you guys can see all that. There we go. It is all in frame. Perfect. Now let's understand, you know, now we've found out what the time cycles are, the quarters, the namings behind all of them, when they begin, you know, etc., etc. Now we need to understand what each quarter its function is, basically, right? So there's four, is it four? Continuation, reversal. Five different things a quarter can do, right? Number one is a quarter can either accumulate, it can manipulate, it can distribute, let me bring this forward, it can continuate, or it can begin a reversal, okay? So 5 different things. Write those down, understand those are the different phases of price. That is the only things that can happen within price. So now our job is to identify which of those things has occurred in one singular quarter, the previous quarter to anticipate what the upcoming quarter is likely to do, right? So let's just imagine this is the weekly cycle, which is viewed on the 1 hour time frame. Each of these quarters is one singular day of the weekly cycle. We know that Q1 is Monday, we know that Q2 is Tuesday, we know Q3 is Wednesday, Q4 is Thursday. So AMDX means accumulation, manipulation, distribution. X here is either a continuation or a reversal, right? Now put brackets between, beside each of these ones here. The manipulation can be tradable. Like I mentioned earlier, we can utilize the lower time frame cycles to actually trade the higher time frame manipulation. So that's why that one is tradable. Distribution goes without saying. Obviously, we want to be trading distribution, right? Oops, almost knocked over my drink. And then X, continuation, reversal, is kind of like, can be a little bit 50-50. Like if you know exactly with high confidence what it's likely to do, then you can trade it, okay? And I'll be telling you guys how to anticipate either of those as well very shortly. So back to what I was saying. Let's go over the first sort of example that can occur within price. By the way, price isn't just tied to these two only, but these are the main signatures that will occur within price over and over and over. So Q1 accumulated, okay, very tight range. It didn't really break out of anything. Q2 then manipulated. You can trade this higher. If you're bearish on the weekly candle, you can trade the manipulation higher initially, the open high of the weekly candle. Okay, so you can trade this, and then you want to wait for a signature in price to show you that manipulation is over, which we will get into later within the bootcamp as well, how to confirm manipulation and how to trade it. And then once manipulation has taken place, the following day or the following quarter, remember this is fractal, this could be the London session and you might be trading the distribution of the AM session. This could be Tuesday and then you could be trading distribution on Wednesday, right? It's all fractal. This could be a 90-minute quarter, Q2 manipulating, Q3 distributing. In this example, let's just say this is Wednesday distributing lower. Q4 is then either a reversal or a continuation, right? And I did say I'll tell you guys when to know which of those to expect, okay? So here's a little tip. If Q3 or the start of Q4 hits a higher time frame key level, so what do I mean by this? A higher time frame gap, higher time frame liquidity, then we can expect Q4 to be the reversal, right? However, if Q3 or Q4 doesn't hit a higher time frame key level, expect it to be a continuation towards that key level, right? Understand that? Write that down, take note of that, okay? In this case, you can see it took sell side liquidity, and let's just imagine there's like a huge gap here that we traded into as well. That's why we offered a reversal. Also, do keep in mind, sometimes if the key level has been hit, instead of getting a nice reversal within Q4, you may also get a accumulation phase. So do keep that in mind as well. Not always the best to be trading Q4 unless it's super, super clean and obvious. Now let's jump into the second example, which is XAMD. So instead of Q1 being accumulation, because it won't always be, sometimes what you'll find is Q1 will continue from what the Q4 of the previous cycle, okay? So obviously we've got Q1, Q2, Q3, Q4. Once Q4 is over, that specific cycle has finished and then a new one begins. So then we begin Q1, Q2, Q3, Q4, okay? But let's imagine this cycle here, Q4 offered a reversal. Now imagine we're entering the new cycle. So let's say this is the daily cycle. This is one whole entire day. This is the PM session. Boom, price coming to a close for the day. Now we start the new cycle. So the new following day, and we're going to be trading the daily cycle, for example. Now Q1 Asia may continue. If it lets me draw, that'd be great. There we go. So now Asia may continue higher for Q1 of the following, new daily cycle. Q1 goes higher, which is the X, continuation or reversal, continues higher, so continues the reversal back higher. Then Q2, we can expect accumulation. So if we don't see accumulation during Q1, expect Q2 to accumulate, because Q1 formed a larger range, it expanded higher, continued higher, so then Q2 likely chops up, right? So this is Q2 chopping up. Then we need to still see some form of manipulation for this cycle. So then let's say Q3 manipulates below Q2 lows, right there, and then we can expect Q4 to be the distribution back higher. Okay, so hopefully that does make sense, guys. And yeah, like I said, we're going to be jumping into some chart examples very, very shortly. But for now, I do really hope that all of that information has sunk in for you guys. Again, make sure to just go back and watch the video again right now if you don't understand this initial information. Excuse me. Because what we're going to do now is jump into some chart examples and show you guys this happening, not in real time, but backtesting basically, right? So yeah, let's jump into the charts. Alrighty, so we're on the charts now. I'm going to be showing you guys 4 different examples. One on the monthly cycle, one on the weekly cycle, one on the daily cycle, and one on the 90-minute cycle, okay? And also, you're probably wondering, how can I view all of these quarters? Is there any indicators to use? The answer to that is yes. The free one, the one that most people use, the one that I used when I first started, is the one here by 2 degrees. So if you search quarterly theory, it's that one there, day quarterly theory by 2 degrees. Go ahead, select that, add that to your chart, and then you can customize which cycles you want it to show and all that type of stuff, okay? And you can see it'll show the sort of rectangular box at the bottom. The grey one represents Q1, the red one represents Q2, green is Q3, blue is Q4. You can also change the colors, whatever you would like to do. Turn on historical cycles to see previous quarters show up in the past for backtesting and stuff like that. However, if you guys would like to take it one step further, myself, I have my own private quarterly theory indicator. As you can see, the Oracle Insights QT Toolkit. That will be linked below in the description. You can grab a 3-day free trial. After that, it's a small monthly subscription fee. But if you want to take it to that next level, if you want to, have easier backtesting sessions and be able to see everything a lot easier, then this would be a lot more, I would prefer this one a lot more. So if I remove the quarters, you can see here it shows like the quarters individually with the dividers, and there's so much more, the quarterly theory stuff inside of it. So if you would like to try that, check that out in the description. But if not, we can still stick to the free one. That is completely okay. So yeah, let's go ahead, and for the example of this video, we'll just use the free one because that's what most people are probably going to be using, okay? So here we are on the 4-hour time frame. This doesn't matter what asset we're looking at because remember, this works across all markets. It doesn't matter. In this case, though, it is ES. So yeah, we're on the 4-hour. Which cycle is that viewed for, guys? Monthly cycle, that is correct. So we are on the monthly cycle right now on the 4-hour time frame. So each of these boxes represent 1 week of the month. The first week, second week, third week, and the final week of the month, right? So in this case, what do we have going on here? What has Q1 done, right? The way that I like to define a continuation is if it breaks out of the previous cycle quarter's range. So what do I mean by this? The previous quarter from Q1 is Q4 of the previous cycle. Did we break out above it or break out down below it? If the answer is yes, I like to class this as a continuation quarter personally. If we fail to break the high and the low, I like to class it as an accumulation quarter. There are ways to actually know as well, which we'll dive into deeper within the later bootcamp videos. But for now, just use this sort of explanation here, right? So Q1 was a continuation, so X. So then what do we expect Q2 to be? Accumulation, so large range followed by a smaller, tighter range, accumulating price, building up buy side and sell side liquidity. Then Q3, coming into Q3, we can be looking for the high to get taken, for that manipulation to take place if we're bearish, or the lows to be taken for bullish manipulation if we're bullish, okay? And remember, this is the monthly cycle, so the monthly candle. So find that bias. If you're bearish, look for Q3 to manipulate the highs, then trade lower. So Q3 manipulates Q2 highs. So this is then classed as manipulation quarter. So you can trade, the longs up to the high, and you can also get into a short after the manipulation has taken place. And I'll be teaching you guys as well also how to confirm manipulation has already taken place, so that way you can actually trade during the manipulation quarter, the move lower. But for now, we just need to understand how to actually identify the quarters for what they are used for. So manipulation here, if you didn't grab an entry there, that's fine. Remember, because we have the distribution quarter coming up shortly. Q4 in this case is D because this was M, so manipulation followed by distribution. And as you can see, that final week of the month did offer a nice open high, low close for that bearish week, okay? So very, very simple, very simple. Okay, so that's why it's very simple and straightforward. That's what I meant to say. And yeah, there's a great example right there. This is one whole entire monthly candle divided into quarters to best view price action. And this kind of little thing that I've got here isn't completely accurate. I think that's a little bit better. I just wanted to sort of show you guys it easier basically, but remove that each quarter, 1 week of the month. Right, now we have a weekly cycle example. So this is on the hourly time frame. And yeah, this is one whole entire week divided into 4. The blank quarter that you can see is for Friday. We can still treat it as if it is a quarter, but it is slightly different. And I think I'll do a whole entire bootcamp episode just for that. But yeah, as you can see, Q1, Monday, Q2, Tuesday, Q3, Wednesday, Q4, Thursday. In this example, we have a XAMD sort of model going on here. So Friday, as you can see, we ran out Friday's high right there on Monday. So I'd class this as sort of like a continuation. We didn't really as if like break out the range as such, but again, like I said, there is something deeper that can kind of confirm this. But in this example, we took out the high. So yeah, we can class it as a continuation because it didn't stay inside of Friday's range. So then as you can see, Tuesday did then accumulate. It took out Monday's low and high. Again, I like to class that as accumulation because it didn't break out of one side of the range specifically. It took out the high and the low, so it's still not getting anywhere. It's still inside of a range. So then we'd be expecting Wednesday, Q3, to put in that manipulation. And then we'd be expecting Q4 to give us that distribution, which you can see here. For the most part, it did. And then we got a small reversal back up into the range because we had taken out a specific low, which is the whole entire low that we put in for the week. So between every single day of the week, we took out that specific low, hence why we did pull back slightly after. However, we did still get, for the most part, distribution, right? And then again, it followed as well. You can see the following quarter gave that continuation lower. So this was Friday, sorry, give the continuation lower. So like I said, we can still use Friday like a quarter. So if we got distribution within Thursday, we could then be looking for that continuation within Friday, which is what happened. So yeah, with that being said, X continuation, Q2 accumulation, Q3 manipulation, Q4 distribution. And most of the time, whenever you get an XAMD model, is usually when you'll see like sort of the middle of the candle putting in the high or low of the cycle, pretty much, right? So the high of the week in this case was Wednesday. This is when you get like that midweek reversal, basically. So the midweek, ICT reversal weekly profile is when this will usually happen if Q1 expands higher for that continuation and Q2 chops up. Then you see Wednesday higher low of the week. However, whenever we get sort of like a accumulation on Monday and during Q1 and then manipulation during Q2 is when you get that classic buy or sell candle essentially, right? Because the manipulation is occurring pretty early on within the candle, that wick's being put in, and then Q3 is that bulk of the candle and potentially Q4 as well. But in this case, we sort of open up high, we put in a wick, then we accumulate, then we run the wick again to put an actual high of the week with clear manipulation during one of the quarters, and then you'll get that reversal. So these type of candles here typically will have like the larger wicks either side and the smaller bodies, and then the buy, the typical buy or sell candles is when the manipulation occurs earlier on, and then you get a big, more bulkier candle body essentially. So yeah, with that being said, now let's jump into the next example, the daily cycle. Okay, now let's jump into the daily cycle example, which is the 15-minute time frame, and this is capturing a whole entire daily candle divided into 4, 6 hours each session. So as you can see here, Q1, this to me I would class as accumulation because it didn't take out Q4's low or take out Q4's high. So you can see it traded within inside of the range, and it is clearly just a very tight range accumulation sort of quarter as well anyway, right? So with that in mind, we're then coming into Q2 expecting manipulation to take place. If we're bullish on the day, we want to see it on the lows. So you can see here, Q2 does indeed manipulate below Q1's lows before then after then Q3 offering that distribution towards the upside. So Q2 manipulated, Q1 accumulated, Q3 is now distributing price higher. And then as you can see, Q4 is then sort of a continuation / reversal, which can sometimes happen as well. The time that you'd expect this to happen is, remember what I mentioned earlier, if the higher time frame objective key level has been hit, then for the first half of the quarter you may get the continuation, and then if it gets hit, then you may see a reversal take place in price. And remember, we can divide each of these quarters again into 4 for the 90-minute cycle, so that's how you can actually capture this move here as well, based upon the 90-minute cycle. So yeah, that is another sort of cycle shown right there. This would be the AMDX cycle: accumulation, manipulation, distribution, and a continuation / reversal. Now for the final example, let's jump into a 5-minute chart, and let me delete this background because that kind of blends in. And the one that we're specifically looking at here is also the tool that I'm using is this one. It's called Fib Time Zone tool, I think it is. Those are my settings. I don't use this at all. I'd prefer to use this indicator or my indicator. I'm just doing this so you guys can clearly see the quarters defined pretty much, right? So, you know, we can do it this way as well. It doesn't really matter. Q1's range right there. You know, we can do this one as a grey box. Not that grey. We need to actually be able to see it. There we go. So, as you can see, another AMDX because we didn't take Q4 as low or high. So Q1 is classed as accumulation right there. We can clearly see that within price as well. Q2 then manipulates below Q1's lows. And then Q3 offers the distribution. And Q4 is that continuation higher towards the higher time frame liquidity, the key level in this case. So yeah, with that being said, that is pretty much 4 clear-cut examples on the charts. Now it's your time to put in the work. Make sure you've taken notes of the video. Go back and watch it all again if you have to. Then, just because you've learned the information, now go apply it to the charts. Go back test this information that I've told you guys. There is a lot more to it. It goes a lot more deeper, but this is the basics. So you need to get these down before we can move forward, right? Yo, what's good, guys? Welcome back to the second episode. I'm back to the second episode of the Quarterly Theory Bootcamp. I do first of all want to say thank you guys so much for the support on the first episode. I'm glad that you guys did enjoy it. The feedback was very positive. So yeah, now I'm really looking forward to continuing the series and just banging out episode after episode after episode, once or twice per week. So yeah, with that being said, buckle up, guys. Go grab something to eat. Make sure you've got pen and paper nearby. Make sure you're taking notes. And let's go ahead and jump straight into it. So second episode of the bootcamp, I want to do everything in chronological order. I want you guys to know each concept one by one, and then we'll tie it all together towards the end. So we learned about the, not the true opens, we're going to be doing that today. We learned about the time cycles and the quarters. So you guys now know when they are, what to look for in each quarter. And now today's episode is going to be about true opens, which essentially ties the quarters and the cycles all together as one. Basically, it filters out the low probability manipulation, the fake reversals, fake retracements, everything that you guys know a quarter can do. The true opens can filter that out. Okay, so first of all, as you guys can see, we've got a little spreadsheet here on the chart telling you guys the timings and the names of each of the true opens. So as always, start with the quadrennial cycle, the 4-year cycle. It's lasting 4 years long. Each quarter is 1 year long. And also essentially the true open is always for every single cycle, the Q2 open. So we have Q1, Q2, Q3, Q4. Ignore Q1, well, don't ignore it, but the true open isn't in Q1. Wait for Q2 to open, and that very first candle of Q2 that prints, once that candle has closed, or even when it opens, sorry, you can just go ahead and mark out the open. So it's the open price of that first candle of Q2. Mark it out, draw out a line on your chart, or you can use one of my indicators to do that for you. And that is a true open, okay? So all these examples that we're going to go through here, every single one of them is just Q2's open, essentially. So quadrennial, as you guys know, comprised of 4 years. First year is Q1, second year is Q2. That second year that comes along, mark out the very first candle of Q2. Mark out that open, boom, that is your quadrennial open, so the true quadrennial open. And that will be the first month of each election year, because remember, like I said in the previous video, each election year is Q2 of the quadrennial cycle, and we view it on the monthly time frame. So that first monthly candle that prints of the election year, mark out the open, and that is your true quadrennial open. Now for the yearly cycle, viewed on the 1 week time frame, and this is what's known as the true year open, or the TYO. And this is the first week of April, because as you guys know, January, February, March, that is Q1. April, May, June is Q2. So the first week of April marks out Q2, the Q2 of that yearly cycle. So mark out that weekly candle open. That is your true year open. Quarterly cycle, again, there's no specific date or time for this because there's many quarterly cycles within each year, but essentially it is the second quarter of the cycle. That's the only way that I can tell you guys it, because there's not a set day that the true quarterly open is every single time. So yeah, just mark out the quarters, wait for Q2, mark out the open of Q2. Monthly cycle, however, is more mechanical. The true month open viewed on the 4-hour time frame, the TMO. This is the second full week of the month, Sunday 1800. So what do I mean by second full week? So we have these things within quarterly theory known as distortion weeks, which is what we actually just had this week. And what it is the week will start within 1 month and then end within the following months, right? So this week that we just had started in September, I think it was like the 29th, and it's ending, or it has ended, within October, right? So that's what's known as a distortion week. So we ignore that week, that's like Q0, just a blank week essentially. And then the following week is our Q1, the week after is Q2. So this is why it has to be the second full week of the month, which there isn't many distortion weeks. I think there's one like every 13 weeks or so. So essentially, come into the month, wait for the first week to pass by. Once that second week opens up, it's the Sunday 1800 candle. So the very first 4-hour candle of that week, okay? Now the weekly cycle viewed on the 1-hour time frame is known as the true week open, the TWO, and this is at Monday 1800. But don't get confused. This isn't Monday's open, this is Tuesday's open. A lot of people get that confused because they see the Monday. Remember, every single daily candle opens up technically within the previous day, because that's when the Asia session is, right? So Monday's candle opens up at Sunday 1800, as you can see here for the true month open. But for our weekly cycle, is Q1 is Monday, Q2 is Tuesday. So the Tuesday open, which is essentially Monday 1800, the Asia session of Tuesday, mark out the open of that on the hourly. So that 1800 candle, Tuesday's open, mark out the open, and that is your true week open. Now for the daily cycle, viewed on the 15-minute time frame, is known as the true day open, or the TDO, sorry, not TDO. And this is just your classic midnight open, the 12 a.m. Candle on the 15-minute time frame, mark out that open. That is your true day open. Midnight open, that's what ICT teaches as well. However, he doesn't really teach any of the other ones, basically. This is why they come from quarterly theory. But that one is obviously from ICT himself. And then we go a little bit deeper here on the lower time frames, so the 5-minute time frame for the 90-minute cycle. These are what's known as the true session opens. And as you guys know, we have 4 sessions within a day. Asia session, London, New York AM, New York PM. So we've got 4 different true session opens for the day. So Asia one this is for the 90-minute cycle. So we know that Asia opens up at 6 p.m. So from 6 p.m. till 7:30 p.m. is Q1. And then 7:30 p.m. till 9 p.m. is Q2. So 7:30, the very first candle, that very first 5-minute candle of Q2, which begins at 7:30. That is our Q2 open. So that's what's known as the Asia True Session Open. Same with London. The Q2 open is at 1:30 a.m. Mark out that 5-minute 1:30 a.m. candle from the open of the body, not the close, not the wick, the open. Mark that out, draw out line, mark that out, draw out line. That's your true session open for London. New York AM is 7:30 a.m. New York PM is 1:30 p.m. And yeah, so then finally for the microcycle, we can't obviously say a specific time, or we'd have a massive list of every single true micro session open, which is viewed on the 1-minute time frame. True micro session open, like I just said, the TMSO. And again, the way I've just put this is second quarter of the cycle, because like I said, if I was to list every single true micro session open in a day, there'll be loads. There's like 30, 40 true micro session opens within a day. But yeah, I'm sure you guys can work that out. Like I said, make sure to apply one of the indicators to your chart. And then once you've got the indicator on your chart, it's very simple. If you're using the free one with the red box, just very first candle on the line of that red box, mark out the open. That's the true open for that cycle that you're viewing on the specific time frame. And then yeah, very simple. So now you guys know the namings and the timings of each of the true opens. And like, as long as you've got an indicator on your chart that shows you the quarters, you don't even need to like know the specific times or days of every one. Essentially all you do is just, like I said, Q2, very first candle, mark out the open. Boom, that's your true open for that cycle. So now let's go ahead and jump into a few more examples here of when and how to actually use the true opens So here we go. We have an example right here, right? As you guys can see, this may seem pretty familiar. Accumulation, manipulation, distribution, right? So now let's imagine this price here. Each of these sort of phases of price, let's imagine this is 1 quarter right here, right? So let's imagine this is Q1, okay? Accumulation within Q1. Then we have manipulation here occurring within Q2, right? Like normal, like this is what we'd expect within a cycle, right? You know, some form of accumulation, then followed that by manipulation, and I've done that wrong. That's not the text. So yeah, that followed by then manipulation, and then we'd expect some form of distribution after, right? And ignore the drawings. I am not by any means a good drawer, or trading view drawer, I guess you could say. But yeah, I just kind of want to make this as simple as possible for you guys. Again, these are all messy. This is not obviously correct, but I just want to I want to see you guys picture this basically, right, within quarters as well. We are going to jump into some chart examples after this, of course, but this specific example. So accumulation, manipulation, and then distribution, right? This is what we expect normally, but when we bring the true opens into the equation, as you guys know, the true open is that very first candle of Q1. So it would be there essentially. So if we move this one up a little bit, as you can see, that line there, that very first candle that is on the line of Q2, mark out the open of that. Then when we're looking for our manipulation, we want to see price dropping below the true open if we are bullish, and pushing above the true open if we are bearish, right? That is the fundamental of a true open. Time-based premium and discount below the true open, longs above the true open, shorts, right? Obviously, we don't just immediately short when we're above it or immediately long when we're below it, but we can use the true opens to gauge when and why we should be taking a long or a short. So with the combination of the quarters, with the accumulation, expected manipulation after, we then form our true open for whatever cycle this is, daily cycle, whatever, it doesn't matter, it's all fractal. Once that true open's there, if we're bullish, we then want to see manipulation below the true open, so price dips below the true open, takes out the previous quarter low, which it doesn't have to for manipulation, but for the most part, it usually will, and we'll dive into that within a future bootcamp episode to know when and why it shouldn't. So it dips below the true open, ideally takes some form of liquidity, so in this case the previous quarter's low, some sell side liquidity, then we'd expect price to begin pushing back towards the true open, break above it to show that price is manipulated below it, and now it's actually managing to get back above it with that closure, solid closure above, as you can see right here. Then you'd expect price to begin that distribution phase and draw towards your higher time frame draw liquidity essentially. So yeah, hopefully that does make sense. So wait for the true open to be established, wait for manipulation to occur above or below, and then you can trade after that the distribution. And yeah, and also if we have a reversal after this distribution quarter, remember we're above the true open. So if we form a reversal above the true open, remember we want to be shorting above it ideally, then that is indeed valid as well. Another thing to note as well is as long as the manipulation has already occurred below or above the true open, like it should do, bullish one below, that doesn't then mean that you can't buy above the true open. It just means that you must at least see manipulation occur below the true open first, then you can look to buy above the true open after that, right? So you don't always need to be below. So if you miss this entry, it's not the end of the world. This is good. At least you've seen the manipulation below it, and then you can still look for longs above here. You know, here maybe if you retest the true open, here, all the way towards the drawn liquidity. Okay. So that's again something that a lot of people misunderstand. They think that you have to buy below the true open if you're bullish. You just have to see manipulation below it. It won't always happen, but if it doesn't happen, then you know that you're pretty much dealing with quite low probable conditions, essentially. So yeah, hopefully that does make sense, guys. Now what I'm going to introduce to you guys as well is another quality theory concept, but it's still on the same topic of true opens, and this is stacked true opens, right? And here's a little diagram here. Essentially what this is we have the current true open of the cycle that we're viewing. So imagine here, Q2, Q3, price action, right? Imagine this being the microcycle, so the 1 minute time frame. Everything's normal, Q2, Q3, Q2, the beginning of Q2, that very first candle, remember, mark out the open. that is our true open for this specific cycle. In this case, the true micro session open, right? Draw that out. Then, let's say we're bullish, we then want to see one cycle above the cycle that we're viewing. So the micro cycle we're viewing here, would then go one above, which is the true, no, it would be the true session open, but it'd be the 90-minute cycle. So microcycle, one above is the 90-minute cycle, which is known as the true session open for the 90-minute cycle. Then what you want to go ahead and do is mark out the true session open for the 90-minute cycle. And if you see the cycle that you was viewing, so in this case, the true micro session open, true open being below the 90-minute one, or one above, whatever time frame you're viewing, like this, in this specific order as well, by the way. So the one you're viewing and then one cycle higher must be above it. This is what's known as bullish stacked opens. And once price dips below both of the stacked opens, so below the 90-minute cycle and below the true micro session open one, then you'll find a very high probable setup, very high probability for a reversal to take place, okay? And then if we're looking for a bearish stacked open setup, it would be something like this. So let me draw an example. So we've got one true open there. Oops, if it lets me draw. And then we got another true open here, right? So now flip this around essentially. So the low time frame one must be above and the one cycle must be below. So imagine this is our true micro session open right there. We'd then go one cycle above and mark out that true open, so the true session open. And if we're bearish, we want to see the lower time frame one, the cycle that we're viewing essentially, be above the one cycle above, okay? And then you'd want to see something like this. Price come above, something like that, and then boom, okay? So you want to see that manipulation, as always, take place above the current true open that you're viewing if you're bearish. But then we're incorporating one cycle above true open for the stacked true opens, okay? And once we have stacked opens, we can then begin hunting for a very high probable reversal setup from there, okay? So yeah, again, also, utilizing the quarters, what they should be doing: accumulation, manipulation, distribution, continuation, reversal, but just incorporating the true opens in play and making sure that we see price run above it, manipulate above it if we're bearish, or manipulate below it if we are bullish. Another thing to note as well is we don't need stacked opens like at all, but if they're there, then it makes it a lot higher probability. But you shouldn't rule out your setup just because it's not stacked opens, unless that is your model, of course. But if there is stacked opens, it will be much higher probability, okay? But the main thing is that you want to see is it manipulates above or below the current cycle's true open that you are viewing. So yeah, hopefully you guys found this little part here useful. Now, as always, let's go ahead and jump into a few chart examples of stacked opens and also just utilizing the true opens as they should be used. So I'll see you guys on the charts. All right, guys, so we are now in the charts for a few examples. As you can see, in this case, we are looking at ES. We're on the 1 hour time frame, which is viewed for which cycle? The weekly cycle is the correct answer. So yeah, as you can see, each of these quarters that are being marked out is from my own indicator, Oracle Insights QT Toolkit, link below in the description. As you can see, it is also marking out my true opens automatically for me. So this is what I was saying earlier. As you can see, as long as you've got an indicator that plots out the quarters, you can see Q2. This very first candle that is on the line of Q2 is where you mark your true open. So genuinely, literally just mark out the open of that candle, draw it out, use an indicator to mark it out for you. It doesn't really matter. And then remember, we're looking for price to drop below the true open if we're looking for bullish manipulation, and then trade above it, whip above it for that bearish manipulation to then drop lower. So in this case of the weekly chart, as you can see, we have a continuation of Q1. So you can see price trades outside of Q4's range, or in this case, Friday's range of the previous cycle. So last week's weekly cycle. So giving us that continuation for Monday, we then get accumulation. And as you can see, the true open is established and price is chopping up around it, right? So it's not, it's wicking below it, it's wicking back above it. It's not clearly breaking above it just yet. So then after we can see that Q2 was that accumulation day, we'd then be coming into the following day looking for that manipulation, right? So Q2 doesn't really form any manipulation of significance. It kind of chops up. and also Q1 kind of expanded to the upside. So coming into Wednesday, looking for that manipulation. If we're bullish on the week, remember the weekly cycle is tied to the weekly candle. So establish your weekly bias, then look for bullish weekly cycle manipulation in line with that below the true week open. So in this case, as you can see, price manipulates below Q2's low, Tuesday's low. So Wednesday manipulation, Q3 manipulation below the true week open. And then to confirm that, you can see price aggressively expands away, displaces away from that manipulation, strongly closing back above the true week open. Okay, so then of course after this, coming into Q4 Thursday, looking for that distribution, and now Friday, either looking for a continuation or a reversal, as we are just at all-time highs. Price is broken above the previous day high, as you can see right there. So we are in for that continuation day on today, this Friday. So yeah, here's a great example of how you would utilize the true opens for the weekly cycle, and this is obviously fractal, so the same concept applies to every single cycle. Basically just adds that extra layer of confirmation. It is essentially just time-based premium discount. Okay, so let's say, for example, let's remove the indicator and say, for example, the true week open was here, right? Let's say the true week open was here. Price didn't manipulate below the true week open in this case. So then we wouldn't really count that as valid, quote unquote, manipulation, right? We usually always want to see the manipulation either above the true open if bearish, or below it if bullish. And it usually will always happen. The only times that you won't really see price trade below or above the true opens for that manipulation is during super expansive candles. So if you're, for example, on the weekly candle, experiencing a super bullish candle, price just opens up, just rips higher basically, you know, true week opens there, doesn't do anything, true week opens there, doesn't do anything, it doesn't drop below it, it just rips higher, higher, higher. So that's the only time when you can sort of expect price not to drop below that true open, but in most cases it will indeed drop below it. I mean, even what we can do here is on the indicator that we've got is we can turn off the delete previous true opens, and we can even go back and just check out, you know, price is super reactive from the true opens. There are very specific points in price that price responds to, reacts from, and then drops lower. Because thinking about it logically, how a candle opens, right? You know, the first sort of period of that candle opening is more or less that accumulation. And then the second, second quarter of that candle is when you're looking for that manipulation. So that's why the true opens are where they are, instead of just being the candle open. Because the candle open doesn't really just open and just instantly manipulate. It'll usually take a little bit of time. So that's sort of like the concept behind the true opens of it being Q2, right? I mean, as you can see, last week's example, true week open established on Tuesday, price trades above it, manipulates above it. This was actually an SMT as well. You can't see on this chart here specifically because this was the one that created the failure swing. So manipulation above that true week open, followed by an aggressive displacement below it, confirming the manipulation is in for that weekly candle. And then that was followed by distribution and a continuation lower. Again, the week before, continuation, accumulation here in Q2, manipulation here during Q3, price trades below that true week open, aggressively breaks above it, and even retest it as well. So it is a very reactive level. So once price is already manipulated, you can still look for longs when price bounces back down below and retest it again right there, as you can see. And yeah, just super, super clear, man, like super clean. And that's just the past 3 weeks. That's not cherry picking examples. It literally is always there. True open, drop below, push higher. True open, in this case, so this is more of like a true open and then just expanding away from it aggressively, right? So not as good of an example there. But again here, true open on Q2, drops below in Q2, aggressively closes above, pushes higher, even retest it because we already had the manipulation occur over here. And then price can still retest it, retrace, bounce off it, and then boom, back higher again. So super, super clean. Let me go ahead and show you guys one more example as well. This is on the 90-minute cycle, and this is literally from today. So Friday's price action, 3rd of October. New York AM session, right? 90-minute cycle of the New York AM session. What do we do? What is the New York AM session likely to do? Well, what did London do? Okay, cool. Now I know what AM is going to do, right? So then we utilized in the 90-minute cycle of the AM session and the true opens, the true session open of the AM, to look for that bullish manipulation below it, get into that move, and then trade it higher, right? In this case as well, this is a good example of stacked opens, which can be shown again on my indicator, link below in the description. True day we have the true session below the true day open. So this is the specific order we need to see them for the bullish scenario of bullish stacked opens. So the lower time frame one below the higher time frame one. So then, you know, what did Q1 do? Continuation or reversal, whatever you would like to call that, below Q4's lows. It broke out below it. So therefore, Q2, the following quarter, offered that tighter range, that accumulation phase. So then what we'll be expecting Q3 to do, drop below Q2's lows. As you can see, it does right here, manipulates below the lows, below those stacked opens. So we can be very, very confident a reversal is likely to occur. And then you can see price aggressively breaks above both true opens, not just one, both. And then from there, it kind of just leaves. It just pushes higher and higher and higher and higher. Q3 manipulation. And as you can see, Q3 manipulated and also gave a move higher, which is something that we will be diving into within a further bootcamp episode. But one thing to note is look how quickly the manipulation takes place within this quarter. That's why it has enough time to actually begin the real move, that distribution higher. And then Q4 can, you know, either be a distribution or a potential retracement as well. So yeah, with that being said, that is two very clear-cut examples of how you will be utilizing the true opens. Hopefully you guys did find this bootcamp episode useful. They are very, very powerful. Price can bounce away from them. It can manipulate below them, manipulate above them. It can filter out fake manipulation if there's not a true open. And we, for example, form what you may think is bearish manipulation, but we haven't actually traded above the true open for that specific cycle. That can be viewed as fake manipulation and actually be building up, generating liquidity on the highs to eventually actually manipulate above the true open, take out those built up highs before giving that move lower. So yeah, hopefully you guys did find this episode useful. Yo, what's going on, guys? Hope that you're all doing well. Welcome back to episode 3 of the Quarterly Theory Bootcamp. This episode right here could arguably be the most important video you've ever seen in your life. And this concept, this one singular concept, can single-handedly change your whole entire life. And I'm not even saying that. This concept is what turned me from unprofitable to profitable. So this is definitely going to be a very, very important episode. So make sure to buckle up and get ready for this video. Basically, the topic of the video is going to be SMT, and more specifically, sequential SMT, which is SSMT, and that is one of the most important quarterly theory concepts there is out there, okay? So without wasting any more time, let's just go ahead and jump straight into it. We're showing you loads of examples on the charts and also giving you guys a full breakdown of how the concept works right here, right now, okay? So firstly, to understand sequential SMT, you must have a basic understanding of SMT, right? And SMT, all it is, first of all, you must be looking at closely correlated assets, right? So what is a closely correlated asset? So for example, we have these things called triads, and it's like the 3 most closely correlated assets within that market group, basically, right? So for indices, you guys know what indices is. We've got NQ, ES, and YM. What we're going to be doing is comparing all 3 of those assets together. So if you can, pull up each chart from each of those assets, and then we're looking for a divergence to form between those specific assets, right? Now, what is a divergence? So a divergence, basically, within price is when we have one asset, let's say for NQ over here, you can see it trades higher, right? But before this move higher, it actually fails to take this specific low here. And then what we're doing when we see that happen is we're looking at the other closely correlated assets. So ES here, for example, and before this move higher, you can see it actually takes out that specific low right there, right? And for this to be valid, it must be the same specific low. So within NQ, you can, mark out your lows, mark out your highs. And if it fails to take out that specific high or low formed at the specific time. So let's say this is 7 a.m. low, right? This is the hourly time frame. This is yesterday's 7 a.m. low right there, right? And then we're looking at ES, mark out that same specific 7 a.m. low from yesterday. And you can see the ES actually runs below it. So it creates a lower low, whereas NQ fails to run below that same specific low and creates a higher low. So one asset's creating a higher low, one asset's creating a lower low. That is then our SMT divergence within price. More markets that you can view it on, I'll show you very shortly. But for example, the forex triad consists of Euro USD, GBP USD, and then DXY. And you can look for the same specific thing within that triad as well. One thing to note though, within the forex triad, obviously DXY moves opposite to Euro and GU. So he's still looking for the same thing. But this, for example, on DXY would be, DXY is low, and then you'd mark out that same specific high on Euro or GU, for example, because DXY inversely correlated, like negatively correlated, okay? But yeah, the same specific concept applies for every single market that you're looking at. As long as you're looking at those closely correlated assets, mark out those obvious highs and lows on each of the assets and look for the SMT divergence to form between those assets, right? And basically what the SMT divergence signals is it's pretty much gonna always be there before pretty much every single market move, almost guaranteed before every single like major reversal. But I'm talking like even small retracements, you know, small reversals that last a few hours or so. There's usually always going to be some sort of SMT divergence there. And what it does is shows strength and weakness within that specific market, right? So if we have ES taking out a low and NQ failing to take out the same specific low, obviously we know that these closely correlated assets should be moving in sync 24/7. So whenever one creates that divergence, that shows strength within this specific market and indicates a potential move higher, right? And then once that SMT divergence takes place, then you're anticipating the move higher, then you're looking for your specific entry model, which within later bootcamp episodes, I'll give you guys my exact entry model that I take right after this, right? So that is essentially SMT divergence explained. I will show you guys an example on the chart later on during the video as well. But now let's jump into what sequential SMT actually is, right? So firstly, before I show you any sort of example of how it should look on the charts or how it should look in general, let's just go over this table here like we always do for every single video, because when looking for sequential SMT, there are very specific timeframes that you must be viewing in order to look for that sequential SMT, okay? And I broke it down into simple form for you guys. Well, firstly, let's start here, right? So this little table at the bottom that we've got, these are the main triads that you want to be looking at for trading, right? So we've got the forex triad. You know, I'm not going to read every single asset out, but you guys can see it. Indices triad, commodities. For commodities, you can also change out copper for platinum and just see whichever works best for you. Oil triad, crypto, and interest rates. And there's many, many more. I'm sure there's a website that you can search up that gives you a list of all the, you know, closely correlated assets, and then you can literally create your own triads with those assets basically. But I wouldn't go more than sort of 3 assets. You could even scale this down to just looking at 2 assets, like for example only NQ and ES, but it's completely up to you. You know, you may miss a few moves if you don't use YM, and if you are using more assets, then you could maybe get a lot of false signals, right? Because there's a lot of SMTs that form. Your job is just to filter out the low probability ones, which is what we're going to be going over here as well. Yeah, what else was I going to say as well? No, I can't remember. So anyway, let's go ahead and jump into this table now, okay? So specific timeframes that we must be viewing to quadrennial cycle. The timeframes here are all the same timeframes that you've already been taught within the cycle and the quarter video. So just stick with those, okay? So quadrennial, 1 month time frame, yearly cycle, 1 week time frame, quarterly cycle, daily time frame, monthly cycle, 4 hour, weekly, 1 hour, daily, 15, 90-minute, 5, micro, 1 minute, okay? Essentially, what a sequential SMT is the SMT example that I just showed you guys. It's SMT between 2 consecutive quarters, okay? So you guys know we have the cycle, which consists of 4 quarters. So within each cycle, we can look for up to 4 sequential SMTs, which by the way, you don't want to see that, but we can, because we can have one between Q1 and Q2, Q2 and Q3, Q3 and Q4. Is that 4 sequential SMTs? I'm not sure. But what you can also do is when a new cycle starts is you can use the previous cycle, so the Q4 of the previous cycle and Q1 of the new cycle, right? So let's say, for example, you know, we look at the daily cycle, Q4 is PM session. Then once that new day opens up, we have the new daily cycle to Q1, Q2, Q3, Q4. Q1 will be Asia. You can look for SMT between the PM of the previous day and Asia of the, you know, the new upcoming daily cycle day that we're inside of, okay? So that is it in short form. SMT divergence between 2 consecutive quarters. Drill that into your head as well. It has to be consecutive, so it can't be Q1 to Q3. It must be in a row. So Q1, Q2, Q2, Q3, Q3, Q4, Q4 and Q1, and then, you know, it goes back to Q1, Q2 again, okay? And also, don't forget to filter in the true opens. So remember, like what I taught you guys in the previous video, manipulation must occur above and below, and that is what confirms our manipulation. That's sequential SMT, okay? Now, in order to make sequential SMT easy for you to understand, what we can do is actually put it down into specific candles, right? Because we know that each, for example, daily cycle quarter is 6 hours long. What you can do, I think you need to have a specific TradingView subscription. So you don't need to use this. I don't use this either. This is just so you guys can understand it a lot easier, right? So daily cycle, 6 hours long each quarter. So what we're doing is looking for the SMT between a 6 hour period of time and the upcoming, the current 6 hour period of time, right? So you can even go to the 6 hour time frame, and that way it combines, it pushes together that whole 6 hour time period into one specific candle. So there's going to be 4 6 hour candles within a day. And to make it super simple, sequential SMT, you can just look for a simple SMT divergence between 2 consecutive 6 hour candles, okay? Same with the weekly cycle, daily candles. So if you see one asset run out the previous day's low and another closely correlated asset fail, and you're looking on the daily time frame, you know that that is a weekly cycle sequential SMT, right? And then you can go on and on. So monthly cycle is SMT between weekly candles, quarterly cycle between 3.25 week candles. Obviously, you're never going to use that, but that's just what a quarter is, 3.25 weeks for the quarterly cycle. Like I said, you don't even need to ever use that, to be honest. Like, I've just got it there just for educational purposes. 90-minute cycle, 90-minute time frame, 23-minute time frame for microcycle. Yearly cycle is a 3-month time frame. Quadrennial is just yearly candles. So, we've got an old yearly candle print, new one opens up, one asset drops below that previous yearly candle low, one asset fails, boom, we know we've got a quadrennial cycle, sequential SMT. So that's how to sort of, see it happen in real time and make it easier for you guys. But what I would recommend is just being on the specific time frames. So, like the 15-minute time frame for the daily cycle. And as long as you've got that indicator, or you already know in your head when the quarters are, begin and end, then you can just literally mark it out on that specific time frame, okay? Also, a thing to note is when looking for sequential SMT, we're looking back at the previous quarter. And what you want to do is a sequential SMT can only occur with the extreme high and the extreme low of the previous quarter, okay? So no random low or high in between. You must mark out the absolute high, the very, very high of the previous quarter. So let's say we start Q3. We're looking back upon Q2. We're marking out the extreme high, the extreme low. Boom, mark it out with a line, super simple. And then we're waiting for Q3 on that specific asset to either, run the high or run the low. And then another thing to note as well is, like I said, we're looking at closely correlated assets. So we're looking at the whole entire triad. The low and the high doesn't have to have formed at the exact same time. So like I mentioned here, for the regular SMT divergence, it does. But now, the reason why this one's a little bit different is because we're looking for the specific high and low within that specific time window. So that specific quarter, okay? And it's not always going to be the same high and low put in at every single quarter for every single asset. So for example, like I said, we enter Q3, we mark out Q2's highest high and lowest low. Let's say it's a daily cycle, right? We're in Q3 of the daily cycle, NYAM. Let's say Q2's highest high is at 2:30 a.m., which is during the London session. So you mark out that high. And then let's say, for example, let's say that was NQ. Now let's think that we're looking at ES. The highest high of ES during the London session, Q2, could be at, for example, 3:45 a.m., right? So we've got NQ printing the high at 2:30, for example, and we've got ES printing at 3:45 or whatever I just said, I don't know. But my point being is the highs and lows don't need to be put in at the exact same time. The only thing that really matters is we mark out the highest high on all assets, wait for one to run above, and wait for the other asset to fail to run above that its specific highest high of the previous quarter, okay? So hopefully that makes sense. I'm going to show you guys a quick example, just one that I created myself, just draw myself here, and then we'll jump into some chart examples, okay? So sequential SMT example, as you can see, 2 quarters of time, Q2, Q3, we're marking out the lowest low. I don't know if I'm going to be able to do this. Okay, I can. There we go. So that's... No, okay, I can't. I didn't think I would be able to. Wait, can I hover above? There we go. So this is the lowest low of Q2. As you can see, draw out a straight line of there. Now we enter Q3. We're waiting for price to dip below Q2's low. Then what we do is be looking at the other closely correlated assets, mark out that specific Q2 low on that specific asset. Remember, it doesn't need to be the exact same time on that asset. Then we're looking for the other asset or assets to fail to run below Q2's low. Once we've seen this happen, we can, identify we had the SMT divergence between the two specific quarters of time consecutively, Q2 and Q3. Then we can begin anticipating a potential move higher and look for our entry pattern. Okay, so hopefully that does make sense. Now let's just go ahead and jump into some chart examples and show you guys how this works in real time. I'll literally show you guys examples from literally yesterday or this week, because it's always there. It's always there. One final thing to note as well, a good little tip is, like I said earlier, we want to see ideally the sequential SMT, if we're bullish, occur below the true open, and bearish occur above the true open, right? So let's say we haven't had clear manipulation within the cycle that we're trading. We can then wait, if we're bearish, for example, wait for price to run above the previous quarter high, put in a sequential SMT above the true open. Then we can be like, okay, cool, this is our manipulation quarter now. So every single quarter that sequential SMT forms, most of the time is the manipulation quarter or reversal, okay? So we'll dive into that deeper in the charts right now. But with that being said, hopefully you guys did find this explanation useful. Now let's dive into the charts. All right, guys, so we're now on the charts and we are indeed looking at the indices triad. So as you can see, NQ, ES, and YM. Now you're probably wondering, what are all these lines marked out on my chart? This is my Oracle Insights quarterly theory indicator doing all the work for me. Like I mentioned in previous videos, it does everything. It marks out the true opens, marks out the quarters, marks out the sequential SMT, the different modes. You can have it mark it out. You can also have it show you in the bottom right. Really up to you, right? But yeah, obviously, you don't need to use that. You can still just mark out, literally like simply just mark out the lows. Or if you're pretty experienced, you can just sort of visualize, we know this low's here. We enter Q4 where, we're looking for a sequential SMT to form and then trade higher, for example. But all the lines that you can see marked are sequential SMTs. And just for a bit of context, look how powerful it is. Like, genuinely look how powerful it is. As you can see, it's pretty much always there before every single move. Retracements, actual moves higher, reversals, retracement, reversal lower, reversal higher. Like, it's just insane, right? It can do so many things. It can confirm expansions. It can give you indication of reversals, retracements, continuation, everything. Okay, so I'm going to put this out here now as well. Sequential SMT confirms everything. Okay, so no matter what cycle we're inside of, AMD X AMD, if we see a sequential SMT form, that is most likely our manipulation for that specific quarter. And then, as we mentioned before, whenever we have a quarter form manipulation, it tends to be followed by distribution. And that's when we can be super confident that it's going to be followed by distribution, is if the manipulation quarter forms sequential SMT, okay? So right here, what we're looking at is, of course, the weekly cycle. So we've got Q1, Q2, Q3, Q4, Q0, which is today, Friday. So Monday, Tuesday, Wednesday, Thursday. And another thing to note as well is sequential SMT, most of the time will put in high and low of no matter what cycle you're looking at. So in this case, this is the weekly cycle. As you can see, the low of the week, the low of the cycle was put in on Tuesday. Why? Weekly cycle sequential SMT. The high of the week, the current high of the week, why was it put in? Bearish weekly cycle sequential SMT, okay? So as you can see, NQ created that failure swing, ES and NQ ran out Q3's high, so Wednesday's high, right at the very start of Thursday, and then that was our manipulation, okay? So how do we actually utilize this sequential SMT to trade each cycle? So as always, coming into each cycle, you want to have that bias, right? What is the cycle likely to do? As we know, the cycles are tied to candles. So if you look at the weekly candle, coming into this week, why could we have expected higher prices this week, right? Well, as you guys can see, we're climbing all the way to all-time highs. We don't really have any reason to retrace back lower. Like, we really don't. Like, we don't have any sort of unfilled gaps. I mean, we've got this one, but it's very far away. And also, because this specific week here, last week, didn't form any sequential SMT, you can see no monthly cycle sequential SMT. It's very unlikely that we're just going to reverse, because like I said, there's always almost sequential SMT there before every single reversal. So if last week didn't form any, why are we expecting price to go lower this week? We're really not, okay? So coming into this week, looking for those bullish bias, the longs, weekly candles. So we know that's tied to the weekly cycle. If we go to the actual specific time frame, the hourly, right? What we're doing is we're waiting for, you can wait for Monday to play out, wait for the true week open to be established, which is the open of Tuesday, and then literally look for that bullish weekly cycle sequential SMT to occur, which in this case, Monday's low took out there on Tuesday for NQ. And if we take a look at YM, you can see that also ES took out Monday's low. YM actually failed, right? So that failure swing right there. And yeah, also, this is a good example. So this Monday's low was formed right there at 10 a.m. for YM, okay? That's the low that we mark out for YM because that's the lowest low of its quarter. And that specific 10 a.m. low is all the way up there for NQ, right? You can see it got ran out and just nothing happened, right? Because price only cares about its specific low of this specific asset. So Monday's lowest low, which is on that line, the candle that's on the line belongs to this new quarter, so Q1, Sunday 1800. This got ran out there at 11 a.m. on Tuesday, putting in that bullish weekly cycle sequential SMT, indicating that reversal is likely to happen. Pair that with the bullish bias that we had, and boom, what do you see right there? So Q2 manipulated, so like I said, and that's confirmed by sequential SMT, so therefore Q3 distributes higher, right? So it targets that previous week high, I believe it was. And it wasn't the previous week high, it's just the current high put in for this week. But you can see overall all-time high, so still just expecting higher until we get an actual bearish clear sequential SMT to indicate a reversal. So distribution, so sort of that continuation, accumulation, whatever you want to call it, Q1, Q2 manipulated below the true week open, bullish weekly cycle sequential SMT to confirm the manipulation. Wednesday, Q3, the following quarter, distribution higher. Then Q4, as we know, can either offer a continuation higher or a reversal. So how can we use sequential SMT to expect a continuation? Well, as I mentioned, sequential SMT is our manipulation and it can indicate a reversal, right? So until we get that, like, we're not going to get anything. We're most likely just going to keep trading higher and higher and higher, right? So in yesterday's case, Thursday, if all assets would have run above Wednesday's high, I would have expected a continuation. But because we put in a bearish weekly cycle, it's only very small, as you can see. It's literally Q3's final candle of the day printed the high, and then Q4 Thursday opened up immediately, ran it out, and you can see YM didn't run it out, and you can see YM's candle was a different time as well. Q3's high was at a different time. Still worked very nicely, okay? So yeah, if all assets would have run out Wednesday's high, we could have expected a continuation. But because we got a bearish weekly cycle sequential SMT, I expected a move lower, right? And where could we have targeted here? Well, you can see we have discount of yesterday's range. Well, it would have been Wednesday's range. Price returned back to that beautifully. Because remember, this doesn't automatically mean we're going to get a full-blown reversal. Remember how I said you can use it for retracements as well. So the logical retracement target would be back to a discount to potentially then go back higher. And what did we form as well at a discount of yesterday's range? Another bullish weekly cycle sequential SMT, right? So now coming into today, because yesterday technically manipulated the highs and the lows. So now it's a little bit, uncertain. That's what's happened when we get opposing sequential SMTs on the high and the low. It can be a little bit tricky, but that's then when we apply, the narrative, the logic. Where does price really want to go in the higher time frame? To me, looking at the daily chart and whatnot, we could easily still just continue pushing back to all-time highs, to be honest, right? But then I can also see a reason why we'd go lower, and the reason why that is because you can see, if we look at the 4-hour time frame, we actually have a bearish monthly cycle sequential SMT, right? So you can see last week's quarter was taken out during this week's quarter here. You can see it was actually taken out pretty early on, and then we did get some nice displacement, and then we kind of just ran it out basically, right? So to me, we're still bullish, like we're still more or less bullish, because until we get nice clear displacement followed by the sequential SMT, we can't be sure it's actually going to give a huge reversal. But you can still see it did give a retracement lower to go higher. The SMT is still there, the sequential SMT is still there because YM hasn't taken its previous week high just yet. So we can still easily go lower. So it's a little bit uncertain right now. But yeah, you can see that's sort of how we could definitely end up going lower in today's price action. And yeah, obviously this is fractal. So daily cycle, we go to the daily cycle. I mean, you can literally see it playing out. This is today. This is a few hours ago, today's price action. I mean, it's just insane, bro. Bullish daily cycle, Q1, Q2, move higher. Bearish daily cycle, Q1, Q2, move lower. Like, it genuinely is insane. Q2, Q3, lower. Q1, Q2 retracement to push price higher to form bearish sequential SMT to then get the real move, right? So this is why what I said, there's a lot of SMTs forming, but your job is to filter out the lower probability ones, and you can do that by zooming out to the higher time frames. Where is price going? What is price likely to do? Then trust the ones that are in line with that bias and narrative that you've got, okay? So yeah, let's go ahead and jump into one more example here. We'll just pick a random time frame. We'll go to the 90-minute cycle. I mean, do I even need to show? I mean, it's just insane. It's just always there, bro. Always there, right? Let's just go back to a random cycle up here. So was this yesterday's? Yeah, this is New York AM yesterday. This is not really what you want to see as well, by the way. You can see we got 1, 2, 3, 4 back-to-back sequential SMTs. A clean cycle will form one sequential SMT, then the following quarter will distribute, because that's what we usually want to see, manipulation, distribution, right? Then we can look for a potential opposing sequential SMT for the reversal. If we don't get sequential SMT, expect a continuation lower. So if we do get many back-to-back, that can be a sign of low probability conditions. So yeah, if you can't tell where price wants to go in the higher time frame, just stay clear of that price action, because it can lead to consolidation as well. So you can see here, bearish, bullish, bearish. You can see it kind of leads to price chopping up, but then eventually the real move does prevail, and you can see we get that move lower, right? And that's because we had that higher time frame sequential SMT in the weekly cycle on Thursday, right? You guys remember I showed you it was all the way up there or something. I mean, we even got a 90-minute cycle right there as well when we got the weekly cycle. So this is what you can do. You can use multiple cycles of sequential SMT in combination. So you can use like a higher time frame one, confirm that by a lower time frame one, right? And what I mean by this is, for example, if you're going from a weekly cycle, sequential SMT is your higher time frame, you can then use a daily cycle or a 90-minute cycle. I wouldn't go much more than 2 cycles lower. So I wouldn't go from a weekly straight to a micro. A weekly to a daily is fine. A weekly to a 90 is fine. Okay, so keep that in mind as well. So same with the daily cycle, you can go from a daily to a 90, and then a daily to a micro, and then obviously lower than that is a nano. I wouldn't go from a daily to a nano though. Okay, so hopefully that makes sense. Do we have anything else to speak about here? Yeah, I mean, that is essentially just it. So identify your bias for the cycle, look for that manipulation above or below the true open, have that manipulation confirmed by a sequential SMT. Okay, yeah, it's not always going to be there, but for me, I don't take a trade until I see at least one sequential SMT, okay? So I find my bias, find my narrative, wait for a sequential SMT to confirm that, okay? So come into the day, are we bullish or bearish? Bullish, okay, cool. Look for a bullish sequential SMT, ideally a daily cycle or a 90-minute cycle, or obviously a weekly cycle. You don't really just want to use like a microcycle to confirm your bullish daily bias. If you go back and backtest, most of the time it will be a daily cycle or a 90-minute cycle putting in high or low of the day, okay? And that's fractal. So weekly cycle putting in the high and low of the week, monthly cycle putting in high and low of the month, usually always there, okay? So make sure you do go ahead and backtest it, sorry, and you'll find really, really magical things. But yeah, I'm glad that this video is now out there. Now we can definitely dive a lot deeper into the Quarterly Theory Bootcamp episodes. I can explain a lot more, because without this concept revealed, it's actually quite hard to, when I'm explaining AMDX, XAMD, how do you confirm that manipulation and reversal? Now you know, and the continuation as well. And also, last thing to note off as well in this video is, like I said, sequential SMT is our manipulation or reversal. So not every single cycle is going to be XAMD or AMDX. It could be, price may continue higher, then it may form a sequential SMT. So it could be XM and then distribution after that. So it could be XMD and then maybe A or something like that. Truly, sequential SMT is what's going to mark your highs and lows of the cycles. So whenever you see them put in, aligning with your bias, you want to be looking for trades in line with that, okay? Yo, what is going on, guys? Welcome back to the Quarterly Theory Bootcamp, episode 4. Today's topic is the true change in the state of delivery, also known as a tCISD. Now, this is a concept that I founded myself. It is based upon multiple other teachings from other people, of course, but the framework that I use for it is specifically made by me. So it is, of course, based upon the change in the state of delivery, a concept taught by ICT. That is where it originated from. So that's where the idea comes from. But then I added my own twist using quarterly theory. And then basically we look for the specific tCISD after something occurs, a quarterly theory concept occurs basically. So I'll break it down. And what it's used for is to confirm sequential SMT. So first episode, we learned about the time cycles and quarters. Then I taught you guys about the true opens, which, those are used to filter low probability and high probability quarters and cycles. And then I taught you guys about sequential SMT, which is then used to filter and, confirm high probability quarters as manipulation, when to expect distribution, etc., etc. And now the true change in the state of delivery is a concept that we use to confirm sequential SMT. So sequential SMT confirms manipulation, and then a true change in the state of delivery confirms the sequential SMT. So yeah, this is how we actually use, we use this to enter. This is an actual entry technique. So I'll be breaking it down for you guys. And this is a very, very important video because a lot of you guys only know the framework so far and don't actually know how to enter or trust a sequential SMT. And this video is going to show you exactly how to do that. So firstly, let me go ahead and show you guys an example of a change in the state of delivery. So this is taught by ICT, and here is essentially what it is. Okay, so pretend this is the markets. We're looking at a chart right now. This is what's called well, first of all, liquidity has to be taken. Okay, so some form of liquidity has to be taken. And then there's two different ways that you can enter a trade. You can either wait for a market structure shift, which is a closure. Oops, that is the wrong thing. Which is a closure above that most recent swing high before the liquidity was taken. So as you can see, price displaces and aggressively closes above the most recent swing high before liquidity was taken. And then what you want to go ahead and do is wait for price to come back in to that market structure shift, that leg higher, the displacement leg, and then you look for your entry around here. Okay, now you can enter that way. However, the risk to reward, as you can see, is going to be a lot lower. As you can't see actually because it's not letting me place it for some reason, but you guys get the point. Your stop loss would be down here, your entry would be here essentially. Okay, so then by this point you'd be at like a 1-to-1 RR, which nothing wrong with that. But for the best entries possible, the sniper entries, you want to be using a change in the state of delivery. Now, what is a change in the state of delivery? So again, liquidity must get taken. Liquidity must always get taken before you take a trade. I mean, you guys should know that by now, right? So here is where our market structure shift would be over here, right? So instead of us having to wait for price to close above that most recent swing high and getting that worse RR, we can actually get in down here before the market structure even occurs, basically, right? And the way we're going to go ahead and do that is the candle or the series of candles that take liquidity. We're going to go ahead and wait for price to close above those specific candles, and more specifically the body of those candles as well. Okay, so imagine this is a candle right here that's taking liquidity. We're then going to go ahead and wait for 1 or 2 candle closures above that specific singular candle. And then that is what's classified as our change in the state of delivery. So the series of down closed candles that take liquidity, they get closed above. And then once it's closed above, that validates the change in the state of delivery. And then you can literally go ahead and just enter at the change in the state of delivery. So, once price retests it slightly, the candle, you can go ahead and enter there. Stop would then go on the low of that most recent low that took liquidity. And then you can go ahead and target much higher. So you'd be entering here. Stop loss down here. Oops. And then you can see the RR would just be so much higher than this one here. Stop loss there. Entry there. Okay. Look how much smaller that entry is. So yeah, obviously there are times and places when you should be using this, and that's what we're going to dive into within this video. And this is just a change in the state of delivery. The one that I'm teaching is a true change in the state of delivery, which is so much more powerful and is very mechanical as well in order, what to actually look for before taking that entry. So now you guys know what a change in the state of delivery is. Let's go ahead and go over firstly the time frame alignment, because you must be on specific cycles, specific time frames to look for the tCISD, right? So as always, all of the cycles are still the same. All of the time frames are still the same. So, the monthly time frame for the quadrennial, yearly for the weekly, etc., etc. Okay. So now a true change in the state of delivery can only occur if a sequential SMT occurs. Okay. So let's say we've got a quadrennial cycle sequential SMT occurring, right? So on the monthly time frame, we can see sequential SMT between 2 consecutive years, because that is what a quadrennial cycle SSMT is. Once that sequential SMT takes place, so let's say we're in 2025, we run below 2024's low. We then have our sequential SMT, if of course a closely correlated asset hasn't run below its previous year low, creating that failure swing, therefore the sequential SMT is there. Once that has formed, what we're going to be then looking for is on the same specific time frame as the sequential SMT, as the cycle that we're viewing, we're looking for our tCISD. So don't drop down one time frame lower, two time frames lower, don't go higher. Say on the same specific time frame the sequential SMT has taken place on, then that's when we'll find our tCISD. Now, a tCISD is a candle closure above or below, in a bearish scenario, the very, very first candle which created sequential SMT. Okay, so that may sound a little bit confusing. We'll go into some examples shortly, but let's just go over the time frame alignment first. But now you guys know what it actually is. This is why we must be on the same specific time frame. So yearly cycle is a yearly cycle sequential SMT, which is on the weekly time frame, and then that same specific time frame, a 1 week tCISD frame, a 1 week tCISD. Quarterly cycle is a daily tCISD. Monthly cycle is a 4-hour tCISD. Weekly cycle is a 1-hour tCISD. Daily 15-minute tCISD. 95-minute micro 1 minute. Okay, so essentially we're staying on the same cycle, the same time frame the whole entire time, and then we're looking for the tCISD on that same specific time frame. Okay, so let's say daily cycle sequential SMT. So London runs below Asia low, for example. That's Q1, Q2 sequential SMT, and then that's viewed on the 15-minute time frame. And then that very first 15-minute candle that ran below the previous quarter low, we've got our eyes only on that candle, not the candle below that. If we print another candle, not the one above that specific candle, then we wait for price to close above it to validate it. So let me show you guys an example right here. This is just one final little mock-up example, and then we'll jump into some charts. And there's lots of little tips as well in order to find higher probability ones, which ones to trust, when not to trust it, etc., which I'll be telling you guys when we do jump onto the chart shortly. Okay, so here's one final example. Remember, a sequential SMT must take place, so an SMT between 2 consecutive quarters. If you don't know what sequential SMT is, go watch is it the previous video? Yeah, the previous video, the Bootcamp episode number 3. That is where I explained sequential SMT. So SMT between 2 consecutive quarters. Just imagine the closely correlated asset hasn't ran below Q2's low. So we got that failure swing. Therefore, we do have a sequential SMT. So that's step number 1. Sequential SMT must occur. Let's say this is the 5-minute time frame, so a 90-minute cycle. We're staying on the 5-minute time frame, the same, very time frame that the sequential SMT took place on. Then, to make it easier, you can literally mark out a line of the previous quarter low and look which candle ran below that low. So, is it this candle here? No. Is it this one? No. Was it this one here? This one right in the middle here? No. Was it this one here? No. None of those. Which one ran below the low? The first very time. This one here. Okay? This very candle here ran below the low. That was the very first candle that ran below it. Okay? So we don't care about any other candle. And also the chain in the state of delivery example that I showed you at the start was, remember, the series of down close candles. This is what makes a tCISD so special, because it's a lot more mechanical and you can get a lot better entries. So sequential SMT, candle that took the low, previous quarter low, creating the sequential SMT, this one. Then what we do to validate it, because it doesn't just automatically become an entry point, we then need to see price close above it in a bullish example, okay? So we took the low, we wait for price to close above the open. So mark out the open of the candle that created sequential SMT, wait for price to close above the open with a body, right? So as you can see, this candle here closed above the open of this candle because it was a bearish candle. You can see, you can mark out the open, which is at the top for a bearish candle. Price closes above it. Then what do we do? Well, now it's valid. There's 2 things that we can do, okay? If we form a gap slightly above the tCISD, so like here, for example, you can enter from that gap, or you can enter directly off the retest of the tCISD, okay? So this candle, you can literally go ahead and mark this whole entire candle out if you would like to, or you can just mark out the open, whatever you would like to do. Look when we tag back into it, okay? Tag back into it right there. And this other candle here, 1, 2. Those are your entry points. Stop goes on the sequential SMT low, the invalidation. If you miss this first entry, you can look for a second entry at the gap slightly above it, okay? So a couple more things to note is when looking at a bullish tCISD, we of course must have a bullish sequential SMT take place, and the candle that creates sequential SMT must close bearish, okay? Because we can't have it, because basically bearish candles support price to go higher, bullish candles support price to go lower. So this is why the candle that creates sequential SMT must close bearish. If it does, cool, mark out the open, wait for a closure above, wait for the retest, like in this example right here. But if the specific candle, which is very rare by the way, because price runs lower, it's running lower to take liquidity, so it's more likely to close bearish. If it closes bullish for whatever reason, don't worry. What we do then is look to our left. So look at the most recent printed candles before the sequential SMT. So let's say this candle here closed bullish, right? Let me delete this, sorry. So this candle, let's say it closed bullish, but the sequential SMT is there. So now our tCISD becomes the most recent bearish candle to our left. So let's say this is bullish, which is our most recent bearish candle. Let's say this one here was bearish, okay? So then this becomes our tCISD. So then what do? Again, same as before, we wait for a closure above it, which happens here, okay? This candle here closes above. Then what do? Wait for a retest of the tCISD. 1, 2, candles tag into it. Stop again goes on the sequential SMT low, and then you can enter off this gap as well if you missed the first entry, and then target some buy side liquidity or wherever the higher time frame is heading towards, right? So hopefully that makes sense. Let me give a quick rundown for a bearish example. So a bearish sequential SMT, exact same principles. We must see a bullish candle that creates sequential SMT. Closure below it is our, it forms our bearish tCISD candle. Or if the candle that creates bearish sequential SMT closes bearish, look to our left, mark out the most recent bullish candle, the open of it, wait for price to close below that, and then boom, we have our tCISD valid, wait for a retest, stop on the sequential SMT high, and then run it down lower, okay? So that in turn is a very basic understanding of a tCISD, a true chain in the state of delivery. It confirms sequential SMT. Sequential SMT confirms our quarter as manipulation, reversal, continuation, everything. And then the tCISD confirms the sequential SMT. Then we can be confident at taking an entry after that, right? So hopefully that is useful for you guys. Hopefully it makes sense. If not, do not worry. We'll jump into a couple chart examples right now. So I'll see you guys on the charts very shortly. All right, guys, so we're now inside of the charts. We're looking at NQ and ES, and we're going to be pulling up U and ES, and we're going to be pulling up YM shortly as well, because remember, sequential SMT can be looked at through the whole entire triad. So yeah, I'm going to be showing you guys examples from all assets, and also not cherry picking any specific examples. We're going to scroll through the charts together and literally show you guys every single setup that you could have taken using the tCISD entry, okay? So you're probably wondering first, how do I have the tCISDs marked on the chart for me? Well, not only do we have a quarterly theory indicator, but we've got a tCISD indicator as well, which will be linked below in the description down below. You can also pick up free 3-day trials for each of the indicators if you want to test them out before making that monthly payment. It's not much anyway, but yeah, link below in the description. As you can see here, my tCISD indicator, you can set the filters and whatnot as well. For me, I just leave everything on default because I know when to trust the tCISD anyway, okay? So yeah, firstly, run the 15-minute chart, which is for the daily cycle. So we're going to be combining both my indicators here. You don't need the indicators, but you can see it just makes my life so much easier. It just marks everything out for me. So right here, you can see we've got a sequential SMT using YM. So this is Q4, Q1. So we go ahead and open up YM. You will see that it created a value swing on Q4's high. So let's take a look. Where is it? Over here. Okay, there we go. So Q4's high was not ran on YM. As you can see, we create that value swing, and remember that's step number 1. So step number 1, sequential SMT takes place. Now what do? Remember, the very first candle that creates sequential SMT becomes our tCISD candle. So we can mark out the previous quarter high, which candle ran above the high first, okay? So let's take a look at ES as well, because it's any asset that runs above it, right? So if ES runs above it first, we use that candle on NQ. if NQ runs above it, we can use the NQ candle on ES as well. I'm going to be giving you guys a few little tips here as well, because there are some things to know. You know, it's not super straightforward straight away. So which candle ran above Q4's high? Well, it was this one here. Okay, 615. But remember, in a bearish sequential SMT example, the candle must be bullish. Our tCISD candle has to be a bullish candle. So remember, what do? Well, we don't use that candle. So we look to our left and use the most recent bullish candle, okay? As you can see, go ahead, mark out the open. Remember, mark out the open of that candle. Wait for price to close below it to validate it. As you can see here, at 9 p.m, it validates the tCISD. And then, yes, you can enter within the following quarter, even if the tCISD is confirmed within the previous quarter. So in this case, sequential SMT takes place during Q1. tCISD takes place during Q1. We don't actually retest it during Q1. We retest it during Q2, and then we get a move lower. Because remember, if we tie everything together, we've got not only the true open here of Q2, we had manipulation during Q1. Q2 ran above the true open, so it's still manipulated above the true open. And I mean, I'm guessing there's probably still some lower time frame sequential SMT up here as well. And then, because Q1 manipulated, we're anticipating Q2 to distribute, okay? The following quarter to distribute. So not only does it open up high, retraces back to the tCISD of the manipulation quarter, then it begins the distribution, and then the following quarter, Q3, we get that continuation lower as well, right? So can you guys see now how we're tying everything together? But yeah, that's something to note. So you can use tCISDs from the previous quarter. You can even use them from like quite some while ago, like 2 quarters, 3 quarters ago. The only time that I recommend that though is if we get a lower time frame sequential SMT inside of it, or if the higher time frame draw liquidity hasn't been met. So let's say, for example, we got a tag into the tCISD and then a huge move lower. Let's say the higher time frame draw was met down here, and then if you see price coming back into the tCISD, I wouldn't then be like, okay, we got a tCISD, now I'm going to enter. You can see that it does work, because look, I mean, look at the rejection from that. That's just insane, right? I mean, even here as well, this is not proving my point whatsoever. This is just showing how powerful it really is. I mean, that's just crazy. But remember, if it comes back into it, we can look for a lower time frame sequential SMT, which we get there. We get a tCISD entry again. Another one here, tCISD entry there. So this means that the higher time frame draw obviously hasn't been met. So we still retrace back into it, and now we can see it's been met. So if we was to truly come back into it now, then we'd be like, okay, yeah, we're not going to trust it anymore. You know, we're going to look for something else, basically, right? But yeah, that is how you would use it. So let me go ahead and just show you guys now a few more examples. So it works in any cycle, any time frame. And the way that I like to use it is step number 1, identify my daily bias. Step number 2, wait for my specific trading time window, which is 9 to 10:30 a.m. Step number 3, look for a sequential SMT on any cycle from the daily to a 90 to a micro or a nano. Look for a tCISD on that specific time frame, entry at the tCISD, stop on the low, and then trade, take the trade, anticipating where I'm expecting price to go, basically, okay? So let's go over a few more examples for now. So, I mean, it's always there, guys. It has to be there before every single move. A sequential SMT is always there, and then a confirmation of that, obviously a closure below the candle of sequential SMT candle, and then boom, the move starts, right? So, I mean, as you can see here, Q1, Q2 with ES. So ES failed to take out Q1's lows. As you can see right there, created equal lows. So not the best case scenario, but if we do get that displacement, then it is still okay. NQ, which candle created sequential SMT? Remember, we don't care about any of these candles. We only care about this candle. In this case, it did close bullish, so we use the most recent bearish candle to our left, which is right there. Closure above occurs at 1955. Entry at the retest of the tCISD, stop on the sequential SMT low, and then run it up to your TP, wherever that may be. Okay, again, immediately after, why do we get the move lower? Sequential SMT again here. This is actually, is this a different type of sequential SMT, which you guys don't know yet? Maybe actually, hold up, let me see. Yes, it is. So we'll not go over that example for now, because we'll save that for a sequential SMT part 2 video. But just know there was a special type of sequential SMT there. The candle that created it, tCISD. Remember, you can enter off that first gap below the tCISD, below the tCISD. Entry, entry, entry. Bit of a larger stop. You don't always have to place it on the invalidation, but it's best to do so. That way, your trade can still have that room to breathe. And if it goes above the stop loss, then it's invalid anyway. Beautiful. I mean, just insane move lower, right? And also what I said earlier about how I identify my bias for the day and only look for sequential SMTs and tCISDs in line with that, this is the reason why. Because if price is bullish, it's literally not going to respect any bearish PD raise. Obviously the tCISD isn't some special PD rate that works 100% of the time. It's like anything else. Like gaps are going to get inversed, order blocks are going to fail, inversions are going to fail if you're not trading in line with the higher time frame, which we're going to be doing a bootcamp episode on narrative and reading price action soon. But we're just going over the basic concepts first, and then we'll tie them all together. So you can see a bearish one here. I mean, it still gives a move lower. Like this is still a move lower, right? Entry at the tCISD, stop on the SMT high. I mean, it still offers 2 RR, right? You could, if you really want to, trade every single one of them and go for like a 1-to-1 RR. It'd still probably be profitable. But remember, like anything else within trading, if you trade it in line with the higher time frame order flow, it's going to be so much more effective. Again, bearish one here, it forms and then just immediately fails. But then the bullish one forms and then immediately works right after, right? So this is why it's super important. Now, let me show you guys how you can actually spot an invalidation of a tCISD, because once one forms, it isn't just, there forever. It can get invalidated. So like this one that actually occurred a few days ago, or yesterday, should I say. So sequential SMT had taken place here. Then you can see it got invalidated and the sequential SMT disappeared. It's not there anymore, right? And this is why tCISDs are super important, because if tCISDs get disrespected, it often means the sequential SMT is going to fail. So we did have a sequential SMT here, right? This candle created it at 9:35. This candle closed bearish. So where's our tCISD candle? The most recent bullish one to our left, right here at 9:30, right? So mark out the open of that candle. As you can see, price immediately closed below it. So that can happen as well if a sequential SMT takes place. And for example, in a bearish sequential SMT, it closes bearish. It can immediately close below the bullish candle and just confirm it straight away. So sequential SMT and tCISD in the same candle, which is what happened here. Price then retested it at 9:40, which again, don't get me wrong, like it still did give a small move lower. Like this was what? Like just about one hour or something like that. Obviously, not one that you would have taken, but as you can see, it gave a small move lower. But now you're probably wondering, how do we know if a tCISD gets disrespected? Well, instead of marking out the open to confirm it with a closure below, price disrespecting the tCISD would be price closing above the closure of it, okay? So think of the whole body as the tCISD. Think of it as a gap. Price trades into the gap, right? Respecting it. If price goes above the tCISD candle, think of it as a gap, then this is price disrespecting the tCISD, okay? So a closure above the closure or below the closure, if bearish in a bullish example, is price disrespecting the tCISD. And often when that happens, it leads to the sequential SMT failing. Not always. It can get disrespected and then reconfirmed, and then you can take an entry. I wouldn't, if price disrespects the tCISD more than 2 times, I would just leave that trade alone. If it confirms it, then disrespects it, and then confirms it again, fair enough. 2 times isn't too bad. But if you see it get disrespected one last time, so 3 times, then just stay away, okay? Just stay away. So as you can see, price closes above the closure of the tCISD body right there, and then just immediately disrespects the sequential SMT. Because think of it as a PD rate, you want to see it get respected if you are in the correct alignment with price, basically, okay? Like it should respect the bearish PD rates, the bearish tCISDs if we are bearish. You can see it failed, a bullish one then formed, and because this one failed, this shows us that price obviously isn't bearish yet, so then we can continue looking for longs essentially. So tCISDs can also show strength and weakness. Now, what do I mean by this? Let me find a good example here. All right, guys, I know exactly what we can do. Let's just go ahead and zoom all the way out, and we'll stick it in replay mode over here. Random spot, okay? Let me show you guys how you would look at the strength and weakness and tCISDs as they're forming, okay? So as you can see, we've actually got a sequential SMT right here between Q1 and Q2. So as you can see, NQ ran below, Q1's low, and I'm guessing it was YM that failed. Yep, as you can see, YM has not ran below, Q1's low right there. So which candle ran below the previous quarter low initially? 810 candle. So what we're going to then do is go ahead and mark out the open, okay? So what I mean now, when I mentioned the strength and weakness is, like I was mentioning earlier, tCISDs are like PDRAs, okay? If it gets respected, you want it to go higher. If you get disrespected, it may continue going lower, but you want to see them being respected if you're in the correct alignment with price. So, excuse me. So in this case, we have a bullish sequential SMT. Obviously, we've not checked the higher time frame right now, but this is just a little example. So what we'd want to see is obviously this sequential SMT hold, and in this case, we'd want to see the tCISD form. So a closure above it to confirm this, and then we can be very, very likely that we're going to run these highs over here, okay, or push towards some sort of buy side liquidity. So our first step is sequential SMT. Then we wait for a closure above that candle that creates sequential SMT. But the way we measure strength is if it forms, then that's showing strength, right? If it's showing weakness, what price will do is actually wick above the body, the open of the tCISD, where we expect price to close above, and it'll fail to close above it essentially, okay? So it'll fail to create the tCISD, therefore showing us that price isn't ready to turn around and will most likely continue back lower. So let's put it in just 1x actually. Let's see the candles form one by one basically. Okay, so we've got 1 wick above, 2 wicks above. So already this isn't a good sign, by the way. This isn't a good sign. Also, a thing to note is when you're looking at NQ, ES, and YM, if NQ or ES confirms its tCISD, you can still enter, for example, if NQ hasn't yet and ES has, you can enter on NQ. If NQ has confirmed it and ES hasn't, you can enter on ES. However, if YM confirms the tCISD candle, in which case CISD candle, in which case here it already has, I personally don't like to trust that, because YM is it's still very correlated, but it's the least correlated out of the 3, and it can sometimes do its own thing, right? So just a little tip there for you guys to keep in mind. So already this is very bearish. I would, if we don't get a closure above here and we wick above it one last time, I would expect that we'd still continue going lower personally if we get one more wick above. But if we close above now, then I would want to see these highs up here get ran. Okay, so as you can see, I'm seeing weakness within this asset at the moment. So if I really don't see this confirm pretty soon, then I'm probably not going to be looking to take my long position, So let's go ahead and see. Okay, so we got another decent closure. Again, another wick above. This is really not good, but at least the candles aren't closing bearish. So you don't need to rule it out immediately. Just keep in mind that you don't want to be entering until it is confirmed, because this is still very much so bearish. Okay, now it's been confirmed. Now we wick into it, as you can see right here. Entry will be at the tCISD, stop on the low, and then we can just go ahead and target the buy side liquidity, okay? So as you can see, price was showing weakness this whole entire time. Now it's showing strength because the tCISD has been confirmed. So now let's go ahead and see if this would actually play out or if it's going to get disrespected. Okay, as you can see, we actually formed a bearish 90-minute sequential SMT now. So not only was we showing weakness for a very long time, we just formed a bearish 90. The candle that created it was this one here, 9 a.m. So this bearish candle here. Look to our left for the most recent bullish one. Is it this one? No. Is it this one? No. Is it this one? Yes. Okay. So let me move this out of the way. So this one here, you would go ahead and mark out the open of this one here. So like this. Ignore the indicator. I think I've got a filter on there. So it would be this very specific candle. Price closes below it, 8.55. We're currently inside of it now. So if we dropped lower and disrespect this bullish tCISD, with a closure below here, I would definitely expect lower, okay? So let's go ahead and see. Okay, nice, very nice candle. So now looking at this, you can see we've disrespected the bearish tCISD. So this bearish tCISD candle was here. Remember, we closed below it to confirm it. We closed above the closure of it right there at 9.10. So this is showing super strength within Enki right now. So I would really expect price to trade towards these highs now. That would be the most ideal situation. Boom, there we go. Okay, as you can see, very nice. So can you guys sort of see how I was navigating price action using the tCISDs? You can literally just use them alone to see strength and weakness, right? So just keep in mind, bearish one formed, disrespected it. Is that bearish? No, very bullish. Bullish one was trying to form. It was failing to form, which means price wasn't ready to go higher yet. But then, as soon as it was confirmed at 8.45, what did price do? Retrace back into it and give us that move that we wanted, okay? So that's my very exact point. You don't want to be taking the trades if you can see price isn't respecting the tCISDs or forming them. Once they are formed, then you can be, okay, very confident. Let me go ahead and take this trade now, okay? And as you can see, even here, just another bullish one formed last second, closure above, and then off we go, boom, okay? So super simple. no cherry picked example. That is literally how I basically work around all the tCISDs every single day, pretty much, right? That, and then zoom out to the high time frame alignment. Am I in line with the high time frame? If yes, look for the tCISDs to be respected or disrespected. If I'm bullish, look for the bearish ones to be disrespected. If I'm bullish, look for the bullish ones to be respected. We don't want to be seeing all this wicking stuff over here. We want to see a nice clean closure through it, pretty much as fast as possible, and then off price goes, okay? So yeah, hopefully that was a useful example for you guys right there. So yeah, that's going to go ahead and wrap it up for this video, guys. Hopefully you did find it useful. The tCISD, one of my favorite concepts, the one that I have founded as well. Been using it for quite some time now. A lot of people out there are already using it as well. Yo, what's going on, guys? Welcome back to the fifth episode of the Quarterly Theory Bootcamp. Today's lecture is going to be a very special one. We're going to be covering the concept of the precision swing point, also known as a PSP, okay? So this is a very special concept. I'm sure you've probably never heard of it before, or if you have, you probably don't have the most information on it. Well, this concept is very special. It actually allows you to top and bottom tick most of the moves. It's usually always there before every single reversal, and it's a very highly efficient way to capture higher RR trades as opposed to some of the other concepts that we've already covered. So without wasting any more time, let's go ahead and jump straight into it. So to actually understand what a precision swing point is, do you understand, we've got the word swing point in the name of the concept. So you need to understand what a swing point is, and here we've got a little example, okay? Essentially all it is a 3-candle pattern where candle number 2 has either a lower wick in a bullish scenario or a higher wick in a bearish scenario than the candle to the left of it and the candle to the right of it, okay? So our swing point candle, we'll call that candle number 2. The candle to the left is candle number 1. The candle to the right is candle number 3, okay? So as you can see, candle number 2 has a lower wick than the candle to the left of it, candle number 1, and also a lower wick than the candle to the right of it, candle number 3, okay? So that is essentially all a swing point is. This is a bullish example, and this here is a bearish example, okay? Super simple. And now you understand what an actual swing point is. Let me show you guys a diagram, an example of now a precision swing point. Super simple. It's the exact same concept. We still need to see that swing point formation form. But if you look a little bit closer, if you look a little bit closer, first of all, you must be looking at closely correlated assets for this specific asset. So like we always do to look for sequential SMTs, tCISDs, we must be looking at a triad at closely correlated assets, okay? So in this case, we're looking at NQ and ES. They have both formed a swing point. Keep in mind the swing point must form at the exact same time. So imagine this is the hourly time frame. Imagine this is 8 o'clock, 9 o'clock, 10 o'clock, okay? As you can see, the 9 o'clock candle on both the assets form that swing point. But if we look a little bit deeper, notice how it closes bullish on NQ and it closes bearish on ES, okay? That is it. That is a precision swing point where we get closely correlated assets forming a swing point at the exact same time, and the closely correlated assets have a different closure amongst each other, okay? So NQ could have closed bearish, ES could have closed bullish. That would still be classified as a precision swing point, a PSP, okay? So super simple. That is what one is. Now, if we go ahead and look to our right here, you can see we've got almost the same example again with ES creating that swing point. NQ, however, this time didn't create a swing point, okay? So you can see here, candle number 2 on NQ isn't a swing point. The swing point here, well, we don't actually know because we don't know what candle number 1, the candle to the left of this candle looks like. But either way, you can see that candle number 2 here isn't a swing point. But if we look a little bit closer, again, within this 3-candle pattern, imagine this is the same time frame, 8 o'clock, 9 o'clock, 10 o'clock, 8 o'clock, 9 o'clock, 10 o'clock. 9 o'clock candle closes bearish on ES, closes bullish on NQ, right? No, it does need to form at the exact same time, but it doesn't need to be a swing point on all the closely correlated assets, right? So as long as at least one of the assets print a swing point and another asset, doesn't need to, but then what we're doing is we're looking at the closure still. So 9 o'clock closes bullish on NQ, 9 o'clock here closes bearish on ES. This would still be classified as a precision swing point because at least one asset has formed the swing point, right? So on this asset, it would be called a precision swing point, a PSP. And the other name that we have for this type of candle is a precision candle or a PSC, okay? Because it isn't a swing point, so we can't call it a precision swing point, but it's known as a precision candle because it has that different closure, bullish as opposed to bearish, amongst the closely correlated assets at the exact same time, right? So we're not looking at random candles, you know, we're not looking at the 7 o'clock candle on NQ and then the 9 o'clock candle on ES, seeing if they close different. No, it has to be the exact same candle on any time frame. So we could be on the 4 hour, looking at the 6 a.m. candle on NQ and ES, as long as NQ closes bullish or bearish and ES has a different closure. So if NQ closes bullish, ES closes bearish for that 6 o'clock candle, that would be, well, a precision candle. But if one of the assets forms a swing point off that specific candle, then it'd be called a precision swing point on that asset and a precision candle on the asset that didn't form a swing point. So these are two scenarios that can occur. You can have one asset print a precision candle, one a PSP, or you can still have both assets forming a swing point at the same time, and they're both just called precision swing points, okay? But the main thing is one asset must print a swing point, and then you must have that different closure amongst the closely correlated assets. You can still trade based upon precision candles. So imagine ES didn't form a swing point here. Imagine it was like NQ, but it still closed bearish. That would still be classified as a precision candle amongst the assets. It just wouldn't be a PSP. And in particular, this video, we're going to be diving into PSPs mainly because those are the ones that are going to yield those higher RR trades, okay? So with that being said, now you guys actually know what to look for in terms of a PSP. Now let me show you guys what PSPs are mainly used for, okay? So let me go ahead and move this image up slightly. Unlock that, push that higher, and then we can dive into our classic old trusty little example sheet that we've always got on every single video, so you guys know the time frame alignment, okay? So pretty basic, you know, it's everything that you guys should be looking for, that you know you should be looking for. Just classic, you know, monthly cycle, 4 hour time frame, monthly cycle, sequential SMT, and then the way the PSP comes into play is on the same specific time frame the sequential SMT forms at. We're looking for a 4 hour PSP formation to form, right? So no matter what cycle we're looking at, you know, you guys know the time frames of the cycles. We essentially must see a precision swing point of that exact same time frame for that specific time cycle form after a sequential SMT, okay? This is not the only way to trade precision swing points. Essentially, this way here, they are used to confirm the sequential SMT. So like we mentioned within the previous lecture about the true chain and the state of delivery, that's the way that we can confirm. That's the way that we can confirm a sequential SMT. We can also use precision swing points to again confirm the sequential SMTs that are forming, right? So daily cycle sequential SMT viewed on the 15-minute time frame. After the sequential SMT has taken place, we want to see a 15-minute precision swing point formation form. Okay. So I know I'm sure you probably got a few questions. So I'm going to clear up a few things here now. So if the candle that creates sequential SMT closes as a PSP, that is still fine. You can still look for an entry after that. Or if the candle that creates sequential SMT isn't a PSP, which, you know, it won't always be, and it's pretty rare to see it. Sometimes, you know, I'd say it's probably got like a 30% chance of forming. That's still fine. You can wait a few candles after the sequential SMT has taken place. Maybe price is chopping up a little bit, then it forms that PSP. And then you can be thinking, okay, cool. We've got our sequential SMT, we've got our PSP. Now I'm going to be looking for my entry. You ideally don't want to see it form too late after the sequential SMT is formed. So let's say we've got a weekly cycle sequential SMT. You know, let's say it forms at, I don't know, 6 a.m., right? 6 a.m. You can look for it to form at the 6 a.m. candle, 7 a.m., 8 a.m., 9 a.m., 10 a.m. If it's like 4 or 5 hours after, so I'm saying like, if it's between like 5 to 7 candles after the sequential SMT has taken place, maybe be a little bit more cautious. You ideally want to see it form pretty close after the sequential SMT has taken place, because essentially what a PSP is another form of a crack in correlation, which is what we're looking for when trading the closely correlated assets. So a sequential SMT is a crack in correlation. It shows us that price is most likely going to reverse. And then a precision swing point is another form of a crack in correlation, which again indicates that price is likely to reverse. So if you combine the two together, we know that we're dealing with a pretty high probability setup. But there's many ways in which we can use PSPs. You can also use them just on their own without a sequential SMT. They can help give you bias. So we'll be diving into charts shortly, explaining the different ways in which we can use them, okay? But lastly, before we do that, here's just a little example of how a precision swing point setup may look after a sequential SMT forms, okay? So as you can see, Q2, Q3, imagine this is two closely correlated assets. Obviously, NQES, for example, right? So as you can see, NQ runs out Q2's highest high. Let's say it's, I don't know, daily cycle. Let's say this is London high, it runs out during the AM session, during Q3. As you can see, we run above it, okay? And then imagine ES fails to run above Q2's high, London's high, and then we're looking for that precision swing point to form. As you can see, this specific candle here closes bullish on NQ, and this same specific candle closes bearish on ES, right? So now we've got our sequential SMT, we've got our precision swing point. I don't even think it formed off the candle that created sequential SMT, I believe. Let me see if I can do this. Yeah, look at that. As you can see, the specific candle that created sequential SMT would be actually this one here, which is kind of like a doji candle, and then the candle immediately after formed as a precision swing point. Then we got that move lower, okay? So that's what I mean. We don't need to see it form off the exact same specific candle. It can be a few candles after, but ideally not too many, because if you wait too many, then usually the move has already kicked off, like this, for example, and then you're looking for a PSP down here, and it's just not going to give the high RR. Whereas in this case here, look at the RR that you could have gotten just based upon that swing point. So now also, I'm going to be jumping into the charts and showing you guys how to actually get the higher RR trades based off a PSP, because there's multiple entries that you can take. As you can see, the PSP candle, our candle number 2, what you can do is actually directly enter off the open of candle number 3 based upon how candle number 2 closes, because you can see we've got that different closure amongst the assets. So bullish for NQ, bearish for ES. So what we can do is enter candle 3 in anticipation that the precision swing point is going to hold. That can be a little bit more risky, so you can wait for this candle to close, candle number 3, then you know you've got the precision swing point formation, 1, 2, 3 candles, enter off 4, stop can go on the PSP high if it's not too large of a stop loss, and then you can ride the move lower that way. My personal favorite way is to enter off candle number 3, anticipating that the PSP candle will likely hold, based upon how it closes. We've got that cracking correlation, bullish for NQ, bearish for ES. Another thing to note in terms of that as well is if we're thinking logically, we've got a bearish sequential SMT, we're expecting lower prices. We kind of want to see the assets printing bearish candles, right? To show us that price wants to go lower. We want to see those nice bearish closures. So the asset that prints a bearish candle is likely more weaker, so less likely to run out the PSP high. So ideally, that would be the asset that you would be wanting to enter on, okay? So entry at candle number 3, stop on the PSP high as it was a bearish closure, anticipating this high not to get ran. And then you can see it's a lot weaker of an asset because it expanded a little bit more aggressively. You can see relatively the same, but like this candle here in the middle was a lot larger for ES, for example. And then also this one seems like it was a little bit larger. But we'll be diving into examples on the charts of this, knowing when and when you shouldn't be entering a PSP and which asset to take it on essentially. But in this case, you can see NQ printed a bullish candle, so it was a little bit more likely to run the PSP high. Doesn't mean it's going to, it just means ideally you want to enter on the asset that prints a bearish candle because it's showing more weakness within that asset. And notice how this asset also formed the value swing for the sequential SMT. Again, that's another form of weakness within this asset because it's failing to take out liquidity, okay? So hopefully that makes sense. That is essentially like a full lecture right there. I can end the video there and you guys will already have the information, but what we're going to do now is jump into a few chart examples and show you, how to use a PSP in its full power, basically, okay? So, yeah, I'll see you guys in the charts very shortly. All right, guys, so we are now inside of the charts and we're going to be going over a few examples. I'll also put it in replay mode a few times to show you guys sort of the thought process behind entering a precision swing point as it's forming in real time, essentially, okay? Well, first of all, I just want to show you another quick example of, of one format essentially. So as you can see, this was literally a trade during this week, Q4, Q1 on the 15-minute time frame. So this will be a daily cycle sequential SMT between the PM and the Asia session. As you can see, NQ creates that value swing. So it's already a lot stronger of an asset compared to the asset that takes liquidity. It's the weaker asset, so more likely to expand higher. And then not only that, if we look at the candle that created sequential SMT, in this case, it was indeed a precision swing point. As you can see, NQ closes bullish, YM closes bearish. Now, you're probably wondering what the dots are marked on my chart. Again, it's my quarterly theory toolkit indicator. It does everything for me. So we've got the precision swing point feature, and we also got many filters, filtered by true open, sequential SMT, etc., etc. So feel free to grab that link in the description down below. And yeah, we'll make backtesting and spotting PSPs a lot easier for you. But Anyway, as you can see, bullish closure on NQ, bearish for YM, both a swing point on both the assets. Again, it doesn't matter if it was or not. You know, ES could have, YM, sorry, could have literally not even been a swing point. So that will be a precision candle for YM, but then a precision swing point for NQ, okay? So as you can see, it created that value swing, so it's already a stronger asset. And then it also closed bullish as that precision swing point as well. So again, the entry that I like to take when these kind of filters align, where you trade in the value swing asset and the asset also closes either bullish in a bullish scenario or bearish in a bearish scenario, being the stronger candle closure, I like to just enter immediately off the candle 3 open. In this case, it wasn't particularly clean because it had no wick, but let's say it just wicked lower a little bit, then you could have grabbed a crazy entry there. But in this case, even an entry there, as you can see, ran it up to 2R, and you know, even a little bit higher if you would have liked to have done. And then you can see, why did we drop lower? Well, let's go ahead and take a look, shall we? So we got another sequential SMT, YM creating that value swing, NQ creating the turtle soup. As we can see, let's go ahead and mark this out. And in this case, you can see a precision swing point form there and one there. So this is what I mentioned. It doesn't need to form off the candle that creates sequential SMT. In this case, it formed a few candles after. As long as it hasn't really like expanded or given like a large move lower, then it's completely fine to enter. In this case, we even formed a gap. So this is something else to note as well. Precision swing points that form inside of gaps are very, very high probability as well, and can help confirm that gap as well for you to trade. So yeah, as you can see, bullish closure there for NQ, bearish for YM. And you can see YM wasn't a bearish swing point, NQ was, right? So again, this would be called a precision candle, and this will be called a precision swing point, right? So again, you know, you can enter off this candle open, stop on the PSP high, or in this case, even if you wanted the SSMT high would be even better if you can afford to do that, because that would be like the true invalidation of the trade. Because we can run out PSP highs and lows sometimes. You know, they're not always going to be, you know, super clean RR and never get ran out. Like that will happen. But if we can apply the filters to make it lower probability to actually get ran out, then that's great, you know. So sequential SMT, PSP, nice closure in line with where you're expecting price to go. So in this case, we actually, you know, create the turtle soup, the stop run, and also close bullish, but we didn't run the high out. So again, it won't always happen. Again, in this case here though, a bearish candle closure there for NQ, and it was also a bearish one for YM, which means if the indicator is marking out, it must be there with ES. So let's go ahead and pull up ES, and it should be a bullish closure for ES. And look at that, there you guys go. So swing point there on ES and also on NQ, only ever so slightly, but you can see because it's got a dot above it, it has to be a swing point. We've got an indicator that marks out the precision candles as well. It's inside of here, sorry. As you can see, where's it at? Precision candles, so you can have them marked out as well. But in this case, like I said, we'll go over PSPs particularly. So nice bearish candle closure. Entry here of candle number 3 as it opens up, stop on that PSP high, and just insane RR as you guys can see. So yeah, you're basically looking for candle 2 to close and then candle 3 to trade back up into candle 2's wick or body slightly, and anticipate that candle 2, that PSP or precision candle at the time high, not to get run, and have it hold as a swing point essentially. But again, if you don't feel comfortable doing that, wait for this candle to close and enter off candle number 4, stop on the PSP high. Again, still nice RR as you can see. So candle 1, candle 2, the PSP, candle 3, boom, the formation's there. We know it's a precision swing point now. Entry of candle 4, stop on the PSP high, and as you can see, very, very nice. But the thing is, sometimes if you don't enter off candle number 3, then the candle 4 entry can be quite a lot lower down. So if you want to take the risk, you can enter candle number 3 if you're truly confident prices, you know, actually going to begin dropping lower, okay? So now let's go ahead and jump into a replay mode feature. Example of one basically playing out like a sequential SMT plus PSP setup, okay? So yeah, let's go ahead and do that now. So what we're actually going to do is we'll just zoom out really, really far, and then we'll stick it in replay mode and literally go over an example as it's forming essentially. But yeah, just to point out, like precision swing points don't have to be after a sequential SMT. They can form at any point, and they generally do just put in the highs and lows of many cycles and days and, you know, sessions, etc. You want to kind of look for them to form at specific points. So rejecting from a true open inside of a fair value gap, or the ICT PDAs like order blocks, breakers, inversion gaps, because we know that swing points are always there before every single reversal. So if we then filter out the regular swing points with a precision swing point, it's going to add that element of the cracking correlation and just make it so much higher probability essentially, okay? I mean, look, as you can see here, the indicator, bullish one puts in the low, bearish one gives a small retracement, bearish one puts in like the reversal. Again, like loads of bullish ones along the way up. Again, it's that same thing as Sequential, SMT, and tCISD. If you're in line with the order flow, most of the ones that form in line with that direction are going to hold and give really nice moves higher, basically. Yeah, as you guys can see in this example, we do indeed have a daily cycle, Sequential SMT. So NQ failed to run below Q2's lows, which in this case on the 15 is a daily cycle. ES did run below the lows, so it's run out London's lows during the AM session. So now we're looking for our precision swing point to form, okay? So this candle here that created it was actually a precision candle. As you can see, it's not a swing point on NQ or on ES. Let's see if it is on YM though. No, not on YM either. So this is actually a great example of a precision candle, which, you know, I said we'll mainly focus on PSPs, but we can go with precision candles again. Same sort of concept, right? Precision candle forms, you ideally want to trade the one that prints the bullish candle in a bullish scenario. So not only did NQ create the value swing, already a stronger asset, but it also created a bullish candle, as the precision candle. So you can enter off this candle, stop on that precision candle low, anticipating it not to get ran essentially. But you can see the asset that printed the bearish candle as the precision candle actually did get ran out. So we created a nice total sweep on the precision candle low, and then we got a nice bullish closure, right? So keep that in mind. I think what I'm going to do is do a part 2 for precision swing points, because it's actually another sort of concept inside of them, which makes it a very, very high probability to enter from and to look for reactions away from to sort of confirm it's going to hold. But we'll save that for a second video, a part 2. But for now, let's continue with this, okay? So let's put it in 1x speed actually and just watch these candles as they play out. See if we can capture a PSP as it plays out. So this candle here was a bearish closure for NQ. If there's no dot, it shouldn't be a PSP on YM either. Oh, no, okay, there we go. Perfect, perfect. So we got a nice example here. As you can see, swing point formed there at 10:30 for NQ, and it wasn't a swing point there for YM. So YM is a precision candle, NQ is a precision swing point. We closed bearish on NQ, we closed bullish on YM. Remember, that's the most important thing, the different closures at the exact same time. If this was bearish closure for NQ and bearish for YM, it just wouldn't be anything. It'd just be a regular bullish swing point and a regular just bullish candle. But because we have that different closure, and now we've got that added cracking correlation, added with the sequential SMT to make this a pretty high probability setup. So again, entry of candle number 3, when it opens up low, stop on that PSP high, low, sorry, in this case, for the bullish scenario, and run it up for that nice high RR, okay? Again, if you was a little bit scared, you can literally enter off candle number 4. Let's say it opens up here, stop on the low and target the highs, for example. So let's see how this next candle opens up. Yep, there you go, it tags you in. So you could have got that entry, or you could have entered off here for the higher RR. And then let's see, so what happens here if we keep letting it play out. See if it runs to those highs. We got an SMT on the highs, but as you can see, eventually did end up running out that high. So again, how we formed a bearish sequential SMT with a bearish precision swing point. So now we could potentially get a move lower, but look how powerful that is, guys. So yeah, super, super nice. Also, one last thing that entered my head before we end off the video there is, do you know the candles that close like doji candles, where they close, where they open essentially? Let me try to find one. Yeah, I think this is one here. See this candle here? Right. So this candle here technically isn't bullish or bearish. It closes where it opens. So, no matter what, you can technically class that as a precision candle or PSP if we close bearish, for example, or bullish on a different asset. If we close bearish on YM, we close where we open here on NQ. So you can class that as like a PSP, look for an entry from there. But for me personally, I don't like to really see those type of candles. I like to at least see a nice clear bullish closure and then a bearish on the opposing asset essentially, okay? But you can class those as PSPs if you would like to do so. Just thought I'd put that out there as well before we end off the video there. But yo, what is going on, guys? Welcome back to the 6th episode. Come back to the 6th episode of the Quarterly Theory Bootcamp. Inside of today's lecture, we're going to be covering the concept SMT-Fill, a very simple but very, very powerful concept. It essentially tells you when and why a fair value gap should hold and when it shouldn't, basically, okay? So yeah, without wasting any more time, let's just jump straight into it. Firstly, I'll show you guys an example of actually what it is. Then we'll jump into the time frame alignment, jump into a few examples, and then we'll hop onto the charts, okay? So for SMT-Fill, essentially what you have to be doing is comparing closely correlated assets, just like you do for all of the concepts that I teach, basically. And this one is no different, pretty much. So SMT-Fill must be looking at closely correlated assets So let's say NQ, ES, and YM, DXY, Euro, GU, all of the triads, everything that we went over within lecture number 1 about the assets and the triads, okay? So now we're looking at the closely correlated assets. What we must see, so step number 1 for an SMT-Fill, we must see a gap form at the very exact same time across, it doesn't need to be all the assets, but at least 2 assets, right? So at least 2 of the assets have to have printed a fair value gap at the exact same time. So let's say we're looking at the 5-minute time frame. Let's say we've got a fair value gap on NQ and ES at, 10 minutes past 10, okay? We must see that gap form at the very exact same time. Then that is step number 1. Step number 2 is then when we're looking for our different variants of SMT-Fill. So now the gap is formed, we're looking for the SMT-Fill to actually form itself. And here is where the variants come into play. So as you can see, variant number 1, one asset trades back into its gap, whereas the other asset fails to trade back into its gap at all, okay? So this is the most simple one. This is the most obvious one to see with your own eyes. Just super simple. You can see, pretend this is NQ, pretend this is ES. NQ trades into its gap. ES fails to trade completely back into its gap at all, right? So that one is super simple. And essentially what this concept does is it shows strength or weakness within the asset or the market that you are looking at. Because as you can see here, we can see that NQ is the weaker asset because it's actually falling back lower, back into price, back into its gap. Whereas the asset here on the right is a little bit stronger because it's failing to return back to its gap. Hence why, it may expand a little bit more to the upside, right? So we can use it to measure strength and weakness. And it is basically just another form of a cracking correlation, which is pretty much all the concepts that I've taught you guys so far is what they are basically, right? So it's a way to show us a cracking correlation within that specific marketplace. And a cracking correlation is an indication that price is most likely going to reverse or, begin some sort of significant or decent move at least, okay? So that's variant number 1. That one is super, super simple to understand. Now we can go a little bit deeper. Variant number 2 is where one asset trades below 50% of its gap and the other asset fails to trade below 50% of its gap, right? So again, pretend this is NQ. You can mark out the 50% level of the gap. NQ trades below 50%. It doesn't fill it completely, but it does wick below the 50% mark. Whereas ES, it trades back within its gap, but it doesn't trade below the 50% mark, right? So again, that is another form of SMT-Fill. Then the final variant, variant number 3, is where one asset fills the gap completely and the other asset fails to fill the gap completely. So again, pretend this is NQ, trades below its gap. It doesn't need to have traded below it, but as long as it's filled it completely to the brim, like literally wick the final part of the gap to fill it completely, the other asset, again, it can trade anywhere within the gap. It can fail to trade below 50, it can go below 50, just as long as it doesn't fill the gap completely. That is our final variant of SMT-Fill, okay? So like I said at the start, guys, very, very simple and easy to understand concept. But when you apply this with different entry models and higher time frame analysis, it is actually very, very powerful, right? So now you guys know what SMT-Fill is, you know what to be looking for. You can be done with the video right there. But what we're going to do is jump into the proper time frame alignment for how to properly utilize SMT-Fill, and then we'll jump into some examples as well of how you can use it for entry models, higher time frame bias, and all of that good stuff, okay? So let's go down here and actually take a look at our, let me make it so you guys can see completely, there we go. Now let's take a look at our time frame alignments, okay? So there's 2 different things in which you can utilize SMT-Fill for. Well, there's a few other things, but these are like the 2 main things, to be honest. So number 1 is you want to see a sequential SMT take place, followed then immediately by an SMT-Fill. That would be your sort of entry model. Or what you can see is SMT-Fill on the higher time frame, so a higher time frame gap, followed then by a lower time frame SSMT, okay? And even for this bottom one, you can create this into an entry model. So you can look for example, a 4-hour SMT-Fill and then a daily cycle SSMT inside of the gap, right? And the thing is, you don't even need to have an SSMT inside the gap for it to hold. The SMT-Fill alone can just be enough. So you could literally have a super simple ICT entry model and base it just pretty much upon a SMT-Fill essentially. So like, I don't know, a 1-hour SMT-Fill and then drop down to a 5-minute and just find a super simple 5-minute entry model, an inversion gap, a break, anything like that, okay? So that's how simple but powerful it can be. But let's first go over the top one, okay? So SSMT followed by an SMT-Fill. What do I mean by this? So obviously, firstly, we must see a sequential SMT take place. So in this case, let's say we've got a quadrennial cycle, SSMT, right? This is of course viewed on the 1 month time frame. All the time frames are the same, you know, for the cycles that you guys already know of. So 1 month time frame we're on. We've got our quadrennial cycle SSMT take place. And then what we want to see is a 1 month fair value gap form, and then essentially we'd be looking for the SMT-Fill inside of that gap pretty much, okay? Super simple. That is essentially all we'd be doing. Again, it works for all cycles. 90-minute cycle, we got a 5-minute time frame, so we need to see a 90-minute cycle SSMT, followed by the formation of a 5-minute gap, followed by a 5-minute SMT-Fill, and boom, that can be an entry model all by itself, right? You can stay on the same time frame, look for the sequential SMT, look for the formation of the gap, look for the SMT-Fill, enter the SMT-Fill, stop on, you know, the SMT low or below the gap, for example, and then take your entry. So that's what I mean by SSMT followed by SMT-Fill. You want to be looking for the SMT-Fill on that same exact time frame the sequential SMT takes place on. Ideally as well, a lot of tip to keep in mind is the first presented fair value gap that forms after any cycle sequential SMT is usually the higher probability gap, and that's the one that you ideally want to see the SMT fill off. Because think about it logically, right? If a sequential SMT takes place, that indicates a reversal. So then if a gap forms after the sequential SMT, we want to see that PD rate respected if the sequential SMT is very likely to hold, okay? Does that make sense? So essentially sequential SMT is like our smart money reversal, and then to actually know the smart money reversal is going to hold, we want to then see the PD rates formed after be respected. So ideally you will enter off that first presented gap, look for that SMT fill inside of it, and then take your entry from there basically. Because if that gap entry fails, then you know that the sequential SMT is probably going to fail, and then you know that you're probably, you know, maybe not on the right side of the market for that specific day. So yeah, that's sequential SMT followed by SMT-Fill. Now SMT-Fill followed by lower time frame SSMT, which is probably one of my favorite sort of things to see within the markets. You know, this isn't my specific entry model. I enter specifically off a sequential SMT plus a tCISD. And if you guys want to know my whole entire entry model, I am actually hosting a free live masterclass on the 6th of November. So if you guys do want to see that, make sure to sign up. First link in the description. It's in a few days. So I want to see all you guys there completely for free. Nothing to sell. I will see you guys there. But yeah, as I was saying, my entry model is a tCISD entry model. But what this is here is this sometimes will just occur, like coincide with my model anyway, because there usually will be a higher time frame SMT-Fill, and then a lower time frame SMT followed by it, and then a lower time frame tCISD, and then entry, right? It's just that sometimes there won't always be that SMT-Fill for my specific model, but if you incorporate the SMT-Fill, it will make it a little bit more high probability. So yeah, super simple. SMT-Fill on any of these specific time frames. So if we got a 4-hour gap, we'd want to see a 4-hour SMT-Fill, and then drop down to the 15-minute, so proper time frame alignment, and then you'd want to look for that 15-minute, that daily cycle SSMT to take place inside of the 4-hour gap along with the 4-hour SMT-Fill. Again, you know, let's go with another example. A daily gap, for example, we'd want to look for a daily SMT-Fill. So that's the first thing that we want to see, that SMT-Fill. And then we want to see drop down to the specific cycle time frame. So daily gap down to the 1 hour. The 1 hour is used for the weekly cycle. So then we'd be looking for SMT between days of the week. And then we'd pair that with the fact that we know they've got a daily gap SMT-Fill. And that setup will just be very, very high probability. So that's kind of knowing when and why a gap should hold. If it forms SMT-Fill, doesn't need to form the sequential SMT for it to hold the gap. The main thing is that SMT-Fill, but this is how we can utilize SMT-Fill with an entry model, essentially using the lower time frame SSMT. Okay, so let's jump into one small example that we've got right here down below, and then we'll jump straight into the charts, right? So as you can see here, this is the higher time frame SMT-Fill followed by lower time frame SSMT entry model. As you can see, 4-hour gap here. We've got variant number 3 of the SMT-Fill. So the left asset, let's say it's NQ, fills its gap completely, and the right asset, let's say ES, fails to fill the gap completely. So we can see this visually with our eyes in the 4-hour time frame. So we know we've got a 4-hour SMT-Fill, but we don't ideally want to enter off the 4-hour time frame unless that is your, you know, entry time frame. But what we can do is scale to a lower time frame, a 15-minute, for example. with the proper time frame alignment, 4 hour down to the 15. Look for, a daily cycle SSMT because we're on the 15-minute time frame. Once that takes place, you can then look for any entry model after that. So I like to use a tCISD, which was taught a few lectures back. So if you haven't already, go watch that. Because essentially, SMT-Fill, then we look for a sequential SMT, and then we look for a tCISD to confirm the sequential SMT. And this is realistically like one of the most high probability setups you will ever see, basically. Because you're getting a higher time frame respecting the gaps with a cracking correlation in the form of an SMT-Fill. Then you're getting a lower time frame cracking correlation in the form of a sequential SMT. And then you're getting a tCISD confirming everything, like combining everything together, letting you know, okay, price is most likely ready to turn around here because we're displacing. We confirm the sequential SMT. This gap will now most likely hold, and then we can go higher from there. So yeah, as you can see, super simple. Also keep in mind, as soon as this wick's put in, you don't need to enter directly at, to bottom tick the move. Like, you don't need to enter as soon as you see SMT-Fill. You can still enter a little bit higher up. I mean, you can even enter off this candle if you really wanted to. You can wait for this candle to close and then enter off this one. But that's probably a question some of you guys are probably going to be asking. You don't need to enter immediately, right? And you don't also need to wait for this candle to close to confirm the SMT-Fill. You can drop to a lower time frame and see if the lower time frame is telling you that price will most likely turn around from this gap. You may get stopped out, it may continue running lower, it may cancel out the SMT-Fill, so you really can, if you wanted to, wait for the candle to close, but you don't have to, right? Like, if this is happening on the lower time frame, this is already super bullish. Like, you don't need to wait for the closure. You can enter somewhere up here, inside of this wick, somewhere around there, So yeah, with that being said, that's one example, the proper time frame alignment, how to use it for the higher time frame bias, which is this case here. You can use a higher time frame SMT-Fills to gauge where price is likely to go, and then you can utilize that by using a lower time frame entry model. Or, for example, we can do the SSMT followed by SMT-Fill, which, we've got SSMT right here, then we've got our first gap forming here, and then literally just pretend that we've got an SMT-Fill there. Pretend this is NQ, it trades below the gap completely. Let's imagine ES only trades, into the gap slightly. That would be an example right there of a SSMT followed by SMT-Fill, okay? So super simple to understand. Now let's jump into the charts and show a few examples of both the higher time frame followed by the lower time frame, and then also sequential SMT followed by SMT-Fill. So yeah, I'll see you guys in the charts very shortly. All right, guys, so we're now inside of the charts, and I'm going to be showing you guys the charts, and I'm going to be showing you guys some examples. Firstly, we'll go over a few examples of SSMT followed by SMT-Fill, because what I've actually got here is within my quarterly theory toolkit indicator. As you guys know, it's very customizable. Link in the description down below. You can test it out completely for free. We've got an option to mark out the first fair value gap formed after SSMT, okay? So essentially all these green and red candles are on the chart is a bearish gap, the first one that forms after a bearish SSMT, and the green ones are the first one that forms after a bullish SSMT, okay? So yeah, as you can see, it will make it very easy to spot this in real time and also on backtesting as well. So firstly, as you can see, we formed a sequential SMT down here on the lows because YM did not run out. Q1's low, was very close. It was, essentially equal lows. But even when we look at ES, you can see ES did create a decent size value swing right there. Whereas when we take a look at NQ, as you can see, NQ ran out the low of Q1, and then where's our first gap that formed? It was indeed here. So then what you can do, you can go ahead and mark out that gap. Remember, the main thing is it must form on at least two assets. ES has it, NQ has it right there at the exact same time. And in this case, so does YM as well. 3 assets is fine, it doesn't really matter. Just as long as it's at least 2, because we need to compare it between the assets. So this gap, it looks like nothing traded into it, but if you zoom in slightly, you can see that NQ did barely just wick into it, whereas ES did not. And also YM clearly did not as well. So that was, an SMT-Fill there, right there. That was the variant number 1. One asset trades back into its gap, one asset fails. So you can wait for that candle to close and enter off this one, or you can enter as the SMT-Fill is occurring. If you want to place your stop on the invalidation point, it doesn't really matter. As you can see, it would have given, excuse me, a nice little 3RR right there. And, probably even further. Actually, no, not further, because this was literally Friday's price action. So this is how you guys know I'm not cherry picking any examples. We're literally just scrolling through previous week's data right here as well. bearish 90 minute. We are on the 5 minutes, so these are all 90-minute cycle SSMTs. As you can see, Q3, Q4, YM ran out Q3's high right there. NQ and ES both failed. Q3's high is all the way up there. First gap that formed, boom, highlighted red, mark out that gap. As you can see, let's see if any asset actually traded back into the gap. So there was no gap there on ES. Was there a gap there on YM? Doesn't look like it, no. So obviously the indicator only marks out the first presented gap, but then it's your job to check if there can be any SMT-Fill. In this case, no, it's only a gap for NQ. So let's keep scrolling. Here we go. We got a bullish one here. This is actually a different type of sequential SMT that took place as well. Let's see if we have a gap. Only a gap on NQ. No gap on YM either. So we won't go over that one. What about right here? We did get a gap there, form on both ES, NQ, and YM, but as you can see, no asset traded back within that gap right there. So let's keep scrolling. Bullish one there, but the SMT got cancelled out. We have, scroll down here. Okay, so we got a bearish one here. This is again a different type of sequential SMT. This is a hidden one, which we will go over very soon actually. So there's the gap there on NQ. Do we have the gap there on ES? ES is indeed there. Boom. And then on YM has a gap as well. Boom, as you can see. So this is Q4, Q1. As you can see, the SMT didn't actually take place through the wicks. Because this is actually a different type of SMT-Fill. No, sequential SMT, sorry, which we will go over in a later bootcamp episode. But just know that this is valid. It is a sequential SMT. This is what's called a hidden one. Essentially SMT between the bodies, between 2 consecutive quarters. Same concept, you can apply. If you guys already know what hidden is, you can apply SMT-Fill entry to that. First presented gap that forms. Right there, as you can see, NQ does fill the gap completely. Whereas ES doesn't quite fill it completely, and then also YM, I believe. Also, you can do this as well, middle line, so then you can sort of clearly see if it goes above 50 or not. YM doesn't go above 50, so we kind of got all 3 variants, 2 variants there, completely fill, and then 1 below 50. If you see this again, you know, it doesn't really matter, but I guess it just extra cracks in correlation. Stop can go on the high of the SMT, and then you can enter at the SMT-Fill for a very, very nice RR right there, as you can see. Okay, so yeah, let's keep going. Let's do one more example. As you can see here, we got a Q1, Q2 SMT, sequential SMT, I believe. Yep, this is a hidden one as well. We did get an SMT-Fill there, I do believe. Maybe not actually, no, maybe not there. Let's see what else we got. If there's no lines there, that means the SMT got cancelled. So I don't really want to show the ones where the SMT got cancelled out because, yeah, obviously the gap wouldn't be valid for the SMT-Fill entry. Okay, we got one here. This is actually a crazy one because NQ was like all the way down here, so you wouldn't really have entered off this one after seeing, you know, YM fill this gap up here. So YM filled that top first presented gap. Obviously NQ did not, but after seeing YM fill it there at 12.35, I mean, you could have entered there, you know, stop on the high, but it would have been, the RR just would have not been really it. You can see it would have played out for a really nice RR actually, but that would have been more of like a higher time frame trade. Like if price is so far away from its initial gap, when you've got one other asset given the SMT-Fill, you can just sort of skip it because, you know, the RR just really wasn't there. So yeah, so essentially that is going to wrap it up there for the segment of sequential SMT followed by SMT-Fill. As you can see, we didn't cherry pick anything. We was literally scrolling through. You can see some clean examples. You can see some not so clean examples. But yeah, if you apply it with, of course, like the correct daily bias, specific timings in the day, it can be a very, very powerful entry model. I mean, we can literally go to the hourly as well, and there'll be loads of clean ones here, like on the weekly cycle. Let's see. Let's see from this week here. I mean, look, yeah, you can see we had one over there, that first presented gap. We literally got one at the end of the day here as well. We got an SMT-Fill right there, so who knows, maybe open price just shoots up straight away. I am still bearish. I don't think it will, because remember, you still need to apply market narrative and logic as well. Don't just blindly take every single one of them. But yeah, hopefully you guys did find that useful. Now let's jump into a few examples where we're going to go from a higher time frame SMT-Fill to base our sort of entry model around that, and then see what price is going to do if it's going to form that lower time frame SMT instead of the higher time frame gap. So let's start with, I don't know, let's go for an hourly gap, okay, and then we'll stick it in replay mode, and we'll go all the way back down here. Cool. So then we can kind of see in real time it playing out the higher time frame SMT-Fill, and we can see the entry model that occurs inside of the gap. So as you can see, we've got a few hourly gaps below us here. So let's let it play out a little bit until we actually come into one of the gaps and see if we can base an idea upon that. So no SMT-Fill yet. No. Okay, there we go. I think we may have got something. Is that a gap there? It's a very, very small gap, but it is a gap. So it doesn't matter the size of the gap. As long as there is one there, then you can always look for the SMT-Fill as long as it's there in at least two closely correlated assets. So yeah, as you can see there, we have a fair value gap. It's there on NQ as well, and it is also there on ES. As you can see, NQ and ES did not trade back within its gap, and this happened, the trade back in happened at 3 a.m. So this hourly candle here, and as you can see, it did expand very largely to the upside. So hourly down to the 5 minute. So we go to the 5 minute here, and we traded back in at 3 a.m. So let's see if we had a 90-minute cycle SSMT take place. It does look like it, yes. So Q2, Q3, as you can see, YM ran out Q2's lows. Did we run them out? Actually, we may have run them out on ES and NQ as well, to be fair. We did, but we've got a different type of SMT, which is between the bodies. This is hidden sequential SMT, which, as you guys, we haven't gone over it yet. We probably will do that in a very upcoming soon lecture. But that is, just know that is a type of sequential SMT. And I mean, ever since we wicked in there at 3 a.m. anyway, any entry model would have worked here, right? I mean, we've got inversions over here. We've got gaps forming that price is supporting to go higher. As you can see, there's our first presented gap as well after this hidden sequential SMT. And then did we get an SMT-Fill inside of there as well? No, we did not, unfortunately, but that would have been clean. That would have been higher time frame SMT-Fill, lower time frame SMT, and then a lower time frame SMT-Fill as well. But in this case as well, in the example that I showed at the very start, you saw I used a lower time frame tCISD. So higher time frame SMT-Fill took place, lower time frame SMT, which is the 90-minute cycle, hourly down to the 5 minute, and then which candle created the SMT? Well, it would have been this one here. No, it would have been this one here, sorry. So this would be our tCISD, and as you can see, the indicator does actually mark it out for you as well. If we turn that on and let that load, as you can see, it's there for ES, and it's over here for NQ. It would be this one here. No, sorry, this one here at 3:05. So then you can go ahead. It gets confirmed there at 3:10. Wicks back in immediately after, stop on the low, and then you can see very, very clean trade there. So yeah, let's do another replay feature here, guys. Let's do a 15-minute gap. Let's do a 15-minute gap. We'll stick it in replay. Boom. Okay. So let's see what we've got here. And remember, like, your entry model can be anything different. As long as you've got that higher time frame SMT-Fill supporting the trade idea, then that's the main thing, So let's see if we've already got one here. I think we may have one in play already. Yeah, okay, we do. So you can see ES fills this gap completely. The same specific gap on NQ. Didn't even get traded below 50%, but even if it did, it wouldn't have mattered because let's say it came here. Would this, oops, my bad. Let's see if it just, say if it came here, right? Would that still be an SMT-Fill, guys? Yes, it would, because ES fills it completely, NQ does not, so that is a form of SMT-Fill, as you guys know. Also, you're probably wondering as well, what if the gap closes below the gap, for example? So as you can see here on ES, we close below the gap. You don't really want to see this, but if it does happen, it's not the end of the world. Just as long as it's only like one asset. If you see like two assets do it, then I'd be a lot more careful. But as long as, you see in the asset that's failing to trade into the gap completely, like fill the gap completely, as long as this is still showing strength to the upside, then that is still fine. So yeah, we had our SMT-Fill. This formed at 11 a.m. So now we go from the 15 to the 1 minute to look for a 1 minute entry model from 11 a.m. So it was the 11 a.m. candle, so it would be here. And as you can see, look what we formed, guys. This is literally perfection right here. We got a microcycle sequential SMT between Q2 and Q3. Literally the very first candle there of Q3, NQ runs below Q2's low. So does ES as well. And I mean, look at the entry model, guys. Like, look at that tCISD confirmed there at 11.16. Wicks back in, stop on the low. I didn't take this trade, but I think I remember watching this one play out actually. When was this? 20th of October? Yeah, I do remember this trade. Yeah, this was very, very clean. And yeah, literally, if you didn't want to take the tCISD entry model, you could have, even waited for like a 1 minute inversion right there to the upside. I mean, we've even got our first presented gap here as well, guys. Very small gap, but remember, as long as it's a gap, you can still look for that SMT-Fill. And look how cleanly that's being respected. Like, that's actually a joke. You can see, did we fill it completely on? Yes, we did. So we didn't quite get an SMT-Fill there. That's unfortunate. But again, first presented gap, tCISD, 1 minute inversion. There's so many entry models that you can use, and this is all based upon, it stems upon that 15-minute SMT-Fill. So this is why always check the higher time frame, see if there's an ongoing SMT-Fill, and then see if you can base your entry model upon that, And I mean, let's play out for a little bit, see if it would go much higher or anything like that. There you go. Look at that. Look at that. So literally from this 1 minute entry model, from the 15 to the 1 minute, you could have gotten 3.5R easily right there, So super, super clean, super, super powerful, and yeah, super simple as well. That's the main thing, literally anyone could trade this model. My personal favorite is the higher time frame SMT-Fill and then lower time frame entry model, like what we've been going over just now. So yeah, super powerful. For me, sequential SMT, I like to enter off the tCISD, so I don't really like an SMT-Fill there, but you can use that as like a continuation entry. If you miss that tCISD, you can look for that SMT-Fill after, basically. So can be very, very helpful, but my favorite higher time frame SMT-Fill, lower time frame entry model, because we know that price likes to respect gaps, and essentially SMT-Fill shows us when price is most likely going to respect the gap. And then once you know that, it's super simple. You can just drop to the lower time frame and take the entry. Yo, what's going on, guys? Welcome back to the 7th episode. Of the Quarterly Theory Bootcamp. Today we got a very special episode. We're going to be covering actually probably the most requested topic that you guys want to see from me, and that is daily bias, and that is what we're going to be going over today. So buckle up, get ready for this episode. It's going to be a good one, very, very informative. As always, I'll show you guys a few examples here, and then we'll dive into the charts and show you guys it working in real time. So yeah, without wasting more time, let's go ahead and jump straight into it. There's essentially two simple techniques that I like to use for my daily bias and for that higher time frame narrative. And essentially all that is candle closures and sequential SMT, more so when you're looking at the daily bias, because keep in mind this is fractal. What I'm going to be teaching you is fractal now. So if your higher time frame is, for example, a 4-hour candle or a 1-hour candle, you can just replicate this but on the lower time frame, right? But this is more or less for daily bias, what to anticipate that following daily candle is going to do using these techniques here. So like I said, two simple techniques. Number one, as you can probably see here, is candle closures, right? So candle closures, the way a candle closes is very, very important. Each candle closures tells us a story on what the upcoming candle is likely to do, right? And that is our goal as traders, to trade that upcoming candle, right? We're looking back at previous price action. How did this candle close? How can that give us information on what the upcoming candle is going to do, okay? So the first one is candle closures, and let me break down each of the sort of different ones that we can get, right? So there's a continuation one, reversal one, and a consolidation candle. So essentially how to anticipate the following candle is using the continuation one, is if a candle closes above the previous candle's high or low, and that's the wick, by the way, not the body, not close with the body, above the wick, right? If that happens, we can at least anticipate the following candle to trade to that previous day high or the previous day low, and more or less we can get that bias for the day and anticipate it to be bullish or bearish. So close above equals higher prices. As you can see, we've got one daily candle. This daily candle closes above the previous daily candle's high. The wick of it, mark it out, closure above, right? So now we're expecting this following candle to be a continuation candle, a bullish candle to the upside. Our first initial target is that previous candle high, because then once that's taken, we could be dealing with a reversal, or if the lower time frame doesn't show us that we're going to get reversal, then we can still keep expecting a continuation, okay? So look back on the previous candle. Did it close above the previous candle's high or low? If it did, boom, you know what you're looking for coming into that new trading day. Now, we've got a reversal candle signature, okay? So I like to call these candle signatures: continuation candle signature, reversal candle signature, consolidation candle signature. So the reversal one consists of a wick below and then close back above, and we can anticipate higher prices for a bullish scenario, okay? So what does this mean? As you can see, we wick below the previous day's low, but we don't close below the wick of it, right? Because remember, if we was to close below it, we'd expect a continuation day lower. Like here, we close above, continuation higher. We wick below, we take it out, we take liquidity, but then fail to displace and close below the previous candle's low, right? And then boom, what does that tell us coming into the upcoming candle? Well, if this candle reversed, what do we usually expect after a reversal? Manipulation. You can see this as we expect distribution, right? So that can give us the bias on this upcoming day here based upon the reversal candle signature here, okay? Now, those are the two main ones that you want to keep in mind. Now we've got a consolidation candle signature, and this is when we fail to take the previous day's high or low. And once that happens, usually the following candle, the third one, is pretty volatile. What it will do more times than not is take both sides of the range. So it will take the consolidation range as high and then the low, or the low and then the high, it doesn't matter. Or it will either be very, very expansive to one side, right? So in this case, it could have easily just expanded aggressively to the upside and gave a very large range candle, okay? So those essentially are the three candle signatures: continuation, reversal, consolidation. Feel free to take a screenshot of those. I'll make sure it's all in picture. Screenshot that, take note of it. Very, very important. And again, like I said, it doesn't need to be for daily candles. This can be the 4-hour time frame. This can be the 2 o'clock candle. This can be the 6 o'clock candle. And then boom, you've got bias for the 10 o'clock candle, right? But I like to use this for 4-hour candles and also daily candles as well. You know what to expect coming into the new trading day. However, these candle closures alone, they can be enough. Like, you can call it a day there and just use the candle closures. And I'd say with like a 70% chance he's going to work out using just these signatures here. Literally go back in your charts and have a look. Like, we'll be doing that shortly, and I'll show you guys how powerful it really is. Oops. However, if we now incorporate the quarterly theory sequential SMT with these candle closures, then we get a very, very powerful indication of what the bias is likely to be for that upcoming candle, okay? So, as you guys know, sequential SMT, if you don't know what it is, go back and check out that bootcamp episode. But more or less for daily candles, we want to see either a monthly cycle sequential SMT or a weekly cycle. Weekly cycle is the best because we know that weekly cycle is SMT between 2 consecutive daily candles, right? So imagine this now, right? We form a weekly cycle sequential SMT. This is Q2, Q3. So we form it on Wednesday, right? Sure, you can go ahead and take a long on Wednesday after seeing this. Cool, that's fine. But what this will also do as well is tell you when the following candle is most likely going to be distribution, right? So we know that we expect distribution after a manipulation quarter. However, if we don't get the manipulation quarter, which is the daily candle, close in the specific candle closures signatures that we went over, then it's more likely than not going to fail, right? It's going to, it may give a move, but it's most likely not going to give that distribution that you could be expecting, right? So weekly cycle SSMT takes place on Wednesday. We can take along on Wednesday, but also we can get the bias for Thursday based on how Wednesday closes, right? Imagine this being Wednesday. We manipulate Tuesday's low. We have a weekly cycle sequential SMT. And then, because we get that reversal candle signature, the bullish scenario, we take the low and fail to close below the low. Then we can anticipate this following candle, which in this case will be Thursday, to distribute to the upside, because we can see we've combined sequential SMT, which we know Q3 manipulated in terms of the weekly cycle. So we expect Q4 distribution. And not only that, but we've got the daily candle signatures closing, aligning with our bias, expecting that distribution within the following quarter or following day. Okay, so that is essentially it in super simple form of how I use candle closures with sequential SMT. If you've got a, for example, say we don't have a sequential SMT on these lows here, it's more harder to trust this as a reversal candle signature and expect higher. And also vice versa, if we have a weekly cycle sequential SMT, but we get like a continuation candle closure to the downside, it's hard to trust this bullish SMT will hold. So ideally, we want to see them both aligning together, okay? But if I really had to choose one, I would say the way a candle closes is more important than sequential SMT. Like, say there was no sequential SMT here, right? Like, we can still expect distribution within this day here. What you could be expecting as well is potentially this low to get ran one last time and then sequential SMT to form. because like I said, it is better if we do have them two combined together. But either way, you know, you can pick one and just use that only, or you can combine the two and then get a very, very powerful interpretation of what the daily bias is likely to be, right? So we got one more example here of how we can sort of trade, you know, a weekly profile, right, using candle closures and sequential SMT, right? So imagine this is all daily candles, right? So looking at the closures alone, you can see Tuesday gives a bullish reversal candle signature to the upside. So we'd expect Wednesday to distribute higher. And then Wednesday also closes above Tuesday's high, which indicates what? Thursday is a continuation higher. Same again with Thursday closing above Wednesday's high, indicates Friday is a continuation higher. And as you can see, that played out perfectly. But if we go a little bit deeper, drop down to the hourly time frame, you'd be able to see we actually formed a weekly cycle sequential SMT between Monday and Tuesday. And then we had that bullish reversal candle signature aligning with it. So very, very high chance of Wednesday being that distribution. Easy longs coming into Wednesday, you know, super simple. And then accumulation, manipulation, distribution, continuation, because we got the continuation candle signature as well. And also in terms of quality theory, AMDX, distribution on Wednesday, continuation on Thursday. We wouldn't be expecting a reversal on Thursday. Why? Because you can see Wednesday closed above Tuesday's high, so we'd expect a continuation. Then Friday could have easily been a reversal, but why wasn't it? Because if we look at Thursday's close, it closed above Wednesday's high, so it indicates a continuation higher, okay? So remember, wick below, closure back above previous candle. So what this means as well is close above, closing inside of this previous candle's range anywhere, okay? So it doesn't just need to be the body or the wicks or anything like that. As long as we wick below, take out, you know, the previous candle's low or high, and then the body of this candle closes back inside of this candle's range, okay? So it can't close below the wick. If it closes below the wick, then that's a continuation indication to the downside, okay? So yeah, hopefully this all does make sense, guys. But what we can go ahead and do now actually is jump into the charts, open up the daily chart for indices, and literally go through every single daily candle closure that we've had now for a few weeks and just show you how powerful this stuff really is. So yeah, let's go ahead and jump straight into the charts right now. Alrighty guys, so we are now inside of the charts. We're looking at NQ on the daily time frame, of course. And what we're going to do, we'll just go scroll through some price action. Just first of all, looking specifically only at the candle closures. And then what we'll do is we'll pull up 3 charts and then see if we can add any sequential SMT onto the candle closures to see if it would, you know, make it higher probability. What maybe if a candle closure signature failed, maybe it wasn't supported by sequential SMT. So yeah, let's go ahead and dive into it and see how these things work, okay? So this is literally the past week's price action. So this whole run higher could have been predicted through candle closures. Close above, higher prices. As you can, oops, that is the wrong thing. Close above, higher prices. Close that down. There we go. Close above, higher prices. Yeah, we've got the higher prices. And then what happens? Reversal candle signature. As you can see, we do indeed get that bearish day. Does take the high and the low, because, you know, this isn't going to be 100%. Like I said, more or less like 70-80% of the chance of the time this works, sorry. And then you can see here, we get the consolidation candle. Well, not really consolidation, because consolidation is where you stay inside of the range and you don't take the high or the low. In this case, we took the high and the low. So this can be seen as a bearish reversal candle signature and also a bullish one, because we take the low, we take the high, we close back inside, right? So it could be a little bit tricky, but what we can actually do is see if that swing point is see if it's supported by any sequential SMT. So the swing point was there on the Thursday. So did we get any sequential SMT on the highs or the lows? So the lows of Wednesday got ran out on all assets, but Wednesday's high got ran on NQ. Did Wednesday's high get ran on YM? No. Okay. So we got the bullish and bearish reversal candle signature, but we have a bearish weekly cycle sequential SMT to support lower prices. So that's how we can filter out which swing points to trust, which continuation candles to trust, which reversal candle signatures to trust. Okay. So we'd expect lower prices coming into this day. As you can see, we didn't take out the previous day's high or the low. So we got a consolidation day, an inside day. And then, so we'd expect this following candle to be pretty aggressive, take the high and the low, or expand to one side aggressively. But in this rare case, we got 2 back-to-back inside candles, which is very, very uncommon, but not impossible, as you can see. But then, because we had 2 back-to-back, we know that we'd expect the following day to be super, super expansive And look what happened. Tuesday was the largest range of the week because it was followed by 2 accumulation days, 2 inside days, followed by an insane expansion day. Okay, and then what did Tuesday do? Close below Monday's low. So we'd expect Wednesday to deliver to the downside. Remember, our first initial target, if we get that continuation candle, almost guaranteed that previous candle low. So if it's a bearish continuation signature coming to that following day, almost guaranteed expect that previous day low to get taken. Okay, as you can see, once it gets taken, then monitor the lower time frame to see if we're going to continue lower or if we could potentially reverse higher, right? So did we form a weekly cycle here? Did we get a daily? Did we get a 90? If we did, they're all reasons to potentially pull back up. Okay, but if we don't have any of that, expect lower and lower and lower. So this candle gave a bullish reversal candle signature to the upside, and you can see didn't end up working because, like I said, not 100%. But let's see if this had a weekly cycle SMT on the lows to support higher prices or not. Okay, so this was Tuesday's low being ran out on Wednesday by NQ. Tuesday's low didn't actually get ran out there on YM, as you can see. And then Tuesday's low for ES did get run out. So we had a bullish reversal candle signature and a bullish weekly cycle, but this one was one of those unfortunate ones where it did just fail, right? You know, like I said, not 100%, but very, very high percentage. But then, as you can see, we get this candle ran below previous day low, failed to close below it. And then if we check out as well on ES, again, ran below the low, failed to close below it. So what does this candle show us? This is a bullish reversal candle signature to the upside. However, you want to see more or less like a larger wick form. In this case, it is technically, mechanically, a bullish reversal candle signature to the upside, but very small wick, and also it wasn't supported by a weekly cycle SSMT, okay? Hence why it didn't hold as a swing point, and then we got a continuation lower, okay? Now we got another swing point form here, bullish reversal candle signature, closure for, what day is this? Friday. So coming into Monday, what could we expect? Potential higher prices, right? However, we don't have a weekly cycle SSMT on this low or a monthly cycle. So I wouldn't expect this swing point to be like the low here. I'd still expect price to continue lower and lower and lower, but this doesn't mean that we can't at least get a retrace. And looking at this, like I said, bullish reversal candle signature, we can almost guaranteed expect that previous day high to get taken. So what I would think is more or less something like this, okay? Take that previous candle high, complete the bullish reversal candle signature, potentially form a bearish reversal candle signature for Monday or Tuesday, and then keep dropping lower because we don't have a cracking correlation to support this swing point to hold for a full-blown reversal higher. In my opinion, it could happen, but that's just my thoughts. Okay, so what we're going to go ahead and do now is literally scroll through some price action, just looking purely at the candle closures, okay? So as you can see, huge expansions higher. It's just more or less always there. Closure above, higher prices. We got reversal one there, didn't quite work. Inside candle here, expands, close above the high. Then we get higher prices, close above, higher prices. We got the previous daily high taken, then reversal candle signature. Then, you know, we'd expect lower here, targeting at least that previous daily low because it's a reversal candle signature. The previous daily low got taken. How do we close? Bullish reversal candle signature. So we'd expect this day here to continue to the upside. Let's delete these drawings. Then how did this candle close? Continuation, higher prices, continuation, higher prices, continuation. This day, inside candle. So what do we expect? Expansion to the downside. How did it close? Continuation lower. As you can see, this candle here as well. Sorry, this one closed below, and then this one gave us that bearish day. And then that bearish day gave us at least a previous day low. That's the main initial target. Something on the lower time frame must have happened here to allow for this daily candle closure to close as a reversal. And then we'd expect higher this day here. As you can see, inside candle. So the following day expands aggressively to the upside. Inside candle. This case is where we get the scenario of previous day low taken. Then go for the high. So both sides of the range taken. How do we close? Above, higher. Okay, you guys get the point. You literally can go back in your charts and just see this. It's literally almost always there, right? It like you're gonna get one of the candle signatures. So if you just trade in line with that, like I said, 70-80% chance, in my opinion, of this, you know, actually working. Combine that with sequential SMT, you are good to go. Okay, so yeah, hopefully this video did make sense. Now you guys can come into each trading day with a solid daily bias, and then you compare that with the concepts that I've already taught you, build your own model, or you can wait for some future bootcamp episodes where we're going to be diving into some models. And daily bias is a very important piece of the pie. If you don't know what that is, the daily bias, then more or less the concepts and the model is going to fail you. But if you trade in line with the daily bias, then you should be good to go, okay? And remember, previous candle high or low is that main initial target. Then look if we're going to continue or reverse on the lower time frame. tCISD, the true change in the state of delivery concept, allowed me to trade for just one singular hour the whole entire week, allowed me to catch 3 trades, and every single trade that I took this week was a winning trade. So 3 trades, 3 wins. How did I do it? How can you guys use the tCISD concept? We're going to be going over some gems and kind of breaking down how it works, and then we'll jump into the charts and give you guys a rundown on the exact trades that I took using my exact framework for the tCISD. So the foundation of the tCISD is the timing element, okay? Understanding that less is in fact more within trading. The longer that you're on the charts, the more likely you are to, overtrade, take a bad setup, whatever it may be. Most traders think that more screen time equals more money. So they sit on the charts all day long, overtrade because of it. Like I said, take mediocre setups, force trades that might take a win and then take another trade just out of pure boredom and give their profits back. But the truth is, your edge lives in one singular 90-minute window per day, right? If you can master the timing, then less genuinely becomes more. As you guys can see again, 3 trades, 1 hour spent total across all 3 trades, not 1 hour for each trade. That's 1 hour across the whole entire week. And that totaled me over $4,250. It was actually a little bit more. It allowed me to pass one 50k account to get 50k in more funded capital. It allowed me to request 1 payout as well. And also, I'm now 1 trade away or 1 win away from requesting a second payout across a different account that I've got. Okay, so these were the 3 trades that I took this week. Just screenshots. We're going to dive into the charts in detail shortly. But nice simple win right there. Nice simple win right there. And a nice simple win right there. Okay, and these results that you guys are seeing right here weren't only made by myself, but also many of my students inside of my Discord absolutely crushed it this week. And on a quick note, just before we do continue, the quarterly theory A to Z guide by myself, 80 pages of pure content, absolutely free, is now linked down below in the description. Over 2,000 traders have claimed it already. So if you guys do want access to that, click on the top link in the description and you will get free access to everything. The concepts I use, the models, how I trade prop firms, psychology, everything. Okay, so now let's move on to the next page, which is it's either there or it's not. That's the beauty of the tCISD concept. The concept itself is mechanical. There's no opinion, there's no second guessing. The shift either prints or it doesn't. No analysis paralysis. You check one thing, did it print, yes or no? Okay, so the tCISD essentially is the very first candle that creates a sequential SMT. So step number 1, sequential SMT must form. Step number 2, which was the very first candle that created the sequential SMT. Once you've identified that, mark out the open of that candle, then simply wait for price to close below that open that you have marked, and then your tCISD is valid. So like in this example right here, sequential SMT, the candle that created it was this big bulky one here. Bear in mind, it doesn't need to be bulky. Mark out the open of that candle. Price closes below it here. Retest the tCISD candle itself right there. That is then when you look for that short, and then you take the short down towards the drawn liquidity. Okay, super simple. There's no second guessing. The tCISD is there or it's not. If it's not there, you don't take the trade. So here's an example here of no tCISD. We have the sequential SMT, but did we ever close below the candle that created the tCISD? Well, which candle created it? It's this line here that I have dotted across. This is the previous quarter high. This is the new quarter. This big bulky candle took out the previous quarter high. But did we ever close below the open of that specific candle? So this is the bearish tCISD, not yet confirmed. No, we did not. Therefore, would you have taken a short? No. And was that a good idea? Yes, because price did not reverse, because we never printed the shift, the tCISD concept that indicates that shift back lower. Okay? Simple as that, guys. Now, the final piece that you were missing is the tCISD, and I can promise this to you guys right now. If you at least trade quarterly theory, I can guarantee it almost is. Even if you don't trade quarterly theory, I have students of mine that incorporate the tCISD entry technique that trade, order flow or trade like basic ICT, because it's just so powerful. And especially people that do trade quarterly theory, I get countless messages every single week, people saying the tCISD has changed everything for me. It's the final piece that was missing, and it truly is. It helped my trading massively as well. And, there's obviously a reason for that. It's just such a mechanical, like a sequential SMT forms, but like when do you enter? Do you enter for the PSP this time here? Do you wait for a swing point to form? Do you enter off an inversion? Do you enter off a gap? Like all those are viable. Either pick one or just go with the tCISD. Now, the sequential SMT shows you guys a divergence, and the tCISD confirms the divergence. It confirms that price is now ready to shift back lower, right? We know that sequential SMT marks our highs and lows of the cycles, but how do we confirm that? That is through the tCISD, right? And then if you stack these two concepts together, you stop guessing where and stop knowing when. And again, that's what a lot of traders struggle with. They'll know the concepts, but they don't know when to apply them. They don't know when they'll work. They don't know when they'll fail. They have no idea like why it failed. And that is the exact moment that most traders never had. The aha moment, okay? That moment that all traders eventually get within their trading when they've been trading for so long. They'll find something that finally clicks. And for most traders that trade quarterly theory at least, the tCISD is exactly that, okay? Now let's jump into the final slide before we dive into the charts, okay? And the final slide is not every asset has to confirm, right? And essentially what this means is if, for example, NQ confirms its tCISD, that's enough for you to, for example, enter along on ES as well, okay? ES doesn't have to have confirmed its tCISD if NQ already has. And vice versa. If ES confirms its tCISD and NQ hasn't yet, you can still take that long position on NQ. Okay? Now, the one scenario that you do need to be looking out for is if only YM confirms its tCISD, just wait. Okay, so say, for example, YM confirms a bullish tCISD, NQ hasn't yet, I wouldn't then jump into a long on NQ because most of the time, YM can do its own thing. Okay? It's a little bit weaker compared to the NQ-ES correlation, and you can apply the same logic as well across the triads. So gold, silver, copper. Copper would be the YM, so you'd want to wait for gold or silver to at least confirm. If you trade the forex triad, it'd be same with Euro USD, GBP USD, and DXY. GBP USD is like the YM, so wait for Euro or DXY to confirm, then you're good to go. Okay. So essentially, let at least NQ or ES, or the two most correlated assets from the triad, confirm first. And by the way, it doesn't need to be both of them confirmed. Remember, it can just be one. So as long as NQ confirms, that's enough to take along on ES and YM. Or if ES confirms, you can take along on NQ or YM. Okay? Now that one rule filters out the weak tCISDs, right? You're waiting for one of the stronger, more correlated assets from the triad to confirm the tCISD for the rest of the triad, essentially. Okay? Now, best case scenario is, all assets confirm at the same time. However, I've taken many trades on NQ with no tCISD because I can see that ES has confirmed it, and I'm now confident that NQ will follow suit with that, essentially. Okay? So, with that being said, there's a few little gems for you guys at how to trade the tCISD. Now, let's dive into the 3 winning trades that we took this week that totaled me over $4,250 in profit alone. Alright, so this is the first trade that we took on the week. Monday we just skipped because, there's nothing clean on Monday. Tuesday is when we took our first trade, okay? Now, I begin trading at 9 a.m. and my window is 90 minutes long. Like I told you guys, stick to one singular 90-minute window. For me, 9 to 10:30. But that doesn't mean I'm on the charts from 9 a.m. all the way up until 10:30. That means I need to find a setup of mine, if it even occurs, within that window. The second I've taken the setup, whether it's a win or a loss, pretty much I'll just hop straight off. Okay, so in this scenario for this week, I took 2 of my trades before the 9:30 open, hence why it's literally like a 15-minute trading day. Okay, so 9 a.m. right opens up here, and I'm going to put it in replay mode for you guys, walk you through my exact step-by-step process. I'm not really going to go over like the higher time frame, top-down analysis, etc. I can see that Tuesday I took a long, so obviously I've came up with some sort of bullish bias, and now I'm going to stick with that and look to take a long. Okay, now you can watch my other YouTube videos that break down the narrative, the draw on liquidity, etc. If you do need help with that, but this is the entry technique, the tCISD itself. Okay, so let's let this play out. Obviously, first things first, we need a sequential SMT. Okay, so let's see if one forms. Boom. Sequential SMT forms right here between Q4 and Q1. Right now, which candle first ran out Q4's low? It was NQ, right? YM has not taken Q4's low, neither has ES. NQ did. Now, NQ took it off this bullish candle here. Now, again, this is something that you guys need to know about the tCISD. In a bullish scenario, the candle that creates the sequential SMT ideally has to close bearish, okay? And then in a bearish scenario, ideally closes bullish. Now, if it doesn't, and in this case it didn't, this candle created the sequential SMT, but it closed bullish. So in this exact scenario, we use the most recent bearish candle to our left, and we mark out the open of that and use that one, okay? So in this scenario, it is this candle here. Now, price immediately created the sequential SMT and closed above that candle high straight away. Then we did close back down below it, right? So I hadn't taken the trade by them, but if we play this in 1x now, my thought process here, forgetting what I even took on Tuesday, is if I now see price close back above here again, then I will look to take a long, okay? So let's see if we can do that. Bear in mind, if we don't close back above it, right, and the sequential SMT fails, then this is no longer valid because the tCISD is no longer there if there's no sequential SMT to support it, right? As you guys can see, we just about failed to take it right there. So, you know, we still wouldn't be in just yet. Wait for that next candle potentially. Still no entry, right? Like, this is the thought process. This is what I'm thinking the whole time. Still no entry. Still no entry. Still no entry. Still waiting. Boom. We closed above it, okay? So now this tCISD is valid for an entry, okay? So we can mark out the body of this one here, and simply all we do is wait for price to come back into the tCISD, retest it, and then look to take a long, right? So let's see. Boom. Price comes into it. Now, I remember exactly what I did here. Usually, I will wait for price to retest the tCISD and then enter there. In this scenario, I was very, very confident that we would literally just trade away from the tCISD immediately. So I just entered a little bit of position here and then added more if we was to get back above it. Okay? Essentially, my entry was around about here. Stop on the invalidation low. And we targeted just a simple fixed 2RR. I think the entry was a little bit better, to be fair. Down here, because I remember this one hit the 2R and then it didn't go too far above it, and then it did reverse back lower, I believe. Okay, so stop always on the invalidation. For example, things like this. Okay, I know that we got edged, but then price did end up coming back up. Not looking great, not looking great. And then boom, as you can see, it does recover nicely. And that is our TP hit right there, okay? And all we need is 2RR, guys, and you can simply get 2RR from a tCISD most of the time if you do trade it in line with that, higher time frame narrative, okay? And that's it. Super simple, done before the 9:30 open, literally 23 minutes into the day, and we're done. That's it, okay? Payout secured, we're hopping off. Right? Simple as that, guys. Okay, now let's jump into the next trade, which was actually on Wednesday, and then I think we took one on Friday as well. Okay, so let's jump into Wednesday trade right now. Now here we are on Wednesday's price action. As you can see, 9 AM, sharp, nice and sharp, ready at 9 AM to begin trading. Okay, we hop on the charts, we go live for the Discord. So if you guys do want to trade live with me, check that out in the description down below. You can test it out completely for free as well. And I'll see you guys inside of there, okay? 9 AM, this is a little bit different of an entry. It wasn't the tCISD specifically, it was actually an inversion tCISD, okay? But everything that we spoke on in today's video applies exactly the same for the inversion tCISD as well, okay? Now, this one was actually a short, and all that happened was bullish sequential SMT down here on the lows. Which candle created it? This one here on NQ. Mark out on NQ. Mark out the open. As soon as price closes above it, that is a bullish tCISD. Okay? Boom. Marked out by the indicator, which you guys can grab in the description down below too. Now, if we're bearish, which I was here, because we're delivering away from a 15-minute gap, we wait for price to close now below the close of the tCISD candle. Okay? So let's let that play out. As you guys can see, now it's closed below. So all we simply do is wait for a small retest of the inversion tCISD. Boom. Entry. Stop on the swing high before the inversion tCISD took place, and target what? A simple 2RR. And if we just let that play out, you guys will see nice, quick and easy TP. Again, completely smash right before 9:30 open, and this was literally 11 minutes into the day. So we're at a total of 35 minutes just between these two winning trades that we had on Tuesday and Wednesday now. 30 minutes in 2 days, guys. Friday was actually one that took a little bit longer. We took that one after the open, hence why it's actually an hour of trading on the week. But it could have been just 30 minutes how we've just taken those two trades, right? But with that being said, let's now jump into the final trade, which was taken on Friday. All right, so we're now on the final trade of the week, which was, like I said, taken on Friday. Here we have a bearish sequential SMT, which candle first created the sequential SMT. It's this one here, okay? 927. What do? Mark out the open of this candle. As soon as price closes above it, that indicates what? This can be our reference point where we can enter short from. So we can also mark out the body just like that. Wait for price to pull back into it and take a short. If we're bearish, that's all we have to do. This is what I mean, guys. This is the final missing puzzle piece for you guys. This is how you enter a trade based on sequential SMT. Sequential SMT, we're now inside the tCISD. Now, it was quite volatile on this day. I could have just entered immediately here after seeing this rejection. Stop up there, 196. A little bit too much for me. So what do? The candle that rejected away from the tCISD, that now becomes my stop loss placement. And I enter with the following candle when it opens up high and then run it lower. Okay, so wait for this candle to open. Short when it pulls up. Stop on the recent swing high that rejected from the tCISD. And in this case, we actually target the bottom of this gap. Around about 3 to 5. It was actually a 3.8R. I remember doing this one on live again. And this one again hit in like a few minutes. Like, boom, done. Okay. Is that easy enough for you guys right there? I mean, come on, guys. Everyone, like literally a toddler could take a trade like this. It's so simple. Do not overcomplicate your trading, please. Okay, but with that, yo, what is going on, guys? Welcome back to a new video. Today we have a very special, highly requested video from you guys, and that is going to be breaking down, covering from A to Z, the inverse tCISD, the iTCISD concept, a concept founded by myself, which originates from another concept that I found myself, the tCISD, the true change in the state of delivery. Right, so what we're going to be doing is breaking down how it actually works, showing you guys how I've requested many payouts, not only myself as well, but many of my students, and also a lot of you guys as well that have consumed my content on my YouTube already, have passed many funded accounts, got many payouts, and have found great success already with the regular tCISD. So now the inversion one just takes it to that next level. It's a slightly more advanced entry technique, but when used correctly is very powerful, and can also frame the narrative and also the bias for you. And I like to say that the inversion tCISD is the way that you master continuation trades. So with that being said, let's go ahead and jump straight into it. I've compiled a nice little slideshow for you guys, and then we're going to jump into the charts and break down some examples in real time. So let's jump into it. So firstly, the elements behind the iTCISD, okay? Literally two simple steps. I know that you can see three here, but one's just for the bearish version and one's for the bullish version, okay? So step number one, super simple, a regular tCISD must form, okay? That's it, right? Now, if we're looking for a bearish iTCISD, so a bearish inversion tCISD, the close of a bullish tCISD candle must be closed below, okay? And then for a bullish iTCISD, the close of a bearish tCISD candle must be closed above. So that may sound a little bit confusing at the moment, but not to worry, we're about to jump into some chart examples and show you guys how it actually works. And when you see it visually, it will be a lot more, easier to understand. Okay, so step number one for the bearish inversion tCISD, as you guys know, a regular bullish tCISD must form. Okay, so in a bullish SSMT scenario, in this case here, bullish SSMT, the candle that creates the sequential SMT must close bearish. In this case, as you can see, it does, right? If it doesn't, then use the most recent bearish candle prior to the sequential SMT. So that's just a regular tCISD, okay? Then what we do is mark the open of the tCISD candle and wait for a closure above it, okay? So this candle created the sequential SMT. In this case, it closed bearish. Mark out the open, wait for a close above, boom. That is a regular bullish tCISD, okay? Now, you're probably wondering, how do we get the inversion, the bearish inversion tCISD from this? Super simple, okay? All we need to do now is, look at this, okay? The close of a bullish regular tCISD candle must be closed below, okay? So the close of it must be closed below. Okay, so the open is closed above for a regular tCISD, and then once that's formed, the close of the tCISD candle must then be closed below. So here's a very clear visual example from before. Sequential SMT bullish, mark out the open of the candle that created the sequential SMT, close above right here, confirms the bullish tCISD, right? And then the close below the close, so this tCISD candle got closed below right here, okay? And that's it. That is a bearish inversion tCISD. You can then enter immediately after the close below or wait for a retest of the iTCISD. So you can enter as soon as this candle closes, or you can wait for price to pull back into the inversion tCISD, which by the way is the whole body of that tCISD candle. So we can come all the way back up here. As long as we don't close back above the open of the tCISD, then the inversion tCISD is still valid and you can look for an entry inside of it. Now, stop loss placement. The best one is to have it on the recent swing high before the inversion tCISD took place in a bearish scenario, or have it on the recent swing low before the bullish inversion tCISD took place, right? Those are going to be your best stop loss placements. You can, play around with it and figure out what works best for you. Maybe have a larger one, maybe have a smaller one, but the invalidation one will be more or less on the high, because think about it logically. If the tCISD has been inversed, we shouldn't then come back above it. Okay, so that's the reasoning behind having it on that recent swing high before the iTCISD took place. Okay, so super simple, guys, but don't worry if you're still feeling a little bit confused. We're going to go over a few more examples and then we'll jump into the charts. It is very simple, but very powerful when used correctly, in line with narrative bias, which we're going to break down in just a moment as well. Okay, so now the step one for a bullish iTCISD, a bullish inversion tCISD. Firstly, a regular bearish tCISD must form. Okay, so think about it this way. If you're looking for a bullish inversion tCISD, then you must have a bearish regular tCISD form. If you're looking for a bearish inversion tCISD, then you must have a regular bullish tCISD form. Okay, that's it. Super simple. So in this case, we're looking for a bullish one, right? So we're then waiting for a bearish one to form, a bearish regular tCISD, which, as you can see, sequential SMT, candle that created it, closes bullish, mark out the open, wait for a close below, boom. Bearish tCISD, simple as that, okay? So in a bearish SSMT scenario, as you can see right there, the candle that creates the sequential SMT must close bullish, right there. If it closes bearish, use the most recent bullish candle prior to the SSMT. In this case, we don't need to do that. Then mark out the open of the tCISD candle, open, wait for a closure below, okay? That's a regular bearish tCISD, which must form before we can get a bullish inversion tCISD. So think it's the same as any other PD rate, right? An inversion gap, right? What do you need to see before you get a bullish inversion gap? There has to be a bearish gap that gets closed above. Same concept with the tCISD, but instead of using gaps, we're using tCISDs, okay? So bearish tCISD formed, and then for the bullish scenario, the bullish inversion, all we're doing is waiting for a close of a bearish tCISD candle above. Okay, we're waiting for price to close above the close of that bearish tCISD candle. So mark out the open, closure below, activates the bearish tCISD, and then mark out the close, and then as soon as we close above it, that activates the bullish inversion tCISD. Okay, so a candle must close above the tCISD candle's close, right there. You can then enter immediately after the close above, so you can enter after this candle closes, stop on the recent swing low, or you can wait for price to drop back into the inversion. You can wait for price to drop back into the inversion tCISD, which happens right there. Again, stop on that swing low, and then look to take it up higher, right? So hopefully you guys did find that useful, and it is making sense. But now what we're going to do is jump into some examples. We've got one more slide here, which shows you a full-on example, and then we'll go into some real charts, right? So here is an iTCISD example. This is in a bullish scenario. So we're still going to be applying everything that I've taught on my YouTube so far. So like narrative, daily bias, direction, draws on liquidity, etc. That's the most important thing. Where's price drawing to? So higher time frame, let's say in this case, our narrative is bullish, our draw on liquidity is bullish, our daily bias is bullish. How are we then going to take a bullish inversion tCISD entry? Simple. All we're going to do, as long as the draw is still there, intact, and as soon as we see a bearish sequential SMT formed, confirmed via a bearish tCISD, all we're doing is just waiting. We're waiting for price to close above and invalidate the bearish tCISD, because that's all it is. It's invalidation of a tCISD, which creates the inversion one. So price closes above the close of the tCISD right there. As soon as we see that happen, enter immediately, stop on the low, or wait for price to drop back into the inversion tCISD, stop on the low, target the drawn liquidity above, okay? Because think about this logically, right? Narrative's bullish, drawn liquidity is bullish. Every single sequential SMT that doesn't align with that narrative, that bias that we've got, so every single one that isn't bullish should just act as a retracement. So we're waiting for price to retrace, and then we're waiting for price to show us that the retracement is over by forming the bullish iTCISD, and then we're entering inside of it, placing our stop on the low, because we then don't expect price to drop back down below the tCISD, because this retrace has already happened. The short-term manipulation is over. Price is closed back above it, indicating higher prices. And also, you know, something else as well that may make things click for you guys is think about this logically. What does a bearish sequential SMT indicate? What does a bearish tCISD indicate? A bearish reversal, okay? So, you know, if we're actually going to be bearish and drop lower, what should they do? Those concepts, the SSMT and the tCISD should hold and allow price to trade into it and then reject lower from it, okay? So, yeah, cool. If that's happening, amazing. You know, we are bearish. But if that fails, what does that tell you about price? It tells you that price isn't actually ready to turn around yet, indicating that price is more likely just going to target whatever liquidity you've got resting above you, okay? So if this fails, right, and the bullish iTCISD forms, that means that price isn't ready to turn around yet. So that means it's more likely to hunt some more liquidity on the highs. Then maybe we could reverse after that, okay? So this is why it's so powerful. And this is the best scenario that I like to use it in myself personally, is when we're very close to a higher time frame draw, and then we form a opposing sequential SMT, then we get that iTCISD after. I'm like, okay, well, there's no reason why we can't run to the draw now, so I'm gonna just take this, okay? Simple as that. Super, super simple. And I also now incorporate this into my 90-minute tCISD model. So, you know, the time window, the bias narrative that I taught you guys, one sequential SMT, and then I can either take a regular tCISD entry or an inversion tCISD entry, okay? So I'd recommend for you guys to sort of test this out, you know, see how you like it. But so far the feedback has been amazing from my mentorship students, and they've, you know, already been getting payouts and funded accounts using this specific concept here. So there's no reason why you guys can't as well. And if you guys do want to apply to be mentored by me, link below in the description. But with that being said, now let's jump into some actual chart examples in real time and just show you guys really how powerful it is, okay? So let's jump into it. All right, guys, so we're now inside of the charts. In this example, we're going to be taking a look at NQ. I'm not going to be showing any like hindsight sort of like trades, inversion tCISDs or anything like that. I've got my own tCISD indicator. And we're actually going to be adding the inversion tCISD function to that very soon as well. So if you do want access to that, pick it up in the description down below. But what I'm going to do is just literally scroll through price and just show you and, you know, get you guys to sort of understand how we could be utilizing the inversion tCISD, okay? So every single tCISD that we see here is just a regular one, right? So if we see a bearish tCISD and then a closure above it, that means it becomes a bullish inversion tCISD, okay? So in this example here, right, we've got four tCISDs, right? We've got a bullish one, right? So price closes above it, confirms it right there at 45 minutes past midnight, okay? So what you can do is mark out the tCISD candle itself, right? As soon as price closes below it, right there at 1:15, what happens? Price drops lower, takes liquidity, then reverses after forming another sequential SMT, okay? So this is what I mean, guys, right? You know, if the tCISD doesn't hold, because it should hold if we are truly, in this case, bullish, right? A bullish tCISD should hold if we're going higher. So if it gets inversed, becomes a bearish inversion tCISD, that often means that it's going to hunt some liquidity below first, and then it may reverse, or it may just continue lower and lower and lower, and you could be wrong about the bias in general, okay? So here's another example right here, right? Bearish tCISD, price drops below at 2 a.m. to confirm it, and then, as you can see, you know, trades back into the tCISD candle. We get no sort of rejection lower from it at all. And as soon as price closes above it, which happens right there at 2:25 a.m., price goes higher. And what does it do? Hunts more liquidity, forms a bearish sequential SMT on the highs. Then it begins to move lower, okay? Then we got our bearish tCISD. Then we get that move lower. Then we got the move lower, formed a bullish tCISD, and then we push higher, okay? So what you're going to actually notice is more or less the tCISDs, the regular ones, are going to be there at the reversal point, right? So as you can see on the lows, bullish tCISD higher. Then what you're more likely to see this is why I said this is how to master continuations, because the inversion tCISDs are going to form, and if it doesn't align with your bias, right, so the regular tCISD is going to form, and if it doesn't align with your bias, it will most likely become an inversion tCISD, which you can then use to enter that does align with your bias. So say you're bullish on the day, we form a bullish sequential SMT, bullish regular tCISD. That's the first entry, okay? Then if price is trading higher and higher and higher, but your draw is still even higher, you can either just enter off another regular bullish tCISD or a bullish inversion tCISD. So what you want to do is wait on a bearish regular one to form, right? As you can see, it forms right there. Price closes below it at 6.15. And then as soon as we close above it, right there at 6.45, what does price do? Pushes higher, okay? So here's a good, few examples down here. And this is literally from today. This is from literally today's price action during London session, right? So what we can do is we can scroll to our left and just take a look at some more examples. So like I said, the regular tCISDs are more or less for catching those very tops, those reversals, as you can see, boom, okay? Again, bullish one here for catching the original reversal to the upside. Bearish one, right? Allows price to drop lower, okay? And then as you can see, as soon as price closes above that tCISD over here, which happens at 205, sorry, price then retests back inside of it, okay? It never reconfirms the bearish one, right? So the bullish inversion tCISD is still valid here. You would then go ahead and take your entry inside of the retest. Like I said, best stop loss is on the swing low in a bullish scenario before the inversion tCISD takes place. As you can see, it gives a very, very nice entry. Again, let's keep going, right? What we've actually got is both a bullish inversion tCISD and a bullish regular tCISD overlapping. So whenever you see this happen, this becomes a very, very high probability, because what this is doing is, in this case, it's invalidating a bearish tCISD and validating a bullish tCISD simultaneously, right? So it's invalidating any sort of idea the price is going to go lower, and it's validating the idea that price is going to go higher. So when they overlap, this then becomes a very, very high probability area for an entry. As you can see, price trades into it and rejects from it multiple times before giving a very, very nice move higher, okay? So let's literally keep going here. As you can see, in this case, you could have used the inversion tCISDs for catching the reversals. There's not always going to be a tCISD every single reversal. In this case, bearish inversion tCISD, right? So first one there, and then we get literally another one here, right? And then literally another one here. So 3 in a row. If you manage to, miss the first one, you could have entered up any of these here. Stop on the swing high, stop on the swing high, stop on the swing high, boom, okay? Super simple. Let's literally jump to a 4-hour time frame. And this is how, obviously the higher time frame ones you can use to sort of confirm and also disrespect the narrative and bias that you could be thinking about, right? So for me personally, right, this whole entire week here, I was bullish, right? I'm bullish on the week. We'd formed a bearish hidden monthly cycle, sequential SMT, bearish tCISD. So all I was waiting for is price to close above the tCISD, and then I would have looked for longs, okay? But as you can see, on the candle that, confirmed the bullish TCI, the bullish inversion tCISD, sorry. Oops, we switched it, yes. Yeah, on the candle that confirmed it, we actually took out the draw on liquidity anyway. So, the draw had been hit anyway. But let's say, for example, we confirmed the bullish inversion tCISD, and this draw was still intact, then that could have been a super easy long straight to that high, okay? So, yeah, as you can see, it's been happening in the past couple of weeks as well, right? Both of these weeks here, back to back, I was bullish. So all I waited for was the tCISD to get inversed. As you can see, price closes above it. If I can draw it out, price closes above it right there at 10 a.m. Wicks back into it a few days later, higher, okay? Same again here, bearish tCISD, closure above occurs there at 10 a.m. Multiple wicks back in, even this, this week, literally yesterday, wick back in, beautiful rejection. So you can use these levels as well to look for lower time frame entries from, to trade higher from, okay? And yeah, as you can see, bearish one gives birth to the actual real reversal, and then the bearish inversion tCISD forms and allows you to capture this move. So it drops down below it there, 10 a.m. Then we get a nice move lower, run back above it, drop that down below it again, and then again, move lower, okay? So now what I'm going to show you guys is one final example, the best way that I like to use it. So let's say these highs were our draw on liquidity, these two equal highs here, okay? And let's say we, was bullish towards this high and we're looking for longs. inside of this candle. So what you can do, once price gets very close to the drawn liquidity, which is up there, right, you can then look for the inversion tCISD to form. And if it forms, that means not only the bearish tCISD is failing, it gets invalidated, indicating that price is probably going to run towards that draw, okay? So actually in this example, we only got bullish tCISDs, and as you can see, they work amazingly well. So if you combine these with the inversion ones, like you literally are rarely going to fail. So yeah, what I wanted to show was a bearish inversion tCISD here, but we didn't quite get one. But you can see as soon as the draw got hit, bearish tCISD entry, and then bearish inversion tCISD second entry. This one, would have failed. Then this one would have given another entry. So yeah, but what I want to do is actually show you guys an example where we are very close to a draw, and then we can use the inversion tCISD. So I don't know, let's say our draw was these lows, okay? These 4-hour lows was, looking to short of this 10 p.m. candle. Drop to 1 minute, see if we had any examples. Yeah, okay, so here we go. So as you guys can see, we formed a bullish tCISD, right there. As soon as we close below it, which occurs there, 850, trade back in, drop lower towards that 4-hour low, okay? Another entry up here as well, right? Bullish tCISD. As soon as we close below it, right there, at 847, we also get a bearish one overlapping. Remember what I said, both happening simultaneously. Very, very high probability entry. Stop loss would go on the highs, right? The swing high before the inversion tCISD, and then you can run it down to that 4-hour low. So this is a bit of an extreme example. I was more or less thinking like, whenever we get a bearish inversion tCISD around about here when it's so close to the draw. But if you're super confident, then you can take trades like this, okay? So yeah, with that being said, hopefully you guys did find this video useful. Now the inversion tCISD concept is out there. Make sure, you guys can feel free to tag me on any social medias of the trades you've taken using this concept. And also, if you have any questions on the concept itself, let me know in the comments down below. Yo, what's going on, guys? Welcome back to a new video. In today's video, we're going to be covering a quarterly theory concept known as the defining range, or the DFR. I haven't actually seen anyone speak about this concept, so this may be new to you guys. So if it is, or maybe you're not too familiar with it, then this video is going to be great to help you understand the concept of the defining range and what it is best used for, how you can catch trades with it, and how you can use it in confluence with potentially the model that you're already trading now, okay? So without wasting time, let's just go ahead and jump straight into it. We've got a small little slideshow here, and then we'll go into the charts for some examples, okay? So defining range, DFR. What is it? How does it work, right? So the defining range, all you have to do is essentially split Q1 of any cycle into thirds, okay? So you can be trading any cycle, the weekly cycle, the daily cycle, the 90-minute cycle, the micro, monthly, any cycle, okay? And then what you're doing is you're looking at Q1 only of that cycle. And then, as you can see here, what we do is we ignore the first third of Q1. So we essentially divide Q1 into 3, okay? So if it's the daily cycle Q1, which is Asia range, it's 6 hours long for each quarter. So Q1 is 6 hours long. Divide that by 3, you get 2 hours, 2 hours, 2 hours, okay? If, for example, you divide, the 90-minute quarter Q1 into 3, you get 30 minutes, 30 minutes, 30 minutes, okay? And all we're doing is we're ignoring that first third. So if we're looking at the daily cycle defining range, which is Asia range Q1, divide it into 3, we get 2 hours, 2 hours, 2 hours. So we ignore the first 2 hours. So Asia actually starts at 6 p.m, ends at midnight. So we look only from 8 p.m. till midnight, okay? And then once we've got that 8 p.m. till midnight, those final 2/3, we mark the highest high and the lowest low of the final 2/3, okay? So this right here is actually an example of Asia range here, okay? Q1, as you can see, one whole entire quarter, Q1 only right there. We ignore the first third, right? So this is the first 2 hours over here. And then we mark the highest high to the lowest low, or the lowest low to the highest high, doesn't really matter, of the final 2/3, okay? So we ignore the first 2 hours, and then the final 4 hours, mark out the very, very high, not any other high, the very, very high, and the very, very low. And then that is essentially our defining range, okay? So how can we now use this to help us with our trading? Well, we'll go into that now, okay? So what you want to do once you found out your defining range is you want to anchor a standard deviation to that defining range, okay? So now these are the settings that I like to use for my standard deviations. So feel free to screenshot this, pause the video, copy them to your charts. Pretty simple, pretty basic, from 0 all the way up to 2.5. We've got some negatives as well, like negative 2.5 to 2.5, essentially, okay? Here's, the bottom settings, and this is what the standard deviation should look like once it has been created, okay? So once you've done that, you then want to anchor the standard deviation from that highest high to the lowest low, or the lowest low to the highest high, okay? Now, what do we do with these specific levels that we get from the standard deviation? Well, firstly, let's look into the manipulation levels, right? So the best manipulation takes place between 0 to 0.5. Generally speaking, anywhere between 0 to 1.5 is okay also. And if a cracking correlation aligns with the manipulation level, it makes the manipulation higher probability, okay? So as you can see, here is an example, the one that we, shown in the previous slide. This is the Asia range that we have marked out. We ignore the first third. We mark out our highest high to the lowest low. We pull that standard deviation. And as you can see, we have our manipulation take place between 0 to negative 0.5, okay? Remember, anywhere from 0 to negative 1.5 is generally okay as well, but the best one will occur sort of between that 0 to negative 0.5, right? And your manipulation, you kind of want to see a cracking correlation occur to be confident that that is your manipulation, right? So, and also as well to make it higher probability, if that manipulation level aligns with liquidity, which it generally will, that Asia low essentially, if price takes out liquidity, then forms a cracking correlation between that 0 to negative 0.5 level, that is when the trade is going to be perfect, okay? So a cracking correlation can be anything such as a sequential SMT, a PSP, an SMT-Fill, and it can be on the higher time frame as well, okay? So you can mark the defining range for the 15 minute, which is the daily cycle, but if we, for example, get, a 1 hour SMT-Fill here, between that 0 to negative 0.5 of the defining range on the 15, then that is still completely okay. For me personally, if I was going to use the defining range, I would look for a sequential SMT between this specific level here, okay? But generally speaking, all the other cracks and correlations are okay as well, okay? So now once the manipulation has taken place, how can we then use the standard deviation levels to project our targets, and where can we expect the distribution to go, okay? Super simple. We have our distribution level, okay? So once the manipulation has formed, you can then target the distribution level. Price often expands to the 2 to 2.5 level. Even higher probability if the 2 to 2.5 level aligns with liquidity, okay? So like we mentioned earlier, if that manipulation level aligns with liquidity, price takes out a form of liquidity, then that's great, okay? That's even better. And same with the distribution level. If price can take out liquidity, even better. So say for example, we've got previous session highs up here, previous day's highs for example, and it aligns with that standard deviation level, and that's perfect, okay? So as you can see here, this is the same example from before. Manipulation takes place between 0 to negative 0.5, and once that manipulation has taken place, price then expands all the way between that 2 to 2.5 level, okay? And remember, it can come a little bit below it, it can go a little bit above it, doesn't really matter. These are just the general high probability levels, areas that you can see price trade to through obviously previous backtesting and many results from the past, okay? So that is essentially what the defining range is. Remember, you can use this on any cycle, so you can project your manipulation and you can project your distribution for that specific cycle. So once Q1 is opened, this is why people say Asia, Monday, they define the range, okay? So Monday sets the stage for the week, because you can use Monday's range to project these levels here, and then you can look for cracks and correlations that align with them, and the manipulation level, towards the distribution level, towards the distribution level, and then you can look to take those trades and be confident where price is going to go and where it's going to manipulate, okay? Remember, this isn't going to work 100% of the time. It can just be used as a confluence with your model that you've already got, or to help you set those targets if you are struggling with that as well. So yeah, with that being said, that's the slideshow over. So let's jump into the chart now and we'll dive into an example. All right, guys, so we're now on the charts. We're on the 5-minute time frame, which is for the 90-minute cycle. So what we're going to do is just go over a few examples, mark out our Q1 final range, and just sort of see how things play out, okay? So first example that I found here, scrolling for a little bit, is this one here, okay? So you can see we have a 90-minute cycle, SSMT between Q1 and Q2, but if we just apply that final range to that Q1 range, then it would make the setup a little bit higher probability. Okay, so we have obviously 5 minute, this is a 90-minute cycle quarter, so it lasts for 90 minutes, right? So we ignore the first 30 minutes. So if this quarter starts at 6 p.m, we mark our range from 6:30 p.m. until, when does it end? 7:30 p.m. Okay, so let's go ahead and find out. So that's 6:25, 6:30 is right there. Okay, so mark the high, then mark the low of the quarter, which is right there, and then we're looking for price to, if bullish, manipulate between 0 to negative 1.5, ideally between 0 and negative 0.5, which in this case it does. It then forms that manipulation, that cracking correlation, as you can see marked out by my indicator. Indicators will be linked below in the description, by the way. I also have the indicator that marks out the defining range for you, so don't forget to check that out. That's in the quarterly theory toolkit one. Okay, so SSMT right there, as you guys can see with YM, between 0 to negative 0.5, and then where do we distribute to? 2 to 2.5, and we want to be looking for those liquidity levels to line up with, you know, the defining range levels. As you can see, a very nice obvious high there, aligning with this gap that hasn't been filled completely as well. And also if you zoom out to, you know, the 15 or the 1 hour, if it's a nice unfilled gap, for example, that can make it even higher probability. Okay, which I'm sure there was something there, to be honest. But yeah, as you can see, it delivers very nicely. Defining range 0 to 0.5, 90-minute cycle SMT delivered to 2 to 2.5. Okay, notice how the manipulation quarter Q2 doesn't automatically deliver to 2 to 2.5 as well. So you can actually use this to capture the distribution which happens the following quarter after, which is usually what happens, right? So, you know, one quarter manipulates, Q2 manipulates, the following quarter distributes to the target, and that's when it does indeed then get hit that 2 to 2.5 level. We had actually hit the liquidity within Q4, so Q4 continuation after Q3 distributed. Okay, how to trade the invalidation of a sequential SMT. Now we all know sequential SMT marks our manipulation, our tops, our bottoms, our highs, lows, gives great trades, right? But sequential SMT won't always hold. How do we know that it won't hold, and how can we get into a trade after that sequential SMT gets invalidated? Those questions right there I'm going to be answering inside of this video with chart examples, showing you guys exactly how you can trade the continuation. So with that being said, let's go ahead and jump straight into it. So firstly, what actually is an invalidated sequential SMT? When an existing sequential SMT fails, that's it. Okay, in short, that's all it is. So obviously now for a little bit of context, sequential SMT is obviously a divergence between 2 to 3 closely correlated assets, right? Say that we're watching 3 assets, NQ, ES, and YM, the indices triad, right? NQ and ES both run above their previous quarter high, but YM fails to do so. That value swing is what creates your sequential SMT, the divergence that indicates the reversal. Right? But if YM then runs above its previous quarter high as well, all 3 assets have then taken their highs, the divergence is gone, and the sequential SMT is invalidated, right? So I assume you guys all know, you know, what an invalidated sequential SMT is. It's essentially a sequential SMT that was there and then gets cancelled out by the asset that created the value swing running above its high. So there's no longer a value swing there. All assets have taken out the high. Sorry to interrupt, guys, but next week I am dropping the biggest quarterly theory resource that is out there on the internet. 80 pages of pure quarterly theory information, every single concept, all the models that I trade, the psychology, how I trade prop firms, risk management, how I use my indicators, how I journal, absolutely everything for completely free. This is $1,000 plus worth of value that I could easily charge everyone for, but I'm going to give it away completely for free. So if you click the link in the description, it will take you to the Oracle Insights website, in which you can pick up the free guide if you're watching this in around about a week time after this video uploaded. But if you're watching right now, apply to the waitlist down below and you will receive an email with the PDF included completely for free as soon as it releases sometime next week. So let's get back to the video. So we've got a little example here on the right. As you can see, let's imagine this asset here is NQ. It has run above its previous quarter high. Just imagine this is the previous quarter high here. Then let's say this is ES. So we're looking at 2 assets here. ES failed to run above its previous quarter high, so it left behind a value swing, right? But then, as you can see, ES, the asset that originally created the value swing, has now ran above that previous quarter high. Okay, so between those 2 assets, there is no longer a value swing, therefore we no longer have any sequential SMT. Now, ideally, this must occur within the same quarter. So let's say we have a sequential SMT between Q2 and Q3. We have ES being the value swing during Q3. If then at some point during Q3, ES cancels out the value swing, so it runs above that Q2 high, just like NQ did, that means we no longer have sequential SMT between both of those assets. So now you guys know actually what an invalidated sequential SMT is. Let's now jump into the second part, which is a failed reversal is a continuation. Now, before that goes over all of your guys' heads, let me go ahead and quickly explain that, okay? So sequential SMT, for me personally, and for many other people, represents manipulation, right? So whenever we see a sequential SMT within price, that to me is manipulation, right? So say I'm bearish on the day and we see a bearish daily cycle sequential SMT form, that is my personal manipulation for the day, okay? So when a sequential SMT then fails, the manipulation has failed too, right? And failed manipulation indicates a continuation. So like I just said, let's say we're bearish on the day, we have a bearish daily cycle sequential SMT, that to me is, oh, that's manipulation, that could be my high of the day, right? But then if that sequential SMT goes ahead and fails, so let's say again, Enki ran above London highs, ES failed to run above London highs, then at some point, ES then takes out London highs, we then don't have a sequential SMT between those two assets, right? And this shows me that, okay, I'm probably wrong on the day, maybe we are bullish, right? And this shows us that the draw on liquidity is in fact higher when a bearish SSMT fails and lower when a bullish SSMT fails. So like within this example right here, we have a bearish sequential SMT here, right? Again, imagine this asset here is NQ. It ran above its previous quarter high. ES failed to run above its previous quarter high. So we could have looked at this and thought, oh, okay, we could be bearish now. But then later on down the line, ES runs above that previous quarter high. Therefore, what? Bearish sequential SMT fails, means the drawn liquidity is most likely higher. And as you can see, both assets then continue to run to that higher time frame draw above. So now, why does a sequential SMT fail and how to actually see it coming, right? There's four main rules that I stand by, right? Number one is it's against the narrative. So if the sequential SMT isn't pointing the same way as the higher time frame draw, it's fighting price. And 90% of the time, it will lose, right? So if you have a bullish daily bias, and then you see a bearish sequential SMT form intraday, 90% of the time, that will fail if your narrative is correct that price actually wants to go higher, right? Rule number two is no true chain in the state of delivery, so no tCISD. The sequential SMT showed up, but it was never confirmed, and no confirmation equals no trade, right? So we have that sequential SMT, however, the tCISD candle was never confirmed. Therefore, for me, that sequential SMT wasn't confirmed either, and it will likely fail until confirmed. Now, if it does get confirmed, this is then when we can utilize the inverse true chain in the state of delivery, an iTCISD, and a failed tCISD often leads to the sequential SMT failing, right? Because if a sequential SMT is confirmed via a tCISD, that should theoretically hold if we're correct in our bias. But then if we're incorrect in our bias, that tCISD may get inversed, so it could get closed above, for example, and that will likely lead to the sequential SMT failing. And then the fourth and final rule is the move off is weak. So the highest probability sequential SMTs will move away with the displacement and fast, okay? If price just consolidates and doesn't show clear displacement, there's nothing behind it. So against the narrative, you know, try and trade in line with the narrative when you can. Wait for a tCISD to confirm this. Wait for a tCISD to confirm the sequential SMT. If it's not confirmed, it will likely fail. And if it does get confirmed, then we inverse the tCISD. Again, that sequential SMT will likely fail. And then last but not least, wait for clear displacement. Wait for price to show you, oh, we have a sequential SMT. I am now displacing in line with your draw. Okay? So like within this example here, we have three of the characteristics of the rules here. So first of all, bearish sequential SMT. Don't want to be trading that if our narrative is saying higher. Number two, no displacement. So after the sequential SMT formed, there was no displacement. Price just continued to consolidate. And number three, we had our tCISD candle because it's the first candle that creates the sequential SMT, but it never got closed below. It never got confirmed. So three things there pointing to higher prices, pointing to that sequential SMT failing. And then let's say this tCISD did get confirmed. If price was to then close back above it, what would that mean? An inverse tCISD indicating what? Higher prices to our bullish narrative draw on liquidity. Okay? And now the entry. So now we know what a failed sequential SMT is, what they can be used for, continuations, how to identify one will likely form, but now the age-old question is how do we then enter after we can see a sequential SMT has failed? Super simple. My number one, the best way that I like to do it is using an iTCISD entry, which is obviously an inversion tCISD. So an iTCISD is just a failed tCISD, right? And when a tCISD fails, the sequential SMT will usually fail with it. So it becomes your reference point. Take the entry on the retest of the iTCISD. So take a look at this example here real quick. Bearish sequential SMT. The candle that created it is this huge candle here. Price then initially closed below it. So it did confirm this bearish tCISD. But if your narrative was higher, you wouldn't have taken this bearish sequential SMT. Why? Because that would be pattern trading. You would wait for this tCISD to get closed above, which happens here. So we close above the open of that tCISD candle. Then our reference point is the inversion tCISD candle. So you can go ahead and mark out the body. When price retests back inside of it, like right here, you can go ahead and take your entry. Stop loss ideally on the swing low before the inversion tCISD took place. And then you can ride it up towards your bullish draw on liquidity. So that's my favorite way to enter after a failed sequential SMT, riding that continuation higher. Now the second way that you can enter is simply by using a lower time frame sequential SMT entry. Okay, so a lower time frame sequential SMT in line with the higher time frame sequential SMT failure. Same direction as the continuation, just a lower time frame. Take your entry off that, right? So bearish sequential SMT, narrative was higher, therefore this sequential SMT failed. And all we do, the second we break above that previous quarter high, and all assets have taken it, therefore there's no longer any sequential SMT. You can wait for a lower time frame sequential SMT to form. So let's say here, this was a 90-minute bearish. This then failed off this candle because this asset here ran above its previous quarter high. And just imagine the rest of the triad had also ran above its high, therefore no sequential SMT. Then you wait for a small pullback after that. Then you can drop to a lower time frame, look for that lower time frame sequential SMT. So in this scenario, it could have been a microcycle. And then you can go ahead and take your entry after that lower time frame tCISD, inversion, order block, whatever you like to enter from after that lower time frame sequential SMT has taken place. And as you can see, price then delivers all the way up towards that higher time frame draw on liquidity. And that essentially is it, guys. It's nothing complicated at all. We know sequential SMT marks the highs and lows of the quarters, the cycles, high of the day, low of the day. So if they fail, we are likely wrong. If we see a bearish 90-minute form and we think, oh, that's the high of the session, but then it fails, that indicates that, okay, we're wrong. Let's just accept it. Let's deal with it. We have no sequential SMT to give us, for example, that move lower. So therefore, we can wait for an entry technique to ride the move, continue the move higher towards the higher time frame draw on liquidity. And with that being said,
hello guys, hope that you're all doing well. Welcome back to a new video. Inside of today's video, I'm going to be showing you all how to spot real versus fake sequential SMT, SSMT. I already have a video about sequential SMT on my channel, so if you want to understand the concept itself, I'd recommend to go and check that out. But I'm sure a lot of you guys know what the concept is, but I'm sure you also struggle with knowing when and why to use it, and knowing which sequential SMT to trust. And that is exactly what we're going to be covering inside of this video. So let's go ahead and jump straight into it. So the first part is understanding the logic behind sequential SMT. Sequential SMT isn't a confirmation tool, it's an indication. So whenever you see a sequential SMT form, it doesn't mean it's automatic buy or sell signal. It means that you can begin preparing for a potential position. The higher time frame narrative / draw on liquidity always comes first. So whenever you open up a chart, you shouldn't be thinking, oh, we have this sequential SMT, I'm going to be taking along. No, you should be looking, where is price drawing to, and what can I do to get myself in line with that move? That is then when you begin to look for that sequential SMT in line with the draw on liquidity. Sequential SMT then shows us when price is ready to begin the move to the draw on liquidity. So as you can see right here, let's say for example we have a higher time frame draw on liquidity being the highs. We're then looking for sequential SMT in a bullish scenario, and we're going to completely ignore every single bearish SSMT that forms until the higher time frame draw has been hit. Next, we're understanding the characteristics of a real sequential SMT. So a real sequential SMT will form in line with the higher time frame narrative.
in line with the higher time frame draw on liquidity, has a tCISD, a true change in state of delivery, and clear displacement. And the last thing to note is it's even better if you see a sequential SMT form during a red folder news event. It isn't necessary, but it makes the sequential SMT higher probability. So in this diagram, as you can see, the first thing that we have to be looking at is the higher time frame draw. In this example, higher prices, we then form a bullish sequential SMT, we then form our tCISD, the candle that forms sequential SMT, closure above that specific candle, confirms this candle here as our tCISD, price then retests the tCISD, and it also has a displacement leg with the formation of a fair value gap. You can then go ahead and take your entry there, targeting the higher time frame draw on liquidity in line with the higher time frame narrative. So now you understand the characteristics of a real sequential SMT, let's go ahead and take a look at a fake sequential SMT. So these are the ones that you want to be ignoring, and these are the things that you can be doing to look out for the fake sequential SMTs. So a fake sequential SMT will be opposing the higher time frame narrative, opposing the higher time frame draw on liquidity, has no tCISD, and lacks displacement. Also, another thing to note is if sequential SMT forms at a completely random time of the day, for example during Asia session or nowhere near a news event or the 9:30 open, yes, they can still play out, but it's preferred to see sequential SMTs form around those key times. So your 9:30 open, your 8:30 news event, your 10 o'clock news event, the 2 p.m. news event, just somewhat around that or during those times will make the sequential SMT a lot higher probability. So as you can see here, this is almost identical to the last scenario where we had our high time frame draw being higher, but in this case we didn't form a bullish sequential SMT between these two quarters, but we did form a bearish sequential SMT between the two quarters. So as you can see, we formed the bearish sequential SMT. People then would have really been looking to short and just instantly hopping into a short, but as you can see, we didn't actually confirm or form a tCISD. We had no real displacement, we didn't inverse any large gaps, and also the whole entire sequential SMT completely opposed the higher time frame narrative and the draw on liquidity. So whenever you see a sequential SMT form that isn't in line with the higher time frame draw, it will often act as a retracement. So it'll retrace into a gap, price then will likely form a lower time frame bullish cracking correlation, and then it will begin the move to the higher time frame draw on liquidity, targeting the initial sequential SMT highs, which is then when we get the Magneto effect. So now you understand the characteristics of a real versus a fake sequential SMT. Let's go ahead and take a look at when you should and shouldn't be using sequential SMT. So once the higher time frame draw on liquidity is met, that's when you can then look for a reversal or retracement sequential SMT, but only after it's been met. So like the example that I just showed you guys just a moment ago, the short, the higher time frame draw hadn't actually been met, so that wasn't a valid short. But let's say after the higher time frame draw had been met, like in this example right here, you can then look for a potential bearish sequential SMT to allow for a retrace into an unmitigated gap or for a potential reversal to occur. And remember, we must use the characteristics of a real sequential SMT to actually confirm that it will hold. So here we have the characteristics of a real sequential SMT. We've taken high time frame draw on liquidity. We've formed a bearish sequential SMT. Also, this must occur above the true open for the specific cycle. We then form our tCISD candle right here, closing below it, confirming it. So this here is our tCISD candle, the one that creates sequential SMT, the very first candle. This candle here then closes below it. We also get an inversion gap happening simultaneously. Price then also trades back into the tCISD before beginning the large run lower. So if price is heading towards a higher time frame draw on liquidity, but leaves behind a lot of unmitigated gaps, you can take trades against the higher time frame draw towards the gaps, but just know they are going to be a lot lower probability setups. So let's say, for example, price opens up, expands heavily to the upside, but we know that price is heading for buy side liquidity. If we form the characteristics of a real sequential SMT, just ignoring the fact of the higher time frame draw, you can sometimes take that short towards the unmitigated gaps, because price won't automatically just expand all the way towards the draw on liquidity. It will retrace before that happens. So if you're extremely sure that price is going to give a retracement, then and then only you can look for that short that isn't in line with the higher time frame draw. But just know it will be a lot lower probability, and you might as well just wait for the retracement to occur and then look for that real move in line with the long narrative. And
hello guys, hope that you're all doing well. Within today's video, we're going to be taking a look at a quarterly theory concept founded by Trader Day. The concept we're taking a look at today is hidden sequential SMT, HSSMT. This is a concept that I'm sure you've never heard of before, and until you've watched this video, you will never be able to spot this within price. So without wasting any more time, let's jump straight into it. So first of all, you need to understand that this is a quarterly theory divergence, so we must be comparing closely correlated assets, the triads which are listed above, and also when looking for this concept, we must see it occur between 2 consecutive quarters. There are of course many more triads and many more cycles, but if you would like to know more information about that, check out my Sequential SMT video, which is already on my channel. So now that we understand that we need to be looking at closely correlated assets and also between 2 consecutive quarters, we can now dive into the concept itself. So first of all, if we take a look at this example of 2 assets right here, you can see to the naked eye, we can't spot any divergence, right? No asset ran below that previous swing low to the left. However, if we just remove the wicks out of the equation, you can see that we do in fact have a divergence right there. So that essentially is all that hidden sequential SMT is. It's just a divergence between 2 consecutive quarters using only the bodies. So when looking for a bullish divergence, we must pay attention to the lowest closure of the previous quarter. And when looking for a bearish divergence, we must pay attention to the highest closure of the previous quarter. So there are 2 variants to this concept, and we'll dive into the first variant now, which is the one that I had just shown you, where you can see that no asset runs below the previous quarter's lowest wick. However, if we just look at those closures only, you can see that the asset to the right actually did close below Q1's lowest closure during Q2, and the asset to the left failed to close below Q1's lowest closure. After this occurs, you can then begin to look for your entry model. In this case, we just use a simple change in the state of delivery, a candle closure above the candle that caused the hidden sequential SMT, and then you can see that price began to quickly run away and target the opposing liquidity. And there is actually one more variant to this concept, which is variant number 2, and as you can see, both assets run below Q1's lowest wick. However, yet again, if we pay attention specifically to those closures, you can see the asset to the right close below Q1's lowest closure, and the asset to the left failed to close below Q1's lowest closure. And then of course you can see we waited for a simple change in the state of delivery before price began to run away and target that opposing liquidity. So this concept can be pretty tricky to spot, especially if it's new to you. So what I would recommend doing is just removing the wicks from your chart and just backtest a few examples just so you can train your eye to see these things. And what I like to do as well is if I can see there's no visible sequential SMT, for example, I can see both assets have wicked above or below the previous quarter, or both assets fail to wick below or above the previous quarter, that's when I then begin to look at the closures and pay attention to see if we have a divergence between those closures. So now that you know exactly what hidden sequential SMT is, let's go over a few chart examples and show you how you can actually enter a trade after seeing the concept occur within price. As you can see here, we're comparing 2 assets from the forex triad. We're taking a look at GBP USD and also Euro USD. We are on the 5-minute time frame, which means we're viewing the 90-minute cycles. And what we can go ahead and do is mark out our high from the previous quarter with the wicks, and we can also go ahead and mark out the highest closure of the previous quarter. So that way we can clearly see if price runs above the high, forming a regular sequential SMT, or if it runs above and closes above the highest closure from Q2, forming a hidden sequential SMT. So this is what you can do when you're first starting out, just to train your eye to see these things. And as you can see, we did indeed get price run above the high of Q2 on both assets,
So this is then when we're scanning for that hidden sequential SMT, and as you can see, we did indeed get a closure above off this candle and also a clear one off this candle here, okay? So then all we need to do is mark out the candle that first formed that hidden sequential SMT, in this case, this up close candle here. And then what we're doing is we're waiting for a closure back down below it to confirm the change in the state of delivery, which you can see we got within this candle here. We can then enter anywhere within this candle. So let's say around here, stops on that turtle soup high, and we can target opposing liquidity right there. Or you could have left a runner down to these lows. So let's see how this will go ahead and play out. And as you can see, we hit both targets very, very quickly. Now in this example here, we're comparing two assets from the indices triad. We're taking a look at ES and also NQ. You can see that we are on the hourly time frame, which is for the weekly cycle. So this means we must see the sequential SMT or hidden sequential SMT between 2 consecutive days. So in this case, we've got Thursday already played out, and now we're looking to trade on Friday. So we're looking for that hidden or regular sequential SMT with Thursday's low or high. So what we can do is go ahead and mark out Thursday's lowest low with the wick, and we can either wait for price to run below that, forming a sequential SMT, or we can go ahead and mark out the lowest closure of Thursday on both assets. And keep in mind, the low or the lowest closure doesn't need to form at the exact same time on both assets. The only thing that matters is we're looking at the lowest closure or the highest closure, no matter what asset we're looking at, okay? So in this case, they did form at the exact same time. So what we need to do now is wait for Friday to either close below or wick below. And there you go, as you can see, we got that closure below on ES, but we didn't get the wick below. And then if we take a look at NQ, you can see we did not get the wick or the closure below, okay? So now we've got a divergence between the bodies, as you can see right there. So all we need to do from here is wait for a candle closure above the candle that formed the divergence, that formed the manipulation. In this case, it was this one here. You can see the candle there, 7 AM for ES. So we can go ahead and use that same candle for NQ. We wait for a closure above it, and then we wait for price to tap back into the order block. And as you can see, price had done that. Price had done that very nicely. Stops on the low, and we can go ahead and target opposing liquidity. And as you can see, TP smashed again very, very quickly. So definitely go and experiment on the charts for yourself. Go take a look at the reversals. Go and have a look if you can't see that SMT or sequential SMT. Pay attention to the bodies, and more times than not, it will be there if you can't see a divergence between the wicks. Yo, what's going on, guys? Welcome back to a new video. Inside of today's video, we're going to be covering the concept true opens, but more specifically, stack true opens, okay? So we're going to do a brief overview of what true opens are, and then I'll be diving into stack true opens and showing you how powerful they are and how you can incorporate them within your trading to find those much higher probability setups, higher probability manipulation, all that good stuff, okay? And also it's very simple to understand and very easy to apply to your trading and see results from as well, okay? So true opens, what is a true open, right? So a true open is essentially the opening price of Q2 of every single cycle, okay? So here's a few examples that I've got here for you guys. So the true week open is viewed on the hourly time frame and it's Monday 18:00. But don't get confused, that isn't Monday's open. That's actually Tuesday's candles open, which Tuesday is Q2 of the weekly cycle, okay? True day open is viewed on the 15-minute, and that's just your classic midnight open. The ICT teachers, a lot of people use that one. And then the true session open is viewed on the 5-minute, and of course we have a different true session open for each of the sessions of the day. So Asia is 7:30 p.m, London is 1:30 a.m, New York AM is 7:30 a.m, and New York PM is 1:30 p.m, okay? So now, what do we look for within these true opens, okay? So as you can see to the left, we look for bullish manipulation below a true open, and to the right, we look for bearish manipulation above a true open, right? Essentially, our true opens can be a sort of time-based premium and discount, where you want to be looking for longs below a true open and you want to be looking for shorts above a true open, okay? Now, this isn't always true. You can, of course, long above a true open, but generally speaking, you want to at least see a form of manipulation occur below a true open if bullish and above a true open if bearish. Once that manipulation has then taken place, then you can look for trades above it and below it, for example, okay? Now, let's jump into what stacked true opens are. So this is how stacked true opens work, right? We need to see one true open on any cycle, okay? So say we're looking at the 90-minute cycle, we'll be looking at the true session open. If we're looking at the daily cycle, we'll be looking at the true day open, weekly cycle, true week open, etc., etc., okay? So it works the same on any cycle. But now what we also need to incorporate is one cycle higher true open. So if we're looking at the true session open, we're also taking into account the true day open. If we're looking at the true day open, we're also now taking into account the true week open, okay? So one direct cycle above, we're adding that true open into our analysis, okay? So now they do need to be in a specific order. So for example, when you're bearish, you know, this one here and then this one here, which is what we're going to dive into now, okay? But essentially stacked true opens is just two true opens, which can help give you the bias, again, look for manipulation, time-based premium discount, but a lot higher probability because we're incorporating not just one, but two cycles together to see if price is really at an extreme discount or an extreme premium, okay? So the bullish scenario. Keep in mind, the stacked true opens have to be in this exact order when you're looking at them, okay? So you can't have, you know, the higher time frame below the lower time frame and say, oh, I'm looking for bullish stacked opens. That doesn't work, right? For a bullish scenario, you must have the lower time frame true open below and the higher time frame true open above, okay? So this can be the daily cycle, this can be the weekly cycle, this can be the 90-minute cycle, this can be the daily cycle, okay? True day, true session below, for example, okay? Now, what do we do once we see this occur within price? Well, as you can see, we have the true day open and the true week open. So the true days opened up below the true week. So now once we see price manipulate, drop below that true day open, we can then really anticipate that we're going to see a very nice move occur to the upside after this, because price is below both of those true opens, indicating an extreme discount, okay? So one true open, price drops below it, sure, that's a time-based discount, for example, but if price drops below two true opens, that's an extreme time-based discount, okay? Because price is below the cycles open on not one, but two time frames, okay? And remember, it must be in the specific order, the lower time frame below the higher time frame. And what you're looking for in order for, you know, to confirm the manipulation is over is ideally a cracking correlation below those stacked opens, okay? So it can be a sequential SMT, a PSP, an SMT-Fill, all of those concepts right there, okay? So now, how does a bearish scenario look? Well, it's literally the same, but just flipped over, okay? So instead of the lower time frame being below the higher time frame, in this case, the lower time frame is above the higher time frame one, okay? So let me do another visual example for you guys. So imagine this being the 90-minute cycle, true session open, and then the daily cycle, true day open comes below it, okay? 90, true day. Or we can have true day, true week, okay? It can be any cycle. I'm just giving you guys some examples, okay? So in this scenario, we have the true session above the true day. So we have that lower time frame one above the higher time frame one, okay? And then same thing as before. All we look for is manipulation above, prices at an extreme premium. So anything above these two true opens is likely to form a reversal to the downside. So we look for our cracking correlation. It could be, you know, a sequential SMT. This could be a PSP. It could be an SMT-Fill on the high time frame to the left. It can be any of those, okay? Once that manipulation has taken place, you can then look to trade in line with those true opens and take it to the downside. Remember, once price drops below the true opens, the stacked true opens, you can still look for shorts even below it. It's just as long as the manipulation has taken place above them, then you are good to go, okay? So that is essentially true opens and stacked true opens in a very short video right there. So hopefully you guys did find this useful. What we're going to do now as well is jump into the chart. I'll show you guys one or two examples of the stacked true opens in play and how you can utilize them, okay? So let's jump over to the charts right now. All right, guys, so we're on the charts now. We're on the 5-minute time frame for NQ, which means we're looking at the 90-minute cycle. So if we're looking for the bearish scenario, we need to see the true session open above the true day open. And for the bullish scenario, we need to see the true session open below the true day open, okay? As you can see, true session above the true day open right there. And then once price comes above it right there, SMT occurs. This one would not be this true session open though, because this one opened up 4 a.m. The true session open for this one here would be Q2's open, Q2's open right there, which actually is marked by the indicator, as you can just about barely see. True session, right? So prices above the true session and the true day in that specific order, session above the day one. 90-minute cycle SMT, back to back, sell off, okay? And then even again, when we open up the new true session open for New York AM, no SMT here, but I can actually remember this day, and there is a PSP right on that very high over there, okay? So here's our indicator, marked everything out for you. Link will be below in the description. Very, very great indicator. 5-minute PSP, sell off right there, okay? Let's, look for a couple more examples over here. True session, so price got a 90-minute cycle below the true session open right there. And this is for the PM, right? PM session, so true session, price drops below it, 90-minute cycle SMT, back to back again as well there. And let's check if we're below the true day open as well. But remember, the true day must be above the true session for a bullish scenario. In this case, it is. The true day open is all the way around here somewhere, as you can see, marked out by the indicator, a little bit lower. So price is very far below the true day open, below the true session open for the PM session, 90-minute cycle SSMT. If you want as well, you can mark out the tCISD, which is right there, and then you would go ahead and, enter off the retest of the tCISD, stopping the SMT low. And as you can see, a very, very nice trade right there, okay? So here's a few examples, guys. Literally scrolling through the chart as well, not picking out any specific examples, just showing you guys how powerful it really is. Hello, guys. Welcome back to a new video. Inside of today's video, I'm going to be explaining what a true order block, a TOB, is. It is an order block that rests inside of a precision swing point, a PSP. By the end of this video, you will know exactly when, why, how you should be entering PSPs and which PSPs to trust using the true order block concept. So without wasting any more time, let's go ahead and jump straight into it. So firstly, what is a true order block? So before a true order block, a TOB exists, a PSP candle number 2 must close. So if you guys don't know what a PSP is, check out the video here. Once you know what a PSP is, you will then know it's a 3-candle pattern. However, our goal here is to trade candle number 3 in anticipation of the swing point to hold. So in order to do that, that is why we use the true order block, which I'll explain in just a moment. So after the PSP candle, that swing point candle number 2 has closed, that is then when you can drop down one time frame to look for the TOB. So within a bullish PSP, it's the final down close candle, the final bearish candle. Within a bearish PSP, it's the final up close candle, the final bullish candle. So let's take a look to this example on the right. So first thing is first, PSP candle must close. So candle number 2, this candle here must close. Then we drop down one immediate time frame lower to this time frame here. So if you have a 15-minute precision swing point form, then drop down to the 5-minute time frame, and within and only within this PSP candle, not this one, not the number 3 that will open up soon, this one only, mark out the final down close candle if it's a bullish swing point, which it is here, okay? So mark out that final bearish candle. You then want to wait for price to close above that bearish candle to validate the TOB. This can happen within candle 2, or sometimes it may happen within candle number 3. And then once you have marked out your TOB, this is then when we can look for entries inside of it, which we'll jump into right now. So how to actually enter from a TOB. So there's 2 different types of entries. A candle 3 entry, which is that precision swing point formation actually forming. So once candle 3 opens, you want to watch for it to trade back into the TOB and take your entry from there. And then a candle 4 entry is if during candle number 3 it doesn't return back to the TOB and the drawn liquidity still remains intact, we can then look for an entry during candle number 4 if it does retest the TOB. So here's an example of how it should look. So 15-minute time frame, swing point forms. This of course must be bearish on one closely correlated asset to make it a PSP. Once this candle here closes, our goal is to enter within this candle here, anticipating the swing point to form and hold and push higher. So once this candle closes, as it's a bullish swing point, mark out the final bearish candle. So in this example, it would be this one here, because candle 1, 2, 3 all rest inside of that 15-minute candle, a 5-minute candle, second 5-minute candle, third 5-minute candle. Okay, so this is all candle number 2 right here. So mark out the open of that bearish candle, wait for price to close above to validate the TOB. In this case, it happened during candle number 2, and then candle number 3 opens up low into the TOB, which is here. This is during candle number 3. a 5-minute candle, 5-minute candle, 5-minute candle. So open low on the 15-minute candle. The first 5-minute trades into that TOB. Take your entry there. Stop on the PSP low. And then you can trade it higher in anticipation of this bullish swing point to form and hold and push higher. So now let me show you an exact example on the charts of how this should look. So this is how a high probability TOB setup should look. So price firstly must hit either a higher time frame key level or form a sequential SMT. Next thing would be a PSP forming. So in this case, the 15-minute time frame, this would be our PSP here. If it of course closed bearish on a different asset, in this example, let's just say it did. So now this is our PSP candle. The high time frame key level has been hit, or a sequential SMT has formed right here. Then we want to drop down one immediate time frame lower. So from the 15-minute to the 5-minute, you then want to go ahead and mark out that bearish candle as a bullish swing point. So that final bearish candle. In this case, we have one 15-minute candle. Inside of it lies 1, 2, 3 5-minute candles. And now the final 3 candles is where we look for our entry, which is that 15-minute candle. So we're looking for an open low into the TOB, which in this case is here. So price opens up low initially on the 5-minute, and the 15-minute candle open up low, trading into that TOB. You then want to look for your entry inside of the TOB, placing your stop on the PSP low, which would be this low here, or this low here on the 5-minute. You of course also want to make sure you do have a higher time frame drawn liquidity in which you can target and expect the PSP to trade away from after getting that true order block entry inside of the PSP candle. So now guys, let's go ahead and jump actually into the charts as requested by a lot of you guys to show you guys this concept working in real time. Alright, so now onto our second example. This time we are again looking at the indices triad, but we are on the 4-hour time frame, just so I can show you guys how the different time frames work. Pretty simple, always just one time frame below the PSP candle. And also I haven't cherry picked any specific example. I'm just doing this right in front of you guys right now. So we can do it here, okay? So 4-hour PSP at 6 a.m. on the 10th of July. So we want to drop to the hourly, and this is the 10th of July at 6 a.m. So from 6 till 9 a.m. we're going to mark out that final bullish 1-hour candle. The 10th of July over here. No cuts, nothing like that, just so you guys can see this is exactly how you do it. So there we go. Like I said, this was a bearish PSP, so we're going to use a final up close candle. As you guys can see, it is indeed this one. Price closes below it right there at 9 a.m. and then price trades back into it at 2 p.m. So this candle closes at 10 a.m. and then we have the 10 a.m. 4-hour candle, which is candle 3 of the PSP. And then we have 2 p.m. which is candle number 4, which is the start of the 2 p.m. 4-hour candle. Price trades into it right there, again forming a 1-hour PSP inside of the 1-hour true order block. So you could have even refined this to a 15-minute entry again right there. So yeah, you want to go ahead and take your entry at the true order block, placing your at the true order block, placing your stop on the PSP high, which is the quote-unquote invalidation for true order blocks, and you can ride it all the way down to the lows as easy as that. Concept is the exact concept that turned me from unprofitable to profitable, and now allows me to pull multiple 4-figure payouts from the markets many times per month. Here's a little payout that I literally requested on Friday from one singular trade. And the very concept that we're going to be talking about today that allowed me to do something like this is high probability quarterly theory kill zones. So let's go ahead and jump straight into it. What actually is a kill zone? A kill zone is a specific time window where price action is generally the most volatile and offers the clean setups. These aren't random, they are the moments when smart money is the most active. Now these are the 4 classic ICT kill zones. So Asian range 8 p.m. till midnight, London is 2 a.m. till 5 a.m, New York AM is 8 a.m. till 11 a.m. and New York PM is 1 p.m. till 4 p.m. And those times are all in East Standard Time. Now looking at those, you can kind of see it's quite a broad range of time, like 4 hours, 3 hours each session. It doesn't really kind of boil down the exact time that you want to be executing within. And also the problem isn't that traders don't know kill zones exist. It's that they treat every kill zone the same. Same attention, same screen time, same expectations. In reality, not every session is created equal. Some are built to trap, some are built to distribute, some are built to reverse, and quarterly theory tells you which one you are in before price even moves. And now you guys have a general description of a kill zone. Let's jump into the main topic of the video, which is how to find and what is a quarterly theory kill zone. So a time window where 2 or more quarters align across time frames, creating a high probability window for price to deliver a clean move. So this essentially means you must have at least 2 cycles that you are trading have overlapping quarters. Okay, so as we know, time is fractal. This could be Q2 of Q2, right? And that could be of any cycle. So in this example here, Tuesday, which is Q2 of the weekly cycle, and then we can have a London session, which is Q2 of the daily cycle. Okay, so that is London on Tuesday, Q2 of Q2. So that whole specific London session is what's known as the quarterly theory kill zone. Okay, it could also mean London session, which is on the daily cycle, which is Q2 again. And then we can have the 90-minute cycle quarter inside of London being Q2. So that way we'd only focus in on that specific 90-minute Q2 quarter, rather than, okay, it's London session on the daily cycle, it's Q2, let's trade Q1 on the 90-minute cycle, Q2, Q3, and Q4. Why would you want to be on the charts for 6 hours? Why not sort of specify and, go down to that high probability 90-minute window, which has those 2 overlapping quarters. So London session, Q2, and then Q2 of the London session on the 90-minute cycle. And why do you guys think my specific time window and the model that I teach you guys on here is from 9 to 10:30 a.m. Eastern Standard Time? What is that? That's, 9 to 10:30 sits inside of New York AM session on the daily cycle, which is what? Q3. And then 9 to 10:30 is what? It's a 90-minute window, so a 90-minute quarter inside of the AM session, which is Q3. And that specific 90-minute quarter is also Q3. So it's Q3 of Q3. So essentially every single day that I'm trading within 2 overlapping Q3 quarters. So automatically my setups are going to be much higher probability than trading, for example, the AM session during Q1. Okay, Q2 and Q1, that's not overlapping quarters, therefore it's not a quarterly theory kill zone, right? And the same quarter appearing simultaneously equals higher confluence. So if you do have that Q2 of Q2 or Q3 of Q3, Q4 of Q4, okay? So like we have here in the bottom right, we have the weekly cycle, so we're trading on Tuesday. Automatically, if you know it's Tuesday, just trade the daily cycle on London session, which is Q2 of Q2. Okay, and you could even go even deeper. So you could go Q2 in the weekly cycle, Q2 in the daily cycle, and then Q2 of the 90-minute cycle inside of London session. And that brings us straight into our next sort of topic, which is high probability quarterly theory kill zones. And this is when we stack the same quarter across 3 cycles. And that is your specific high probability quarterly theory kill zone. Okay, so the rule here is you need at least 2 to 3 overlapping quarters to call it a quarterly theory kill zone. The more alignment, the higher the probability. So if we have more than 2, more than 3, more than 4, it could be the monthly, the weekly, the daily, the 90, the micro. Stack as many as possible, and this will give you the highest probability time window. So your lower time frame could be entering off the microcycle, and that may be, I don't know, let's say you want to enter on Q3 of the microcycle within the AM session, right, within 9 to 10:30. So you could have, for example, say I took a trade on Wednesday, Q3, New York AM session, Q3, 9 to 10:30 inside the AM session, Q3 of the 90-minute cycle, and then the micro cycle on top of that, which is 9:46, I believe, till 10:08 or 10:07. So if we waited till 9:46 and executed from 9:46 till 10:08 on a Wednesday, inside the AM session, inside of the Q3 of the 90-minute cycle, inside of Q3 of the microcycle, that specific 22.5-minute quarter, which is on the microcycle, will be your very, very extremely high probability quarterly theory kill zone. Okay? Now, if you guys know a little bit more about quarterly theory, you will know that Q2 generally manipulates, Q3 generally distributes, and Q4 generally reverses, okay? So we can have specific kill zones for specific functions. So Q2 of Q2 of Q2 can be your manipulation kill zone, right? You can have Q3 of Q3 of Q3, which can be your distribution kill zone. And that's why I specifically trade the AM session 9 to 10:30 because it generally is a nice distribution move, okay? Like, you can trade the manipulation, you can trade the reversal, but I like seeing the manipulation take place prior, waiting for my quarterly theory kill zone, and then looking just to ride that move, ride that expansion, just get in, boom, expand lower or higher, whatever it may be, okay? And then you have your reversal kill zone, which is Q4 of Q4 of Q4, and it can be, for example, Thursday, then the PM session, and then Q4, the 90-minute cycle, all overlapping. Then you could go deeper. It could be Q4, the microcycle. You could go even higher. It could be Q4 of the monthly cycle, the yearly cycle, the quarterly cycle, right? You know, the more quarters you've got overlapping, the higher the probability the setup is going to be, okay? Now we know what they actually are, you know, how to spot a quarterly theory kill zone. We enter the kill zone. Now what do we do? You know, this is where a lot of traders will just freeze up. And, you know, they'll know the time window, but they don't know how to execute, okay? And this is where the quarterly theory kill zone entry confirmation comes into play, right? So being inside a kill zone doesn't mean you just trade. You don't just place a trade because you're inside of a kill zone, okay? It means if something clean presents itself, it has a much higher chance of playing out, okay? So this is the general checklist that I like to follow here on the left side of the screen. The entry confirmation checklist, okay? At least 2 to 3 quarters aligned across timeframes. Sequential SMT is present inside of that quarter. So if, for example, you're trading 9 to 10:30 a.m., like I do, I want to see a sequential SMT take place inside of Q3 of the 90-minute cycle. So it would be between Q2 and Q3, okay? We have that sequential SMT inside the current quarter. Then we wait for a tCISD to print on that, you know, cycle on the lower time frame one. So say we trade in 9 to 10:30, it will be the daily cycle and the 90-minute cycle, okay? You can just wait on that 90-minute cycle sequential SMT, then a tCISD on that lower time frame compared to waiting for the daily cycle one, because we may not even have a sequential SMT there. If we do, wait for it on there, okay? Then we take the actual entry itself within the kill zone window, not before and not after. So I will only place a trade the second 9 a.m. hits. The second we go past 10:30, I will not look to place a trade. If I'm already inside of a trade within that window, fine, I can hold it because I've already entered inside of the kill zone window, okay? So an example of this would be Wednesday Q3 alignment. So weekly cycle, Q3 being Wednesday, New York AM session, which is the daily cycle, Q3, 90-minute cycle, which is Q3, right? And then we'd see, so that's 3 Q3s overlapping, weekly, daily, and 90. Then we'd look for a 90-minute cycle sequential SMT between Q2 to occur inside of Q3. And then a 5-minute tCISD because it's a 90-minute cycle. And we have right there 3 Q3s for one very clean setup, okay? Now, the edge isn't the session. The edge is knowing which session, on which day, at which time, all saying the same thing. So, you know, how we go through the daily to the 4-hour to the hourly, and we want to see all of those aligning for the highest probability setup. That's aligning price, but we're aligning time right here. Now, if you combine the two together, you will very rarely lose, okay? And that's what a quarterly theory kill zone is, aligning all those specific times all at once, okay? So there's a little example on the right. Wednesday Q3, we've got a sequential SMT between Tuesday and Wednesday. Then going even deeper, we have a 90-minute cycle sequential SMT between Q2 and Q3, then a 5-minute tCISD, and then a beautiful entry, okay? So to clear one thing up as well, they don't need to be consecutive, you know, quarters overlapping. So it doesn't have to be a daily cycle Q3 and then a 90-minute cycle Q3. It could be, for example, a weekly cycle Q3, which is Wednesday, and then a 90-minute cycle Q3, okay? So it doesn't need to be, you know, daily cycle, then one immediately lower. It could be a daily cycle Q3, then a microcycle Q3, okay? As long as you have at least 2 quarters overlapping, you know, using the entirety of the cycles, ideally from like the weekly and lower if you're taking intraday trades, and then, you know, yearly and sort of below that if you're taking, you know, more swing trades like trading the weekly range, for example, okay? But with that being said, now you guys know the high probability time windows in which you should be trading. You can base a specific kill zone that you execute within every single day. For me, 9 to 10:30, it's always Q3 of Q3. Or if you want to be a little bit more flexible with it, you can wait for specific days to take specific trades at different times. So if you're trading Tuesday, you can look to enter within Q2, of the 90-minute cycle, the daily cycle. If it's Thursday, which is Q4, you can look to enter within Q4 of the 90-minute cycle or Q4 of the daily cycle, for example. Okay, so you can be pretty versatile with it, but try and at least wait for 2 quarters to overlap, 3 for the highest probability, and then anything more than that just is insane precision. Okay, so with that being said, yo, what's going on, guys? Welcome back to a new video. Inside of today's video, we're going to be covering the quarterly theory concept, time-based premium discount. So a lot of people don't actually know about this, and you know, when I teach them about it and whatnot, they're like, okay, I haven't actually heard of this before, but it is pretty cool. Okay, so it's kind of like a very mechanical way to find your premium discount, incorporating that time element. Okay, so instead of being confused, which range do I use, which time frames do I mark this high, do I mark this low, it's very mechanical, and all it is very simple. We're just going to dive straight into it. Is we're looking at the previous higher time frame quarter, depending on what cycle we're trading. Okay, so if we're trading, for example, I don't know, let's say we're trading the daily cycle on a Wednesday, we're looking back upon the previous higher time frame quarter. So the daily cycle on Wednesday, what's our higher time frame to the daily cycle? Would be the weekly cycle, just one cycle above. Okay, so from the daily to the weekly cycle, and then what did I say? Previous quarter. So from the daily to the weekly and the previous quarter, if we're trading on Wednesday, the previous quarter will be Tuesday. Okay, so that is it. It's a weekly cycle, Q2. Okay, so you trade in the daily cycle on, you know, Wednesday, sort of just doing your own thing. Then you move up one time frame, one cycle higher, so from the 15 to the hourly, and you mark out that previous quarter. So if it's Wednesday, the previous quarter would be Q2, because Wednesday is Q3. Okay, and that is it. It may sound complicated, but we're going to go over some examples, so do not worry. And here is a few, you know, of the ranges that you can use, right? So if you trade in the microcycle, you're marking out the previous 90-minute cycle quarter. If you trade in the 90-minute cycle, you're marking out the previous daily cycle quarter. If you trade in the daily cycle, you're marking out the previous weekly cycle quarter. And if you are trading the weekly cycle, you're marking out the previous monthly cycle quarter. Now you can go even lower with this. You can go to the nanocycle, you can go to the yearly, quadrennial, whatever you want. But this is just essentially the concept behind it. Okay, so if we were trading the weekly cycle, then all we'd do is essentially mark the previous monthly cycle quarters range, which essentially is the previous week's range. And when you trade in the daily cycle, you mark, you know, the previous weekly cycle quarter, which is essentially the previous daily candles range. Okay, when you go to the 90-minute and the microcycle, then it's just, you know, not the previous day or previous week. It's just literally the previous 90-minute quarter, the previous micro quarter, all that type of stuff. Okay, so here is an example that I have marked out here, right? So here's Q1, right? Because, right, imagine you take this trade here on the 5-minute, utilizing the 90-minute cycle. You see, you know, bearish 90-minute cycle, SMT, a tCISD, cool, I want to take short, right? How do you then check if you can take a short in terms of time-based premium discount? So let's say this is during a London session of the 90-minute cycle. Okay, so London session, 90-minute cycle. What is our previous higher time frame quarter? Well, we're going to go from the 90-minute cycle up to the daily cycle. And if we trade in London, what's our previous quarter to London? It would be Q1, the Asia session. Okay, so this is the 15. This is where the short took place, around about here. Okay, on the 5-minute, you can see right there the SMT there, right, that I got marked out, literally exactly right there. Price was at a premium, but how do we mark it? Okay, so this is London, right, on the 90-minute cycle. If you was on the 5-minute right there, so you would go to the 15, and the previous quarter to London is Asia. So this is Asia session, Q1 right there. And what do? You literally just mark the high, the extreme high, and the extreme low, and that is your premium and discount. Okay, now we're going to go into some examples as to how to utilize premium discount if you don't understand, you know, which level they're at and whatnot. So let's just jump into that, right? So premium, once you have your range marked, premium is anything above the 50% level, the middle line. Okay, so you've got your range marked from the high to the low, or the low to the high, doesn't really matter, right? And anything above this line here, that 50% towards the upside, right? Anything above there that I've got marked in red is classed as a premium. So this is a time-based premium. This means price is a lot more likely to offer sells as price goes from a premium into a discount. And also, obviously, if price is at a premium, you know, pricing is more expensive, price is likely to pull back, offer a retrace, allow people to get in for that cheaper price, essentially. Okay, and that's all a premium is. And then the discount's the complete opposite. Okay, so premium is the top part, discount's the bottom part. Once you have your range marked, discount is anything below the 50% level, the middle line. So anything below this middle line is classed as a discount, right? And as you can see, price, you know, originally was in a discount, if you remember from the previous slide, and then it came back into a premium. Okay, that first slide that we've shown. So we caught, the shorts once price was in a premium. Price dropped from a premium back into a discount. Remember, it goes from a discount to a premium, premium to a discount, right? So once it comes back to a discount, it then offered longs and traded higher, okay? So you can see how you could have utilized both the longs and the shorts from that first example that we showed on the first slide. So that is how it works essentially, okay? Now, what is an extreme premium and discount, right? So it's the same concept, that time-based premium and discount concept. Previous higher time frame quarter, mark it out, low to high, you got your premium and discount, right? Now, extreme premium is once price trades not only into a premium of that range that you have marked out, but above it, okay? And an extreme discount is once price trades not only into a discount of that range that you've got marked, but below it, okay? So anything above premium is an extreme premium. Anything below discount is an extreme discount, okay? And here's an example, again, utilizing the 90-minute cycle. Right, so this is Q3 of the daily, this is the 15. So this must mean this was on the 90-minute cycle during the AM session, right? So what's our previous higher time frame quarter? Well, if we trade in the 90-minute on the AM session, we go from the 90 to the daily. And if we're in the AM session, we're looking back at London's range, okay? So we're marking out London's range right there from the low to the high, right? We've got our premium discount. Price doesn't only come into a premium, right? It comes above it. It then forms a 90-minute cycle sequential SMT, and then it offers shorts back to a discount and below it, okay? So once price hits these premium and discount levels, what you want to be looking for is those cracks and correlations to confirm price is ready to trade away from that level. So from a premium to a discount, you're looking for a crack and correlation to occur within a premium, and then you can look to take that short, okay? So ideally as well, if you're trading the 90-minute cycle, if you execute on the 5-minute, you want to see a 5-minute crack and correlation in correlation to the previous higher time frame quarter, okay? So in terms of the 90-minute cycle, is an extreme premium in terms of the previous sessions range. So you want to ideally see the crack and correlation occur, on that time frame, that 5-minute compared to the 15 or anything lower, okay? So that is essentially how you can structure it, right? So if you execute on the 1-minute, just always look at the previous 90-minute quarter, see where you're at. Are you looking for shorts? Are you looking for longs? Of course, price won't always go into a discount before giving longs. Price won't always go into a premium before giving shorts. It can just be a confluence, and it can be a part of rules of your model as well, because usually once price is at a premium, the shorts that are going to occur are going to be a lot higher probability compared to shorts that take place, all the way down here, for example, because you're going to be catching the highs and you're going to be catching the lows, right? So what we're going to do now is we'll jump into the charts. We'll go over an example of how this works actually in real time on the charts, just so you guys can understand it that little bit better, okay? All right, guys, so we're now inside of the charts. We're on the 5-minute, and we're going to be taking a look at NQ, going over a few different examples on different timeframes and whatnot, okay? So if you want to backtest this, you want to ideally look for sequential SMTs that are marked out, and then you can look to see if they occurred within that time-based premium discount or extreme premium discount. Okay, so here you can see literally just a few days ago as me recording this video, I think it was yesterday, yesterday, we formed a 90-minute, actually technically it would be part of today's price action. This is the Asia session. So this is the Asia session, 90-minute cycle, 90-minute cycle, 90-minute cycle, SSMTs, and then a beautiful short entry, right? And we can clearly see this is above London's high. So we know that this occurred at an extreme premium, not London's high, sorry, PM's high. So this was, let's mark it out, right? So SMT marked out there, just so we can keep an example during Asia. So we're going to the 15, one time frame higher, and marking out Asia's range, okay? Not Asia's range, I keep saying that, PM's range, sorry, okay? In this case, it's very small because it is obviously, or it was, sorry, a bank holiday. So let's turn this down to the premium and discount one that I like to use. These are my settings, by the way, guys, for premium and discount. And as you can see, anything above 50 premium, anything above at that premium level is an extreme premium. 90-minute cycle SMT occurs there, also a daily cycle, even better, and then clean shorts, okay? So that was a very clean example right there. Now let's just, find a few more. Let's look for that SMT first. So here we go. We have a daily cycle, SSMT. What day did this take place on? On Monday. So we're going to go one cycle higher, one time frame higher, and it's going to be Friday's range that we're marking out, okay? So daily cycle on Monday. So we're going to go to the hourly for the weekly cycle and mark out the previous quarter, which is Friday. And as you guys can see, high to low, right there, and we are very, very far below at an extreme discount. Again, another example of an extreme discount, daily cycle SMT, and then a move higher, okay? So very, very clean stuff there. Yo, what is good, guys? Welcome back to a new video. Inside of today's video, we're going to be covering one of the most key concepts within trading in general, not just quarterly theory, but in general, and that is draw on liquidity, or DOL, okay? Essentially, the draw on liquidity is one of the most important trading concepts. Without it, you are essentially trading blind. Without knowing the DOL, every concept and model out there will fail. A draw on liquidity is an area the price wants to draw towards, and there are many ways to identify them, okay? So there's a quick little brief overview. As you can see to the example on the left, it's essentially points in the market that price wants to draw towards, okay? So if you're, looking for shorts here, but price wants to take this high, your bearish concept, your bearish model is going to fail, okay? So what we're going to be doing is covering the different ways in which you can find the draw on liquidity, the most effective ways, and how to know, if the draw on liquidity is actually real and if it's going to hold and whatnot, okay? So let's just jump straight into it. So the first draw on liquidity is previous X highs and lows, which can be previous quarter high or low, or previous candle high or low, okay? As we all know, a quarter is and can be a candle. For example, if you're trading the weekly cycle in terms of quarterly theory, the previous quarter high is essentially the previous candle high, the previous day's high, okay? So as you guys can see on the example to the left, previous day's highs and previous day lows act as great draws on liquidity for that intraday, that daily bias. If you're coming into the day bullish, you want to be trying to target that previous day high, for example, okay? Same thing with trading the quarters, intraday, can be on the 90-minute cycle, microcycle. If you're bullish for that specific cycle, you want to be targeting the previous quarter highs, and if you're bearish, you want to be targeting the previous quarter lows, okay? So if you look back upon all the previous candles / quarters, they all have something in common. They almost always take the previous candle high or quarter high or low, okay? So literally go back in your charts, look at the daily candles. What does almost every single daily candle do? And not even daily, but every single candle in general, even on the 15, the 5, the 1 minute, it almost always either takes the high or the low of the previous candle. So that can be one of your most prominent, your most strong draws on liquidity. Once you've established that bias, that is your main draw for that current candle that you are trading, okay? Now, our next draw on liquidity that we have is unmitigated gaps. So an unmitigated gap is essentially a fair value gap that has not yet been traded into, okay? As we know, price likes to reject away from gaps, but before it can even reject away from one, it must first trade into that gap, right? So as you guys know, fair value gaps are great for holding price. You can look for trades inside of them, but before price even gets inside of them, it has to draw into it, right? So not only can you take trades away from gaps, you can also take trades into gaps, right? So if you see, 2 or 3 or even one huge gap left behind in price, you can often anticipate price to pull back into that gap, right? So price will usually seek a fair value gap after liquidity has been taken, and think in terms of external range liquidity taken, right? And then back to internal range. So once we take those previous day's highs, that previous quarter high, previous quarter low, then we can look for that move back into internal range liquidity, which is essentially fair value gaps, okay? So as you guys can see in this example right here, price left behind a pretty decent size fair value gap here, while offering a reversal candle signature as well, so indicating lower prices. And then you could have looked for a short into that gap right there, okay? So open high, once price was all the way up here, you look for a short in towards this gap over there, okay? And like I said, it often works great when there's many gaps left behind, when price is super overextended. At that point, it makes sense for price to retrace, rebalance those gaps, right? So that's on mitigated gaps. Next, we have a low resistance liquidity. Now, this is one of my favorite types of liquidity. Low resistance liquidity is multiple failure swings in a row. So instead of seeing price take liquidity, it actually fails to do so, and as a result of this, builds up even more liquidity, right? So once the low resistance liquidity has been built up, it then acts as a great draw, and price often slices through it very cleanly, okay? So visual representation of low resistance liquidity is multiple failure swings in a row. So it's like trend line liquidity, okay? Imagine pulling a trend line just like diagonal of loads of liquidity left behind or down, for the highs. As you can see, 1 failure swing, 2, 3, 4, 5, 6, 7 right there. So 7 failure swings all in a row. And then as you can see, the delivery to those low resistance liquidity lows is very clean. Price just slices through them cleanly, no hesitation, just straight through all of them, almost, within 4 or 5 candles or so, okay? So that is what low resistance liquidity is. It's essentially just points in the market where there's a lot of liquidity built up, and price often delivers straight through it very nicely, okay? And now final type of liquidity is equal highs and lows, okay? So I'm sure a lot of you guys know what these are, but essentially equal highs and lows are 2 liquidity points that align with each other perfectly or almost perfectly. They act as a great magnet for price. It's essentially the market leaving behind multiple points of liquidity, therefore making it a high probability draw for price. So like low resistance liquidity, it's essentially the market failing to take liquidity in the first place, therefore building up more. Therefore, that area where it's built up the liquidity becomes a very strong draw for price. So as you can see in this example, we have liquidity here, right? Then price was drawing towards it. It just failed, creating almost perfectly equal highs. Bear in mind, equal highs don't need to be the exact same level to the tick. It can be a little bit lower down below, as long as it's like pretty clear like that, equal highs, right? So as you can see, equal highs left behind, price retraces lower and then delivers very cleanly towards those equal highs, okay? So whenever you see equal highs and lows on your chart, they often do act as a very nice draw on liquidity. So yeah, with that being said, that is going to wrap up this video. Just nice, short, to the point, liquidity explained in under 7 minutes right there for you guys. The 4 different types of liquidity points I like to use. And yeah, once you pair this with the candle closures and the cracks and correlations, and then you identify the draw on liquidity with a clean model, you're going to be, good to go, and you're going to be navigating these markets very, very well.
Hello guys, welcome to the how to find your daily bias video, incorporating quarterly theory and candle closures. I can guarantee that by the end of this video, you will all know how to find your daily bias with ease every single day. And also, of course, knowing your daily bias is a very, very important part of trading, because most of you guys are probably intraday traders, and if you are trading intraday, all of your setups, all of your sequential SMTs will fail if you're not trading in line with where the daily candle is going to go. So without wasting any more time, let's go ahead and just jump straight into it. So the first thing is candle closures. This is one of the most important ways, if not the most important way, of framing that daily bias. The way a candle closes tells us, it gives us insight on what that next candle is likely to do. So go ahead, take a screenshot of this and really study how these candles actually give you insight on what the next candle is likely to do. So for the continuation day, we're wanting to see the previous daily candle close above or below that day's previous daily candle. So as you can see in the example to the left, we have 3 days. Day number 2 closes above day number 1, above the wick, okay? So when I say closures, I don't mean the body, I mean the wick, okay? And then you can see day number 3 delivers to the upside, okay? For the reversal candle, we want to see price wick below or above the previous daily candle. So candle number 2 wicking below candle number 1, and then following that, we need to see candle number 2 closing back inside of candle number 1's range, okay? So as you can see, the down close candle, we wick below it, and then we close back above that candle's wick, okay? So remember, this is all about the wicks, not the bodies, okay? So you can see closure back above the wick, and then the following day delivers to the upside, okay? So that's when we know our reversal has been initiated, because there is always going to be a swing point before every single reversal, okay? Now for consolidation, all we need to see here is a candle, a daily candle, fail to take out the previous day's high or low, okay? Both of those, we don't want to see the high or low taken. And then once we see this happen, usually day number 3, the following day, will be a pretty aggressive candle, either taking out both sides of the range, the previous day high and previous day low, or you'll just see one aggressive move to either side. So just absolutely running through the high or absolutely running through the low, okay? So look below for the continuation, close above or below equals higher prices, or if you're bearish, lower prices. For the reversal, wick below, closure back above the previous candle's wick equals higher prices. And for consolidation, failure to take previous candle high or low, indicating that we are range bound, okay? So really study these candles, understand how it gives us insight into the following candle. Now to be taking a look at Sequential SMT, SSMT. If you haven't already, go ahead and check out my video on my channel about that if you don't know what it is. But essentially all it is SMT between 2 consecutive days in terms of the weekly cycle, okay? So this is how it should look. We want to see the quarter that we're trading inside of run below the previous quarter low in a bullish scenario, or run above the previous quarter high in a bearish scenario. So as you can see, this here is a bullish scenario. Q3 runs below Q2's low, and then we get some nice displacement. We got our tCISD to the upside. And now once this SSMT has taken place, we know that we can expect distribution because SSMT is our manipulation or sign of reversal. But remember what we learned about candle closures, we must see a nice candle closure that aligns with the SSMT, okay? So bullish SSMT, if we don't get the reversal signature candle closure, which remember is a wick below and a closure back above, if we don't get that, it's very, very hard to trust the bullish SSMT, okay? So whenever we see bullish SSMT or bearish, we need to take a look at the daily candle the following day, see how it closes, and see if we can expect candle number 3 the following quarter to distribute, okay? So this is why distribution comes after manipulation, because we have the candle closure and the SSMT supporting it, okay? Next, we're going to be taking a look at monthly cycle SSMT, which is of course SMT between 2 consecutive weeks, okay? So whenever you see a large amount of candles run below, like on the example to the left, and then we close back above, make sure to drop down to the 4-hour chart and see if we have any monthly cycle SSMT, okay? So what I like to do is look at the 4-hour, see if we have any monthly cycle SSMT occurring within the week that I'm trading. If we do, let's say for example it occurs on Monday, I'm then going to wait for Monday to close and see if we get the candle closure for the reversal signature. In this case we do. You can see in the example to the left, the daily chart, the large up close candle, wicks below the previous week's low, while closing back above that candle's wick back into the range, okay? So when we see this happen, we can anticipate the following day and even more days to be bullish, because remember this is SMT between 2 consecutive weeks, so it should be a lot more longer lasting, okay? Next, we have combining candle closures with sequential SMT. So like I've been mentioning in the video, we must see the candle close in our direction to support whichever SSMT we have forming, okay? So always look at that weekly cycle on that 1-hour time frame. Whenever we see a weekly cycle SSMT take place, of course we can trade on the same day that it takes place on, after it's been confirmed, as always, but it also gives us insight on what the next day is likely to do, okay? So if we get the reversal signature candle closure, which is the wick below, closure back above, what can we expect the following day to do? Deliver to the upside, okay? So weekly cycle SSMT, wait for the day to end, look at the candle closure. As long as we didn't close below the previous candle's low, and we actually wick below, but then close back above into that previous candle's range, then we can expect day number 3, the following quarter, to trade to the upside. So you guys can see how quarterly theory incorporates actual singular candles and how it can give you insight on what the next candle is likely to do, okay? Now, last but not least, let's go over an example of a weekly profile incorporating SSMT plus candle closures, okay? So as we know, if we're coming into a week, we must have a weekly bias. We can have a weekly bias. We can do the exact same as taught in this daily bias video, because price is fractal, okay? So whatever happens on the daily chart will happen on the 1-minute chart, it'll happen on the weekly chart, okay? So do your analysis. What is the week likely to do? Okay, if we're bullish, what do we expect the first half of the week to do? Manipulate to the downside. And then how do we confirm this? Well, we confirm it by looking for a weekly cycle sequential SMT, wait for that day to close, the one that formed the SSMT. If we close back above, what can we expect? Higher prices, okay? So Monday opens up low, trades to the downside. We then have Tuesday open up, take out Monday's low. Tuesday then closes back inside of Monday's range after wicking below Monday's low, while also putting in that weekly cycle SSMT, okay? So SSMT and daily candle closures go hand in hand. If we don't have both of them supporting each other, then we can't trust it, okay? We find it very hard to trust if the daily candle closure doesn't align with what the weekly cycle SSMT is telling us, okay? So our reversal signature has begun on Tuesday. We can then of course expect Wednesday to deliver to the upside. And then what do we expect on Wednesday? Well, if it closes above Tuesday's high, the wick, which you can see it does in this example, then what can we expect Thursday to do? Bullish again. If Thursday closes above Wednesday's high, what can we expect Friday to do? Again, bullish, okay? So closure above equals higher prices, wick below plus closure above equals higher prices, okay? And then we know for consolidation, which is a lot more rare, it's very rare that you'll find a candle fail to take out the previous candle's high or low. Maybe it'll happen once every 1 in 10 candles, but when we expect that, we know that we're dealing with consolidation, and we can expect the following day to be a pretty aggressive move, either taking out both sides of the range or just pushing towards one side, okay?
Combining sequential SMT with candle closures has allowed me to get 3 or 4, I don't even know, payouts in the past couple of weeks now. I'm literally losing track. So these two concepts paired together are extremely powerful. And inside of today's video, I'm going to be showing you guys exactly how you can combine them to reach the maximum precision in your trading. So let's go ahead and jump straight into it. So the two confirmations behind my A+ setup, okay? Candle closures, sequential SMT. That's it, right? Now, candle closures confirm sequential SMT, and sequential SMT confirms candle closures. Now, don't go anywhere just yet. I know that may be confusing, but we are going to be diving deep into both of those and explaining exactly why and how, okay? When you combine these two concepts, you unlock a new level of precision, and in today's video, we'll show you exactly how to do so, okay? So firstly, let's jump into the candle closures, right? So we have bearish candle closures and bullish candle closures. Now keep in mind, a bearish candle closure doesn't mean the candle closes bearish. Well, it does, but when we're looking at these specific types of closures, it doesn't mean it in that regard, okay? So for example, a bearish candle closure, if we look into the left, we have a bearish continuation candle closure and a bearish reversal candle closure, right? Now, the continuation one, I'll hover my mouse around it. As you can see, closes below the previous candle's low, the wick, like the lowest of wick, not the body, not, halfway of the body, nowhere else, below the wick of the previous candle. And this candle here, we must close below it. So the closure of this candle must be below the wick, okay? Now, a bearish reversal candle signature is where we trade above the previous candle's high. So at some point during this candle, we were above the high of that previous candle. However, we failed to close above it. So we wicked above it, and the closure of this candle closed back inside of that previous candle's range. They didn't close above the wick of it, right? If it did, that would have been a bullish continuation, but it didn't, okay? This is a bearish reversal candle signature. So wick above, failure to close above, and we close back down below, equals bearish reversal candle signature. Now, this candle wicked below and also closed below. So we actually accomplished, we managed to close below the previous candle's lowest wick. This is a bearish continuation candle signature, okay? Now, exact same for the bullish scenario, but just opposite directions. So a bullish continuation candle signature is when we have a candle, body close, above the highest wick, so literally above the wick on the high of the previous candle. So this is the wick. We have a body closure of this candle above this wick, okay? Bullish continuation candle signature. Now, same for the reversal. We wick below the previous candle's low, but we failed to close below it, okay? Wick below this. So at some point during this candle, we were below the wick of this candle, but we failed to close below it. We pull back up and close back inside of this candle's range here, okay? So if we would have closed below of this candle, below this wick, that would have been what? A bearish continuation candle signature. Now, the reason why this is a bullish scenario, because yes, if we would have closed below it, it would have been a bearish continuation candle signature. But we failed to close below it. Therefore, we failed to get the bearish candle signature. Therefore, it's what? It's bullish. It's a bullish reversal. So bullish reversal, bearish continuation, bullish continuation. Okay, super simple. Screenshot this if you need to do so, and just study these candle closures here. Okay, they may look, they may look familiar. I'm not claiming that I made these candle closures myself. I've seen many people speak about them on the internet out there, but these are super powerful. This is just your, classic swing point, right? But these candle closures alone don't mean anything, right? Like once we see this, it doesn't mean we just short. This is then when the sequential SMT comes into play. Okay, now what is sequential SMT? Many of you guys watching probably already know what it is, and if you do, just skip forward a couple of minutes. If not, sequential SMT is SMT between at least two closely correlated assets. So for example, NQ and ES. You can use three, so you can use NQ, ES, and YM and look for SMT between those three, but it must happen between at least two. And what must happen? Essentially an SMT between two consecutive quarters and using the highest high or lowest low of the previous quarter. So within quarterly theory, we have 4 quarters: Q1, Q2, Q3, Q4. Okay, on the daily cycle, Asia is Q1, London is Q2, New York AM is Q3, New York PM is Q4. So what do we need to see? Two closely correlated assets, it can be NQ and ES. Two consecutive quarters, so it could be Q1 and Q2, Asia and London, and the highest high or lowest low. So the highest high of Asia may get run above on NQ, whereas ES fails to run above the highest high of Asia, which is literally exactly what happens in this scenario. In this case, NQ fails to run above Q1's high, the highest high. So you mark out the highest high. Did we go above it at all during Q2? No. However, ES, mark out the highest high of Q1. Did we go above it during Q2? Yes, we did. Now, this is obviously fractal. Q1 could mean Monday. Q2 could mean Tuesday. This could be a weekly cycle, Monday, Tuesday. This could be a daily cycle, Asia, London. Could be a 90, could be a micro, it could be anything. Monthly cycle. Obviously, we know that quarterly theory is fractal, and we can find our quarters on any time frame, any cycle. Okay? So, now that you guys know all of the candle closures, you know what sequential SMT is. Now let's dive into how we can combine the two together. Okay? So, combining candle closures plus sequential SMT, number 1. This is part 1, the second page will be part 2, okay? Because, like I said, candle closures confirm sequential SMT, and sequential SMT confirms candle closures. In this specific page here, I'm going to be showing you how candle closures confirm sequential SMT, okay? So, sequential SMT, then we must see the correct candle closure to confirm it, okay? Multi-cycle sequential SMT, then we must see a weekly candle closure. So what this means is, let's say for example we have a bearish multi-cycle sequential SMT, like in this picture down here. You can't see the second asset, but just imagine that this asset failed to run above the high of that quarter, and another closely correlated asset ran above its high. So that is a bearish multi-cycle sequential SMT. Now the quarter where sequential SMT takes place, we must see that higher time frame candle close correctly. Okay, now stay with me. Obviously, when looking at the monthly cycle, it's essentially weeks. It's weeks of the month. So Q1 is week 1, Q2 is week 2, Q3 week 3, Q4 week 4. Okay, same with the weekly cycle. Q1 is Monday, which is a daily candle. Q2 is Tuesday, which is a daily candle. So essentially, a monthly cycle sequential SMT, its higher time frame candle is a weekly candle, right? Because each monthly cycle quarter is 1 week, right? So imagine this is a sequential SMT between Q1 of the monthly cycle and Q2. So this is one weekly candle, this is another weekly candle. All sequential SMT is SMT between those higher time frame candles, right? So imagine now we have a sequential SMT Q1, Q2, right? This is Q1's candle, this is Q2's candle. So we run above Q1's high, we have the sequential SMT, and then obviously you can enter within that quarter. That quarter to me is a manipulation quarter, right? Obviously we can trade the following quarter as distribution, but how do we trade that distribution? How do we know it's going to be distribution? Simple, using the candle closures right here, okay? So yes, you can get into a short during this candle, but then you can also be confident to take a distribution short the following candle, because look at this candle. What is this? A bearish reversal candle signature. What is this? A bearish multi-cycle sequential SMT. So do you see how the sequential SMT is now confirming that this is a high probability bearish reversal candle signature? Okay, and this is obviously fractal. So a weekly cycle sequential SMT, imagine this is Monday, imagine this is Tuesday. We must then see a bearish reversal candle signature close on Tuesday. and then we can trade Wednesday for that distribution to the downside. Keep in mind the the asset that doesn't actually quite create a bearish reversal candle signature here, like you can still trade that one as distribution to the downside. Okay, daily cycle sequential SMT. So this is SMT between Asia and London, for example. This is Asia's candle. This is London. Which candle do we use? The 6 hour. So 6 hours, 6 hours. Why? Because each daily cycle quarter is 6 hours long. Okay, so its higher time frame candle for that quarter is 6 hour candles. We have 4 6 hour candles during the day. So this can be Asia, London. This is six hour candle runs above the previous 6 hour candle high. We have a sequential SMT between the two 6 hour candles, which is what? A daily cycle sequential SMT. Then we can confidently trade the following 6 hour candle as distribution to the downside. So this could be London manipulating above Asia highs, confirmed by a bearish reversal candle signature, confirmed by a bearish daily cycle sequential SMT, super high probability shorts coming into the AM session. Okay, same 90-minute cycle sequential SMT, 90-minute candle closure. Now, once we can see these candle closures, because we can see that sequential SMT has now confirmed the candle closure, then how do we now confirm this candle closure using sequential SMT? And that brings us into part 2. Now combining candle closures plus sequential SMT part 2. This is then when sequential SMT confirms our candle closure. So we've established a candle closure. We know it's a bearish reversal candle signature. We know it's a bullish continuation candle signature. Whatever it may be in this scenario, as you can see, we have a bearish reversal candle signature, which in the last example was confirmed by a sequential SMT. So now we're looking for distribution on this candle here. Candle number 3. This is our classic swing point, and this is when swing points work. Okay, this is when CRT works. Whatever you guys trade, this is then and only when it works. And we're looking at this candle here to be confirmed by a lower time frame sequential SMT. Okay, so weekly candle closure, we look for a weekly or daily cycle sequential SMT of this following candle. Okay, daily candle closure, we're looking for a daily or 90-minute cycle sequential SMT of this following candle here. Okay, 6 hour candle closure, we're looking for a 90-minute or microcycle sequential SMT. The reason why there's 2 sequential SMTs, the first one is best case scenario, the second one is like a backup. Okay, because we're not always going to get a nice clean, for example, daily cycle sequential SMT to confirm a high or low of the day. Ideally we do, that's best case, but most of the time it will be like a 90 minutes. If there's no daily, look for a 90-minute. Okay, so for example, weekly candle closure is indicating bearish based on this bearish reversal. Obviously, we're looking to trade this following candle number 3 here. We're looking for a weekly cycle or daily cycle sequential SMT. Obviously, a weekly cycle ideally, is our high of the week, but it won't always be. So we can look for then a daily cycle, and this can be, for example, a bearish daily candle closure. So let's say we got Wednesday. This is a bearish reversal candle signature indicating what? Lower prices. We're trading Thursday. The Thursday candle has what? Opened up high. We're looking for shorts already. We know our bias based on the candle closure. And then we're looking to confirm our shorts off this candle by what? Well, a daily cycle, best case scenario, or 90-minute cycle sequential SMT. Okay? Then obviously, you can use entry technique, whether it be a tCISD, inversion, whatever it is, to get yourself into that trade. So here's a little example right here. This can be fractal. So let's just imagine this is a daily candle closure. So like we just said, this is Wednesday. We got a bearish reversal candle signature. We're looking to trade Thursday. Then during Thursday, we form this beautiful daily cycle sequential SMT. I don't know, between London and New York AM. Then we have our entry technique, tCISD. Then we can take our entry at the tCISD, stop on the sequential SMT high, and look how this candle flips. So we've confirmed our bias for this day based on the previous day's daily candle closure. Then we've confirmed our current daily candle that it is going to trade in line with this candle closure through what? Sequential SMT. So this whole sequence here is a real 2-stage sequential SMT. Okay, that's what it's always ever been. Higher time frame sequential SMT, right? Then lower time frame sequential SMT on that following day to confirm your distribution candle to where? The downside based off what? The bearish reversal candle signature plus the sequential SMT that occurred between these 2 days to confirm this as real manipulation. Okay? Now that I know this video might be a lot for some of you guys, watch it back as many times as you need to do so. that is completely fine. But once you do get your head around this, it makes reading price action so much easier. It's like one of those things you can't really teach. Like, you can watch this video lots and lots of times and you will begin to understand it. But it's just one of those things that, like, when you see it, like, when you know. So watch it back as many times as possible. Any questions or anything like that, drop them in the comments. I will try my best to get back to every single one of them. To a new video. Inside of today's video, we're going to be covering my 90-minute tCISD model, also known as the freedom model, the model that has allowed me to get many payouts and also pass many funded accounts. But not only myself, it has also allowed lots and lots of traders to become profitable and request huge payouts. So that is amazing to see. So I feel like it would have been a little bit rude not to sort of cover it again and go in depth within the model just that little bit more, show you guys a few examples on the charts as well of it playing out in real time, and also getting a little bit more in detail, telling you guys when you should be taking the model, when you shouldn't, and all that sort of stuff. Okay, so without wasting any more time, let's go ahead and jump straight into it. So the first page, elements behind the model. So there's 4 simple steps behind this model. Number 1 is you must have a clear bias / draw on liquidity. And this means you must know where price is heading before it actually gets there, right? You must know which high or low price is trading towards. And you want to know the narrative, why price is trading towards there. Once you've got all that figured out, which, by the way, we're going to get into detail of every single one of these steps as well in just a moment. Just think of this part here as like your checklist first, okay? Step number 2 is once you know where price is heading, then you're going to be looking for a sequential SMT, a SSMT, which is a cracking correlation between closely correlated assets, indicating a shift in direction. So step number 1, we know where price wants to go. Step number 2 is that indication that price is ready to start trading towards the high, for example. Step number 3 is then our true change in the state of delivery, our tCISD, which is a confirmation tool of our sequential SMT. And all it is a candle closure above or below the candle that created the SSMT, okay? Step number 1, know where price is going. Step number 2, wait for that indication of the shift in direction towards our drawn liquidity. Step number 3, use the tCISD to then confirm the sequential SMT is likely to hold. Step number 4 is the final one, the timing element. All trades must be taken within the window 9 to 10:30 Eastern Standard Time. Right, you can trade this model any time of the day. You can even find your own specific 90-minute windows. That's completely fine. However, the one that I personally trade, the one that I have got most of my data with, is between 9 to 10:30. However, it does work 24/7, okay? And what I recommend to my students as well that can't trade the 9 to 10:30 window is they pick another window, a 90-minute window, so a 90-minute quarter, either Q2, Q3 of London session, Q2, Q3 or Q4 of the AM session, or Q2, Q3 of the New York PM session. So pick one specific 90-minute window that works with your schedule and then stick to that day in and day out. Before that time window starts, you don't look at the charts, you don't take a trade. A minute after that window is over, you close down the charts, you get on with your day, okay? Simple as that. This is then going to eliminate any potential over trading. Also, the model itself is only going to be able to form a few times within that window. So you're not actually going to be able to overtrade and take dumb trades, because until the model's there, you're not going to take anything, okay? But before we do go ahead and get started, I just want to mention something to you guys that I've never done before. As you guys may know, I do run a one-to-one mentorship, the Quarterly Mastery Circle. And as it is coming up to Black Friday, we're going to be giving away one spot completely for free. By the way, we charge thousands for this mentorship, and one lucky winner can win this completely for free. But it's only for people that are really locked in, that actually want to transform their trading. We've taught many traders from non-profitable to over $500,000 in funding in just 2 months. So if you guys like the sound of that and want to be a part of it, I'll leave a link below in the description. Top link in the description. Go ahead, click on that and just fill out a small form. It won't ask you for any, credit card details, anything like that. Just a form, and then you will be applied and you will be notified if you are the winner of the free one-to-one mentorship slot, okay? But anyway, now let's jump back into the video. Now we've got our checklist. Let's go ahead and break down each individual part of the checklist one by one, so you guys know exactly what you are looking for, okay? So step number one is that bias, right? So the way that I find bias is very, very simple. There's 4 simple tricks that I use, right? And you don't need to use all 4. This is just more or less if you want to be super, super advanced. You could literally stick to number 1, which is daily candle closures, and just call it a day. But obviously this is for people that want to increase that win rate, want to get that higher level of precision. So step number 1 is daily candle closures. So if you haven't already, check out my daily bias YouTube video. There's one in the bootcamp and there's one just elsewhere on my YouTube as well. If you just search daily bias, go ahead, watch that video. It will essentially show you visual representations of how each daily candle closure should look in order to know if we're going to get reversal, a continuation, if we're consolidating, all that sort of stuff. Essentially, it is if price closes above the previous candle's high, the wick, then we can expect a continuation the following day. If it wicks above the previous day's high, but fails to close above it, then we can expect a reversal. So I just sort of apply those, but then we add the cracks and correlations as well, right? So number 2 is monthly cycle or weekly cycle, SSMT, which, as you guys know, if a weekly cycle occurs, for example, between Monday and Tuesday, that can then give us the bias for Wednesday, potentially even Thursday, and potentially even Friday as well, okay? Because think in terms of distribution, continuation, and then a potential discontinuation higher again within the final quarter, okay? Step number 3, we've got daily time frame, PSP/SMT-Fill. So again, just go to the daily time frame. Have we printed a PSP? Have we got an SMT-Fill? These are all cracks and correlations that can allow us to know when price is going to shift direction or if we're going to get an expansion, for example, okay? Number 4, the final one, the most simple one, is are we respecting or disrespecting a raise, specifically on the daily time frame? So do we have a bullish daily gap? Are we trading inside of it and then rejecting higher from it? If we are, that is a very simple way to know that we are still bullish. But if price closes below that gap, disrespects it, then we can be thinking, okay, we're probably going to have a shift in direction here. The daily time frame may shift to bearish now, okay? So again, note these all down. Just keep mental note of them. It takes 2 seconds to open up your chart, go to the daily time frame, and just look for these 4 simple things, okay? So do that, keep that in mind, and you'll be good to go. Number 2 is draw on liquidity. Now, the 4 draws on liquidity that I use is previous X highs and lows. So X means previous day high or low, previous session high or low, previous 90-minute high or low, previous week high or low, previous month high or low, okay? All sequential, all previous week, month, year, day, session, 90-minute window, micro session, okay? You guys get the point? Those are obviously usually very great targets. Number 2 is unmitigated gaps. So what this means is a gap that has formed within price and that we haven't traded back into yet, okay? So essentially just a wide open gap. Price has not traded back into it yet because we know that usually price does trade towards the gaps. It rebalances the range and then trades higher from there. So we can take the trade away from the gap, but we can also take a trade towards the gap in anticipation that it will get filled, okay? Number 3 is premium discount, a raise, and liquidity. So literally pull a fib from the high to the low of like the dealing range. And if we're in a premium, mark out your discounted liquidity, discounted fair value gaps, order blocks. The way that I like to find premium discount is previous higher time frame quarters range. So if we're trading the daily cycle on a Wednesday, for example, literally go to the hourly time frame and mark out Tuesday's range, low to high, and then boom, that is our premium discount for the entirety of Wednesday when looking at the daily cycle. And you can mark out those liquidity pools in a premium, the fair value gaps, all that good stuff, okay? Because we know that price likes to go from a discount to a premium back to a discount, right? Number 4 is previous candle high or low. So same with like the previous X highs and lows, previous quarter high and low. Those usually do align with the previous candle high. For example, previous day high or low is, again, you know, if you're trading Wednesday, then that is Tuesday's high or low, for example. But yeah, like this is a video that I'm going to go more into depth with as well, like the previous candles highs and lows, because understanding the anatomy of a candlestick is very important. And it's something that I use within my trading, like a very, very large amount. Is if you go to a chart, there's always something that you'll find in common, and that is the previous candle high or low usually always gets traded to. So if you're trading, for example, an hourly candle at 9 a.m., for example, and it hasn't taken 8 a.m.'s high or low, you know, if you can identify which one it's going to go for first, you can look for the entry model in line with that. And like I said, there's a very high chance that it will take that previous candle's high. So it's almost a guaranteed, like, not really like a guaranteed TP, but a guaranteed trade that could occur within price, right? If you've got like an 80% chance of knowing the 8 a.m. high is going to get ran during that 9 a.m. candle, and you look for this 90-minute tCISD model in line with that, and just take TP at 8 a.m. high and potentially even runner, then you're going to be ahead of 99% of people just with that knowledge in mind, right? So yeah, those are the draws on liquidity. Having a clear draw on liquidity is key. First, identify where price is headed. Then that's when you can focus on your entry, which is what we're going to jump into now. Firstly, once we've identified where price is going, now we're looking for the entry model, which is a simple sequential SMT within 9 to 10:30 window. And it can be a daily cycle, a 90-minute cycle, or a microcycle. It doesn't have to be all of them. It doesn't have to be two of them. It can only be one. It can literally be a microcycle, that's it. Or it can be a daily cycle and that's it. The reason is, excuse me, the reason is why it can be any is because once we've identified that draw on liquidity, we don't need to wait for 2-3 stages of sequential SMT to form to get into the move towards the draw, right? Like you only need one. As long as you can clearly identify that price is traded lower, form some sort of sequential SMT. So, price is here, right? It just drops a little bit lower, maybe at 9:30, for example. It's formed a microcycle. Maybe the daily cycle low is like all the way down here. So it logically doesn't make sense for price to go from here all the way down there. This is then when we're looking for the microcycle here, for example, right? And I don't know, let's say there's a 15-minute gap to our left as well, even higher probability. It takes it, and then boom, our drawn liquidity is all the way up there, and it just trades straight to it, okay? So just think, like, does it make sense to go all the way for the daily cycle low? Or does it make sense just for a microcycle to form? Usually if the draw's very, very close nearby, it doesn't need to manipulate that far. Just a small little wick lower, microcycle or a 90, and then boom, off we go, okay? Also, a thing to keep in mind is if we're waiting for a microcycle to form and all assets run below the previous microcycle quarter low, right? Then we know that we can't get a microcycle sequential SMT. So then we work our way down. Okay, cool, we can't get a micro, so now we're waiting for 90. Oh, all assets traded below the 90-minute low. Now we know that we're looking for daily, right? So you can do that like process of elimination as well to help you know which sequential SMT is going to form, which one's going to hold, all that good stuff, okay? So it can be one or multiple. Once the drawn liquidity is clear, only one is needed. Bullish sequential SMT takes place below the true open, as always. Bearish sequential SMT takes place above the true open, as always, okay? Super, super simple. If you don't know what a sequential SMT is, go ahead and check out my SSMT video on my YouTube channel. It's literally the very first video that I ever posted. Scroll all the way to the bottom, go ahead and take a look at that one, okay? So now, one sequential SMT, what comes after that? A true change in the state of delivery, a tCISD. So now, what a tCISD is, for example, a bullish tCISD is a candle closure above the candle that created a bullish sequential SMT, and that candle must be bearish. So here's a visual representation of a bullish sequential SMT, right? Which candle first ever created the sequential SMT? It wasn't this one. It wasn't this one. It wasn't any of these. It was this very specific candle here that we've marked out the open of. If you draw a straight line, boom. That very candle created the sequential SMT first. So then, in every single case, that candle itself is our tCISD candle. But the catch is, in a bullish sequential SMT, this candle has to close bearish, right? If it does that, cool. Mark out the open, wait for a close above, and then you're good to go. However, if, let's say, for example, this candle that created a bullish sequential SMT closes bullish itself, then we look to our left within price. So we're looking left, 1, 2, all left here, right? Then you just mark out the most recent bearish candle, okay? Recent bearish candle, okay? The open of it. So if this one closed bullish and this one closed bearish, mark out this candle's open, wait for a close above, boom, we have our tCISD confirmed, and now we have everything that we need. And then in the case of a bearish tCISD, a candle closure below the candle that created a bearish sequential SMT, and that candle itself must be a bullish candle. So literally it's just the opposite, right? So bullish sequential SMT, the candle that created it has to be bearish. If it isn't, look to your left, look to the most recent candles, mark out the most recent bearish one. In a bearish case, the candle that creates sequential SMT has to be bullish. If it doesn't close bullish, look to your left, mark out the most recent bullish one. Always mark out the open of the tCISD candle, and then wait for price to close below it, okay? So here, the tCISD candle, we know it's there, but 1, 2, it wasn't confirmed of these two following candles, it was finally confirmed off this one. And then your entry is essentially just back inside a retest of the tCISD candle. So this one candle, mark it all out, price wicks in once, twice, and then off it goes. You can see a gap overlaps with it as well. That isn't 100% necessary. That just increases the probability of this setup here specifically holding, okay? So now you guys know everything that you're looking for. Let's go ahead and jump into a few examples right here. So, oh, actually, no, never mind. We're missing literally the most important part. Well, essentially, kind of the most important part, if you do want to increase the win rate of the model. Like I said, you can trade it any time of the day, even during Asia, but the time element is what makes this very, very high probability. So, 9 to 10:30 a.m. in Eastern Standard Time, which is New York AM time. Wait, New York AM? Just New York time, sorry. But it is within the New York AM session. That's why I said that. So, the reason why I chose this timing is obviously it is a 90-minute quarter. It is Q3, but it lands perfectly within Q3 of the daily cycle. So it's Q3 daily cycle, Q3 90-minute cycle. As you can see, Q3 within Q3. And what do we know about Q3? Q3 is generally one of our highest probability quarters. It will often offer like the main bulk of the candle. It'll often offer the distribution. If it doesn't, it will usually give some clear manipulation and then begin distributing right after, okay? So within this time window, not only that, we have many volatility opportunities, specific trading indices for the open, but for the rest is completely fine with forex and, you know, commodities, all that stuff. Actually, the 10 a.m. open isn't there on those, but either way, it is still a very high probability quarter, but more or less better if you are trading indices. So we've got that 9:30 open, 9:45 news, 10 a.m. 4-hour candle open, and also potential 10 a.m. news, okay? So we've got the chance of potentially 4 volatility windows just within that small, tiny 90-minute window itself, okay? And even if we don't get 4, there's guaranteed 1 at least every single day because 9:30 is always going to open, right? So there's guaranteed 1 volatility injection every single day, as opposed to trading a random 90-minute quarter within Asia. There's no guaranteed volatility injection. And in fact, I don't think there's ever any volatility getting injected at that time, right? So this is why I chose this specific window, not only because it's Q3 of Q3, which is the bulk of the candle most of the time, but we've got many volatility opportunities, and also these volatility windows specifically, if you see those specific timings create, for example, a sequential SMT and then a tCISD model, those are very usually high probability, like 9:30 may open up and clearly manipulate some lows, creating a nice 90-minute tCISD model, or 9:45 may manipulate and create a nice 90-minute model, right? So it's all combined with those timings to make it even higher probability, okay? And if we form the model prior to those timings being released, the 9:30 open, then you can expect the open, for example, the 9:30 open to distribute, right? So if you form the setup prior, you can take it, stop on the SMT low, and then literally ride that 9:30 distribution higher, okay? So with that being said, that is now covered everything within the actual model itself. So let's jump into a few examples we've got down here, okay? So this is example number 1. This is a daily chart, right? So purely looking at daily candle closures, this is what I mean. You can just use daily candle closures alone. In this case, this did close as a PSP as well. But what type of candle closure is this? So it wicks below the previous day's low, but it fails to close above it and closes back inside of this candle's range, okay? So it wicks below here, but it doesn't close below here. It fails to close below here. This is an indication of a reversal. So this is a bullish reversal candle signature. So we can come into this day here expecting higher prices, okay? Think of this day as our manipulation, and then we're using the cracks to sort of confirm that as well. So in this case, it closed as a PSP. So we've got a crack, we've got a bullish, obviously indication of a reversal, and then we're expecting distribution within this day here, right? So all we're doing is just, if we know we're bullish or very high chance we're bullish, we're waiting for this candle to open up low, put in a high and then close, right? So on that low, essentially, if possible, when it's put in that wick, or as long as it hasn't printed like a large expansion body already, then we're looking for the 90-minute tCISD model, specifically in line with our bias. We're not going to go against it. We're going to trade only in line with our bias, right? So then you can see, look at the timings at the bottom. I apologize. Hopefully I can remove this blue line. There you go. You guys can see the timings at the bottom there. Obviously we don't start until 9 a.m. But what happens at around about 9:18, we can see that price drops below Q4 of the microcycles quarters low at around 9:18. Then we get our tCISD form slightly before 9:30. It looks like it formed around about 9:28. So then, you mark out the tCISD candle, price retest the tCISD at 9:28. It looks like once again at 9:30, but your stop loss ideally goes on this sequential SMT low, right? So here's our tCISD, mark it out, price closes above it right there. But again, we enter off the retest, so we wouldn't have entered here. You can if you want. The RL wouldn't have been as as good. But then once the tCISD that you marked out is getting retested, wicked, we wick below the body of it. But as long as we don't close below it, then it's still valid. So then you would take your entry here. Stop would go on this sequential SMT low, and then as you can see, 9:30. Like I was just mentioning just a moment ago, tCISD model prior to 9:30 equals 9:30 distributes to equals 9:30 distributes to the upside. Okay. And again, below, the true micro session open, all that good stuff, right? Now let's jump into a second example. Here is a daily chart right here. Here's our continuation candle signature. So this day here closes above the previous day's high. So what does this indicate? A continuation within this following day right here. Again, we'd expect an open low, high, close. And this is what I was meaning, like the previous candle high is almost a guaranteed place for price to trade to once you've established your candle closure, right? So if you got the continuation one to the upside, this high is almost guaranteed. For example, in the previous example, the reversal one, the candle that created that reversal, that candle high, candle number 2 high, is almost just like a guaranteed place for price to trade towards, right? So if that hasn't been taken and you're still trading that 9 to 10:30 window, then you're just golden. It's very, very high probability. So either way, here is our time window at the bottom, as you can see, 9 to not all the way to 10:30, because this again is just a microcycle. The 1 minute chart, these are my favorite. Usually there will be like a daily cycle and a 90, like one of those and then a micro. So you usually have around 2, but honestly, just one micro alone is completely fine. Okay. So as you can see, 1 minute chart. In this case, it was between Q1 and Q2. This actually is confusing for a lot of people. Can you see this is a sequential SMT, right? But this asset specifically here created a failure swing, right? This is a failure swing sequential SMT. So that means if we're marking out our tCISD from here, let me see exactly where it's marked from. Yeah, it's marked from this candle here. But you can see this candle itself didn't run below the previous quarter low. All that means is this candle on the asset that did run below the low, that is our tCISD candle. So say for ES, for example, this specific candle, imagine wicking all the way down there, runs out the low. So on ES, if that candle closes bearish, that would be our tCISD candle, okay? But also we can replicate that within the asset that failed to run below the low. So NQ, for example, failed to run the low. But this is why you got to be looking at multiple charts so you know the specific time of the tCISD candle on ES. Once you've found it out, it looks like on here is around about like 9:26. Mark out the very exact same candle, the open of it on NQ, the one that created the failure swing. Wait for price to close above, which it did here around about 9:27, it seems like. And then we wouldn't take an entry here or here. We would take it off the retest. We retest the tCISD right there. Boom. Stop goes on, in this case, the failure swing sequential SMT low. As you can see, it doesn't get run out. You take the entry at the tCISD, stop on the low, and then boom, just let that run. Okay. So how are you guys feeling at the moment? Are you guys sort of, getting the gist of this model now, seeing how powerful it really, really is? Hopefully you guys are, but that is going to do it for today. Remember, we are giving away a one-to-one mentorship slot, which costs thousands completely for free for our Black Friday celebration. Remember, link below in the description. So if you guys do want to learn this model more in depth and trade alongside me using this model every single day, this is going to be your opportunity. But yeah, with that, hello guys, hope that you're all doing well. Today we have a very special video. I'm going to be giving you guys my own exact entry model, step-by-step process that I follow day in and day out. So this is what I like to call the 90-minute tCISD model, or the freedom model, as it only requires you to be on the charts for a maximum of 90 minutes per day. This model incorporates quarterly theory and my very own concept, the tCISD, the true change in the state of delivery. This video will be great for people who are struggling to find an entry model or don't have any faith in their own current entry model, and can also be great framework for people to build upon that already have functioning working entry models. So without wasting any more time, let's go ahead and jump straight into it. So the 3 components of the model is only 3 simple steps. So step number 1, we require a sequential SMT, an SSMT, which is an SMT at the extreme high or low between 2 consecutive quarters. Step 2, we use a true change in the state of delivery, a tCISD, which is a candle closure above or below the candle that created sequential SMT. Step number 3 is our specific time window, that 90-minute window in which we look for our setup, 9 to 10:30 a.m. Eastern Standard Time. This is the specific time window in which we hunt for the model. So now let's go ahead and break down each of those steps and give examples of every single one of them so you know exactly how to piece them together. So step number 1, sequential SMT, SSMT. We require at least a daily cycle, a 90-minute cycle, or a microcycle SSMT to form within the time window 9 to 10:30 a.m. We can have more than one. We can maybe have a daily cycle and then a microcycle. We could maybe have a 90-minute and then a microcycle. It doesn't really matter if we have 2 or all 3, that's fine, but we require only one. You can choose the specific one if you'd like to make it more mechanical, the 90-minute cycle being my favorite. As you'll find, we get a lot of 90-minute cycle SSMTs within that specific time window in which we trade. Last thing to touch on for SSMT inside of this time window is if we're bullish, we look for SSMT below the true open, and if we are bearish, we look for SSMT above the true open. So if we see a 90-minute cycle SSMT form and it's a bullish one, we then need to check and make sure that that SSMT occurred below the specific true open to that cycle. So the 90-minute cycle, we would need to be below the true session open, which in this case is 7:30 a.m. Eastern Standard Time. We need to be above the true micro session open if bearish and below the true micro session open if bullish. And then finally, if we see a daily cycle SSMT form, we must be above the true day open if we are bearish and below the true day open if we are bullish. Now, anticipating manipulation and distribution. So coming into our time window, we must see what price has done prior to the time window to anticipate what is likely to occur within the time window in which we trade. So always pay attention to what occurs before 9:30 to anticipate what 9:30 is likely to do. So this is mainly catered towards indices, that 9:30 open volatility. However, even if you are trading something like forex, you can still pay attention to what occurs before our time window 9 to 10:30. For example, if we have 8:30 news. So if we have manipulation prior to 9:30 open, we can anticipate the 9:30 open to distribute. If we have no manipulation prior to 9:30 open, we can expect 9:30 open to manipulate. If 9:30 manipulates, then 10 o'clock expansion. If 9:30 distributes, then 10 a.m. retracement or potential reversal. So always keep these if-then sequences in mind. Make sure to take a screenshot, take a note of this, because this is going to be a very key component of how we can actually anticipate which sequential SMT to look for. So next, we have our true change in the state of delivery, our tCISD, which is a candle closure above or below the candle that created SSMT. So if we see a daily cycle SSMT form within our time window, we're looking for a 15-minute tCISD. If we see a 90-minute cycle SSMT occur, we're looking for a 5-minute tCISD. And if we see a microcycle SSMT occur, we're looking for a 1-minute tCISD. So now if you look at the example to the right, we've added a little bit more lipstick from the example in the original SSMT slide. So this is, just imagine, it being a 90-minute cycle SSMT, price drops below the true session open, we run out Q2's lows, we form that SSMT, and now we're looking for that specific candle that created the sequential SMT. So you go ahead, mark out the open of that candle, and in a bullish scenario, the tCISD candle, the one that creates sequential SMT, must close bearish. So if it doesn't close bearish, we're looking to our left before the SMT occurs, and we're using the most recent bearish candle before the SMT occurred, okay? So the only scenario we use that logic is if the candle that creates sequential SMT in a bullish example closes bullish. Most of the time it will close bearish, and if it does, great. Go ahead, mark out the open of that bearish candle, wait for a candle closure above it. Then this is when our sequential SMT is validated and our tCISD becomes valid to look for an entry inside of. So now you guys are probably wondering, how do we actually enter off the tCISD candle? Well, let me go ahead and show you guys right here. So the entry will be on the retest of the tCISD candle or the first fair value gap presented close to the tCISD. So sequential SMT takes place. Look at the red dotted line. That very first candle that ran below the previous quarter low is our tCISD candle. Remember, it must close bearish. If it doesn't, look to your left and use the most recent bearish candle. So go ahead, mark out the open of that candle, wait for price to close above it, which you can see it does. We then form a gap right above it as well. So what you can do for your entry is either enter inside of that gap, because if the gap forms, sometimes it may not return completely back to the tCISD, or if there's no gap there, or sometimes even if there is a gap, it may still return back to the tCISD. But as soon as price wicks into that tCISD candle itself, this is then when you are looking for your entry. The best stop loss placement in this type of scenario would be on the SSMT low, because that is the invalidation of our trade. So now you guys are probably wondering, what time frames do we need to be using and all that type of stuff. So you can choose a specific time frame in which you enter. For me, I enter on the 1 minute. It could be the 5 minute, it could be the 15 minute for you guys. It doesn't really matter. The way that you would actually enter, let's say this, for example, is a daily cycle SSMT and a 15 minute tCISD. Because I enter on the 1 minute, I wait for price to, of course, come into the gap, come into the tCISD and retest it. Then I drop to the 1 minute time frame and look for my entry model, basically refining it from the 15 to the 1 minute. So whether that be a 1 minute inversion, a 1 minute swing point forming, a 1 minute fair value gap forming in line with where I'm expecting price to trade away from, just any bullish signature on the 1 minute that shows that price is probably going to trade away from the 15 minute tCISD. And the stop loss placement would still be the same. If you can afford it, of course, if the stop loss is too large to place it on the 15 minute low, the one that created sequential SMT, that is fine. You can still refine it, but just keep in mind that if you do get stopped out, it doesn't exactly invalidate the trade idea. So for me, I would always go for that larger stop loss, reduce the size of the RR of the trade, just so I know that my trade is a lot more safer and it has that room to breathe. And if it gets stopped out, then that means my idea was invalid. So let's say you guys enter on the 5 minute time frame. If you form a 90 minute SSMT, you can enter just essentially off the 5 minute tCISD retest. Or if it's a 15 minute, again, you can drop to the 5 minute. Just wait for like a nice 5 minute bullish closure away from the tCISD. Then you can go ahead and be confident and enter within that trade. Another thing to note as well is I wouldn't always recommend placing limits at tCISDs. I always like to wait for at least a small rejection away from them, whether that be a small wick forming or a swing candle forming inside of the tCISD. Just something to show me that it is most likely going to hold. It doesn't need to be a lot, just a small rejection wick is fine, because if you don't wait for that rejection, price could easily just run completely through it and just hit your stop loss instantly. So hopefully that clears a lot of things up for you guys that are still understanding and learning about the tCISD. Sequential SMT, tCISD, entry at the retest of the tCISD, and this all must occur within the specific time window, 9 to 10:30 a.m. Eastern Standard Time. So this is the specific time window in which we hunt for the model, not a minute after, not a minute before. As soon as the clock strikes 9, we hunt for our entry. As soon as it gets past 10:30, we stop looking for our entry. Now you guys are probably wondering, why did I choose the specific 9 to 10:30 a.m. window? The reason being is because that coincides with Q3 of the daily cycle, which of course is the AM session, and then also Q3 of the 90-minute cycle within that AM session. So essentially we have Q3 of Q3 both overlapping, and if you guys didn't know, whenever we have overlapping quarters, that is usually when you get the most explosive price action. And we all know what Q3 is mainly used for, which is that distribution, because it is the middle of the candle. But generally speaking, that specific time window does print high and low of the day most of the times if we do get that reversal. So this specific time window mentioned does work best within indices, but it is still great for all other markets. You will always be able to find something to do within this time window. We have the 9:30 open volatility, sometimes 10 o'clock news, the new 10 a.m. 4-hour candle open, and most importantly, the entirety of the 9 a.m. candle, which, like I just said, generally is the largest range candle of each day. If you take a look at the example to the right, that is our specific 9 to 10:30 a.m. window viewed on the 5-minute time frame. As you can see, the 9:25 candle manipulates. You can't see it in that example exactly, but it does manipulate above Q2's high. So that is our manipulation prior to 9:30. Then you can see 9:30 distributes to the downside. And because 9:30 distributes, remember what I said earlier, if 9:30 distributes, 10 o'clock will likely be a retracement or a reversal. And then you can see right there, 10 o'clock does offer that retracement, and you can't see it in the rest of the image, but we do then begin continuing to the downside. So now that you guys know exactly how this model works, let's go ahead and jump into an example on the charts of exactly how you would use it. Alright guys, we're inside of the charts now. We are of course looking at the indices triad, YM, NQ and ES. Remember, our first step is sequential SMT, so you must be looking at those closely correlated assets. And just to be completely transparent with you guys, what we're going to go ahead and do is flick to a random day of the calendar. We'll do 7th of August 2025, Thursday, because I don't want to go too far back, just so we can view it on the minute time frame if needs be. And I'm going to walk you through my step-by-step process, right? So coming into our trading window, 9 o'clock, obviously we're not trading the entirety of the Q3 of the daily cycle because that is 6 hours, but we are of course looking at the daily cycle to see if we have any sequential SMT take place, right? Because that can be our place where we look for our entry. In this case, we have no daily cycle. SMT, all assets did trade above London's high, as you can see. Q2 high is traded above. This candle in the middle does belong to Q3, just in case you guys didn't know. Now, next best thing would be that 90-minute cycle, SMT, which is the most common as well within this time window. So let's go ahead and take a look. As you can see, nothing there either on the 90-minute cycles. All of Q2 highs traded above on all assets right there. So yeah, we have no 90-minute, no daily cycle. So what then is our last resort? It would be that microcycle. Okay, so let's go ahead and check the 1 minute. If we can even go back this far, let's take a look. Hopefully it allows us to do so. Okay, cool, there we go. The dividers are not quite marking out too well, so what we'll do is hop into replay here and see if it now marks out the dividers for us. By the way, the indicators that you can see on the charts are both of my custom indicators. Will be linked below in the description. The one that marks out my tCISDs and also the one that marks out the dividers for me as well. So here we go. As you guys can see, Q2 and Q3, we do indeed have that microcycle SMT. Okay, as you can see right there, NQ running above Q2's high, and then of course ES failing to push above Q2's high right there. Okay, so now what is our final step of the process? Well, which candle initially ran above Q2's high on NQ? The very first candle. And in a bearish scenario, remember we require a bullish candle. In this case, the one that ran out the previous quarter high did close bullish, so we use this exact candle. Go ahead and mark out the open of the body. As you can see, my indicator has marked that out for me. And then what do? Closure below to confirm the tCISD candle, and then we look for an entry back inside of this candle right here. So you can go ahead and mark it out as well. I do just like to use a body. You can use a wicks, it's completely up to you. But look how nicely we respect the body of this tCISD candle. Your entry then, of course, is inside of the tCISD. Remember what I said, wait for a signature showing you that prices trading away from it. So this big bearish candle would have been nice. Then you could have entered off that third candle that opened up high back into it. Stops go on the SMT high, because if we push above here, this essentially would invalidate the idea of our trade. And then you can go ahead and target resting sell side liquidity, or you can target a set RR, which I target 3 RR every single time personally right there. Okay, so did you see how simple that was, guys? Very simple, repeatable entry model. This, of course, if you trade it in line with the higher time frame drawn liquidity, with the bias and whatnot, it is going to be so much more effective, which is pretty much what I do. Like, the model isn't completely mechanical unless you make it mechanical, because we're not looking for a specific sequential SMT. We're looking for at least one sequential SMT, which shows a cracking correlation the price wants to turn around. So if you then pair that with very high quality of reading price action, which is what you guys should be focusing on as well, getting better at reading price action. If you just pair this simple repeatable entry model with that, you're going to be unstoppable. To be honest, you're going to be unstoppable as long as you know where price is going. You require at least one sequential SMT, a tCISD for an entry, and then you can go ahead and take that entry, and you can just be done for the day. 1 to 2 trades within this 90-minute window, and that is you done for the day. So yeah, that is going to wrap up this video here, guys. I hope that you did enjoy it. Now that my entry model is out there for all of you guys to use, make sure you guys are tagging me on social medias and showing me your success with it. I've already seen so many of you guys crushing it that are inside of my Discord as premium members and mentorship students. But now all of you guys can use it, so make good use of it. Make sure to, of course, backtest it as well, and don't forget you can add your own twists onto the model as well. The main specific function though is at least one sequential SMT and then the tCISD, which, don't get me wrong, does work throughout the whole entire day, but this specific 90-minute window, it makes it very, very high probability. Hello guys, within today's video, I'm going to be giving you all a very simple and straightforward to follow quarterly theory model. This model only incorporates 3 concepts, and when used correctly can yield insane accuracy. So without further ado, let's jump straight into it. So the first concept, which is the base of every single setup, is sequential SMT, also known as SSMT. Now I do already have a video posted about this on my channel, so if you don't already know what it is, I'd recommend to go check that out and then come back here. But for a quick breakdown, a sequential SMT is an SMT divergence between 2 consecutive quarters. So let's imagine the example that we're looking at below is 2 different closely correlated assets. One asset runs below Q1's lowest low, and another closely correlated asset fails to run below Q1's low. So one asset is creating a turtle soup, one asset is creating a failure swing. We must see at least one sequential SMT, and one is all we need for this model. However, the more, the better. And then from there, the second concept we're going to be using is precision swing points, also known as PSPs. Again, I already have a video posted on my channel about these, so I'd recommend to go check that out and then come back here. But for a quick rundown, a PSP is a swing point with a divergence in the swing candle's closure. So one asset must close bullish and one asset must close bearish. So again, imagine the 2 examples down below are 2 closely correlated assets. One asset creates a swing point with a bearish candle closure for that swing candle, and another asset is creating a swing point at the same time but closing bullish for that swing candle. So this is going to be the base of our setup, at least one sequential SMT followed by a PSP. Now the PSP doesn't need to form on the candle that creates a sequential SMT, however you do want to see it form pretty close after the sequential SMT has occurred. And the final concept we're going to be using is true order blocks. So essentially all you need is a precision swing point, and then within that precision swing point candle, that candle number 2, you're going to drop down 1 time frame lower, and within a bearish PSP, you're going to look for the final up close candle, and within a bullish PSP, you're going to look for the final down close candle. So let's imagine here, we're looking at a 4-hour precision swing point, so that candle number 2, we're going to drop down 1 time frame lower, which will be the hourly time frame, and then as this is a bearish precision swing point we're looking at, we're going to mark out that final up close candle within candle number 2. So as you can see, we've got it marked out on the right. You then want to see a candle closure below it to validate it. The true order block can also be validated within candle number 2, or you can look for it to be validated within candle number 3. So now we know how to use those 3 concepts. All you're going to do is just combine them together. So step number 1, look for that sequential SMT. Step number 2, look for that precision swing point. It must form on the time frame that the sequential SMT has formed. And then you're going to drop down 1 time frame lower to look for your true order block within inside of that PSP. So let's take a look at a chart example right here. As you can see to the left, this is the 15-minute time frame, so therefore we're looking for a daily cycle sequential SMT. And as you can see, Q3 created a failure swing on Q2's high, and then we formed a 15-minute PSP shortly after. And then from there, we drop down to the 5-minute time frame. We look for that final up close candle within the bearish PSP. As you can see on the right, we marked it out, and then all you need to do from there is wait for a candle to close below it to validate it, and then you wait for price to trade back into that true order block. Now price can trade back into the true order block on the 3rd candle of the PSP formation, or it could even trade back into it within the 4th or 5th candle. And the best stop loss placement here would be on that PSP high, or you can wait for price to trade into that true order block and then wait for price to trade away from it, placing your stop on that swing high that formed inside of the true order block. Now a few things to note, you can even drop down 1 time frame lower to look for a more precise entry once price has traded into that true order block. So 15-minute sequential SMT, 15-minute PSP, 5-minute true order block, and then a 1-minute entry once price enters that 5-minute true order block. And also, if we see a PD array form slightly below the true order block or within inside of it, then this increases the probability of that order block. And one final thing to note is if you drop down even one time frame lower, so in this example, the 5-minute true order block down to the 1 minute, you will more times than not see an inversion fair value gap or a fair value gap resting within inside of that 5-minute true order block, which makes the trade setup even higher probability. And that is it, guys. Literally a 3 simple step quarterly theory model which you guys can use, and of course go back into the charts, test it out for yourself, refine it, see what works, see what doesn't work as well. But trust me when I say this, when used correctly, this model is insanely powerful. And this should go without saying, but if you look for this specific setup in line with the higher time frame order flow, it rarely fails.
Hey guys, welcome back to a new video. In today's video, we are going to be going over another quarterly theory model. This specific one is called the 2-stage SSMT model. I'm going to be going over the exact framework you must follow, as well as an entry model which you guys can use. So without wasting any more time, let's go ahead and jump straight into it. So first things first, I'm going to pop up a screenshot real quick, just of the main quarterly theory quarters and also the main triads. There are, of course, higher and lower time frame cycles and more triads that you can be using, but if you would like to know more about that, I'd recommend to go check out my SSMT video, which has already been posted on my channel. This model is for people that know what SSMT is and would like to create a model around it. So now you guys know what SSMT is. All we need is a high time frame SSMT followed by a low time frame SSMT, okay? So your low time frame can be one immediate time frame lower than what the high time frame SSMT is, or it can be 2 time frames lower, okay? So what do I mean by this? So within this example, you can see that our high time frame would be the hourly chart, which is of course the weekly cycle, okay? So we must see an SMT occur between 2 consecutive days of the week. Once we've then seen that, we now have our weekly cycle SSMT, and now we can drop down 1 time frame lower, which would be our mid time frame essentially, because our low time frame would be 2 time frames lower, and you can use it with the mid time frame or the lower time frame, okay? So mid time frame, 1 immediate time frame lower from the hourly would be the 15-minute, which of course that means we'd be viewing the daily cycle, okay? And look for that daily cycle SSMT to occur slightly after or at the exact same time that the high time frame SSMT is forming, okay? So that's it, guys. Just 2 SSMTs, 1 on the higher time frame, drop down 1 time frame lower, and then you must see it on that time frame as well, okay? So hourly, weekly cycle SSMT, drop down to the 15-minute, and then a daily cycle SSMT, okay? And now I'm sure that you guys are probably wondering when you should be looking for that second stage. Well, as long as the first stage stays intact, like the SSMT is still there, you can look for it on the same day, or you can also look for it on the following day, okay? Because as you guys know, once we have that high time frame SSMT, we can almost guaranteed expect the following day to give us that distribution, which is then when we can look for our second stage in that following day, okay? But we can also look for it on the same day that the weekly cycle SMT occurs, because you guys know that we can still get moves occur within that manipulation quarter, okay? So now let's jump into the second example, which would be our high time frame SSMT followed by a low time frame SSMT, okay? So like mentioned before, find your high time frame. It can be anything. In this example specifically, we are using the hourly. So once that weekly cycle SSMT has played out, once it has occurred, we're now then dropping down 1 time frame lower, and that's when you're looking for the SSMT there. And if you can't find it there, then you can drop down 1 time frame lower than that, okay? So now we're going from the hourly, skipping the 15-minute because nothing is there on the 15-minute, and dropping down to a 5-minute, okay? So of course, once we're looking at the 5-minute time frame, this means we are viewing the 90-minute cycle. So now we just need to look for a 90-minute cycle SSMT in line with our weekly cycle SSMT. So like mentioned earlier, on the example to the left, we have that weekly cycle. The asset to the far left runs below Monday's low, creating that turtle soup. The asset slightly to the right fails to run below Monday's low, creating that failure swing. And now we're looking for that 90-minute bullish SSMT to occur, okay? It doesn't matter what quarters it occurs in. Like in this example, you can see it occurs in Q2 and Q3. It doesn't need to be that. It can be Q3, Q4, it can be Q1 and Q2. It can even be Q4 and Q1, okay? But that is essentially it, guys. That's all we need. We just need a higher time frame SSMT, which is our stage 1, and then we need either immediate time frame lower SSMT or skip 2 time frames lower and look for an SSMT to occur there, right? So that's it. We have our one stage being the high time frame, and then our second stage being either the mid time frame or the low time frame. So now that you guys know how to identify the high time frame and the low time frame SSMT, let's now jump in to an entry model which we can use after that has occurred, okay? You guys can use any entry model that you would like. However, this one here is my personal favorite, and that is on the second stage SSMT that occurs, I like to look for my change in the state of delivery to occur. And I like to call it a true change in the state of delivery because it isn't your usual regular change in the state of delivery, which everybody speaks about. It's slightly different. So a true change in the state of delivery is a candle closure above or below the first candle that forms SSMT. Must be a down close candle for a bullish change in the state of delivery and an up close candle for a bearish change in the state of delivery. If the candle that creates a bullish SSMT is a bullish candle, use the most recent down close candle as your change in the state of delivery candle. If the candle that creates a bearish SSMT is a bearish candle, you can then use the most recent up close candle as your change in the state of delivery candle. So, like you can see in the example to the right, let's imagine that we already have our high time frame SSMT in play. This is now our second stage that we're looking for, and as you can see, it occurs right there between Q3 and Q4. So that first candle, the very first one that runs below Q3's low, becomes our change in the state of delivery candle. So now all we're doing is waiting for a candle closure above that specific candle to validate our change in the state of delivery. That now becomes our order block, and then we wait for price to trade back within that down close candle, look for our entry inside of there, placing our stop on the SSMT low or below the change in the state of delivery candle low, and then from there you can just target opposing liquidity. So now that you guys know exactly how to find your two stages of the SSMT, exactly how to enter the trade after finding that, let's jump into one final example of how it would play out within the charts. So our stage 1 in this example would be the 15 minute, which would be the daily minute, which would be the daily cycle bearish SSMT. You can then drop down one time frame lower, which would be the 5 minute, and in this case that is what we have done. We have found that 90-minute cycle SSMT that occurs pretty close after the daily cycle. We then identified our chain in the state of delivery candle. That is the candle that formed the SSMT. Reason being is because if you look at another closely correlated asset, the one that actually ran above Q3's high, that specific candle that we've got marked out was the candle that created the turtle soup on the other closely correlated asset. So that also becomes our chain in the state of delivery candle within the asset that creates the value swing. So now all we're doing is waiting for a candle closure below that, which we do indeed get right there, and then price trade back within the order block before then giving that huge move lower. So again, entry at the order block, stop on that failure swing high, targeting opposing liquidity. And that is everything, guys. All you need to create a simple model is two stages of SSMT followed by a low time frame chain in the state of delivery, stop on the SSMT high or low, and target opposing liquidity. Very simple and easy to follow model, which is of course fractal, so you can be catching 1 to 5 trades per week using this on the lower time frames, or if you would like to use it on the higher time frame, you can of course go for around 1 to 3 trades per month. It all depends on your trading style. You can of course use it for swing trades, scalp trades, intraday trades. So with that being said, we are going to wrap up the video there. I hope that you guys did find it useful, and I hope that you guys have success using this model right here. Hello guys, welcome back to a new video. In today's video, we're going to be going through a 2-step quarterly theory model. Super simple to follow, and we'll also be showing chart examples of this exact model playing out. But before we begin,
you guys need to understand that every single concept and also this whole entire model revolves around comparing closely correlated assets to each other. So these are known as triads. I've got a list of the main triads that you want to be looking at on the screen here. Feel free to take a screenshot of this. And also keep in mind there are many more triads that you can be comparing to each other. However, these are just the main ones. So the first step of the model is sequential SMT, SSMT. This is always going to be the base of pretty much every single quarterly theory model. The sequential SMT is there to give you that directional bias. It's there to tell you when the markets want to reverse. And essentially all it is an SMT divergence between two consecutive quarters. So one asset creates a turtle soup, the other asset creates a failure swing. I do have a video about sequential SMT on my channel, so feel free to check that out. But the next concept we're going to be looking at is SMT-Fill. So SMT-Fill is a fair value gap that forms at the same time. One asset returns back to its gap, the other asset fails to return back to its gap. So this is another form of a cracking correlation. And like sequential SMT, this shows us when the strength or weakness within the markets. And we can utilize this to know when the markets are ready to expand. I do also have a long form video about SMT-Fill on my channel, so feel free to check that out if you haven't already. However, just those two concepts is all we're going to be using. That is literally it, sequential SMT plus SMT-Fill. So what we need to do now is blend those together, and we need to see a sequential SMT form. Then that first fair value gap that forms after the sequential SMT is where we're looking for our SMT-Fill entry. So essentially, the base of our setup is sequential SMT. The more we have, the better. For example, we can have a high time frame sequential SMT followed by a low time frame sequential SMT, and then we need to wait for that first fair value gap that forms after the sequential SMT we are viewing. And keep in mind it needs to be there on at least two closely correlated assets, and then we're looking for that SMT-Fill. As you can see in the example down below, the asset to the left created the turtle soup for the sequential SMT and then failed to return back to its fair value gap. The asset to the right created the failure swing for the sequential SMT, and then it did return back to its fair value gap. And then if we combine that with the higher time frame order flow, the higher time frame drawn liquidity, we have a super simple two-step entry model. Let's jump into a few chart examples of this playing out in real time. Within this example, we're going to be comparing NQ to YM, and we're looking at the hourly time frame, which is the weekly cycle. So this means we need to see sequential SMT between two consecutive days of the week. And as you can see, the quarters are being marked out for me by my very own quarterly theory indicator, which will be linked below in the description. So as you can see, YM during Q2, Tuesday, run below Monday's low. And then if we take a look at NQ during Tuesday, you can see it failed to run below Monday's low. So YM is giving us that turtle soup, NQ is giving us that failure swing. And all we need to do now is wait for that first fair value gap to form after this sequential SMT. And there we go, you can see a fair value gap forms on both the assets, and this also formed very close after the sequential SMT. So this is great because it's showing that we're getting displacement very quickly after the sequential SMT has occurred, and we're also getting that fair value gap formation. So now let's see if one asset returns back to the gap and another fails. And there we go, that 10 AM candle on YM returned back to its gap, and the 10 AM candle for NQ failed to return back to its gap. And all you can do from here is you can scale down to a lower time frame and wait for price to reject out of the gap, look for a lower time frame entry model, or you can enter on the same time frame after the candle closes away from that fair value gap. So you can enter after this candle closes, placing your stop on the swing low inside of the fair value gap, and you can target a 2RR or whatever you would like to. In this case, we'll target a 2RR and we'll see if this plays out. A little bit choppy. And there we go. As you can see, took a while to get there, but it did still play out with very minimal drawdown as well. Within this next example, we're going to be comparing NQ to ES on the 15-minute time frame, which is the daily cycle. So this means we need to see sequential SMT between two consecutive daily quarters. In this example, Q4 and Q1, which is the PM session and Asia session. So as you can see, NQ has already given us that turtle soup running below Q4's lows, and then ES is giving us that value swing, failing to run below Q4's lows. So if we let this play out now, we're waiting for that first fair value up to form. So you can see here, we did get a very small one on ES, but remember it needs to form on both the assets. So if one asset forms one here, and the other asset isn't forming the gap, then you need to continue to wait for both the assets to form the gap. No fair value up yet. And there we go. We've got a fair value up on both the assets. So if we mark that one out, and all we're doing now is waiting for one asset to return back to the gap and another asset to fail. There we go. We have our SMT-Fill. This is not the regular SMT-Fill. This is another variant of SMT-Fill, which I do speak about within the SMT-Fill video. This is a variant where one asset fills the gap completely and the other asset fails to fill the gap completely. So this is still an SMT-Fill. It's a cracking correlation. And what we can do now is, again, like I said, we can wait for price to reject out of the gap, enter as soon as that candle closes bullish, placing our stop on the swing low inside of the gap, and we can target some liquidity to the left. And let's see how this would play out. And there you go, for a 1-to-8 risk to reward ratio, and this is all in the space of under 3 hours, and price runs straight to 1-to-8 RR, targeting the liquidity to the left. Very clean trade, all from one sequential SMT, one SMT-Fill, entry after the candle closure out of the fair value gap, stop on the low inside of the fair value gap, targeting sell side liquidity. Yo, what's good guys, welcome back to a new video. Today we have a highly requested video, and that is going to be covering a swing trade model that incorporates quarterly theory and also a concept of my own. I've had the request to create this swing trade model for a while now, for the people that can't be on the charts for as long, or for the people that prefer executing on the 1 hour, the 4 hour and above. Okay, so this model is very simple, and it will allow you to capture the weekly and the monthly range. So essentially capturing the weekly open high low close, also open low high close, depending on if you're bearish or bullish. The same thing for the monthly candle. Okay, now you have the ability to execute on the 1 or the 4 hour time frame, and all it requires is two simple concepts, no fluff. Okay, so I'm sure some of you guys may have seen my 90-minute tCISD model out there on my channel. This model essentially requires the two same concepts, but it's just utilizing different timeframes and different cycles to capture those higher time frame moves, right? So let's just jump straight into it. So the first concept that we need, this is what we have to see before even thinking about taking a trade, and that is sequential SMT, also known as SSMT. The first thing that must occur for you to begin hunting for this model is a sequential SSMT. This must occur either on the 1 hour weekly cycle for the weekly range, or the 4 hour, the monthly cycle for capturing the monthly cycle range. Weekly cycle SSMT is an SMT between 2 consecutive days of the week. One asset of the triad takes the previous day high or the previous day low, whereas the other asset or assets fail to take the previous day high or previous day low. So for example, we're trading on Tuesday, NQ drops below Monday's low, and let's say ES fails to drop below Monday's low. That would be a weekly cycle sequential SMT, and that's the first thing that we require for this model. Now, a monthly cycle SMT is an SMT between 2 consecutive weeks of the month. One asset or multiple assets of the triad takes the previous week high or the previous week low, and the other asset or assets fail to take the previous week high or previous week low. Okay, so it's super simple. NQ runs above previous week high, ES fails to run above previous week high. That is a monthly cycle sequential SMT, and this is the first thing that we do require for this model. Okay, so choose whether you want to execute on the hourly or the 4 hour, or maybe just whatever you see. You know, if you see a weekly cycle, you can take that trade, and then once this SSMT has taken place, you are then looking for a tCISD, which is a true change in the state of delivery, a concept created by myself. And all it is A true change in the state of delivery takes place only after a sequential SMT has occurred. Within a bullish scenario, it is a candle closure above the candle that created sequential SMT. So like in this example here, this candle created sequential SMT, and then within a bearish scenario, it is a candle closure below the candle that created sequential SMT. Okay, the tCISD must take place on the same time frame the SSMT occurred on. So if you have a weekly cycle, a 1 hour sequential SMT, what do you then have to see? A 1 hour tCISD. Okay, and those are the two simple concepts. That's all you need. Now remember, if you want to trade this more effectively, I would recommend for you to find your draws on liquidity on the higher time frame, find that narrative, find where the weekly or the monthly candle is likely to draw towards, which you can do so by watching my previous videos, my liquidity video or the narrative video. I've got many of those on my channel, so check those out and then apply the swing trading model in line with those. Okay, now you're probably wondering, how do you actually enter the trade? And that is bringing me to the final part, which is the entry. Once the tCISD has taken place, you have two opportunities to enter. At the retest of the tCISD, so once the tCISD has taken place, you can see price opens back, trades back into the tCISD candle itself, the body, so you can take an entry there, or at the first presented fair value gap after the tCISD. So where's our first gap? Right here. Price wicks into it. This can also be an SMT-Fill as well, so you can take that from there. And the best stop loss placement will be below or above the SSMT. Okay, so if you enter long based off a weekly cycle SSMT, a 1 hour tCISD, enter at the retest, stop goes on the SSMT low, and then you can then target a simple 2RR or the previous week's high or low, or previous month's high or low. Or if you can find the drawn liquidity more effectively, and you know the price is likely to head even higher than the previous week high, you can hold for that little bit longer. Okay, but keep in mind, when you are trading the weekly and the monthly range, just remember what day of the week it is and what week of the month it is, right? So if you enter a trade on Monday, for example, and you're holding all the way up until Thursday, and it puts in that weekly high, do you anticipate price to pull back on Friday? Okay, so just remember where you're at in terms of the weekly range and when price is likely to pull back, so you can take out your position at potentially higher the week, and then you can be satisfied with what you made on the week, or you can just go ahead and target a simple 2RR and be satisfied with that. Okay, so yeah, hopefully you guys did find this video useful. Like I said, it literally requires a sequential SMT, a tCISD.
Yo, what's going on, guys? Welcome back to a new video. We've got a banger video today. What we're going to be doing is we're going to be backtesting my 90-minute tCISD model, the Freedom model. If you haven't already seen it on my YouTube, go ahead and check it out. I know that a lot of you guys do trade it. A lot of people have been asking me for backtesting results and whatnot. So what we're going to do is go ahead and backtest some trades right now, live in front of you guys. So first of all, before we get started, we need the essentials, right? So what we've got is we've got the music, the lo-fi work music, so we can really lock in for this backtesting session. And we've got a bottle of water as well to keep us hydrated. Would probably be better if it was like an energy drink to keep me awake, because I have only just woken up, but it's completely fine anyway. We'll get into it. We'll be completely fine, I'm sure. So yeah, what we're going to be doing is, obviously you guys know the 90-minute tCISD model is essentially a sequential SMT plus a true change in the state of delivery, a tCISD, within the 9 to 10:30 a.m. Eastern Standard Time window. It can be any sequential SMT. However, for the purpose of this video, for the purpose of easier backtesting results, we're just going to be utilizing the 90-minute cycle, which is on the 5-minute time frame, and we're going to be doing it on indices. Okay. And now you guys are probably wondering what website, what application we're going to be using to journal the trades and look for the results. Well, let me go ahead and show you guys. Look what we've got here, okay? Look how clean this is. Oracle X. This is an all-in-one AI trading journal created by myself. This is my journal. So if you guys do want to go ahead and check it out, there will be a link to it in the description. The cheapest priced AI journal out there on the market. And also it is completely free if you guys want to test it out for up to 10 trades, okay? So essentially you can, generally trade inside of here, get all the stats, and then we can utilize the AI feature, ask it questions to reflect upon your trading and whatnot. So yeah, that's what we're going to be doing here, okay? So first of all, we need to create our checklist, so our strategy. So create strategy, we're going to go ahead, 90-minute tCISD model, boom, okay? You don't need to put anything there for the description. So great strategy. And now what we're going to be doing is actually adding rules, complements to the strategy. Okay, so add rule. this is essentially adding a confluence. So SSMT, I mean, this kind of goes without saying, like we need to see a SSMT plus a tCISD anyway, but you know, why not? Let's just do it anyway. And then we'll do, let's add a rule here. So we'll go before 9:30 open, and we'll do after 9:30 open. Obviously, you guys know that we can't be trading before 9 o'clock or after 10:30 anyway. But what we can do is add these two different specific confluences and sort of see, basically utilize the AI feature to see which one is more profitable, essentially. Because this is what you guys can do. You can add different tags as well, which I'll show you guys soon as well. And yeah, so here's our confluences. As you guys know, super simple, literally a two-step model within a specific time window. Okay, so what we're going to do is manage the rating. So our A plus trade is going to be, hold up, oh no, okay, actually we'll leave that as it is. We'll go configure rating. This is what we do here. A plus grade is going to be all of the concepts aligning. We'll do after 9:30 open. I feel like would be more A plus in my opinion, because then we can see if the manipulation has already played out. Entering before 9:30 can be a little bit more sketchy, but it's okay. The configure rating, and we'll just say A grade is just before 9:30 open. But obviously you guys can really customize this, add more confluences and whatnot, but just for the sake of this video, we're going to keep it nice and simple. Okay, and then that's it. You know, we'll hover over the journal, add new trade, and then we'll go ahead and journal each trade as we go along. Okay, so let's go ahead now and jump into the chart. So 5-minute time frame, all we're going to be doing is looking for a 90-minute sequential SMT plus a tCISD. We're going to enter at the retest of the tCISD, and we're going to go for a 1 to 2 RR fixed, okay? And then if it runs 1 to 1 RR, then we'll go break even, and then we'll move to break. We'll move to break even basically, okay? So before we get started, let me quickly hydrate. Okay, we've got the lo-fi music on, so we are all set to go. So yeah, let's get started then, guys. We are looking at indices here as well. So yeah, let's lock in. So 9, boom. Boom. Also for this as well, it can be a Q2, Q3 90-minute SSMT with a tCISD inside of Q3, or it can be a Q1, Q2 SSMT, Q2 tCISD, and then enter the retest during Q3 of the Q2 tCISD, essentially. So yeah, what day is it today? We got Monday, so let's go ahead and see. Also, the indicators being used are all my indicators as well. The Sequential SMT one, which is inside of the Oracle Insights QT toolkit, and then the tCISD one makes it super easy, marks everything out for me, so I'm not wasting any of my own time. Link below in the description as well. Okay, so yeah, let's go ahead and get started. So here you can see we've got a hidden sequential SMT between Q2 and Q3 with YM, I believe. Yep, as you can see, drag this over here. NQ did not close below the lowest closure of Q2, and YM did. So which candle was this formed off? Let's go ahead and do that. The tCISD is picking up this one here at 9:40. So let's see. YM. Just always want to double check as well. So we wick below there at 9:30, and we hadn't wicked below there on NQ, but we actually closed below here at 9:40. So that's when the hidden sequential SMT took place. So this is indeed correct. tCISD there at 9:40, and then we would take our entry at the retest. Which would be right here. Stop goes on the SSMT low, and then like I said, we'll target that fixed to RR. So it looks like our first W already literally within this week here. There we go. So yep, there we go. There's our first W. So let's go ahead and now take a screenshot of that for the journal. Keep in mind, I'm going to be placing all the trades on NQ every single time as well, okay? Just for the sake of this video. So that's trade number 1. So, what we need to actually do is, I forgot to mention, add account, backtesting. Let's say it's just, I don't know, let's just say it's a $50,000 account, and we'll risk 1% every time, basically, okay? So let's go to journal. New trade, backtesting account, net P&L. This would be, if we're risking 1%, it'd be $1,000 if we're going for that 2RR. 1%, 2RR. Entry time. Let's go ahead and see what time we entered at. So this would be at 10:15, so just within our window, 10:15. Exit time was indeed at. Also keep in mind for this model, guys, you know, as long as you enter within the time window, you can hold through it basically. You know, you don't need to close out as soon as the time window ends. You basically just want to be entering within the time window essentially. So 1340. This was yesterday, I believe, right? What day was yesterday? 27th of October. 27th. There we go. And then we copy and pasted the screenshot. So press Control V. Boom. Straight in. Right. Also, we're not going to be doing anything to do with psychology because obviously this is just, you know, this is literally just backtesting. So no psychology included within that. Also, the rating. I would say the rating of this one was probably 4-star. It was after 9:30. But I'm not really too much of a fan of the hidden SMTs, and also it did look pretty choppy, so I'd say a 4-star. We're not going to do the notes as well, but just remember I'm showcasing the journal here as well within this video, kind of like a two-in-one basically. I want to show you guys how powerful it really is. You can also use your voice if you can't be bothered to type, but we're not going to do any of that. Tags and attributes, again, we're not going to do any of these either, but again, the more tags that you guys add, the more beneficial it's going to be for the AI feature because it's really going to recognize the patterns within your trading basically. Also, let me put my phone somewhere that's not going to be, we'll leave it up there. That'll do. Just, I don't want you guys to keep hearing the vibration if you can already. So that's a win, and yeah, that is basically it. So let's choose our 90-minute tCISD model, SMT tCISD after 9:30 open, and there you go. It's given an A+ setup right there. So save trade. And then here we go, boom. There, all journals dashboard will also update, of course. As you can see, super clean. And if we go to journal as well, you can also click on the playbook and look how clean that is as well. You sort through your trades on here as well. Backtesting accounts, you know, live accounts, whatnot. Super nice. So now let's jump back onto the charts and let's continue to the next day. So this was Friday, 9 AM. As you guys can see here, this was the, I think, was it CPI day? I believe so, right? We had a 90-minute SSMT. tCISD confirmed there at 8:30, but you can see we just never retested it, so that wouldn't have been an entry. So no entry there within Thursday. Let's continue to now the next day. Oh, that was Friday, sorry. So let's go to Thursday now. No entry here, no Q2, Q3 SSMT. So nothing there on Thursday. Let's go to Wednesday. There we go. Looks like we got something here. Would this have been a win or a loss? So let's take a look. So we had Q1, Q2 sequential SMT confirmed after this candle closure. And then if you would have entered off the retest of this one would have been a loss right there. Stop on that high. Would have been a loss? Yeah, it would have been a loss. 2RR. So that would have been a loss there, but then the one after would have been a win. So we'll journal that one as well. Believe it would have been a win anyway. We'll have a look in just a moment. Let's just journal this one though. Boom. Copy image. New trade. Net P&L minus 500. Loss 1%. 1RR. Let's do -1. I think it's just one. Yeah, it's just 1RR. That's what you type. And then the date is 22nd of October. When do we enter at? When do we get out at? We would have entered there at 9:05 and exited at 9:10. So 09:05, 09:10. Boom. Paste the screenshot in. There we go. That's all good. Backtesting. SMT, tCISD. This was before 9:30 open. So remember, we may be able to spot a pattern here. I'd say, again, 4-star. You know, it could have been a little bit cleaner. But overall, it was just the model, you know. The star ratings are more or less for when you're trading live, I guess. Backtesting doesn't really affect it too much. So now we got another one here. So we had a Q2, Q3 SMT caused by this candle. And let's see. So it got confirmed here at 9:30. Entry there would have been at 9:40. Stop would have went on the SSMT high. So again, actually, unfortunately, this would have been another loss here, which is completely fine. I believe so, right? Yeah, unless it ran like 1RR. Oh, it did. Wait, did it? Yeah, it did. So this would have been break even, actually. I completely forgot about that, actually. Would this trade here have been a break even? Oh, no. No, this one definitely wouldn't have been. But this one would have been here, actually. So 1-to-1 RR. Move stops to break even. So this would have been a break even there. Just unfortunate that we confirmed it. And then, you know, we went back into it. And then we disrespected it, like the tCISD, we closed over it. So, you know, the tCISD is no longer valid, but the SSMT still remained there. And then we closed back down below the tCISD. So if you really wanted, like, you could have taken it off here and that would have been a nice W, right? But in this case, let's just say 2 trades per day maximum, okay? Let's just go ahead and say two trades max. So 1-to-1 RR right there. So then let's go ahead and journal this one as a break even. So that's good then. It wasn't, you know, at least it wasn't a loss. My browser's glitching out. Okay, there we go. So let's paste the screenshot in there already. We've got $0. Risk 1%, 0 RR. Entry time here would have been at 940, and we would have got stopped to break even at 950. So 940. Oh, 950. Boom. And yep, that's it. Pre-trade track list. tCISD, this one was after 930. Let's stick on 4-star as well. And then we will save the trade here. Little hydration break. Okay, so far we're up $500 from 3 trades. That's $500 from 3 trades. That's not a bad little ratio to start off with. Excuse me. All right, so now let's go to the next day, which is Tuesday. I wasn't really a fan of this week here, to be honest. I don't know what you guys thought. Let me know what your thoughts were in the comments of last week's price action. But I wasn't really a fan, to be honest. So Q2, Q3, unfortunately, no retest of the tCISD there, but we did get a bullish one here. Q1, Q2. Oh wait, no, I'm tripping out. I'm completely at the wrong time here. No, yeah, I am. Okay, my bad. So it looks like we would have got an actual nice W here. So we had a Q1, Q2, SSMT. Let's see, tCISD would have been this one here. And yep, this one would have been a very, very nice W. So confirmed here at 8:30. And then entry just basically, you know, anywhere within that 9 to 10:30 window. Stops goes on the SSMT high. And the reason why you can enter a retest of like a Q2 tCISD, guys, is because if Q1, Q2 SSMT takes place, then usually Q3 will be the distribution, right? So we're just looking for that entry basically within the distribution quarter. That's the sort of reasoning behind that one pretty much. All right, so there we go. Let's go ahead and take a screenshot of this one now. So beautiful. So now we're up $1,500 on this account in just under 2 weeks. Insane stuff. So we got $1,000, risk 1%, 2RR, copy paste this. Entry time was indeed at, what was it at? I mean, yeah, it doesn't really matter. It would have been before 9:30. Let's just say we entered at just immediately 9:05 basically, and then we hit TP at 9:30. So 9:05, 9:05. But yeah, a couple opportunities there if you missed the first one at 9:05 anyway. So I'd say this was a pretty 5-star trade because you can see that we displaced a decent amount away from this SMT high as well, respecting gaps, disrespecting bearish ones. So I would genuinely say that's a 5-star trade. Obviously, can't really rank it probably while you're back testing, but yeah. So there we go. So $1,500 on the accounts now. Let's hop into the next trade. So we got Monday. I should do this first. So no entry here within Monday. As you can see, the indicator just doesn't mark any tCISD out. So that's how you know no sequential SMT took place, or one may have taken place but just got cancelled out basically. But we need that tCISD to enter anyway. So genuinely would have been no entry. Looks like a nice one there, Q3, Q4, but that wouldn't have been within our window. Q1, Q2, nothing. Q2, Q3, again, nothing here either. I don't believe. No SMT took place on that high, right? No SMT on that high. No. So we got nothing there. So now we go back to Thursday. Oh, this looks very messy. Wow. So we got a bearish one, which looks like it would have been a W. Let me take a look. So we got confirmed there the tCISD at 9 o'clock. Entry would have been inside the tCISD. Stop on the SSMT high. And I think this would have given 2R, no? When did it run stops out? Right there. Would have been a 1.9 out, but it really just depended on like where you got the entry at. Let's say we got it around here, you know? Let's say we got that better entry. So that would have been a 2.18R. Right there, I believe. Yeah. But really messy. It would have been, either a win or a break even realistically anyway. It doesn't really matter. But let's just mark it down as a win. So this would have been another $1,000 win. Also, if I said we can take up to 2 trades per day. If we take a W off the first trade, then we're not going to be looking for another trade. Basically, it's if we lose the first one, then we can go in with the second one, with half risk basically. So what time would we have got in at? 9:15, and we would have got out at around 9:30. Cool. 9:15, 9:30. I would say definitely a 3-star in my opinion, actually, just looking at that price action. tCISD before 9:30 open. Stay trade, bash, perfect. Alright, cool. Let's keep it up, guys. We want to get to maybe around like 10, 12 trades, something like that. And then I'll show you guys how to utilize the AI feature, basically. So the 15th, this is like a really nice SMT, actually. Let's see what we got, though. Q1, Q2 gave a nice entry. And then Q2, Q3. Since we got a bullish one, let's take a look. So yeah, we did get a bullish one. So the SMT there took place at 9:05. Then we did close above. So this one would have been a loss. This one here would have been a loss. Entry there. Stop on the SMT low, which would have been like right there. But then this second one, the second one wouldn't have given an entry, unfortunately, anyway. Wait, hold up, unless I'm tripping, hold up. Is this the Q2, Q3, and 35? Bearish. So this bullish one, yeah, no, this bullish one is definitely a loss, yeah. So it would have been something like this, stop on the lows, boom, and then, yeah, just instant stop out, basically. Which is completely fine. Not every day is going to be a clean day, of course. So this would have been minus 500 loss, 1%, 1 RR, copy paste, boom. Entry would have been at literally 9:20, and you would have been stopped within the same candle. So that would have been a pretty fast day. 9:20, but before 9:30 entry though. Before 9:30 entry, sometimes it seems to be working well, sometimes it don't. So this is what I mean, guys. Now we've got all this data collected, whack it in the AI, and it will really be able to help us out. All right, so it's saying that we got a bearish one here, but the bearish SMT is not marked out, so that must mean it was cancelled out. So yeah, that would have been no entry there anyway. So now let's go to Tuesday. See what we got here. So we got a Q1. See what we got here. So we got a Q1, Q2. We've got an entry there. Let's see the Q1, Q2 hold. Yep, Q1, Q2. This was formed here at 8:35, confirmed at 9 o'clock. Trade back in here. Stop on the SSMT low. This did not run 1R, so that would not have been a break even. So that would have been a loss right there as well. Let's copy paste this into the journal. See, we're getting a lot quicker at this now. So if you guys can just get this down, just spam them all out really quick. 1% risk, 1 to 1 RR, copy paste. Would this have been a quick stop out or a slow one? So 9:15, stopped out at 9:35. Again, before 9:30. So, once we spot this pattern that we take most losses before 9:30, what are we then going to do, guys? Also, I forgot to do something. Wow, I've been forgetting to change the date. That is my bad. You can also click this here as well, actually. 14th. Was it 14th October? Yeah, it was. Okay, that's annoying. So maybe the stats are going to be messed up a little bit. Well, not the stats, but like the AI won't be able to tell us like which day of the week we take most of our loss on and whatnot. But we'll begin doing it now, so it will still catch up eventually. All right, so that's that trade journaled. Zoom back out. Then we go to Monday. Let's see what Monday's got in store for us here. Again, it looks like a pretty nice entry there, but unfortunately no retest. And then it did give another entry there within Q4, but that's without, outside of our window, so no trade there. Friday, the following week, let's see what we got here. I can see a bearish tCISD, but let's see if it would have been a valid entry or not. Q2 highs ran out right there, so at 9:30 on NQ, but I believe I must have ran them out beforehand. Oops. There we go. Let's take a look. So we ran out the high at 9:15, hence why our tCISD is marked there of that 9:10 bullish candle. Because remember, for a bearish tCISD, no bearish scenario, it must be a bullish candle as the tCISD. So confirmed there at 9:15. But this wouldn't have been an entry anyway. This would not have been an entry because you can see this candle literally just went boom, just straight through it. I like to wait for at least a small rejection. This one would have been, yeah, you just wouldn't have taken this one realistically because there would have been no reaction. It just would have been a straight bullish candle, higher. You want to at least wait for a small wick to form, basically. So this one definitely was very, very avoidable. So I'm going to class that as a no trade just because I know myself, like, I do like to wait for that small rejection. But it depends how mechanical you do it, because there is a bit of discretion within my actual trader myself. So here we go. We got a Q2, Q3 SSMT. Yeah. What else do we have here? We got a Q1, Q2 one here as well. So let's see if this would have been a valid trade potentially. 8 a.m. caused the SSMT, so our tCISD is here. Closure above. This was all within Q2 though. And then when did we close back above it? Close back above it there at 8:25. So let's go ahead and mark out the whole box just to see if we are respecting it. So 9:30 comes along there, and stop would have gone, entry inside of the tCISD, stop on the SSMT low, targeting that 2R right there. It depends where you would have got your entry. If you would have entered a little bit lower down, it would have given 2R. If not, it would have been a break even. So either way, a win or a loss would have been something like that. So I'll mark this one down as a W. And even if you miss this one anyway, it looks like we got a really nice setup here of this bearish one here. So either way, it would have been a W day right there. So let's copy this one. Also, what date and time? Let's see if we can try and remember that all at the same time. So 9th of October, entry at 9:10, exit at 9:25. I'm not going to be able to remember all that. I think I've already forgot it. Paste that in. $1,000, 2R1. Yeah, I've already forgot everything, guys. No, 9th of October, and then entry at 9:10, exit at 9:25. 9th of October. Oh, I forgot it already. Oh my god. I can use this. 9:10, 9:35. That's what it was, right? Yeah. 9:10, 9:35. 4-star. Yep, I think that's everything. Save trade. There we go. So let's see how many trades we've got journaled now. We've got 1, 2, 3, 4, 5, 6, 7, 8. Okay, cool. We can get a few more in. We can definitely get a few more in. How long are we in? We're 25 minutes in, so we definitely got some time here. So let's see, Wednesday. Also, if you guys are enjoying the style of video, do let me know in the comments down below if you'd want like a part 2 or like more sessions of this. Maybe we can make it like a weekly thing where we just backtest like a full month every video or something like that. Also, one thing to note is, if you want access to anything, the journal, indicators, all linked below in the description, as well as I'm hosting a live free masterclass on the 6th of November at 1 p.m. Eastern Standard Time. If you do want to sign up to that, I'll basically explain my whole entire model and breaking it down as well a lot deeper. The link to apply for that and register to get your spot, because they are very limited spots, will be in the description down below. Okay, so make sure to do apply to that, and I look forward to seeing you all inside of the masterclass. But anyway, back to the video. Looks like we got a few potential setups here. So we got a Q1, Q2 SSMT confirmed there at 8:45. Trade back in. Where's it at? Trade back in here at 9 o'clock. Stop on the SSMT low. So this would have been an absolute banger of a trade right here, guys. 2R right there. Insane. And then we even got another 90 there. Super clean. Super clean. The bearish one came after the bullish one, so we'll just take the bullish one. So yeah, we'll take the one that appears first, basically. Let's see if we can try and remember it. So 9 o'clock. Exit 9:30. Simple. 8th of October. That's the main part. 9:30, 8th of October. Paste that in. 1,000. I'm going to be able to remember it. I know I am. Then to our 8th of October, right? 8th of October, 9, super simple, and then 9:30. Boom. Oh, so I've been forgetting to do this. I'm useless at this, aren't I, guys? I'm only just getting used to it myself as well, because we have only just released it. We have indeed only just released it. So yeah, I mean, I'm really happy with the final product, basically. I mean, we're always going to be updating it to make it better, adding new features and stuff. So yeah, like I said, literally the cheapest AI trading journal out there on the market. And you can also test it for free as well to see if you guys actually want to pick it up. So yeah, that is that trade. It just makes journaling so much fun as well, and backtesting as well, because you're actually getting like a huge reward out of it. You're getting those AI insights that you wouldn't normally get of like a regular like Notion journal or writing it down on paper or something like that, you know. You're actually getting a very valuable insights and saving you from a lot of time as well. So let's see what we got here. We got a Q2, Q3 SSMT. This was formed here at 10 o'clock, and then we confirmed it at 10:05. Entry would have been inside of the tCISD. Stop on the low. Would we've got a break even, or would this have been a loss? Let's take a look. Believe a loss. Yes, because we opened high anyway, so yeah, that definitely would have been a loss. Definitely would have been a loss, but I'd say we're due for a loss though after quite a few little winning streak right there. So what time is this at? So this is 7th of October. Entry at 10:10. Exit at 10:25. Cool. I think I've already forgot all of that, but it's fine. 10:10. Wait, let's do it. 10:10. Oops. 10:10. 10:25. 7th of October. There we go. We got it. Risk. RR 500. Loss 4-star. tCISD model. SMT tCISD after 9:30. Boom. Save trade. There we go. So how many trades do we have now? 10 out of 10. I'll tell you what, we'll do 2 more, okay? Do 2 more trades right here. And then I really want to, really looking forward to showing you guys the actual use of the AI features as well. Because realistically, like, that is the main, the main thing about the journal is obviously it looks super, super clean. And I would genuinely love it without the AI feature, but the AI feature just cherry on top right there. So let's see what we got here. We got quite a lot of stuff going on. We got a Q2, Q3 SSMT bearish. Which one took place first though? And did the bullish one even hold? Because it looks like it may have been gone. It may have been gone, yeah. So let's see. We ran out the low instantly. So that was at 9 o'clock. Okay, so this may have actually been a win actually. Even this bullish one that I thought may have been a loss. So entry would have been inside the tCISD. Stop on the SSMT low. And yeah, this would have been a win actually. So this is what I mean about the tCISD model as well, guys. Like, even if you're on the wrong side of the markets, 2RR is insanely achievable with the tCISD model, literally. And especially if you've got the 1RR break even thing as well, like, truly is special. So let's go ahead and see. We would have entered there at 9:20 and exited at 9:25, 6th of October. This would have been a pretty decent week. 9:20, 9:25, 2RR, risk 1%, $1,000 profit. I may have made a few mistakes as well in terms of when I've been inputting data, so do keep that in mind, guys. 4-star trade, save trade, perfect. And now let's jump back into the charts and let's do the final trade of the video. But remember, like I said, guys, if you do want to see more of this, we basically backtested the whole of October, so we can easily get through 1 month every video. So if you guys want to see, like I said, maybe make this a weekly series where we backtest 1 month together using the journal. And if we get like through the whole entire year, imagine the AI insights that we're going to be able to get from the model. Like, it's going to be actually mind blowing. But yeah, anyway. So here we got a Q2, Q3 SSMT. Let's take a look. So this would have been confirmed here at 9:45. We also got a bullish one. Did we get the bullish one first? No, unless we... Wait, hold up. I think we may have done, actually. No, ES. Oh, wait. Maybe YM gave it. 9:15. Yeah, we did. Yeah. So 915. So the 915 candle created it, which in this case closed bullish for NQ. So we look to our left, use the most recent bearish one, closure above at 920. Entry just wicked into the tCISD, stop on the SSMT low, which would have been right there. And then as you can see, 2 hour was literally delivered, and was it a singular candle? So you guys wonder how I get my one or two candle TPs on like the 1 minute time frame. This is how right here, the tCISD model. So 3rd of October, entry was at 925, exit at 930. So let's see if we can remember all that. It's 3rd of October, quick. 3rd of October, 920, was it 920? 920, I'm gonna have to go back and check because I'm stupid. 925, 930, okay, that's it. 925, 930. We'll start tCISD, copy paste, boom. SMT, tCISD before 930 open. $1,000, 1% risk, 2 RR, and that is it. Saved. Boom. All right. So now, the part that you guys have probably been waiting for, the grand reveal. So let's go to the dashboard first and see what the stats are going to be. Remember, we started at 50k on the account, just literally risking 1% for a 2 RR every single trade. This was basically for the whole entire month of October. Let's see what your account balance would have been at after that. There we go, 55k. So that's a 5k profit increase for just the month of October. Keep in mind, I personally don't think October's been the cleanest of months ever. You know, we've been at all-time highs. We've had the gov shutdown, no news, anything like that. So for that type of month, I would say this is pretty insane, to be honest, guys. I would genuinely say this is pretty insane. So overall, 64% win rate, which, by the way, you know, is very solid for a 1 to 2 RR. I think to be profitable with a 1 to 2 RR, I mean, I don't even know what it is. I think it's like 40%, something like that. So we're 25% over that average. And also, this is just for 1 month, which, like I said, in my opinion, is a pretty bad month as well. So I would say this is very, very solid for a 2 RR. You know, you're going to be winning more trades than you're not. So it's going to be great for your psychology as well. Total 12 trades, 58.3% win rate. Profit factor 3.5. Sharp ratio 9.4. Average win obviously $1,000. Average loss 500. Max drawdown $1,000. So here's the calendar as well. So you can see first week was green, second week was green, third week was a loss, fourth week was a loss, and then the final week was a 2.5k win right there, as you can see. So overall for the month, 2.5, 5k, minus 400. Minus 1,000 would have been 4k, but then we got 1,000 here, which doesn't update there within week 1. So yeah, very, very good stats. Let's check out one last thing. As you can see, you can scroll through like this, or you can put it in playbook, see all of your trades there. You remember, the trades that you're going to be taking, you want them to be looking the exact same every single time. So scroll through here and you can really see the ones that, you know, appeal to your eye, and they're the ones that you just want to be looking for every single day. So now, the AI coach, the best part. Let me just showcase this as well. As you can see, there's some predefined questions which you can just click and it'll just give you a response, or you can ask it yourself. Reflection, you can choose trades to reflect upon. Ask it to give you insights. You can ask it to generate a summary of each trading week, and you can also set your own custom goals. So, I mean, come on, guys, insane stuff, right? Insane stuff. So let's go ahead and say, I don't know, do most of my losses occur before 9:30 or after 9:30? I believe in this case it was probably after 9:30, but we don't really have the biggest sample size of trades ever. So let's see what it says here. I would have thought the win rate would have been higher after 9:30, but yeah, we'll see. So losses concentrated in early hour trading. So 3 out of 5 losing trades, 60% occur before 9:30. These trades resulted in a combined P&L of minus 1,500. The single losing trade after 9:30 was a $500 loss, and that was only 20% of total losses. So in summary, your early morning trading before 9:30 is a significant source of losses. Okay, so it was before 9:30. Okay, interesting. So the market volatility and potentially less developed price action, which is correct. That usually is, you know, what happens sometimes. During this period, are costing you. You're losing 60% of your total losses during this time, indicating a clear pattern of poor performance. Stop trading before 9:30 entirely for the next week and analyze the results. Like, My head is blown, bro. Like, this is insane. This is an AI telling you this, bro. Like, are we for real right now? Are we for real right now? Insane. What other question should we ask it? Let's clear chat and we'll ask it a predefined one. So look, you can even do like psychology ones. I can't speak. It's been too long. It's been 37 minutes. Okay. How consistent is my risk management? In this case, it should literally be perfect. It should tell me it's perfect. All my losses are the same. All my wins are the same. We've got the break even. Inconsistent risk to reward ratio. So that's 5 out of 12 trades. From 1% risk and 2R. 3 trades show a 1R risk to reward. 1 trade shows a 0 risk to reward. So that'll be the break even. 1 trade shows a 1.8R. Okay, so I may have typed in some of the stats here. But you can see here, stated risk percent is consistently 1%, which is good. However, your risk to reward ratio is highly inconsistent. Your explicit target are 2R and 6 trades, but 5 trades were either 1R, 0R, or 1.8R. So I may have actually made a mistake there. When entering the losing trade, I potentially should have put -1R, potentially. I think that's what it is, because the journal here is picking up that I been typing 2RR and then 1RR, so it's a little bit different, right? I think that is why, personally. But I mean, it's just so quick and the responses are just so clear as well. I mean, let's reflect upon a trade here as well. Let's just literally generate prompts and see what it says about this trade. But remember, the way that I was backtesting was super simple. It's just literally 4-star screenshot. I didn't give it any sort of anything, you know, basically. Oh, this is the generate prompts. Let me do the insights, actually. Sorry. Let's do a summary, actually, for this month here. Actually, we'll do it for this month here, generate summary. And what this will do is break down the whole entire trading week for you, essentially. Literally insane. And you can export this data as well, you know, do whatever you want with it. Let's see. Oh, okay, I generated now. There we go. So based on 4 trades, the weekly trading performance overall, winning trades 3, losing trades 1, 2.5k P&L. Best trade October 6th, $1,000. I may have accidentally typed 1 in the end, that's why. A, user rating 4, risk spend 1%, no additional notes. So you can see it can't go too in depth until you actually basically pump it information, essentially. So whenever you journal in trades, give it as much information, write down the pre-trade checklist, add the tags, etc., etc. But in this case, like I said, it was very basic. So I'm basically just showcasing what you can do with this AI here. And if you pump in more information, it's going to give you very, very specific descriptions of your trades as well, okay? So, yeah, with that being said, that's probably going to wrap it up here, guys. If you do want to go ahead and pick up the Oracle X all-in-one AI trading journal, will be linked below in the description down below. Remember, you can test it completely for free, and also the pricing is the cheapest out there on the market. We are unbeaten in the pricing. So if you want to go ahead and pick one up, and just think of it as an investment in yourself, right? You want to invest within your trading. You want to be getting the best statistics possible, the help of the AI to help spot patterns within your trading. And it just really is, there's no downside to it. It's only positives, you know? And also you're creating a good, healthy habit, which is journaling every single trade. And also, if you can't be bothered to backtest, you can see that session that we did was actually pretty fun. So you may be more inclined to do that, okay? So yeah, if you do want to pick up the purchase one, just click here. It'll say upgrade. Go ahead and click that and then choose whichever option you want. The yearly one's cheaper than the monthly one, but the monthly one is still super, super affordable, okay? Also, if you guys don't like the purple mode, you can choose dark mode or light mode, flashbang right there, which I actually quite like the light mode, but I would definitely need to have some sort of light on in my room to actually be able to see, because that's flashbang me. So yeah, if you do want to pick it up, link below in the description. To the very first episode of the brand new Quarterly Theory Gem series. I'm going to drop in one of these videos every single week for you guys, and inside of each video there's going to be 3 completely different Quarterly Theory Gems each episode. And trust me when I tell you guys, I know ball when it comes to Quarterly Theory Gems. I do. That's kind of how I built my following originally on Twitter/X. I used to post 1 Quarterly Theory Gem every single day for probably around about a year straight. So I do know what I'm talking about when it comes to the gems. I know so many more small intricate gems that you guys probably have never heard of before. But without wasting any more time, let's go ahead and just jump straight into it. But quickly, before we do get started, I just want to say, using these gems that I'm going to be teaching you on this whole entire series, it allowed me to buy a car like this, a brand new Porsche at the age of 21. So shout out Quarterly Theory, and let's jump straight into it. So the first gem that we have here for today's episode is intermarket relations, okay? Essentially, quick breakdown is whenever the Forex market is expanding, we can anticipate the indices market to be consolidating, okay? So whenever we see one market consolidating, we can anticipate the other market to be expanding. So the other way around, let's say, for example, FX is consolidating, we would then expect indices to be expanding, right? And knowing this information here, how can it be valuable? How can it be of use to us? Well, what we can do is, if we can clearly see on the daily time frame, for example, the Forex market has been inside of a consolidation for quite some time now, we would then focus on the indices market because they are likely having an expansion, so we can catch some more cleaner moves intraday as the price action, the daily candles, are actually expanding towards targets. And vice versa, when we see indices consolidating, we can then look to trade the Forex market, Euro USD, GBP USD, etc., because they are likely to give that cleaner price action day to day, as those markets are likely to be more clean and expanding to those higher time frame targets. So let's quickly jump onto the charts and go over an example of the one that we've just had recently right here. All right, so let's take a look at the consolidation versus expansion times across the indices market and also the Forex market, okay? So if you guys trade indices, you would have known we've been going through some absolutely crazy consolidation recently. So let's kind of mark out the starting candle when the consolidation began roughly. Obviously this isn't to the T completely, but a general, 2-3 weeks of consolidation on indices equals 2 or 3 weeks of expansion on Forex. So let's say the consolidation began, let's be nice, let's say the 10th of February, okay? So we'll draw out a box here, and let's say it ended around the 19th of March, okay? Because you can see from then, we've kind of been getting some decent moves over the past couple of weeks, a nice clean move lower, breaking below the consolidation low, and then also a nice, reversal back higher here, respecting the gaps and delivering to actual targets, okay? Whereas this, terrible. So this began more or less on the 10th of February and lasted to, let's say, the 20th of March, okay? So now if we go over to Forex and we'll take a look at the 10th of February, right? Which if we go ahead and mark out again a box from the 10th of February, which is here, till the 20th of March it was, which is roughly around about there, okay? So as you can see, indices consolidating like crazy, whereas Forex expanding very, very nicely. Okay, there's no consolidation here, maybe for a couple of days here and there. That's just normal, right? We don't expect every single candle to be a large expansion, but more or less nice, clean, clear movement to the downside, right? And then, as you can see, literally like the past week or so, probably starting from when the expansion ended around the 20th of March. So from the 19th up until the 3rd of April, we can then mark out the same as well. So the 19th of March, which is here, until the 3rd of April, which is just recently right there. You can see we experience not necessarily expansion, but clean price, like clean, clear price action. We clearly delivered down to the consolidation lows. We put in a low and then we began trading back higher, right? So you can see we're getting clean price action now within indices and then choppy price action within Forex, okay? And we can again go back in time and take a look at this again. So let's find another consolidation phase here within indices. So around this period here, from around about the 2nd of January, let's say up until where was this high point? The 28th of January. So the 2nd up until the 28th, okay? Consolidation. Let's see how Forex was looking from the 2nd of January up until the 20th, I believe it was. So here we go, 2nd of January up until the 20th, round about there, clean, clear price action. Again, not expanding like insanely aggressively, but still delivering to the lows and then putting in a low and then reversing back higher, okay? So as you guys can see, there's a pattern here, right? This generally happens quite a lot. So currently, Forex is here within inside of this range. So until it breaks out of this range, which, would be the high, or the low, we can expect Forex to continue consolidating, and this means we can be focused more or less on the indices market and look for those nice clean expansion moves right now looking towards the upside. But I would say until we inverse this gap, it's not 100% clear, but if we can close above this gap, then I would not be surprised if we continue expanding up towards these highs here, for example. Okay, so yeah, hopefully guys made sense of that. Let's jump back now into the second gem. And now for the second gem of the episode, we have the first presented fair value gap after SSMT. so the first presentation gap after sequential SMT. Now, the first gap that is formed after a SSMT is a very important gap to pay attention to. If an SMT-Fill is then formed inside of it, you have a two-stage cracking correlation. Pair this with the higher time frame order flow, and it rarely fails. So essentially all this is we need to wait for a sequential SMT to occur. It can be on absolutely any cycle. It can be the micro, the daily, the 90, it doesn't matter. And then we're looking for that very first fair value gap to form on the exact same time frame that the sequential SMT took place on. So say we had a bullish 90-minute cycle sequential SMT, we would then wait for that very first 5-minute gap to form immediately after the sequential SMT. It doesn't need to be right away, ideally a little bit less. The quicker it forms, the better, but as long as it's not too far away and as long as price hasn't expanded higher just yet. So what we can then do after that is use that gap as a reference point and look to take our entry inside of it. And if an SMT-Fill or a PSP or potentially a lower time frame sequential SMT then occurs inside of that gap, we have a multi-stage cracking correlation entry, and that is very, very high probability. So let's go over an example on the charts of this happening right now. All right, so now we're on to our second example on the charts here of the first presentation gap after a sequential SMT. And funnily enough, we actually coded this into our quarterly theory toolkit indicator, which essentially shows you all the quarterly theory concepts you could possibly ever need. Link below in the description underneath the indicators section. And yeah, all you need to do, turn on first fair value gap after sequential SMT, and also first inversion gap is another little gem, but we'll save that for a different day. First fair value gap after sequential SMT, turn that on, and all it'll do is it'll mark out the candles for you, right, that form after a sequential SMT. So as you can see, literally looking at the previous day's price action, in this case this is Friday, today's Sunday, so a couple of days ago. Bear in mind the market closed early here as well at 9 a.m, so like terrible price action, but still we had a hidden daily cycle. No, sorry, at the time it was a regular cycle sequential SMT right there, right? First presented gap. So if we turn it on replay, just so you guys can kind of understand this a little bit better here as well, right? Look at that first presentation fair value gap right there, playing out beautifully clean right there within NQ. And if you play out one more candle, it does go a lot higher as well. It is a wick, but as you can see, if you entered off that gap, you could have, rode that whole move all the way up to the highs, right? And then obviously this was NFP, so you wouldn't really be trading NFP anyway. But if you was to stay in, it would have, gave a very, very nice move higher. And that's just the first example. No hindsight, nothing like that. And again, we can keep scrolling, right? So right now we're on the 15-minute. So this is the daily cycle. Look at this one right here, okay? Nice little daily cycle on the highs. And then we form that first presentation gap after the daily cycle. Let's see if we had some sort of SMT-Fill inside of it. So if we hover over that gap, the specific gap that we're looking at there, no gap there on YM, and it is a little gap there on ES, but unfortunately no tag of that gap. Now, you don't need to enter inside of the gap. The gap can just be like a confirmation tool almost of this sequential SMT being a little bit higher probability. But obviously, it's a nice entry model as well, right? So there's no entry off that one specifically. No daily cycles formed. Here we go. Here's our next daily cycle. As you can see here, we have two back-to-back, right? And they both work. Right? So initially we had a hidden here. What is my charts doing? Oh, I think it's because I'm in replay. Either way, hidden daily cycle sequential SMT. First presentation gap right there. Mark it out. Very, very small, but it's still there, right? And if I can drag this out a little bit, there we go. Very small to see, but a couple of weeks into it, and then a very, very nice move lower. And this is, quite a big move lower. 450 ticks is no joke. And then again, why did we go back higher? We got another daily cycle SMT on the lows. What is TradingView doing? Strange. And then again, daily cycle, first presentation gap, mark out that gap right there. Or you can just, use the indicator, it just marks the gap for you. Entry inside of it, and then again, very, very nice move higher. Okay, so as you guys can see, this is a great way to not only kind of confirm a sequential SMT as well. Usually by the time a gap forms, the tCISD is also there as well, so it's like even higher probability, tCISD and a gap, but then you can also use it as a reference point for an actual entry as well. Now you can just enter off the same time frame immediately, stopping the SSMT low, or you can drop to a lower time frame once we're inside of that higher time frame gap. So like the 1 minute, the 5 minute, for example, and refine your entry, get a bit of a better RR if you would like to do so. But yeah, either way, both work great. And yeah, hopefully you guys found this useful. Let's jump now into the final and third gem of today's episode. And now finally we have our third and last quarterly theory gem of today's episode, and this is going to be the 6-hour PSP. Now this has actually gained a little bit of popularity recently. I tweeted this out probably about a year ago, maybe even over a year ago today. So I was one of the first to speak about this in the space, and it can be very, very powerful, okay? So if you guys don't know what a PSP is, it essentially helps us to identify reversals and continuations. And basically what it is we're looking at closely correlated assets, and then we're waiting for a swing point to form, and the candle that forms the swing point must be a different closure amongst the assets. So a bullish swing point forms, let's say at midnight. We're then looking for that midnight candle to close bullish on one asset, for example NQ, and then that midnight candle must close bearish on another closely correlated asset, for example ES. Okay, so the 6-hour time frame condenses each daily cycle quarter into a singular candle. Since PSPs help us identify reversals and continuations, spotting one lets us anticipate the next 6-hour candle's move, revealing where the next daily session quarter is likely to go. So as we know, PSPs, are usually there before reversals, or at least continuation moves higher or lower. If we spot a PSP on that 6-hour time frame, it shows us that that session is likely the start of a reversal. So say for example, the midnight candle on the 6-hour time frame forms as a PSP. We can then expect that London session to be our manipulation for the day, and then we can trade that third candle, candle number 3, expansion away from the PSP, and that would be the AM session. And that way we can gain information that we'd expect the AM session to begin expanding higher if we have a bullish PSP formed during the London session candle. And now let's jump into an example of this on the charts and see how powerful it really is. All right guys, so we're now into the final and third example of our gem from today, and this is going to be the 6-hour PSP, okay, on the charts, showing you guys how powerful it really is. So again, indicator marks out precision swing points, turn it on, go to the 6-hour time frame. I believe you can only view the 6-hour if you have a certain plan for premium on TradingView or something like that. But if you can't view it, it's fine. It's not the end of the world, but it can be very helpful. So let's actually remove the first presentation gap as well. We don't need both here. That's the one from last example. Now we've got our PSPs on, okay? Now let's take a look. 6-hour, so the dot marks a PSP. Essentially that's the PSP candle. Green is bullish, red is bearish. So as you can see, literally a couple of days ago, Monday 30th of March, 6 a.m. PSP, and then as you guys can see, that 12 p.m. that PM session delivered to the downside. Now the thing is, with this gem here, the main target that you want to be having is that PSP low. So say a bearish PSP formed, a bearish swing point formed during AM session, your target for PM is AM lows. That's essentially AM session telling you, okay, the higher the day is likely in, you can now target my lows basically, okay? So keep that in mind, and you'll see within most of these examples that will be the case, okay? Bullish PSP here at 6 a.m. So AM session, PM delivered up to the high and also hit the highs above it as well, but the main target is that PSP high, okay? Bearish one here during PM. So Asia hit the lows of the PM lows essentially. Another bearish one here, and we just about hit the lows of the AM session right there during the PM. So it did what it was supposed to do. Not the best of candles, you wouldn't necessarily expect it to instantly reverse after hitting the lows, but in this case it did, okay? The main thing is that previous, the PSP low or the PSP high, sorry. Bearish PSP here during PM, hence Asia delivering to the downside, right? Bearish one here, bullish one here, 6 a.m., PM delivered just about up to the high, another bullish one here, PM, and then AM delivered, Asia, sorry, delivered up to PM's highs. And then this one here actually did fail because it was a bearish PSP. So we would have come in to this candle here, the Asia candle, anticipating PM lows, but it did just fail there. But again, we've gone through about 8 examples, and that's the first time it's failed, right? So you guys can see this clearly works very, very well. Again, a bullish one here during Asia. London delivered up to Asia highs. Bearish one here during AM. PM delivered down to the lows. Bearish one here during Asia session. London delivered down to the lows. Bullish one here. Didn't quite hit the highs there of the PM session. So probably around about 2 out of 13-ish times or something like that, this has failed. So it's got an 80+% chance of playing out. So yeah, you guys can definitely incorporate this into, finding the narrative, kind of understanding what the bias and the direction of the specific daily cycle quarter that you're trading based on if we get a 6-hour PSP or not, right? So they're not super common, right? But when they do occur, you guys can see how powerful it really is, okay? Now, another little gem as well is to think if this works on the 6-hour PSPs, daily cycle quarters, what other quarters do we have? The 90-minute cycle, 90-minute candles. We've got the microcycle, which is around about 22 minutes. We've got the 22-minute candles, okay? So something to think about there, but we'll save that for a different day. But yeah. Yo, what's going on, guys? Welcome back to the second episode of the brand new quarterly theory gem series. You guys absolutely love the first episode, so cannot wait to continue doing this series. This episode today is going to be an absolute banger as well. And before we do get started, I do want to show you guys what is possible by trading these gems that we're going through in this series. I managed to pull 1.6k from one singular trading day this week, while getting 4 wins, 1 loss on the week. And also another student of mine, Connor, managed to pull over $50,000 in profits during the month of March. Absolutely insane. So let's go ahead and jump into the gems that allow us to do things like this. So the first gem of today is SMT MSS. So this means SMT market structure shift. Essentially all this is any lower time frame sequential SMT that opposes the higher time frame will be used as a way for price to drop into a premium / discount or a PD array that was formed via the higher time frame sequential SMT before realigning with the higher time frame direction and using the lower time frame sequential SMT as a draw on liquidity. So as you guys can see in this example here, on the 4-hour, we have a monthly cycle sequential SMT between Q1 and Q2. And then just imagine this 15-minute, the daily cycle sequential SMT occurred on the day or the day after of this monthly cycle SMT occurring. So like around about here, for example. And because the higher time frame had already been set in play by the bullish monthly cycle sequential SMT, this daily cycle that opposes the higher time frame sequential SMT, so a daily cycle going against the monthly cycle, which one do you guys think is more powerful? Obviously the higher time frame, the monthly cycle. So this bearish daily cycle that occurs here will essentially allow for the 4-hour to retrace lower into a 4-hour PD array, so a 4-hour gap inside of this leg higher right here. Or for example, it could be pushed into a discount of this leg here as well. And once this retracement has then finished, we can then go ahead and look for a long position in line with this bullish monthly cycle. And we can go ahead and target the initial bearish daily cycle sequential SMT highs, okay? So as you guys can see, a bearish daily cycle occurred here. Price then drops lower towards this 15-minute gap and also into this 4-hour one. This is then when we're hunting for longs because we know not to trust this bearish daily cycle because the higher time frame is bullish. And then once we get into our long position, we can go ahead and target those initial bearish daily cycle sequential SMT highs. So now let's quickly jump into the charts and give you guys an example of this occurring in real time. All right, so we're now inside of the charts going over an example of the SMT market structure shift, okay? So in this scenario, as you guys can see, we're looking at the 1-hour time frame for the weekly cycle. We have a nice, clean, clear-cut bullish weekly cycle sequential SMT occur. This is literally on the week that we have just had, okay? So Q1, Q2, total soup there in Q2, value swing there for ES, okay? Clearly, bullish weekly, confirmed by a 1-hour tCISD as well. Now, once this has formed, using the exact methodology that we just went over, every single sequential SMT that opposes this bullish weekly cycle should fail on the lower time frame, okay? So if we form a bearish opposing weekly, that could outpower this one and allow us to drop that lower. But the daily cycle, the 90 and the micro, if they form bearish, they should all technically fail. Obviously, this won't work 100% of the time, but generally this is, you know, what you can use to help you identify if it's a real move or an SMT market structure shift. So if we now go to the daily, the 90 or the micro, and look for anything bearish that formed literally since 7th of April, 3 p.m., we can see that it most likely failed. As you can see, price just clearly ran higher, so we can already see it failed, but let's go to the 5-minute, for example, look at the 90-minute cycle, okay? Let's go ahead and take a look. Boom, boom, boom. So this is when it formed down here on Tuesday. Price just ran higher, and let's see what we had. So I can already see 2 inversion tCISDs here, both bullish, and inversion tCISD is essentially a failed bearish regular tCISD. So if we put this in replay, you guys can see here at one point in time after this bullish weekly had been set, we ended up forming a bearish 90-minute, okay? So as you guys can see, we had it here between Q1 and Q2, right there, Q1, Q2 indicator marking this out for me. Link below to the indicators used here. You can go ahead and grab those as well. Free trial, everyone can test it out for free, okay? So bearish 90-minute, Then, as you can see, this is our tCISD candle, price closed below it, and then immediately inversed it on NQ. This is why I love inversion tCISD so much, because using what we just went over, we know we have a bullish weekly in play on the lows. So all I'm doing is looking for any bullish regular tCISD or any regular inversion bullish tCISD to form in line with that bullish weekly, and I can take a long. And again, as you guys can see, this one failed, and then another bullish inversion tCISD formed right after over here. And basically all these bullish inversion tCISDs can be entries. You can look for regular bullish tCISDs as entries as well. This is why I always emphasize, if you can, try trade in line with that higher time frame order flow, okay? And that order flow is set by these higher time frame cycle sequential SMTs, right? This is why I always tell my students, because it's so important. And also, speaking of students, I've actually just launched a bigger and better program called the Oracle Circle. This is going to be a one-to-one mentoring group. I'm only taking in a maximum of 10 people. So if you do want to apply to the waitlist, link below in the description. The waitlist applications will be reached out to and let known if they are accepted on the 21st of April, okay? So go ahead, apply, link below in the description. But either way, yeah, as you can see, try trade in line with whatever is the highest of time frame cycle sequential SMT that has formed, okay? Anything else against that is an SMT market structure shift, bearish 90, retrace, bearish 90 initially here as well, small retrace, inversion tCISD, back higher, okay? So now let's jump into the second gem of the episode. All right, guys, so our next quarterly theory gem of today's episode is the Revolving True Open, the RTO. Now, essentially, this is a super simple concept to understand. The Revolving True Open is the opening price of a quarter where a sequential SMT has formed. Once there is an RTO, you can treat it like a regular true open, looking for shorts when price is above and longs when price is below. Okay, so looking at this example here, you can see we have a bullish daily cycle sequential SMT between Q2 and Q3. Now, you guys know the true open of every single cycle is the opening price of Q2. Okay, so actually our normal true open would be around about here where my cursor is, and now an RTO is the quarter open when a sequential SMT occurs. So as you can see, a bullish daily cycle sequential SMT occurs during Q3, the green box. So then what we can do is, once we see that has formed, we can mark out the very first candle of Q3, mark out the opening price, draw it out in real time, and we can treat it like a regular true open. So once that bullish daily cycle sequential SMT has occurred, we can then look for longs anywhere below the RTO of that quarter, and even better if we form a second stage below the revolving true open of that 15-minute daily cycle, like in this example right here, a nice bullish microcycle sequential SMT, and also it looks like we have an SMT-Fill also, and then we can look for the highest of probability long positions right there. So instead of waiting for the bullish daily cycle to occur and price just to rip higher and deliver higher, then getting a late entry, you can use this essentially as a way to identify, okay, we have a bullish daily cycle, we're still at a discount in terms of this bullish daily cycle. This is where I want to be looking for my long position, below the RTO, and then you can essentially position yourself and bottom tick that move to ride the expansion all the way higher. And also you can treat that RTO as a nice target as well. If, for example, you enter below it, you can then target the RTO, because once price comes above it, that's essentially price now at a premium of that current quarter. So that's a good way to be taking profits, to be moving to break even, because if you are wrong about this bullish daily cycle SMT holding, it's likely going to trade above the revolving true open and then just drop back lower if you are wrong about the higher direction. So let's jump into the chart and go over an example of this in real time. All right, guys, so we're now going to go over an example of the revolving true open right here inside of the charts. And as you guys know, for the first example, we literally did an example of the week that just happened. Same here for the revolving true open. It just goes to show I don't need to cherry pick examples from years and years ago and stick it in replay mode, whatever, okay? Like, every single time a sequential SMT there is there, it works. Like, right here, literally right here on the highs as well. Like, here on the highs, it's always there. Here on the lows, it's always there, okay? So, no need to cherry pick any examples, but what I am going to do in terms of showing you guys an example is find the cleanest one. Obviously, that is ideal, okay? So, we got one right here to mark the very low. Down here, a bullish 90-minute cycle literally just occurred on Friday. So this is just the cleanest one. So let's go ahead and go over this one here, okay? So let's stick this in replay mode just so we can walk you through the step-by-step process of finding an entry. using the revolving true open, right? So step number one, obviously wait for a sequential SMT to occur. Okay, now this one here during Q3, this one occurred right towards the end of the quarter. Ideally, when you're looking for a sequential SMT, you want to see it form fairly fast towards the start of a quarter, like this bearish one. This is a great entry here, okay? Because sequential SMT is manipulation, and we want to see manipulation occur as fast as possible, not late on towards the quarter, as fast as possible. So like right here, Q3, Q4. In this scenario right here, as you can see, ES ran below Q3's low, YM also, and Q failed. So we have now a bullish 90-minute cycle sequential SMT. Step number two, we mark our first candle of Q4 because this is the quarter in which the sequential SMT occurred. So in this scenario, a bullish candle, mark at the open. This is now our RTO, okay? Revolving true open, right? Now, you don't just want to press buy immediately once you're below the RTO of the quarter, obviously, okay? You don't want to do that. You would still want to wait on confirmation, but you wait on confirmation to occur below the RTO in order to get yourself the best entry of this quarter, okay? So what you can do is drop to a lower time frame. So in this case, the 5 minute down to the 1 minute, and then we need to see some sort of bullish signature indicating higher, some sort of bullish reversal signature. So it can be an inversion, it can be another lower time frame sequential SMT. In this case, we don't have anything here between Q1 and what has now just opened up, Q2. And then also we can mark out this low, so we know that, you know, as long as price doesn't trade below this low, the 90-minute cycle is still there, and any entry above here, below the RTO, but around this area is valid, okay? So what could be our first entry technique here? Can be a lower time frame inversion. So do we have any gaps resting here? Not really. No, we don't really have any gaps here, to be honest. Probably not the best of examples. We do have one here though on ES. So let's mark this one out. Once ES inverses this gap, we could look for an entry on NQ, okay? As long as we have solid displacement. So let's see if ES inverses it. There we go. As you can see, ES does inverse it, and also we form a nice bullish 1 minute gap. So that again could be another entry technique that you guys enter from. Maybe we get some sort of SMT-Fill here. I don't know if we come all the way back down to it or not. And it doesn't look like we do in this scenario here. Let's see if we form, you know, maybe another gap. Okay, no, we do come back into it. Okay, cool. So as you can see, price is now inside of it. Maybe wait for the next candle to print because this is a pretty bearish closure inside of the gap. We didn't disrespect it, and we do have an SMT-Fill, so this is a valid entry. But let's wait for one more candle to play out. Okay, well, we got it here anyway. So, yeah, basically we would have waited for the next candle to print. And as you guys can see, it would have actually closed above the gap. So you could have taken your entry there with your stop down on this low, right? On the sequential SMT low, always the invalidation stop if possible, and then ride it higher. As you can see, though, if you would have waited a little bit longer, it did get inversed. So what would you have done in that scenario? Just wait for it to get closed back above. As long as that 90-minute is still there, as long as our entry is below the revolving true open, which you can see is retested multiple times again as well before pushing higher. Great reference point for price, great entry point, great stop loss, and then target opposing highs, RR, you know, whatever you want, okay? And as you guys can see, it played out very, very nicely right there, okay? So super clean stuff. It's almost always there, so do look for it. And yeah, with that being said, let's jump now into the third and final gem of today's episode. And now for our third and final gem of today's episode is how to anticipate a PSP, a precision swing point soup, okay? So a PSP, essentially, if you guys don't know, is a swing point that forms across correlated assets where the swing point candle itself, candle number 2, closes bullish on one asset and bearish on another. It's basically a cracking correlation occurring based on the color of the candle closure, okay? And it has to be a swing point also. Now, a soup is essentially a liquidity sweep, so it's price taking out that swing high candle, running above it or running below it, okay? So how do we actually anticipate when this will happen? Because a lot of people enter from the PSP candle and then just get stopped out, and they just don't know why, okay? Now, the two ways that I like to look at it is the open of candle 3 and the higher time frame order flow. So when candle 3 opens, so candle 2, that PSP candle has printed, you're trying to enter off candle 3, anticipating the swing point to hold. But what you need to be looking at is once candle 3 opens, look for it to head towards the PSP or displace away from it. If it looks like it's heading towards, for example, if it's a swing low and price opens up candle 3 and instantly drops towards the PSP low, you don't want to enter. You want to wait for it to displace away from the PSP candle, come higher away from it, okay? Now, this is how to identify if it's going to get souped based on the order flow, is if the higher time frame is bearish, for example, bearish candles are less likely to be souped. So if you form a bearish swing high and the candle that creates a swing closes bearish on NQ, for example, forms a swing high, and like in this example right here, NQ forms that bearish swing point. So it's bearish, but the candle that created the swing initially for NQ was bullish. What does that tell us? It shows us that, okay, we've got a swing high, but NQ is the stronger asset compared to ES because it's failing to print bearish candles. So once that bullish candle has printed, it's a lot more likely to get ran above because NQ is the stronger asset in this example. And the asset that prints a bearish candle, in a bearish scenario, a bearish swing high, this is price obviously showing us, okay, ES is the weaker asset because it's actually forming bearish candles as opposed to NQ still forming bullish ones, okay? So if it forms a bullish swing high as a PSP, that asset is a lot more likely to get ran above, and ideally you want to enter either on the bearish one, so like for example ES, or wait for price to create the soup of the PSP high, and then you can look to trade after that, okay? And for the open of candle 3 scenario, as you can see here, price opens up, you wouldn't enter immediately, you would wait, and then once it drops back to the open and comes close to this candle's low, then you can enter shorts, okay? For example, if you did the same scenario on NQ, you would see it literally only opened up high, higher, 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 you wouldn't enter. You would wait for the soup, then when it comes back to the open, then you can enter, okay? And also once price creates a soup on that PSP high, it then also likely forms, depending on the time frame, a sequential SMT. So if it's a daily time frame PSP, anticipate which asset is more likely to get souped. Then once it gets souped, look for, if it's a daily time frame soup, it would be a weekly cycle sequential SMT. As you can see, NQ forms one here between Q2 and Q3. ES creates the value swing, and then you have yourselves a very, very high probability setup. You have cracking correlation number 1 being the PSP, cracking correlation number 2 being a PSP soup, only one asset takes out the high, and cracking correlation number 3 being the sequential SMT, and in this example, cracking correlation number 4 being then an SMT-Fill for a very, very nice entry. So this is actually one of the highest probability setups that can actually ever form. So let's go ahead and jump into the charts and go over an example of this exact setup. All right, guys, so we're now inside of our third and final example of today's episode, which is going to be the PSP soup. Okay, so what I'm going to do is, again, using our quality theory toolkit indicator, is turn on the PSP setting on the toolkit. Okay, so what this is going to do is mark out the PSP candles for me, and then we can look at the examples super easily for when back testing and whatnot. Okay, so as you can see, the bullish ones are green, the bearish ones are red. So we have a bullish swing point, again, literally just formed in this last previous week that we just had. Okay, Tuesday, 7th of April, right? Why would this have been a good long position? Based on the open of the candle. So like I said, wait for the candle to open, wait for it to come back to the actual open of the candle. So initially, right here, open low with this wick, price then trades higher back to the open. Where's our clear draws? Right, we've got this high, we've got this high, so then we can look to long towards it, okay? In this example, no PSP soup occurred, because as you can see, even the bearish candle, the one that printed the bearish candle, the technical weaker asset, did still give a nice rejection there, okay? So there's that one. We've got another one here on Thursday. Again, the bearish one didn't get souped because it was such a large rejection. This was a pretty bad day anyway inside candle. This was actually a half day that we had actually on Friday, bank holiday, hence why I didn't really go too far. But I did actually want longs if this day was a normal day up towards these highs, and they did indeed deliver off Monday basically, okay? So yeah, there's that. Let's try to find an example where a soup actually occurred. So we got another bearish PSP here. Again, it almost souped it, but this is what I was talking about. Look at the open. Look how the candle opens. Super aggressive towards the upside. At this point, you wouldn't be looking to short because it's so close to the high. Once it begins rejecting lower, back to, like I said, the open, then you can look to take a short. Didn't quite deliver in the same day, but the following day did deliver, overall down to these lows later on in the week, okay? So there's that. I do actually really want to find a PSP soup though. All right, let's try to drop down to the hourly, for example, and see if we got any occurring on here. So we got a bullish one here. Did this bearish PSP get souped? Yeah, okay, this one did. So as you guys can see in this example right here, we have a 1 hour precision swing point. This is a bullish one. This NQ printed the bullish candle, hence why we wouldn't have expected it to get souped. Drop lower, come back to the open, long position, okay? Wait for that open, don't enter immediately. And then within the one that printed the bearish candle, as you can see here, 7 p.m. Again, look at the open as well. Opens up, aggressively drops lower, soups out the low, then gives the move higher, okay? And like I said, you can look for, sequential SMTs occurring off the PSP soup. So this was between 7 to 8. This was at Asia session anyway, so you wouldn't really have been trading during this time. But we can see if there was something there or not. We can definitely take a look. No, I don't think there was anything there in this example here. No, so as you can see, no asset did run below Q1's low right there. Again, it won't always happen, but it's just that extra layer of confirmation. And then you can actually enter from that PSP soup and be confident that, okay, the PSP's been souped, we have a sequential SMT, now price could trade higher from here, for example, okay? But yeah, hopefully you guys did find these examples useful right here. Again, it's just these little small gems, these little tips that you can always keep in the back of your mind. And always be actively thinking of when you're inside of the charts, just so you don't blindly trade these concepts. Like, everyone knows what a PSP is, or if you don't, then super simple, we went over it earlier. But not everyone knows these small intricate details, when to enter, when not to enter, how to expect to soup, all these types of things. So this is why these episodes are super, super valuable. But with that being said, what's going on, guys? Welcome back to the third episode of the quarterly theory gem series. Today we have a special edition episode. We're going to be covering 3 separate quarterly theory models that you guys have probably never seen before that are very, very powerful. And also, using these type of models allowed me to pull another $1,200 payout in just a couple of trading days this week alone. Let's jump straight into the first model of today's episode, the PSP soup entry model. So the precision swing point soup entry model. Precision swing point is when we have a swing point form on one asset that closes bullish and another asset that closes bearish, and a soup is when price drops below that PSP, takes it on one asset and not on another asset, okay? So the way that a PSP soup entry model works, and yes, this is of course fractal, you firstly want to see a lower time frame sequential SMT form right after a higher time frame precision swing point has been souped. Okay, so when one asset drops below the precision swing point candle, you want to see a lower time frame sequential SMT form, okay? In this example, the 2 a.m. candle was souped by the 6 a.m. candle, forming a daily cycle sequential SMT. So there are, of course, specific times in which you need to be looking out for this, because each time frame doesn't specifically cover a sequential SMT cycle, okay? So if you're looking at the 4-hour time frame, a 4-hour candle doesn't necessarily encapsulate the whole entire daily cycle quarter. However, if you look at it from the 2 a.m. candle and the 6 a.m. candle, generally that 2 a.m. candle covers 4 hours of London session, and the 10 p.m. candle has 2 hours, but usually the low or the high of the London session will form inside of that 2 a.m. candle. So like in this example right here, the final 2 hours of this 10 p.m. candle were technically London, and the whole entire rest of this 4-hour candle here at 2 a.m. was the remaining of the London session, okay? And as you can see in this example, this created a precision swing point right here as NQ closed bearish, ES closed bullish. So this swing point that has formed holds the daily cycle London session low. So once we can then see the 6 a.m. 4-hour candle open up, soup out this PSP low, and remember what we spoke about in the last episode, which asset out of these two would we expect to create the soup? Well, when bullish, the asset that prints a bullish candle as a PSP is less likely to get ran below. The asset that prints a bearish one is more likely. So we could have anticipated the 6 a.m. candle to open up low, sweep out the PSP low, form a daily cycle bullish sequential SMT from London to New York AM session, this is how it looks on the 15-minute time frame. And then you can go ahead and find your entry technique after that. So you can do the same with 1-hour candles. You can look for a 90-minute cycle sequential SMT to form on the high or low after a 1-hour PSP has been souped. You can do the same with 15-minute candles to look for a microcycle. And of course, the daily time frame is a perfect encapsulation of the weekly cycle quarter. So once you see a precision swing point form on the daily time frame and then price soups it, that is a weekly cycle sequential SMT, as long as another asset hasn't souped its PSP as well. So essentially, this is a very high probability entry model because you have multiple cracks in correlation, the precision swing point, one asset sweeping the precision swing point, and a daily cycle or any cycle sequential SMT forming on the low of that PSP. And of course, you can use the specific candles for quarterly theory. So a 6-hour PSP, souped, that is a daily cycle. 90-minute candle souped, that is a 90-minute cycle. You can use the daily ones, which is the weekly cycle like we mentioned. Weekly time frame ones is for the monthly cycle, so on and so forth. But let's go ahead and jump into the charts and break down an example of this happening on the charts. All right, guys, so we're now inside of the charts, taking a look at NQ, ES, and YM. And we're going to be looking at the exact same sequence as the one that we just went through. So the 4-hour PSP forming at 2 a.m., the 6 a.m. candle souping it out with the daily cycle, and then the move occurs, okay? So we scroll back a couple of weeks back. This setup isn't, super common because obviously there's only one singular 2 a.m. candle every single day. So it has to close as a PSP, and then it has to be souped, which doesn't happen all the time. You can maybe expect maybe once per week, maybe 2 or 3 times every couple of weeks or so, okay? But in this example, and this was from a couple of weeks ago, we have that 2 a.m. 4-hour PSP, right? And in this scenario, it formed as a bearish swing point. So this is the bearish scenario, right? So look at the candle closure on NQ, it closed bearish. Whereas if we take a look at the candle closure on YM, right here, a little bit choppy, but we'll zoom in for you guys right there. 2 a.m. closed bullish, okay? So in a bearish scenario, which candle is more likely to get souped out? The one that closed bullish, because that is showing us, okay, this asset is failing to close bearish, it's now more stronger, so that next candle is more likely to open up, create the stop run, create the soup, and then give that move lower, okay? And as you can see, NQ never ended up getting ran out with that 6 a.m. candle, whereas YM did. So now all we do, once we see this, we drop to the 15-minute and confirm there was definitely a daily cycle sequential SMT there. If there is, then we can look for our entry technique. So this was on the 4th of February. Let's go ahead and take a look, okay? 4th of February. Let's go all the way down here. As you guys can see, we can mark out that PSP high, and we can see right there clearly from our indicator, YM did run it out, and that ran out occurred at 6:45. And look how clean this entry technique was, guys. We had the 6:45 candle create it. So this is our tCISD candle. So you mark out the open, wait for price to close below it, which occurs simultaneously at 7 a.m. 7:15 then trades back into the tCISD, which is where your entry would then be, or my personal entry technique would be. So we can mark out the body, enter at the retest, stop would go on that PSP high or on the sequential SMT high, whichever one you would have preferred. In this case, let's place it on the sequential SMT high, and then we can go ahead and target a post on liquidity or a set RR for even lower, okay? But as you guys can see, look how clean that sequence is right there. And the specific times you want to be using this, so for example, that 2 a.m. 4-hour candle, and you can also use this, for example, like on the hourly. But remember, like I said, an hourly candle doesn't encapsulate a whole 90-minute cycle quarter, but sometimes when that PSP forms, it can be the high of the previous 90-minute quarter, high or low, for example, okay? So once you see the PSP form on the hourly, once it then gets souped out, which you can see on one asset or 2 assets, then drop to the 5-minute and confirm, okay, there is now a 90-minute cycle sequential SMT here. Then you look for your entry technique, which can be, for example, a tCISD, and then you can be super confident that trade is likely to play out. It's the perfect sequence: precision swing point, PSP soup, sequential SMT, and then entry model, okay? And again, it's not going to be a super common entry model, but when it forms, it is going to be very, very high. It is going to be very, very high probability, okay? So with that being said, let's go ahead and jump into our second model of this episode. All right, so now for our second model of the series, we have the OSOK, the OSOC, or the one shot, one kill model. Have you ever wondered how to catch the high or low of any cycle? This is one of the models that allows you to do exactly this. This is a 2-stage sequential SMT model. If the higher time frame sequential SMT is a turtle soup, you must see a failure swing on the immediate time frame lower. So the immediate time frame lower creates a sequential SMT, and it must be a failure swing, and then vice versa for the opposite, okay? So say the higher time frame creates a failure swing with the sequential SMT, you then want to see the immediate cycle lower create a sequential SMT, but be the turtle soup, okay? So like in this example right here, we have Q1 and Q2 of the weekly cycle. Let's just imagine, right? So this is Monday and Tuesday. So NQ on Tuesday runs above Monday's high, creating a turtle soup for the weekly cycle sequential SMT. ES, on the other hand, creates a failure swing right there for this weekly cycle sequential SMT. And then what's our immediate time frame lower than the weekly cycle? It would be the daily cycle. So then we'd expect the opposite thing to happen on the daily cycle that occurred on the weekly. So if NQ was a turtle soup on the weekly cycle, we would want to see a failure swing with the daily cycle, which is what happens here between London and New York AM session. Failure swing right there, okay? So weekly cycle, turtle soup, followed by a daily cycle failure swing right after. And then ES is the opposite, failure swing on the higher time frame, followed by a turtle soup right after. And this is what's called the one shot, one kill model. And this can happen on any cycles, okay? So let's say, for example, you're trying to catch the high of the day. You'd want to see a daily cycle followed by a 90-minute cycle, turtle soup on the daily, followed by a failure swing on the 90. Or opposite way round, failure swing on the daily, followed by turtle soup on the 90. If you're trying to catch the high or low of the week, this is the model that you would use here, the weekly cycle followed by the daily cycle. Trying to catch the high or low of the session, that would be a 90-minute cycle, followed by a microcycle. Just keep in mind they must be the specific order, so turtle soup followed by failure swing, or failure swing followed by turtle soup. It can't be turtle soup, or failure swing. Well, it can, but that won't be as high probability, okay? Super simple model, literally so easily followable, right? This is like the common theme with all of these models that we're going to be going through. They are super powerful, but super easy to follow as well, okay? So let's jump into the charts now and go over an example of this happening in real time. All right, guys, so we're now on the charts going over an example of the one shot, one kill model. So like I said previously, there are specific sequences that mark the high and low of specific cycles, okay? So starting on the weekly cycle, followed by a daily, that marks our high and low of the week most of the time, okay? So as you can see here, we have a weekly cycle bullish, sequential SMT, NQ and ES both ran out their Q1 lows. So this is Monday's low, ran out there on ES, also ran out here on NQ. However, if we take a look at YM, you can see a nice clear failure swing right there, okay? So this is step number one. Identify the sequential SMT, identify is it a turtle soup, is it a failure swing? In this case, NQ was the turtle soup, and let's just look specifically between NQ and YM for this example. Turtle soup, failure swing. Okay, so now when we're looking for that one immediate time frame, that cycle lower, the daily cycle, we must see NQ be the failure swing, and we must see YM be the turtle soup. Okay, so let's drop to the 15-minute, and this occurred during Asia session. So as long as we get a daily cycle between Asia and London, or London and New York AM, New York PM, that's fine. Generally, it doesn't need to occur immediately as this weekly cycle is taking place, but say this expands, then the second leg down, like the retracement, it can occur there, okay? So let's go to the 15-minute, and this was on the 30th of March, and we're looking for NQ to give us that failure swing, okay? 30th of March, and we're looking for that failure swing right there from NQ. So we're on the 15-minute right now. So let's take a look. So remember I said between Asia and London, or London and New York AM, right? So this is where the weekly cycle took place. This is essentially a weekly cycle right there on that 1 hour, the higher time frame. Boom, turtle soup, failure swing, and then the second leg, the second stage of sequential SMT right here between London and the New York AM session, as you can see, is a failure swing right there for NQ. Boom, perfect, that's what we want. However, on YM, it is that turtle soup, which again is what we want right there, okay? So yeah, that's essentially it, guys. And then after this takes place, you can then use any entry technique that you would like. In my scenario, in my case, I would use my entry technique, which would be the tCISD. So we mark out our tCISD candle, and I would enter right there at the retest of that tCISD. Right there, stop would go on the sequential SMT low, and then you can go ahead and target a pose on liquidity, or you can go ahead and target a set RR, whatever that may be that you do like to do, okay? And as you guys can see, this was our low of the cycle, formed via the one shot, one kill model, and from there we just continued expanding higher, okay? So yeah, hopefully you guys found that useful. Now let's jump into our third and final model of today's episode. All right, and now for our final and third model of today's episode, we have the 90-minute cycle 930 model. Now, this is one of my favorite models. As you guys know, I do trade the tCISD model. The video is already out on YouTube. Go ahead and check that out if you haven't already. But I essentially use this logic as well inside of this model because I trade from 9 to 10:30 a.m. Eastern Standard Time, okay? Now, this model, during the 9:30 NY Open, if no manipulation has occurred prior, so to me, manipulation would be if no sequential SMT has occurred prior and confirmed itself by a tCISD, you can anticipate a sequential SMT, in this case a 90-minute cycle, manipulation to form, okay? So if we can see we clearly have no manipulation prior to the 9:30 open, we would anticipate a 90-minute cycle sequential SMT to form at that 9:30 open. Doesn't need to be immediately, but it can be, maybe 5 to 10 minutes after. If you can see 9:30's gone higher and it's trending higher, boom, bearish 90-minute forms. Then after this has happened, you have two chances to look for an entry, either a 5-minute precision swing point entry or a 5-minute SMT-Fill entry. As you guys know, my main personal model will be a 5-minute tCISD entry, but these two here also work very, very well. So in this example, as you guys can see, we have Q2 and Q3, of course, right? And at 9:30 or around that 9:30 window, ES runs above Q2's high, forming a bearish 90-minute cycle sequential SMT. And it doesn't need to be the exact candle that creates a sequential SMT. It can be, 2 to 3 candles after on the 5-minute, but you want to see that precision swing point form. In this case, it does form off the very candle that creates a sequential SMT. That can be your first entry. And if you miss that one, or you want to wait for a little bit more higher probability entry, you can wait for a gap to form, and then you can look for an SMT-Fill inside of this gap, like happens exactly right there. ES tags into the gap, NQ does not, and then we begin the expansion move towards the downside. So now let's jump into the charts and look at an example of this occurring in real time. All right, guys, so we're now on to our final model of today's episode inside of the charts right here, the 9:30 model, okay? What we're going to do is, like I said, it's a PSP or an SMT-Fill entry model. So let's, for this example, turn off the tCISD, go into our toolkit right here, and we can turn on PSPs. And then we also have an SMT-Fill indicator, so we can turn that on as well. Remember, if you guys want any of these indicators, they are linked below in the description, okay? Some are free, some have free trials, super, super affordable tools to help you with your trading, okay? And because we've got the SMT-Fill on, let's turn the maximum gaps up to, let's say, 50. So that way it will show a lot more gaps here, okay? So when we're back testing, it should be a lot easier, right? So 5-minute time frame, we're looking for that 90-minute cycle sequential SMT to form either at 9:30 directly or 5 to 15 to 20 minutes after, okay? So let's see what we've got. What we can do is click this as well. We can type this into 9:30 right there, and then we can easily backtest this model. Right, here we go. Just picked a random day, and we have an example right here. So this is Wednesday, the 14th of January. As you guys can see, sequential SMT here on the 90-minute cycle. This occurred at 9:30 directly, so the 9:30 candle on YM ran above Q2's highs of the 90-minute cycle, okay? Now, the candle itself, when it closed, it didn't form anything. There was no entry model there. However, the following candle did. So 9:35 created a PSP. So bullish candle closure there on YM, bearish for NQ. So what we could have done is entered immediately off the open of candle number 3. When it opened up, would have been better if it traded higher. This is a pretty bad RR, to be honest. But you guys can still see it did work out very nicely. And remember, if you're too worried to take this entry here, or you want a little bit more confirmation, wait on a gap to form. We got one here at 9:40. It was only a gap there on NQ though, so no SMT-Fill there. However, then our next gap that formed, that we had an SMT-Fill inside of, was this one here at 10:25, okay? So you can enter immediately off the SMT-Fill, stop on the recent swing high before the gap, and go ahead and target the lows, right? Or what you could have done is, waited for this candle to close away from the gap, entered off the following candle, stop on the swing high formed inside the gap, and as you can see, you could have caught a nice RR there, and most likely even more as well if it continues to drop. I don't know if it does. Let's find out. Yeah, there you go. So overall, could have caught a little bit more RR there. I don't know how much further it goes, but either way, Isla would have entered off the SMT-Fill after seeing a small rejection. So maybe somewhere around here. So a little bit lower of an RR, but you can still see it did play out very, very nicely, okay? So with that being said, guys, trading the NQ live in front of my whole entire Discord. This is exactly how I did it. First of all, there is the proof, as you guys can see, fresh 200k account. Bear in mind it is an evaluation, okay? But either way, we're over halfway past to locking in another $200,000 in for the capital. So yeah, let's just dive into it, show you guys what I took on the charts. As you can see, the magnet did indeed help out. Okay, magnet always works. I'm joking now. Okay, so let's dive into it. So first of all, this is the trade. Our original stop loss was up there. Okay, so about 5 hour roughly. We entered at around 9:43, so a little bit after the open. Okay, why did I even take shorts? Let me break everything down. First of all, let's start with the weekly candle. Okay, what is my direction for the week? What am I expecting this weekly candle to do? Because everything is important. Everything ties into each other. It's Tuesday. It's the second day of the week. Generally will form, the high or low of the week, depending on if we're bearish, the high of the week should be in on Monday/Tuesday. Okay, so if I'm bearish, I'm looking for that high week to have been put in already, and I'll show you guys why I used to confirm that in a second. Okay, weekly bias is bearish. As you can see, the previous week's close was an inside candle, but we have so much liquidity below. We have, first of all, we open up fairly close to the previous week low anyway, right? And also we have the previous week's low, this low here as well. And if we go to the monthly time frame, we just start the new monthly candle, which is what did the previous month close as? A bearish reversal. Okay, and it's what? It's a PSP. YM closed bullish, NQ closed bearish. Okay, now which is the stronger asset out of the three? YM. Therefore, what? It souped out its PSP high. Okay, also 2 unfilled gaps below, so I'm just like super bearish, at least down to previous month low here essentially. It souped out the high, which in turn has formed what? A bearish yearly cycle, which by the way hasn't been confirmed by the tCISD yet, we need to wait on this closure. But it also formed a quarterly cycle, which is essentially a yearly cycle quarter divided into 4. Okay, and we just started the new yearly cycle quarter, so we also just entered the Q1 of the quarterly cycle. So essentially it happened simultaneously, and it happened off this candle here, July the 26th, which is this candle here. As you can see, we closed bearish on NQ, therefore we can't use that candle as our tCISD, so we use our most recent bullish one, which is here, 30th of June, automatically got closed below. So looking for that new week to deliver lower, generally based on what I just said. So I want to see this tCISD here on the daily time frame be respected. And is it being respected? Yes, of course it is. Okay, Monday traded into it, looking for Tuesday now to trade lower. Now, what has confirmed that the high of the week is likely in for me? Weekly cycle, or every single day of the week. Daily candle closure and weekly cycle. Okay, as you can see, the daily candle closure was an inside candle, rejected away from the tCISD though, which is quite bearish anyway. And then also, at the start of today, we formed a bearish weekly cycle. Right, so NQ and ES both failed to run out Monday's high. YM did. Okay, this formed at 6 p.m, so literally immediately. tCISD, again, just confirmed immediately that most recent bullish one there at 2 p.m. Since then, looking for price to just deliver towards our drawn liquidity. Okay, expecting high of the week to be in now. So enter my time window, 9 to 10:30 a.m. All I'm looking for is shorts because this framework here is so bearish. We have a clear drawn liquidity, which is, you know, this daily low down here. Previous day low had already been taken, which was my main target for the day. But then we didn't show any reversal signatures and only showed continuation ones, indicating that we keep delivering down towards the lower targets. Okay, so simply 9 to 10:30, look for shorts down to this daily low. Let's see what we've got. Okay, we had bearish daily cycle, which the tCISD got reconfirmed. So this daily cycle was formed immediately, 6 a.m. with ES. NQ failed to run out London highs, ES did. So 6 a.m. candle is our tCISD. If it closed correctly, it didn't. So we use our most recent bullish one, which is here, 545. Mark at the open, price had closed below it immediately. Then we inversed it. Then we closed back down below it. Then we inverted it again, and then coming into my window by 8:45. So within my 9 to 10:30 window, the tCI essentially had been reconfirmed to the downside, formed a 15-minute gap, overlapping with it as well. Price then trades into the gap. We have the daily cycle supporting potentially higher the days in there as well from that intraday tracking correlation. 5-minute time frame. Let's just check what we've got here. I believe we had a 90-minute. Yeah, 90-minute bearish too. Formed at 9:30 with ES as well, which is great. Just classic 9:30 manipulation. You know, tCISD confirmed, all that good stuff. NQ respecting it. Swept out this liquidity. Lower. Still held the 90. Go to the 1 minute. And we can look for, you know, entry here. Essentially, you could have entered from anything though. You know, you could have entered off the 15-minute tCISD retest again there at 9:30. You could have entered off this 9:30 wait once it traded into the tCISD and, you know, began rejecting away from it. Like, you could have entered anywhere. I personally entered off the 1 minute time frame, so I waited for a signature on the 1 minute to show me that now price is ready to go lower here on the 1 minute. And the fact that it's aligning with the 15, the 5, the daily, weekly, literally everything aligned here. It's like a multi-stage sequential SMT, which I don't need personally for my model. Just at least one with a clear draw is fine. But we had it, you know, we had it. Higher probability, we'll take it. Okay, we had a hidden bearish micro there at 9:30. As you can see, 9:30 took out the Q1's high, but we did not close above the highest closure there of Q1. Okay, within NQ. So we're still holding that bearish micro cracking correlation. So we quite literally have a micro, a 90, a daily, a weekly. Also, we have a monthly cycle. I forgot to show you guys that. Let me quickly show you guys. 4 hour. YM took out previous week high. NQ did not. and we confirmed our 4-hour tCISD today. So many draws below, like, it's just so obvious, guys. Come on, man. Bear in mind, we're on a 7-win streak right now. This is actually crazy. Past 3 weeks, 7 trades, 7 wins. All taken live in front of the Discord as well. If you guys do want to join, link in the description. I've also just added a Booco AI bot. You can ask the bot question 24/7, get a response in literal seconds, and it's trained from everything I know. It'll give you an answer in seconds. You've got a question about Sequential SMT, PSP, whatever it is, it'll answer immediately. Go check that out. There's a 3-day free trial as well for the premium. If you click on the link, trade live with me in the description, you can test it all out, okay? So the actual entry itself, like I said, held this hidden micro. We then displaced. This was our first presented gap after the hidden micro. tCISD there, inversion tCISD, essentially entry then from this gap. I'll wait for price to trade into it and reject lower, which it did there at 941. Originally respecting the gap, that was the main game plan. But I wasn't really worried once price traded back above it. By the way, originally our stop was up here, actually. Sorry, that's my bad. It wasn't there, it was just here, okay? But then as you can see, we did inverse the gap, but then immediately closed back down below it. The reason why I wasn't worried as well is because the tCISD candle was so large. It was a big, thick tCISD candle, acting like an order block, supporting price to go lower. So if the gap failed, it wasn't the end of the world. It did immediately get reconfirmed, which was great. And then once we broke down below this low here, that's then when I did trail my stop down to here. And then like after this one, we essentially just went break even slightly before 10 a.m. Yeah, like around about here, just to account for any potential wick higher at 10 a.m. just to like give us an unnecessary loss at that point. Because if we just come break even, we'd likely sweep out this high, etc., etc. So we could have just re-entered. Either way, break even just to secure our position. And then we genuinely just sat and just rode it all the way down to the daily time frame low. We put the magnet there, let the magnet do all the hard work, and that was it basically, guys. So yeah, so many guys inside the Discord as well did catch W's. You guys can check inside the profits channel, inside the Discord community, which is free as well. You can join the free Discord community in the description. Scroll through it, at least 15 people posting wins, people past accounts, getting payouts. Insane. Okay, so yeah, if you guys inside of today's video, I'm going to be showing you guys exactly how I trade for just 90 minutes maximum per day. So I have the rest of my day to do whatever I would like. And just trading that 90-minute window this week has allowed me to request $1,200 in funded payouts. I also made another $2,000 on an account. I just need a couple more winning days to request that next week. And I also passed 3 accounts this week also, 2 50k accounts and 1 25k account. And all of that was done for just trading 90 minutes maximum per day. I actually ended up taking a trade every single day this week. We had 2 quite big wins, 2 very small losses, and 1 break even. So let's go ahead and jump into the charts so I can show you guys my exact model I use to get these results this week. Also, before we jump into the charts, here's a few results from my one-to-one mentorship students this week alone. So first of all, before we dive into the trades we took on each day, I'm going to showcase my exact thought process and narrative reading for the week and how I identified what I would expect each day to do. If you guys don't care for that and just want to see the trades I took, skip to this time right here that I put down below on the screen, and that will dive straight into my trade recaps. Now inside of the charts, the single trade that I took this week was taken on NQ. And first of all, let's start on the weekly chart, okay? So weekly chart, what do I want to see on the week? You know, why was I bearish at the start of the week and maybe more bullish towards the end of the week, right? So first of all, my narrative coming into this week here, so this is the weekly candle that has just closed. This is the week that we just traded, right? Looking back upon the previous weekly candle closure, what was it? This is a bearish reversal candle signature to where? To the downside, right? So the main target whenever we have a candle closure like this, indicating lower, is the previous week low. Right, so my almost guaranteed target that I wanted to see get hit this week was previous week low, which coincides with a nice bullish weekly gap that hadn't been tagged into prior to this week. Okay, now also if we go ahead and pull up the 3 charts to look at the triad, you guys can see if we look at the candle closure specifically, ES closed bullish last week, NQ closed bearish, right? So what is this? This is now also a precision swing point candle. So again, this indicates a reversal lower. So it just gave me that little bit more confidence to look for shorts coming into the start of the week, right? Now, my main target being previous week low, what does that mean? It means I'm looking for shorts all the way down to that low. Then once the low has been taken, I could then begin to frame longs. Why? If we form a bullish cracking correlation inside of this higher time frame weekly gap, okay? And did we form a cracking correlation inside of it? Yes, we did. So we tagged the gap on both ES and NQ. So unfortunately, no SMT-Fill. That would have been nice, but not needed. So then if we drop to the 4 hour, we can go ahead and see if, number one, did we form any monthly cycle, sequential SMT inside the gap? The answer is no, because all assets actually took out the previous week low, okay? So what's now our next best thing? What's our next higher time frame cycle we can use to gauge if we're going to get a move back higher or not? Would be one cycle lower, which would be the weekly cycle, okay? So 1 hour for the weekly cycle. Now, what would we need to see on the weekly cycle to indicate a move higher, to indicate how lower the week is in? That would be a bullish weekly cycle sequential SMT, okay? Now, initially we had one here with Monday's low. ES and both NQ took out Monday's low on Tuesday, whereas YM on Tuesday failed to take out Monday's low, okay? So that alone was enough for me to then say, okay, now the following day I'm looking for longs, okay? So both Monday and Tuesday were the days I actually took both my wins on. Why? Because they were such easy shorts, because my main target for the week was previous week low. I literally just purely look for shorts for the most part. I think I may have taken one long here, which we'll dive into shortly, and I'll tell you guys why. But for the most part, we're looking for shorts down to that gap. Now the gap's hit. Now we've got a weekly cycle sequential SMT. What now confirms this sequential SMT would be a tCISD, okay? So where's our tCISD candle? So if we mark out the Monday low, which is the very first candle of Tuesday that took out that low, right? It was this one here at 9 a.m. on NQ and on ES, okay? Now, can we use this 9 a.m. candle as our tCISD candle? No. Why? Because this is a bullish SSMT scenario, so we can't have a bullish candle as our tCISD candle. So if it was bearish, this would be our candle. But it's bullish, so what do? We look to our left and we look for the most recent bearish closure before this candle here. So it's not the 8 a.m. candle, it's the 7 a.m. candle right there, okay? So we go ahead and mark out the open of this candle, and then we wait for price to close above it. And this actually occurred off the 9 a.m. candle itself. So this candle created the sequential SMT initially, and close above what would be our tCISD candle immediately, okay? So seeing this, obviously very, very bullish now, okay? However, we did end up dropping back down below this low again, which, you know, sometimes can happen. It won't hold 100% of the time, but that's fine as long as the sequential SMT remains intact, which it did, and then we get back above our tCISD, which was this candle here, and we closed back above it there at 12 a.m., okay? What we can do as well is mark out this whole body of this tCISD candle. And as you can see, once it got closed back above, not 12 a.m., sorry, at 12 p.m., price then came back into it multiple times towards the end of Tuesday and start of Wednesday, right? And as you can see, all the bodies were respecting the tCISD candle. So seeing this obviously is very bullish, and we're looking for price to trade away from it to the upside, okay? And that's exactly what price did right there. So then obviously nice and easy longs on Wednesday. And then because Wednesday also formed another sequential SMT, because YM actually took out Tuesday's low, whereas NQ didn't, this could be, you know, another manipulation day. But more or less for me, Tuesday manipulation, Monday continuation, accumulation, whatever you want to call it, it doesn't matter. Sequential SMT is the main thing we're paying attention to. Sequential SMT is our manipulation. Once it occurs, distribution follows, right? And then a potential continuation if higher time frame draw has not yet been met, which what was my higher time frame draw? Previous week high, so therefore I anticipated continuations on Thursday and also on Friday, because why? Friday, you know, still hadn't have taken my previous higher time frame draw, okay? So that's more or less the whole entire week right there, kind of how I saw each and every single day. And obviously once I identified what I wanted each day, I then looked for my model in line with that essentially. So now let's dive into each day specifically and go over the exact model I used and the trade I took on each of the days. All right, so here we are on Monday. Now Monday, I actually took a long, right? And there's one very specific reason for taking a long, even though I wanted shorts down towards that previous week low, okay? Now, most of the time, and I always preach to try and trade always in line with that drawn liquidity, the narrative, etc., the narrative, etc. Now, the only time I will go against that is if we have a huge expansion in line with that direction that I'm expecting price to go. So if I'm bearish, if we have a huge bearish expansion to the downside, I don't mind then taking it long, because price has to retrace, okay? It doesn't have to, but like there's a 90% chance it will retrace before continuing that move towards your target, okay? Now, I was obviously bearish on Monday. We had a nice clean setup here. So we had a bearish, you know, sequential SMT. We had one here between Q4 and Q1. This was actually a hidden one because as you can see on ES, we never closed above the highest closure of Q4. Whereas on NQ, we did off that very, very first candle. of the quarter right there at 9 a.m. So there's our tCISD candle, and there was obviously quite a nice entry around here generally. Okay, obviously I didn't quite catch this one. This was only 8 minutes into my trading window. If you guys don't know, I only trade from 9 to 10:30 a.m. Okay, now my actual model itself is I require at least a daily, a 90 or a micro, plus a true change in the state of delivery on that specific time frame, ideally in line with my drawn liquidity, unless I'm taking a retracement trade like this, and then I'll take that trade. Okay, so I missed a short here. Unfortunately, it was just too quick. Like, it just formed like 8 minutes into my window. I hadn't even done my analysis by that time or anything like that, or I was in the process of doing it. Okay, then as you can see, because we had manipulation prior to 9:30, what did 9:30 do? It just delivered to the downside. Okay, and that's generally what 9:30 will do if price manipulates prior. So obviously now I'm seeing this huge expansion to the downside. I'm thinking, okay, we're gonna obviously want to pull back into this leg here, retrace, and then continue lower. So what do I now need to see in order to take a long? Based on what I just told you guys, what's my model? A sequential SMT plus tCISD. And what do we have on the 1 minute time frame? We have a microcycle sequential SMT. So Q2 lows were taken off the very first candle of Q3 on both NQ and ES right there. Okay. However, on YM, as you guys can see, YM never took out Q2 lows right there. Okay. So what do I now need to wait for? That would be a true change in the state of delivery. So where is our tCISD candle? Well, 9:45 took out the low, forming the sequential SMT. So it would usually be this candle, but why isn't it? Because it closed bullish. Can't have a bullish tCISD candle in a bullish scenario. So we use our most recent bearish one, which would be 9:44. So we mark out the open, right? And we wait for price to close above it. Now, here's a little tip about the tCISD that you guys might not know, but my mentorship students already know this and have known this for a while now, but you guys can get this one as well, a little gem. If between the two most correlated assets out of the triad, if one of those confirms its tCISD before the other, you can take a trade on the other asset that hasn't quite confirmed it yet. So NQ didn't quite confirm it, right? It hadn't confirmed it, at this time, 9:47, but ES did, okay? So I can now confidently take a long on NQ right here because I can see that ES has confirmed its tCISD already in anticipation that NQ will also, okay? So we've dropped this down to 1x. My entry was, I'm just waiting for like a couple more candles to play out, and then I more or less wanted to enter a trade, place my stop on that recent swing low. So I believe it was off this candle here. Yeah, so I entered off this candle as it was trading lower, right? So around here, stop went on the, again, still on the invalidation, the sequential SMT low, and I just target a simple 2RR roughly, okay? Now, right there, okay? Now, as you can see, unfortunately, the candle that I entered from did confirm a bearish tCISD because we had a bearish micro from YM. So that isn't the greatest thing to see ever. And to be honest, if I hadn't entered off this candle directly, I probably would have waited for the next candle to invert this tCISD or something like that, okay? But I'd already entered, my stop was in the invalidation, I trusted my setup, and then if we go ahead and let this play out right here, you guys can now see we had a beautiful candle straight after, this is what I love to see, it just started ripping to the upside. After we got this candle closure, I was very confident that we'd hit my TP, and as you guys can see, we did indeed do so in just 2 or 3 minutes. Okay, and off that candle, we got the inversion tCISD, all that good stuff, right? Now, like I said, I was bearish the first couple of days of the week down to that weekly gap. So every single move against that bearish scenario should just be a retrace. And as you guys can see, what do we go ahead and do right after? We begin dropping back lower in line with our drawn liquidity. Because every single move higher is just a retrace. That's when you can look for that bearish sequential SMT plus tCISD combo. And as you guys can see, it works out very cleanly. Nice short entry there, another nice short entry there, because they're all in line with the drawn liquidity. Now, if you guys are wondering, how are these marking out for me? I have my indicator suite, the toolkit, SMT-Fill, statistical bias, tCISD, all linked down below at oracleindicators.com. You guys can pick them up. We have a few free indicators and some within our premium suite, so go ahead and check those out, link down below in the description. So now let's go ahead and jump into Tuesday's trade. Alright guys, so we're now on to Tuesday, and we're going to go ahead and cover the second trade that I took here of this week. So Monday was a win. This was also another winning trade right here. So Monday, Tuesday, both wins. So let's go ahead and cover this trade right here, okay? So obviously, general basis is I'm expecting Monday, Tuesday to create that open low into the weekly gap. And then obviously I'd reassess the situation once the gap's been hit. But overall, I want to see shorts into that gap. So what do we form intraday as well? So rather than the trade that we had on Monday, that was just a little retracement, we actually had some nice framework intraday here. So we had a bearish, this was a hidden weekly cycle sequential SMT. So as you can see, no assets actually took out Monday's high, right? But if we can see closely, NQ did not close above the highest closure of Monday on Tuesday. Neither did ES, but YM, the highest closure, was here, and we actually closed above it off that very first candle of Tuesday. Okay, so 6 p.m. right there, obviously on Monday, but technically that is obviously the first candle of Tuesday. Okay, so as you can see, we closed above the highest closure there. So that is our tCISD candle. So that is the 6 p.m. candle of Monday. So we can go ahead and mark that one out on NQ right here as well and use it as our tCISD candle. Price closed below it at 8 p.m. And then obviously ever since then, it remained valid, intact. It never got disrespected. So obviously now I'm coming into my trading window looking for shorts as this is in play and it's in line with my narrative, right? Now I entered obviously around that 9 a.m. candle, right? And as you guys can see, we more or less traded into this gap here. Now I think we actually ended up respecting this gap. I don't think this is the full candle closure here. So let me go ahead and show you guys. So obviously we got a bullish weekly as well, but that doesn't faze me. Like, I don't care about opposing sequential SMTs. Once I've established my narrative, I'm only looking for trades in line with that, okay? So I didn't care for this. I just saw this as a way for a retrace higher into this gap. Now I'm looking for any reason to get into a short. So 15-minute, did we have anything on the 15-minute to, kind of frame a trade-off as well? Yes, we did. So we had a Q1, Q2, daily cycle sequential SMT. Obviously, YM took out London, Asia high, sorry. That was our tCISD. Again, we traded back into, that first presented gap below the tCISD, or just about. I think we did hit it when I show you guys the actual trade that I took. And obviously, Q2 manipulated. Q3, I'm looking for that distribution to where? In line with my draw, okay? So there's the 15. We had another bearish scenario. Did have that bullish daily on the lows, but again, like I said, I don't care about that, right? Now, we also had a bearish 90. And what is this? A huge expansion to the upside. So what was the trade on Monday based off? Price expanding and then retracing back lower. Now, this one was an expansion, and the trade that I'm looking for is actually in line with my drawn liquidity. So I was very, very confident in this one because there's two outcomes. It either likely retraces to go lower and I catch a W anyway, or it continues fully in line with my whole draw lower and I just catch the actual move, right? So I like these type of trades that are like that one, okay? So bearish 92, obviously no tCISD because price was so far above it. Then, because we had a daily and 90, the weekly 1 hour tCISD, I then dropped down to the 15-second. Now we also had a micro, but the 1 minute tCISD would have been so far away. It was actually this candle that created the sequential SMT. So it was at 9:30. I wasn't wanting to wait for price to get all the way down here. So what's the next best thing? 15-second. And this is then when I look for a bearish nano cycle sequential SMT. So we go ahead and put this in 1x right there. You guys can see, I think it's the next quarter that forms it. We hit into that 15-minute gap up there as well that I got marked out. And you guys can see the new quarter opens up shortly. I think it was ES that took out the high. There we go. ES now took out Q3 of the nanocycles high. First candle of Q4. So where's our tCISD? It actually confirmed immediately because we can't use that bearish candle in the bearish scenario. So we use this most recent bullish one. 9:39, 15 seconds. Mark out the open. Price obviously closed below it immediately. So now indicator should mark this one out too. There we go. So all I did was wait for price to trade back into it. Entered after a little rejection. Stopped where? On the sequential SMT high. And just took my 2 RR, which aligned roughly with this low right there, okay? And as you guys can see, this trade hit in about 3 candles. And these are all 15-second candles. Okay, in 1 candle, nevertheless, okay? So literally around about a 15-30 second TP. And look how clean that framework, that entry, the model is right there, okay? So that was another very, very W day. That was, a nice confidence boost to start off the week with those 2 back-to-back wins. So now let's jump into the couple losing trades that I took and also the break-even trade that I took on Friday, which would have been a win, but I'll show you guys why it wasn't. So let's go ahead and now jump into Wednesday's price action. All right, guys, so we're now taking a look at Wednesday's price action. So this was our first losing trade of the week, and I would happily take this losing trade a million times over. Why? Because it was my model. It aligned with what I wanted to see with the overall narrative. So why would I not take it? Okay, so it's absolutely fine loss. It was also a very, very small loss as well. I'll show you guys why I did scale my stop loss up, and also I risked a little bit less on this one anyway. The way that I like to do it is if I take a trade before 9:30 open, I will reduce my risk to half, essentially, because then that will allow me to have 2 bullets for the day. So I have a set amount of risk for the day. I take half trade before 9:30 if it stops me out, like due to a wick or something, but then my idea gets reconfirmed after 9:30, then I'll take the second trade, essentially, okay? In this case on Wednesday, I did only take that one small half risk trade, which ended up even being less risk because I moved my stop up because I didn't get what I wanted to see after 9:30 anyway, okay? So initially coming into the day, obviously we'd hit now that weekly gap down here on the lows, okay? We also formed, obviously, the weekly cycle between Q1 and Q2, and we had another one here between Q2 and Q3 on the weekly cycle. All the tCISDs confirmed, all that good stuff, equal highs built up here. So all I'm looking for 9 AM to do now is just initially trade low, form some sort of 90 daily or micro tCISD on the same time frame, and then look to take a long, okay? Now, also as well, before we hop into the actual trade itself, I forgot to tell you guys, or I have told you guys before, but I'm sure most of you guys don't know, I actually run my own premium Discord server in which you guys can trade live with me every single day. Take trades like this with me every single day. You also get access to a lot of things as well included in that membership, which is all the indicators completely for free, HSSMT trading guide, 10 premium quarterly theory lectures, daily analysis, daily trade recaps, daily forecasts, daily absolutely everything, okay? A premium community with obviously like-minded quarterly theory traders like yourselves, okay? And we have many people getting, you know, lots of payouts, passing lots of accounts, reaching profitability, etc. inside of that group. So feel free to check it out in the description. It's the Trade Live with Me line in the description with the WOP premium membership. It does have a 3-day free trial as well, so you can test it out completely for free and see if you guys like it. If you do, feel free to stick around and be in that community with me. I answer everyone's questions, trade live every single day, reprice action together, etc, etc. Okay, but in terms of this trade now, we went over as to why I was looking for a long. So all I need now is either a daily, a 90 or a micro. Now, if we look at the 15-minute, we saw that all assets had also taken out London highs, okay? So we had no bearish daily cycle sequential SMT, which is a good thing because we now don't have any opposing sequential SMT to our trade, okay? So we knew we couldn't really get a daily cycle. I wouldn't want it to see price all the way down here if I'm truly bullish. So what's our next best option? The 90-minute cycle, sequential SMT, okay? And what I saw coming into this window, Q3, so the candle hasn't printed yet, but I'll show you guys in just a moment. I saw that all assets had already formed, not all assets, I saw that all, the trade as a whole, sorry, formed a 90-minute cycle sequential SMT between Q1 and Q2. We formed our tCISD, and we also got an inversion tCISD. So price essentially opened up inside of, you know, this more this more or less like inversion tCISD sort of candle around here. You know, came close to this tCISD down here as well, and actually hit it on ES. Okay, so Q2 formed sequential SMT. That's manipulation to me. So now I want Q3 to initially open low a little bit and then trade higher. Okay. Now, because the 5-minute traded into the inversion tCISD that formed in the previous quarter. So if we go to the 1 minute, I don't like entering directly off an older tCISD in the previous quarter directly. So I want to look for a lower time frame cracking correlation, okay? And essentially what we got was right towards the end of literally like the first couple of candles of Q4 of the microcycle, we had formed a bullish microcycle sequential SMT between NQ and ES, okay? Now it was formed off this candle here at 8.58. So as soon as price closed above this candle, I'm now satisfied and ready to take a long up towards the highs, okay? So as you guys just saw, we had like the double micros form off the bat. The tCISD, like I was so confident in this trade, I then dropped to an even lower time frame being the nano. I don't usually do this, but like I said, we had the 90-minute cycle inside the 5-minute tCISD. We had the micro, we had like technically double micros. So then I dropped down to the nano, then waited for a sequential SMT here. As you can see, all assets took out Q4's low of that first candle of Q1. So I would have wanted to see a hidden. So if we let the next candle play out, you guys can see YM ended up closing below the lowest closure there of Q4 of the 9 AM 15-second candle. Okay, so now this is our tCISD candle. So we mark it out, we wait for price to close above it, which happens shortly after. Boom, there's our tCISD. So all I did was simply wait for price to, it didn't quite hit the tCISD because it was like quite low down. This candle was quite above. So I think I entered roughly around about here. Stop went down on the low. So this was, you know, around about 40 ticks. Hence why I was pretty confident taking this. It was just like such a small risk trade. We ended up getting tagged in. Also, the target would have been like, well, let's say around 2RR roughly. We ended up getting tagged in off the next candle, I believe. Let's see which one. This one here. So we would have ended up this one here, that first presented gap after the tCISD. So right there. And then once price hit up to these highs, I then moved my stop to the recent low that got put in, I believe it was. Oops, let's play out. Playing out. Boom, boom, boom. Speed this up a little bit. Boom, 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 boom. Coming higher. Boom. Okay, and then it hit these highs here. So then I moved my stop loss to, I think it was more or less like this low there. No, these lows here. Sorry, because we formed another nano plus a tCISD right there. So this was more or less the stop. Oops. This was more or less the stop around here. And then obviously full target being up there. Then as you guys can see, price ended up coming and hit my stop loss. So that was just in general anyway a half-ish trade, plus I essentially halved my stop loss as well, so it's like 25% of my normal risk on the day. So very, very small loss right there. I did then want to see obviously continued higher prices, but if we hop out of replay here, let's go to back to Wednesday, go to the 5 minute. I wanted to see like a bullish 90-minute cycle, sequential SMT, to be like really, really confident in our long positions, which was round about here. Well, I didn't initially want to see one. I wanted to, see this tCISD over here hold, like we mentioned at the start, okay? But then all assets ended up taking out Q2's low. But as you can see, if we mark out the closure, NQ never closed below it there at 9.25, and then 9.30 kind of confirmed what would have been the tCISD, okay? Because as you can see, ES did close below that lowest closure at 9.25 as well. NQ closed above it. As you can see, it turned into an inversion tCISD because it confirmed it. Then it closed directly down below it. And on that candle closure that closed back down below it for the second time, it then essentially cancelled out this hidden 90. We no longer had this original 90 and no longer any hidden 90 here. So then, obviously, I did want to see lower for the most part. But if we go to the 1 minute, you can see we cancelled out the hidden 90. And we actually formed a, let's go to 9.15. We ended up forming a micro on the very low. So I actually called this long down here. This was actually fairly clean. Where was it at? I think it was a micro. Was it a micro? Q2. No, maybe it wasn't a micro then. No, so I don't think I generally just don't think that we formed anything. Hence why I didn't take that second bullet, because I wanted longs. But the 90 failed, and then we just didn't get anything else down here on the lows, right? So, yeah, I more or less just didn't take anything. Price then ended up, just running. I think we had like a lot of nano down here, I believe is what it was. I do remember calling some sort of long down here, and then price just ran, essentially. Okay, so that was Wednesday's losing trade. Now let's go ahead and jump into Thursday's one, and then finally Friday's break-even trade, which would have been so close to being such a banger. So stay tuned for that one towards the end. All right, guys, so we're now looking at Thursday's price action. And again, this was another little small loss. This was, again, an entry prior to 9.30. So, half risk on the day. Didn't end up taking another trade after as well. And I'll show you guys why. It was pretty much like deja vu of the previous day. I think we had a 90 hidden, then it failed, etc., etc. Then we went higher. Okay, so again, literally coming into Thursday, like we said at the beginning of the video, looking for that continuation because Wednesday distributed, we still hadn't hit the previous week high. So anything that isn't towards the previous week high, I see as a retrace lower to then look for that real move in line with that draw, which is higher. Okay, so I saw on the day as well, all assets had taken out the previous day high, which is good, by the way, because we had no bearish weekly cycle sequential SMT up here. So no bearish cracking correlation. So again, any move lower should just be that retrace. Okay, 15 minute. I don't remember what we had in the 15 minute. Let's see, did we have like any daily or anything like that? We didn't. So all assets had taken out London low. We did actually have a bearish daily cycle as well within Q3. And we did, kind of deliver quite far from it. So again, we was quite overextended to the downside. I overall wanted to see higher anyway. So I wouldn't necessarily care about this too much. So again, I just keep scaling my way down the cycles and looking for that 90 daily or micro plus the tCISD. Okay, so we go to the 5 minute. I believe we had a 90 here. So yes, we did Q1, Q2, 90-minute cycle, 2 90-minute cycle, sequential SMT. Okay, we did initially confirm the tCISD because I think we formed a hidden initially. Yes, we did. So YM formed a hidden at the 820 candle. and then as you can see, we closed above that tCISD, then we did close back down below it. So that's already not quite a good sign for longs, to be honest, but this happened before my trading window anyway. But then we formed it with wicks. Okay, so we had it initially with hidden, it then did fail, then we formed it with wicks. Okay, now which candle created the SMT with wicks? It was this one here, 855, right? So all we're doing is waiting for price to close above here. I'm pretty sure we formed another 90-minute cycle sequential SMT anyway. Yes, we did. Okay, so put this back in 1x. So we did actually end up confirming the original one, and then we formed another 90-minute cycle sequential SMT with the first candle of Q3. We ran out Q2's lows on ES and YM. So again, where's our tCISD candle here? It was actually the exact same candle. So the previous SMT was this tCISD candle, and the tCISD was here because 9 AM formed it, but we closed bullish. We can't use a bullish candle, so we use an 855 candle. Price obviously immediately closed above it. Then the following candle, 905, traded right back into that tCISD. So then I dropped to the 1 minute time frame and framed my entry from that 5 minute tCISD. I think we may have even got a micro. Yeah, we got a micro as well. We hit this tCISD here. Overall, this was very clean. Like, this is literally exactly what I wanted. I wait for a little retrace away from it. I don't know if I entered there directly, but it was somewhere roughly around here anyway. Stop obviously on that sequential SMT low, and then, you know, targeting around about 2 RR. Okay. So if we let this one play out here, you guys can see, I think it did just run straight to stop loss. Boom. Yeah, so it ended up hitting our stop loss. We then formed another micro here between Q1 and Q2. Then we got the tCISD. Now I remember calling this one as, again, a pretty good entry because it's, you know, a sequential SMT prior to 9:30 in line with my draw. But because I'd already taken that first trade of the day pretty early on into the session, I then didn't want to hop into another one quickly after. I wanted to save my second bullet for after 9:30. But this one would have actually played out. I do remember this one actually. So it's just unfortunate. Like, it was my model. It was in line with the draw. But this is what I said earlier. Sometimes it'll just fail. And then, you know, it may form another one. Then that one may work. But if you can remain disciplined and, you know, obviously not take like 100 trades. So yeah, you can see it actually ended up. Did it end up wicking below where the stop? Yeah, it ended up wicking below again a little bit at 928. We then did close back above the tCISD at 929. And then we did end up pushing higher. So my, you know, draw would have been around here. I think it was even slightly below it for that 2R. So it would have ended up hitting. But had we evented off that second tCISD, we would have got wicked out anyway. So it's a good job we didn't take it. Then we formed, obviously, this bearish micro up here. And then I think we got a bit of a lower move lower. And then we just ended up ripping higher. Yeah, so we came into this inversion tCISD. I think from here, then we just started ripping. Yeah, then we ripped. And then, yeah, overall, price just obviously continued higher for the day, okay? So, yeah, that was pretty much the trade recap right there. Like I said, it was like literally deja vu of the previous day. If we go to the 5 minute, I think we ended up cancelling out the hidden 90 as well. Yeah, so we did have a hidden 90 initially at... was it a hidden 90? Yeah, I think it was because the tCISD was there. Yeah, it was with ES, so ES never closed below the lowest closure there of Q2. NQ did close below it at 920, then we closed above it there at 925, so that coincided with the micro as well. So this was actually a pretty decent long. It's a shame it wicked out again though. That would have been quite annoying had we have taken that second entry. Luckily we didn't though. But then overall the idea did end up playing out. We cancelled out the hidden 90 though at 935, but that micro was still there in the lows. And then I believe okay, we ran out the lows. I think we got a Q3, Q4, then we ripped higher for the rest of the day. Yeah, and then I think it did just rip in PM session. Yeah, there we go. So because that hidden 90 had failed and it was just a micro on the low, really a microcycle isn't enough just alone to, you know, push price all the way higher to like previous week high or whatever intraday. Hence why we came back down that second time to form the actual 90, because a 90-minute cycle or daily cycle is ideally what you want to confirm your low or high of the day, okay? So as you can see in this scenario, I think low of the day just got put in immediately, technically there on Thursday during Asia session, but like the technical, like second low of the day, whatever you want to call it, low of the session there at least, was put in by that 90-minute cycle, which will usually be there like most of the time, okay? So that's what happened there. That's what kind of played out, and they were the two small losses that we took on the week. And then on Friday, we ended up taking a break even. So let me go ahead and show you guys that trade right now. And now, last but not least, we have Friday, our fifth and final trade of the week. Would have been a great way to end off the week with another little W there, but it was a break even, so not the end of the world, okay? So Friday, like I said, you know, still wanted to see previous week high on the week. We never ended up hitting it, but obviously, you know, we don't have to hit it. We can still have that as our draw and just trade in line with it, essentially, okay? So when I came to Friday, 9 a.m., obviously 8, 9 a.m., like around about here, okay? I saw that all assets had already taken out the previous day high, so I didn't expect a end of week reversal back into the range. Also, why would I have not really expected one? Because initially we opened up low, traded away from this gap. Price will only reverse back into the range if it's quite expanded to one side, okay? At the time, it was, you know, around about here. That's not really expanded to the upside very much at all. Like, what does it need to return back to? You know, it's not going to return back to the open. And, well, it can, but it's not likely. Whereas if we so overexpanded, like this, for example, on YM, I would have expected Friday, you know, if it had already looked like this coming into Friday, I would have expected it to obviously pull back into the range. But NQ and ES, they hadn't really expanded, you know, to the upside in that direction. So if it's not expanded in the direction, then obviously I'd just expect it to trade in line with where the draw was, which for me was that previous week high, okay? Now, also what would have made me thought that we may have had a reversal on Friday was if we would have formed a bearish weekly cycle sequential SMT. Why? Because our weekly cycles, sequential SMTs, put our highs and lows of the weeks in quite a lot of the times. Low of the week right there, weekly cycle. We never had a weekly cycle on the highs, hence why we never had like a defined high of the week, okay? So, obviously, coming to that conclusion, looking for a long on Friday. I think the 9 a.m. candle, yeah, right there, 9 a.m. was there. This is the hourly candle that we traded. Let's see what we had. I know the exact entry because it was literally yesterday. Today's Saturday for me, so it's literally yesterday. No daily cycle. All assets are taken out London lows. Did we get a 90? I don't even think we did. I think it was just purely a micro, if I'm not mistaken. Yeah, no assets took out Q2's low. I didn't want them to because it was so far away as well. I remember saying that inside the live session. At the time, I didn't trade at 10. It was at the time like around here. So I didn't want to see price come all the way down here if I was truly bullish. Okay, it was more closer to just trading towards the highs. And that's what we did. But you guys can probably imagine what happened here. Looking at the wick there on that 9:30 candle. You guys can probably see what's coming here, okay? So, 1 minute, obviously, you know, micro, 90 or daily, plus tCISD. In this case, it was a micro, plus 1 minute tCISD. And this was our entry. Keep in mind, we would not have got stopped out if we kept our stop on the original stop loss placement, okay? So, we had a micro. So, let me quickly just show you guys this micro so you guys can, let's put it in replay actually. Easier for you guys. That's what we've been doing the whole video anyway. So, NQ took out the previous let's put this back on 1x previous micro session quarter low, which was Q1's low, immediately first candle of Q2. So there's our tCISD candle. Wait for price to close above it, then our entry is confirmed, which happens straight after. Yep. And now, because price had such a small body on this tCISD, I didn't necessarily expect it to come all the way back down to the tCISD, so I just more or less entered off this following candle's open low around here. Maybe it was the next candle that opened up low. I think it did come into this gap, if I'm not mistaken, or around, yeah, near it, I believe. Okay, maybe it wasn't. No, I definitely got in before this candle here because that's when I moved my stop to break even. So I must have, yeah, like roughly entered around about there. You don't need to enter off the tCISD directly. Main thing is you can enter a little bit above it or below it if you get the good RR, obviously, as long as it's not too large of an RR, and also if it's not too much risk. So on the day, it was only a 50 tick stop loss, which is barely anything. Usually my stop loss in ticks is around about 80 to maybe 100 like maximum. So 50 for me is quite low. So I was happy taking this one a little bit above the tCISD. Also, ES did trade into the tCISD, but that was before that was after I entered anyway. So yeah, we was targeting 2RR. Actually, no, we was targeting these highs actually in this trade because I'm just pretty certain on higher prices. We was targeting these highs on this trade. Then I saw this candle here at 928 come back down to roughly our break-even area, okay? So after this candle had closed, and obviously price, what I said in the stream was wait for prices to take out these highs again off this candle here, then I moved to break-even, and it did. So we moved to break-even, and then you guys can probably guess what happened next. 3, 2, 1, boom. Okay, so that was pretty annoying, but I am okay with that, okay? Because in my head, a break-even is always going to be a losing day every single day of the week, and also that's what separates a good from a bad trader. Okay, if you can accept the break evens for what they are and just move on. All I did here, guys, after taking this is I just chilled out, just spoke to chat for a while, answered some questions, and just kind of watched price and, you know, just, you know, kind of reflected on the trade, and that was it. And we just chilled out, and that's it. Okay, I wasn't thinking, oh no, I'm missing out here, I'm going to foam my way in, like price is running towards my target. Like, yeah, it was, but I wasn't interested in taking a trade. Price just continued higher and higher and higher for the most part as well. So like, I wasn't really interested in taking anything here. There was no, like, my entry model wasn't there, so nothing for me to take anyway, you know. I did call this first presented gap being a good entry, because once we tagged into these gaps, we hadn't hit the main draw for the day, which I think was, I don't know what this high was. I think it might have been, is it London high? Yeah, London high, that was it. So you can see we came into this gap before hitting London high, which was our main target. I did call this for being a good entry. Way too large of a stop loss for me though, and again, it wasn't really my entry model there. The tCISD was there, fair, but like, no, it was way too large of a stop. Then it did end up hitting that London high, and then I think we had a bit of a retrace lower, and then we ended up just continuing back higher straight after that, I believe. Let's see, put it in 10x. I think for the most part of the day, like, we did end up running above these highs again, but it was just like later on in the day, basically. Yeah, as you guys can see right there. Okay, so that pretty much wraps up today's video. Hopefully you guys did find it useful, kind of a little insight as to why I expected, you know, what happened on each day, how I managed to execute the trades, my model as well, all in one video, and kind of the results that yielded me from taking the 5 setups, 2 wins, 2 small losses, and 1 break even. Still ended the week very profitable, and also gained some extra funded capital as well for, you know, the upcoming next few weeks as well. So now I can get even larger payouts across more firms, etc., etc. So it just goes to show, you know, you don't need to win every single trade. You just need to follow your model, have a strict risk management plan, and just execute, okay? And if you do that, then you will see results like this as well. And like I showed you guys at the start, like the results my students have seen as well from taking the same trades as me, you know, trading live with me and kind of just learning the model as well and just being able to execute and do that themselves. That's what it's all about, okay? So if you guys do, so today I made $1,792 day trading the Nasdaq in around about 10 minutes. Copy traded on my 4 Lucid accounts. As you can see, this was the trade that I took here. So, you know, obviously within the 9 to 10:30 window, sequential SMT on the microcycle, 1 minute tCISD, entry at the tCISD, stop on the low, target the highs. My simple repeatable model, okay? But let's go ahead and break down, you know, the reason why I even took along in the first place, okay? Because it's okay having the model there, but we don't want to be trading it mechanically necessarily all the time. We still need to build the narrative behind the trade idea, okay? So looking at the trade as a whole and looking at the previous day's candle closure, why did I anticipate higher prices today? I actually call this in my Discord literally so perfectly, it played out perfect, okay? So looking at Monday's closure, as you can see, it was technically a continuation candle closure to the downside on NQ. The same also with ES, okay? So don't get fooled by this candle closure here. There was an M-log there, it looks weird, but we didn't close above Friday's high, okay? Friday's low. So we didn't close inside Friday's range. We closed below it. So this is still a continuation candle to the downside. And YM, however, closed as a bullish candle reversal signature to the upside, okay? So Monday took out Friday's low, but we didn't close below Friday's low on YM, right? So if we take a look at NQ, where if I turn my indicators on so you guys can see as well, this is NQ in the middle here. We did end up taking, closing below, Friday's low. So how does that give us information on what to expect today? Well, we know that NQ and ES were the weaker assets because they gave the bearish continuation candles to the downside. So where's our main target for Tuesday, which is today? It would be Monday's low, right? Now, how did Monday close as well? It closed as a PSP. So as you can see, NQ closed bearish, YM closed bullish, and also ES closed bullish, right? So looking at the actual closures of the candles themselves, with the PSP, which candle is more likely to run out its previous candle low? Its PSP low, basically. The one that closed bearish, okay? Because that is obviously the weaker asset as it's closing bearish. So not only did it give a bearish continuation candle to the downside, also a bearish closure, and it's a PSP, right? So NQ was very likely to take the low. ES didn't need to because it did close bullish as well as the PSP, but it was a continuation candle to the downside. So it was a lot more likely to take the low rather than, for example, YM. So I literally said inside my Discord yesterday, I expect NQ to take the low, potentially ES, and YM to fail. And what happens when one asset fails to take previous day low and one asset takes it? That's a bullish weekly cycle sequential SMT. So I wanted to see a bullish weekly cycle sequential SMT form, and then once that formed, tCISD, and then trades up to this daily gap. Okay, so if we go to the 1 hour and look at the weekly cycle, right, as you can see, if we mark it out here, well, the indicator marks it out for us. As you can see right there, YM failed to take out Monday's low, as we just went over. Monday's low all the way down there. YM nowhere near it. NQ kind of opened up, first few hours of the day, took it out as it closed relatively, close to the closure of Monday. It opened up, relatively close to Monday's close, so it kind of ran below it straight away. And then, which candle ran below the low, which was the very first candle? Was it this big bullish one? No. If we zoom in and have a really close look, as you can see, this bearish one just barely wicked below it. So what does that mean? This is then our tCISD candle. So we mark out the open of that candle, right? And then, once price closes above it, which it did here, again, my indicator marking it all out for me. Literally don't need to draw anything. Once this closes above, this is now kind of confirming, okay, the bullish manipulation is now over. Longs have now been set in place. Now what you can do is look for your entry model on the lower time frame in line with that bullish scenario until at least a draw has been hit for the day, which for me was the daily gap and the previous day high. Oops. So we can mark that out. And coming into my window, I trade at 9 to 10:30 a.m. Eastern Standard Time. As you can see, the 9 a.m. candle open up low and then delivered to the highs. So I essentially look for my entry model, in the bullish scenario inside this 9 a.m. candle, looking to ride it up to the highs, and that's literally all I did. Okay, so what we had as well, we did have a few more extra cracks. We had a daily cycle, right? We had a few sequential SMTs actually. We had this daily cycle here, so between London and New York AM. As you can see, YM ran it out there at 6:30. We can put this in replay as well, just so we don't get confused by the new candles. This is more or less my window here, what I traded. Bullish daily cycle on the lows. As you can see down there, NQ and ES failing to take out London lows, whereas YM did right there. Okay, again, which candle created it? It was this one here, 6:30 candle for YM. So we use that same candle for NQ, mark out the open, wait for price to close above it, and it does, and then it again activates longs here, and we got a beautiful retest of the tCISD right there at 8:15, while also tagging into this 15-minute gap. Beautiful entry there. So if you guys traded potentially 8 a.m. around that time, this would have been a great entry for you guys. But obviously I didn't get on the charts until 9 a.m. So I'm just looking for my entry model again from 9 a.m. basically. So we had a daily cycle, we had a weekly cycle. We also ended up forming a 90-minute cycle as well. Right there, as you can see, YM again creating the total suit. YM will quite clearly be in the weaker asset out of the three here. On the day at least, because it took out London lows and also created the 90-minute low, 90-minute cycle SMT. So that formed at 9:30. So our 9:30 candle is there. Obviously, this one closed bullish on NQ, so we can't actually use this one as our tCISD candle, because in a bullish scenario, the tCISD candle has to be bearish. So if it closes bearish, cool, you can use that one. If it doesn't, you use the most recent candle to the left. So in this case, 9:25. Mark at the open, and as you can see, it kind of closed above it immediately anyway after the 9:30 candle closed. So then we can look for our long positions anywhere inside of the tCISD or slightly above it. As you can see, we just barely missed it, but more or less my entry was, around about here. Stop, below the tCISD, and then just target the highs for like a 2.5. But I did scale to the 1 minute, because I don't enter immediately at the tCISD if it's not on the 1 minute, right? What I do is wait for a reaction. So we had this gap here at 9:30, right? And what I said was inside my Discord is I want to see price close above this gap here, because initially we formed it at 9:30, we went higher, cool. Then we came lower, we inversed it. So in order for me to be confident, that we're going to go back higher, I want to see price close back above this gap here, okay? And it did. It closed back above at 9:33, right? We also formed a micro right here. So this micro was actually formed from YM quite a while ago. So it formed at 9:32, hence why this is our tCISD candle here. The same candle, 9:32. So we can go ahead, and use this as even more confluence. We had a 5-minute tCISD inside of a 1 minute, or a 1 minute one inside of a 5-minute one, should I say. And if we make this one red so you guys can kind of see it a bit better. This general area here is where I wanted to enter. It overlapped with the inversion as well, that 9:30 inversion. So basically all I did, guys, was wait for price to come into the inversion, wait for price to form a wick, entered roughly around about here when it started pulling up, stop on the low below the gap, below the tCISDs and whatnot. Oops, if I can actually do it. There we go. And then more or less, target like a 2.4 or something. I did want to hold longer, but because a couple of the Lucid accounts that were copy trading have a consistency rule, I didn't, want to go making like 700 or 800, something like that. More or less just, 400, 500 is enough for the consistency rule on the 50Ks. And that's all I did. So yeah, just closed out around about, 2.4R roughly. Literally the world's easiest model, guys. All you've got to do is work on the ability to frame the narrative and the draw. Once you know where price is going, you guys can see how easy it is. We had the weekly at the start of the day with a tCISD, so it's like all I'm doing now is waiting for my specific 90-minute window, waiting for my tCISD model to form. Once it forms, enter. Stop on the low, target the highs. That's as simple as it gets, okay, guys? So yeah, that's pretty much the trade breakdown from today. So hopefully you guys did find this useful. Also as well, one thing to quickly know is currently in the space is a lot of prop firm deals going on. So if you check out the propfirmio.com website, link below in the description. It's in the description. It says like best prop firm deals. Click on that link. This is very dark right now. But yeah, either way, as you can see, Apex 90% off, Lucid 50% off, and also Tradeify 40% off. Those are like the three main firms I would recommend right now. Tradeify just dropped a new update, Tradeify 3.0. Lucid are insane. I mean, these are the accounts that I copy trade today on TradeC. Amazing platform, super affordable pricing. It's like $70-ish, $60-ish dollars, no activation fee for a 50K account. Insane. And then Apex, obviously the OGs, 90% off, can't go wrong, 20 accounts, okay? So, yeah, hopefully hundreds of thousands of dollars of prop firm evaluations, and also generated thousands and thousands of dollars of prop firm payouts, all while using one very simple entry model. And inside of this video, I'm going to be showing you guys that exact entry model, as well as my playbook of how to pass evaluations and also generate prop firm payouts consistently. The problem that most traders have is they don't actually understand how prop firms work. A prop firm is essentially a way for you to leverage very low capital. So you can be trading with hundreds and hundreds of thousands of dollars of funded capital, and you only have to pay a very small price for that capital. So for example, if you are trading futures prop firms, you can pay $70 and you get given $50,000 of funded capital to trade with. Now you're probably wondering, how does that make sense? How is that profitable for that company? First of all, in order to actually get payouts on that $50,000, you need to pass what's called the evaluation phase. And all you need to do is make a certain percentage on that $50,000 balance. And for futures, mainly it's 6%. So if you can make $3,000 of profit on that 50K account, you then pass what's called the evaluation phase. And then you get given another fresh 50K account, and any percentage, any profit you make on that account, you can then request and get that money right into your bank account. And also forgot to mention as well, it's not an actual real $50,000. It's all demo money. But the reason why prop firm companies can even do this is based purely on the statistic that 95% of traders fail and only 5% can actually make it. So if you think about it, you've got 100 traders, 95 of those traders are consistently buying these prop firm evaluation accounts, and those 95 people are constantly blowing these accounts and giving this prop firm money in evaluation fees. That's how they can then get their money and pay out the 5 out of the 100 traders that can actually prove they can pull money from the markets. And now you're probably wondering, which prop firm account is best for you, because there are both forex and futures prop firms. So if you're a futures prop firm, these are the ones that I would recommend right here: Apex Trader Funding, My Fund of Futures, Alpha, Tradeify, Lucid, and Take Profit Trader. And if you're a forex trader, these are the ones that I would recommend here: FTMO, Alpha Capital Group, Funding Pips, the 5%ers, and also Blue Guardian. And what you can do is you can use this website right here called propfirmio.com, link below in the description. It allows you to compare all the prop firms to each other and also find the best discounts at the time. So as you can see right now, Apex Funding is running an 85% off sale. So this makes the account, if you go to the details section and come down here, select Tradeivate, select a 50K account, this makes this account just $24. So you can get funded with $50,000 for just $24 right here. And you do have to pay an activation fee on futures accounts, which is around about $80. So around about $100 all in, and you can be trading with $50,000 of capital. And once you pass that evaluation phase, anything you make on top of that 50K balance that you get given is yours. Okay, you can withdraw it straight into your bank account. You can go ahead and spend it. do whatever you want with it, okay? But yeah, this website here is really helpful. You can see there's a compare section, so you can go ahead and see, you know, the profit split, the daily loss limit, drawdown type, all these intricate details. And also you can go ahead and click on the details section and you can see all the pros and the cons of each of the prop firms. So yeah, again, if you do want to check it out, find the best prop firm for you, link below in the description, propfirmio.com. One quick thing as well, if you do purchase any account off this site, if you go to the giveaway, go ahead and type in the information here. You are entered into a draw every single month to potentially win a free funded account. And also you can submit each purchase for points as well, as you can see right here. And then you can go ahead and spend the points on the rewards that are down here at the bottom. So discount codes, free accounts, and also merch. Now, the main issue that I see with people that trade prop firm accounts is number one, they lack a clear strategy, something that they can follow on a day-to-day basis, something that they can really trust, have so much confidence within. And also this ties into the constantly switching and strategy hopping that some people do. You know, one day they'll be trading ICT concepts, and then they'll switch to trend lines, support resistance. And the second thing is the lack of good psychology. Now, a lot of traders, they may have the model down, they may have the strategy down, but if they can't control themselves in the live markets while they're trading these prop firm accounts, they're going to go ahead and find out very quickly. They're going to blow accounts consistently, and you're going to have no clear direction in your prop firm journey. Now, these prop firm accounts are there for you to abuse. They're there for you to stack up, get multiple funded accounts, and request bigger payouts on. So if you lack either two of those things right there, you know, psychology, over trading, emotional trading, FOMO, and constantly switching strategies, then you're not going to be able to maximize the prop firms. But don't worry, I used to be in that exact same position as well when I first started trading and first started out with prop firms. I lacked clear direction, I had bad psychology, but the one thing that changed everything for me is make everything simple, okay? Have one specific model, one specific strategy that you can confidently follow every single day. Have an exact time window in which you look for that model, so just 90 minutes per day or around 1 to 2 hours maximum. Make sure you have actual trust in that one model as well, backed up by data, backtested stats, whatever it may be. You need to have a model that you can confidently trust and execute upon the same time every single day. And once you have that down, the emotional, the psychology side of things literally completely disappears, right? You may have 1 or 2 bad habits, but you can always work on those after the fact. But you'll have no more FOMO because you'll know exactly what you're looking for. No emotions will creep in whether you take a win or a loss because you will know it's part of the system. You know that you should lose this percentage of time and you know that you should win this percentage of time. So just focus on one model, one specific time window, 90 minutes for me, 9 to 10:30 a.m. Eastern Standard Time, and only take setups that align with the high time frame bias and narrative. If you are trading against a higher time frame, most of your trades will likely fail. And those are the changes that I made to go from inconsistency to a 70% plus win rate. So just understand that within trading, less is more. A simple entry and strict filters equals consistency. Don't just take it from me and my results, but this is also how many of my students, including Erwin, managed to gain over $500,000 in funded prop firm capital. So when trading an evaluation, which is the challenge phase before you actually get funded, I personally like to take things a little bit more aggressive, so I'll risk considerably more on those evaluation phases, but you only really want to be doing this when you have that one confident model that you can follow each and every single day. If you don't have trust in your model, then just take it slow. I'm talking around about 1% is what you ideally want to be risking. So let's say you're trading a futures prop firm account, there's 4% drawdown usually. That would mean that you would have to lose 4 trades in a row before you lose that account. However, if you are trading a forex prop firm account, they usually have around about 10% of the thousands of dollars of prop firm payouts, all while using one very simple entry model. And inside of this video, I'm going to be showing you guys that exact entry model, as well as my playbook of how to pass evaluations and also generate prop firm payouts consistently. The problem that most traders have is they don't actually understand how prop firms work. A prop firm is essentially a way for you to leverage very low capital. So you can be trading with hundreds and hundreds of thousands of dollars of funded capital, and you only have to pay a very small price for that capital. So for example, if you are trading futures prop firms, you can pay $70 and you get given $50,000 of funded capital to trade with. Now you're probably wondering, how does that make sense? How is that profitable for that company? First of all, in order to actually get payouts on that $50,000, you need to pass what's called the evaluation phase. And all you need to do is make a certain percentage on that $50,000 balance. And for futures, mainly it's 6%. So if you can make $3,000 of profit on that 50K account, you then pass what's called the evaluation phase. And then you get given another fresh 50K account, and any percentage, any profit you make on that account, you can then request and get that money right into your bank account.
And also forgot to mention as well, it's not an actual real $50,000. It's all demo money. But the reason why prop firm companies can even do this is based purely on the statistic that 95% of traders fail and only 5% can actually make it. So if you think about it, you've got 100 traders, 95 of those traders are consistently buying these prop firm evaluation accounts, and those 95 people are constantly blowing these accounts and giving this prop firm money in evaluation fees. That's how they can then get their money and pay out the 5 out of the 100 traders that can actually prove they can pull money from the markets. And now you're probably wondering, which prop firm account is best for you, because there are both forex and futures prop firms. So if you're a futures prop firm, these are the ones I would recommend right here: Apex Trader Funding, MyFunded Futures, Alpha, Traderify, Lucid, and Take Profit Trader. And if you're a forex trader, these are the ones that I would recommend here: FTMO, Alpha Capital Group, Funding Pips, the 5%ers, and also Blue Guardian. And what you can do is you can use this website right here called propfirmio.com, link below in the description. It allows you to compare all the prop firms to each other and also find the best discounts at the time. So as you can see right now, Apex Funding is running an 85% off sale. So this makes the account, if you go to the details section and come down here, select TraderVate, select a 50K account, this makes this account just $24. So you can get funded with $50,000 for just $24 right here. And you do have to pay an activation fee on futures accounts, which is around about $80. So around about $100 all in, and you can be trading with $50,000 of capital. And once you pass that evaluation phase, anything you make on top of that 50K balance that you get given is yours. Okay, you can withdraw it straight into your bank account. You can go ahead and spend it, do whatever you want with it, okay? But yeah, this website here is really helpful. You can see there's a compare section, so you can go ahead and see, the profit split, the daily loss limit, drawdown type, all these intricate details. And also you can go ahead and click on the details section, and you can see all the pros and the cons of each of the prop firms. So yeah, again, if you do want to check it out, find the best prop firm for you, link below in the description, propfirmio.com. One quick thing as well, if you do purchase any account off this site, if you go to the giveaway, go ahead and type in the information here. You are entered into a draw every single month to potentially win a free funded account. And also you can submit each purchase 4 points as well, as you can see right here. And then you can go ahead and spend the points on the rewards that are down here at the bottom. So discount codes, free accounts, and also merch. Now, the main issue that I see with people that trade prop firm accounts is, number one, they lack a clear strategy, something that they can follow on a day-to-day basis, something that they can really trust, have so much confidence within. And also this ties into the constantly switching and strategy hopping that some people do. One day they'll be trading ICT concepts, and then they'll switch to trend lines, support resistance. And the second thing is the lack of good psychology. Now, a lot of traders, they may have the model down, they may have the strategy down, but if they can't control themselves in the live markets while they're trading these prop firm accounts, they're going to go ahead and find out very quickly. They're going to blow accounts consistently, and you're going to have no clear direction in your prop firm journey. Now, these prop firm accounts are there for you to abuse. They're there for you to stack up, get multiple funded accounts, and request bigger payouts on. So if you lack either two of those things right there, psychology, over trading, emotional trading, FOMO, and constantly switching strategies, then you're not going to be able to maximize the prop firms. But don't worry, I used to be in that exact same position as well when I first started trading and first started out with prop firms. I lacked clear direction, I had bad psychology, but the one thing that changed everything for me is make everything simple, okay? Have one specific model, one specific strategy that you can confidently follow every single day. Have an exact time window in which you look for that model, so just 90 minutes per day or around 1 to 2 hours maximum. Make sure you have actual trust in that one model as well, backed up by data, backtested stats, whatever it may be. You need to have a model that you can confidently trust and execute upon the same time every single day. And once you have that down, the emotional, the psychology side of things literally completely disappears, right? You may have 1 or 2 bad habits, but you can always work on those after the fact. But you'll have no more FOMO because you'll know exactly what you're looking for. No emotions will creep in whether you take a win or a loss because you'll know it's part of the system. You know that you should lose this percentage of time, and you know that you should win this percentage of time. So just focus on one model, one specific time window, 90 minutes, for me, 9 to 10:30 a.m. Eastern Standard Time, and only take setups that align with the high time frame bias and narrative. If you are trading against a higher time frame, most of your trades will likely fail. And those are the changes that I made to go from inconsistency to a 70% plus win rate. So just understand that within trading, less is more. A simple entry and strict filters equals consistency. Don't just take it from me and my results, but this is also how many of my students, including Erwin, managed to gain over $500,000 in funded prop firm capital. So when trading an evaluation,
which is the challenge phase before you actually get funded. I personally like to take things a little bit more aggressive, so I'll risk considerably more on those evaluation phases, but you only really want to be doing this when you have that one confident model that you can follow each and every single day. If you don't have trust in your model, then just take it slow. I'm talking around about 1% is what you ideally want to be risking. So let's say you're trading a futures prop firm account, there's 4% drawdown usually. That would mean that you would have to lose 4 trades in a row before you lose that account. However, if you are trading a forex prop firm account, they usually have around about 10% of drawdown. So that would mean you would have to lose 10 trades in a row. Now, if you are trading a futures prop firm account, you guys may know, or if you don't, you can use either minis or micros, okay? So essentially 1 mini is 10 micro contracts, and those are what you use to enter the trade. So you can enter with 1 mini, 2 mini, 10 micros, 20 micros, and I would personally say 1 mini or just a few micros under, so around about 7 or 8 micros is generally enough for a futures prop firm account on the evaluation phase. However, if you are trading a forex one, they're based on lot sizes, so you would need to use a lot size calculator on Google to determine how much risk that stop loss is that you're using. And now when you actually pass that evaluation challenge and you get funded and you get to trade with that capital, this is then when you really want to tone down on the risk. So let's say you was risking 1% on the challenge phase. I would completely cut that in half and potentially even more. So you want to be risking around about 0.3, 0.6% per trade. So that way you would have to lose around about 7 or 8 trades in a row on the futures prop firm and around about 20 to 22 trades in a row on a forex prop firm. So statistically, you shouldn't actually ever blow those accounts unless you go on a really bad losing streak. But this is the thing that happens, right? Many traders can't control their emotions, their psychology. They may have a good model, right? And they may be able to take 10, 12 trades in a row without losing the account. But what they may do is lose 1 trade, go on till, and then blow it all. So this is why having a combination of a good model and good psychology is the perfect recipe for trading these prop firm accounts. Now, the maximum amount of trades that I would recommend taking per day is 1 to 2, okay? 1 if possible. So if you win that first trade, you're off the chart straight away. Don't even consider giving the profits back to the market. However, if your first trade is a losing one, and as long as you haven't risked that full amount for the day, you can go ahead and take 1 more. But once you're 2 losses down on the day, call it quits, okay? Please call it quits. Don't give any more of that funded account drawdown back to the markets. So just 1 to 2 high quality setups per day. That's only as well if your model even presents on the day. So for me personally, I take around about 1 to 3 trades on average per week, because not every single day will my model be there, and not every single day will my model be there and very high probability. Okay, I focus on very high quality setups. If it's not high quality, I just won't take it. And finally, the time window that I execute within is 9 to 10:30 a.m. Eastern Standard Time, just 90 minutes per day maximum. Most of the time I'll take a trade in 20 to 30 minutes in and I'll be done for the day. Now let me show you guys my exact model, my system that got me funded in just 2 days, 2 trading days, 1 trade on Wednesday, 1 trade on Thursday, both wins back to back. Let me go ahead and break down the exact model that I use to take these trades, pass an account, get funded with $25,000 in just the 2 days, okay? So run the charts right now here. Essentially my system requires me to look at 3 closely correlated assets. So in this case, ES, NQ, and YM, these are all future assets. Basically, all I did was use a higher time frame structure. So on Wednesday, this is the trade that I took right here. As you can see, if we go ahead and look at the daily chart, right, we're looking at NQ here. So Tuesday's candle traded below Wednesday's low, but it failed to close below it. So it wicked below it, but failed to close below it. That to me is an indication that price is ready to reverse higher. So the daily candle closure showed me that we want to see higher prices. So all I did on Wednesday was scale to a lower time frame and look for a long entry. So I already got my bias down just from the candle closure. And then if we go ahead and drop down to the 5 minute and we go all the way over to Wednesday, also as well, the indicators used for my model will be linked below in the description if you want to pick them up, test them out for yourself. But let's go ahead and go all the way to Wednesday. So this is Thursday over here. Okay, this is the Wednesday trade, right? So all that happened here was I waited for my specific 90-minute window, in this case, 9 to 10:30 a.m. Eastern Standard Time. As you can see, indicator marking out that Q3 quarter right there. And all I did was looked at the closely correlated assets. I waited for one asset to drop below Q2's low, right? And as you can see, YM was the one to do so here. So we mark out Q2's lowest low. YM runs below it. What time does it run below it at? 9:40, okay? At 9:40, what was NQ and ES doing, right? So you can see here, 9:40, we closed as a bearish 5-minute candle, but we didn't take out Q2's low, right? So YM did, NQ and ES both failed.
So this is what's called a sequential SMT. It's an SMT divergence between two consecutive quarters. And then my entry model itself is a true change in the state of delivery, a tCISD, and all that is we look at the candle that ran below that previous quarter low, so the 940 candle. We go ahead and mark out the open of that candle after the candle closes, and then we wait for price to close above the open of that candle. So as you can see, the 945 candle closes above the 940 candle, and then all I do is go ahead and take my entry once price drops back down into that true change in the state of delivery candle, so the 940 candle here. So as you can see, 950 does it right there. I go ahead and take my entry at the retest of that candle. Stop goes on the sequential SMT low, and then I go ahead and target the most recent 5-minute swing high, or 2 to 3 RR, or potentially leave a runner to a higher time frame target sometimes, okay? In this case though, I did drop to a 1 minute. So we go to the 1 minute. What I did was scale my entry. So I actually ended up a little bit higher, waited for the rejection from the tCISD, but then I was able to place my stop on this recent swing low down here, right? And then I could maximize my RR from this trade, getting around about a 2.8 RR instead of around about a 1.7 on that 5-minute time frame. And this trade alone got me around about 8%. Now on forex prop firms, they require 2 phases most of the time. 8% on the first one. Once you pass that, then you need 5% on the next one. So this one got me around about 8% because I took it quite aggressive. I risked around about 2-3% to hit for a 3 RR. So that got me roughly around about 8%. So then all I needed coming to the next day was just a 5% trade. So let me go ahead and break that one down for you guys right now. But essentially all my model is, look at the daily candle closure. That's my bias for the day most of the time. A weekly and a monthly cycle sequential SMT can also alter that potentially, or give me more confluence. In this case here, we didn't have one, so I just looked purely at the candle closure, and then I waited for my specific 90-minute window. Then I waited for at least a daily, a 90 or a micro sequential SMT, in this case a 90 and a micro, and then enter at the true chain in the state of delivery. So now let's go ahead and break down Thursday's trade, which will look the exact same because all of my trades do. So now the second trade was Thursday, the following day, and if we're looking at the candle closure, as you can see, we're looking at Wednesday's candle. It closed above Tuesday's high. Right, so instead of wicking below, we closed above it. That's what's called a bullish continuation candle signature to the upside. So my bias for the day is looking for longs, and that's what I took on Thursday, okay? We ended up closing out bearish on the day, but that doesn't matter. We don't need to be right about the whole entire day, just within our specific time window. So again, we dropped down to the 15, the 5 to look for that daily cycle or 90-minute cycle sequential SMT. In this case here, we had what's called a hidden daily cycle sequential SMT. So instead of looking for a divergence between the wicks, we use the bodies if or last it's wick below the previous quarter low, okay? So we mark out the lowest closure here, right? So this is London session, Q2 to Q3, still consecutive quarters. And as you can see, we just barely failed to close below the lowest closure there of London session during this candle here at 9:15. Whereas if we take a look at ES and we mark out the lowest closure of London session, you can see we did actually end up closing below it at 8:45. So now this is what's called a hidden bullish daily cycle sequential SMT. And then all I did from here was drop to 1 minute time frame because there was nothing on the 5 minute. So let's go ahead and go to Thursday around about 9 a.m. And as you can see, this blue line that I'm marking out is price heading back above it, giving us that hidden daily cycle, while simultaneously giving us a microcycle sequential SMT. So if we go ahead again between 2 consecutive quarters, Q1 and Q2, as you can see here, the first candle of Q2 literally ran below Q1's low. So what time was this at? 9:23. So again, what do? Go ahead and mark out that same candle open here on NQ. We wait for price to close above it, which happens right there at 9:25. And then where do we enter, guys? You may know now, you mark out the tCISD candle. You can mark out the body, not the wicks, the body. All we're doing is looking for price to drop back into that candle. We take our entry once price drops into it. Stop goes on the sequential SMT low. And then in this trade here, I target around about 3 RR, getting that final 5% to pass phase 2. And as you can see, it delivered very nicely in just a few minutes as well. So this is what I'm saying, guys. My system usually delivers at trades in around about 30-40 minutes into the trading day. So it's 90 minutes maximum that my model can form within, but usually around about 30-40 minutes. And yeah, essentially that is, again, the same model. Daily candle closure, specific 90-minute window, 1 sequential SMT, 1 tCISD, entry at the tCISD retest, stop on the SSMT low, and go ahead and target around about 2 to 3 RR. So now you guys have a very good insight on how I actually trade. So firstly, I wasn't on the charts all day long. I didn't take 10 trades per day, just one clean setup
within that specific 90-minute window, and that's all I need. Align with the bias, like I showed you guys on the daily chart, and this is what's called real consistency. Now, if you guys want a more in-detail breakdown of my exact model, my exact system that I use to consistently pass prop firm accounts and consistently get payouts on, then go ahead and watch this video right here, as this will give you the exact blueprint that you need to consistently pass these accounts and get payouts. The final segment about this video is how to scale funder capital. So what I would always recommend to every single trader out there first getting into prop firms is focus on passing your first few accounts, focus on getting funded at least 2 to 4 times, and focus on getting at least 2 to 3 payouts. Once you can do that with one singular account, this is then when you want to implement the scaling. All this means is purchasing more prop firm accounts. So instead of trading with one 50K account, you can add another 50K account. So then you've got $100,000 in funded capital, and you just keep repeating this process. You can actually get millions of dollars in funded capital. So now just imagine you make 1% per week on a 50K account. That's only $500, right? But if you're doing the same with $1 million of funded capital, that is then $10,000 per week, which I'm sure is enough for a lot of you guys. But if it isn't, keep going bigger. You know, maybe you get 2-3% per week. Maybe you can get $2 million in funded capital. And also, if you're wondering, you know, how can you trade multiple prop firm accounts all at once? If you do go to the prop firm of your account, you can look at the deals, click on trade copier, and there's 2 trade copies right here. You can simultaneously link all of your prop firm accounts together and trade them all just with one click of a button. And now the final part that I need to tell you guys, please, please, please formulate a plan, find a model that works best for you, find a risk management plan that works best for you. Once you can do this, religiously stick to it. One single mistake can lead to you spiraling out of control and blowing all of the funded accounts that you worked hard for and also paid out of your own money for. So while yes, you can get access to hundreds of thousands of dollars of capital for just a few $100s, you still need to treat it like it is real money and trade professionally by sticking to your rules. So with that, inside of my trading journey, I've generated thousands of dollars in verified prop firm payouts, passed many accounts, and also gotten a lot of my students profitable, and they've gotten large payouts as well. Inside this video, I'm going to be showing you the 5 indicators that I use on a daily basis to generate thousands of dollars per week and sometimes even per day in prop firm payouts. Okay, by the end of this video, you will know how to get the indicators, how to set them up on your chart, and how to use them in the most efficient way possible. So before we do get started, all indicators featured in today's video are available at oracleindicators.com. Some of the indicators are completely free, and our more premium tools come with a free trial, so you can test everything before committing. They are also priced to be accessible, so the cost is never a barrier. A quick disclaimer, these indicators are strictly educational tools designed to help you read price action. They do not constitute financial advice. So with that being said, let's go ahead and jump into the first indicator that I use. And that is going to be the quarterly theory cycles, Oracle. So every single indicator that you guys see that has Oracle without a plus on the end, that is a completely free indicator, okay? So this first one here is completely free. You guys can search it up right on TradingView, or you can go to oracleindicators.com and claim free access to this one, okay? Essentially, what this does, the features of it, it allows you to have quarter color customization. Essentially, what this indicator does is display the quarterly theory quarters on your chart for you, so you guys can clearly trade quarterly theory and see price divided into 4, okay? So the features of this indicator is quarter color customization. So you can customize the colors of the quarters. You know, maybe you don't want them the classic gray, red, green, blue. You can have whatever color you want. You can show up to 6 cycles at once. So, you know, it'll display the quarters either at the top or bottom of your chart, and you can have it show the cycle that you're looking at, so the micro, then the 90, then the daily, then the weekly, then the monthly, if you really wanted to, okay? I personally just use 2, but we'll jump into that shortly. You can have it show up to 6 cycles at once, so like we just mentioned, quarters below and above charts. So if you prefer to have it above, which I personally do, you can, or you can have it show below, okay? And there's also an option for the quarter dividers. So if you want to see the quarters displayed at the top, while also having dividers come down onto your chart, so you can also see it within the candles, you can also have the option for that, okay? So it's an all-in-one indicator, so there's less indicators to manage, very customizable, fast loading times and good performance, options for quarters above and below, and show up to 6 cycles simultaneously. And if you want to grab access to this one, quarterly theory cycles, Oracle on TradingView. So now let's jump into the charts and show you guys how to grab it and how I personally have mine set up. All right, guys, so we're inside the charts. This is, of course, the quarterly theory cycles indicator. If you do want access to it, go to the search bar, search quarterly theory cycles, Oracle, like that, and then it will show up here, okay? So make sure to favorite it, and then also drop a boost and a comment if you guys do enjoy it, okay? Now, these are my current settings I am running for the indicator. So I have layers to show 2. All of these ticked on, show on chart cycles and only. Now, if you want it to show below, you untick both of these 2 here. You untick this one and then this one here, okay? So in that specific order, and as you can see, it will then go to the bottom on my chart. I personally prefer it up top. I think it's just cleaner. It's like more out the way, you know, it doesn't overlap with the candles at the bottom. So you just click on here, and then it will go to the top. If you want it to show on both, the top and bottom, then you just turn only off, okay? Now, if you want to change the colors of the actual quarters, as you can see, all here, click on it and just choose a color that you want. Now, Q0 is for Friday or a Joker week, okay? So as you guys know, the weekly cycle, Friday technically isn't a quarter, so it will be colored as this color here, okay? And then same for a Joker week, this will be the color of the Joker week right there. Now, the text itself on the quarters, you can change the color of that as well. If you want it to black, as you can see there, black looks actually pretty clean. I think maybe I'll go for like a grayish color. Yeah, you know, nice and subtle right there. Okay, dividers, if you don't want them on, just turn the opacity to 0 and it will remove them. Okay, I personally prefer them, so I'll leave them on for now. Okay, so those are my settings. Feel free to play around with it. Nothing too crazy for this one. Click OK, and then as you guys can see, it will show right there, okay? If you do want more cycles, then just change this number. So 3 cycles, it'll show. Currently, I am on the 15, so it's showing the current, which is daily cycle, 1 above, weekly cycle, and then here's the monthly cycle, okay? Now, if I go back down, turn this to 2, it will then show me the daily cycle at the bottom, and then 1 above, which is the weekly cycle, okay? So as you guys can see, it's just a nice way to view the quarters. You know, we're on the 15th, so we know this is Asia, London, New York AM, New York PM. You know, this is all of Wednesday, this is all of Thursday, Tuesday, Monday, etc. Okay, so that is exactly how I have my quarter one set up, and you guys can copy that or customize it to your liking. If you do want to remove the bottom bit as well, so once you've got it all added, what you can do, click on this. As you can see, there's like a little like box there. If you find that annoying, click up top right, and there you go, it removes it, okay? And if you want to change the settings again, click down here, click on the box, and it will pop up down there, and you can customize it there, okay? So yeah, that's how I have that one set up. And if you want to access, oracleindicators.com or search it on TradingView, okay? So this one is a part of the premium tools. However, there is a free trial that you guys can get and test out before committing, okay? Now, the quarterly theory toolkit is essentially an all-in-one quarterly theory indicator. It will show you all of your quarterly theory concepts. It will show you your PSPs, sequential SMTs, quarter dividers, defining range, tropons, precision candles, high probability gaps, whatever it is, it's inside of here, okay? So you can have it also show alerts, so you can set alerts for those specific concepts. So for example, a weekly cycle sequential SMT, once it occurs in price, you will then be alerted, okay? Again, it's an all-in-one indicator, less indicators to manage, very customizable, fast loading times with good performance, auto mode for multiple asset classes, so you can have it go on auto triad, so whenever you pull up NQ, it will automatically compare the indices triad, NQ, ESYM, okay? And you can also customize the triad that you are viewing, so you can have it set to potentially an intermarket triad, NQ, DXY, and one of the stock bonds, whatever just work inside of it. So now let's jump into the second indicator that I use. So now for the quarterly theory toolkit Oracle Plus indicator, you can go ahead, go to indicators, search it here, quarterly theory toolkit Oracle Plus, and it will show up here if you spell it correctly, like that, right? And it will have a lock next to it. Just click on it, and it'll bring you to the actual page, or you can click on my name, Bootcamp Trades, right there, and it will then pull up access to grab the indicator. Click on it, like this right here, and it will show my scripts here. Click on scripts, and it is the quarterly theory toolkit one here. Click on it, and then you can get access at oracleindicators.com, or you can just search right now oracleindicators.com and grab access from there, okay? So that's how you get access to this one here. There is a 3-day free trial. If you don't like it, just don't use it, okay? For me, this is probably my favorite indicator out of the five, because this does most things for me, okay? Click on it, look at the customizations, guys. We've got colorblind mode if you're colorblind, text color. This is just in general for all the text colors. So if we change this one to like yellow, as you can see here, it will change to yellow right there when it updates. Just give it a few seconds. So we have firstly colorblind mode. So this is for when it shows sequential SMTs at the bottom. So we go to the 5 minute, for example. Hopefully we have a sequential SMT here. Let's see. Yep, we do. So if we click on colorblind, in the bottom right where it shows the sequential SMT for text, it will change to an icon of a chart going up rather than just a green dot. Okay. So that's for all of my colorblind people out there. Don't worry, we got you guys. Auto triad. So this is just how it connects to the triad that you're viewing based on the asset that you've got open. You can untick this and just customize the assets if you prefer. I leave it on. Sequential SMT. Lower time frame text, mid time frame text. Now, lower time frame is the time frame that you're on, the one that you're currently viewing, the cycle that you're viewing. Mid time frame is one directly above. Okay, so lower time frame text, if we're on the 5 minute, it shows me the 90-minute cycle down there, and also if you have this mid time frame, it will show one cycle above. So if there's any daily cycle, which there isn't right now, or it would show it there, it will show it right next to it as well. Okay. Position. This is just where it shows it. Now you don't need to have the text ones on if you don't want to. If we move this to the side, you can see we have lines marking out sequential SMTs as well. Okay. The high and then the low right there, the low down there. Okay. It says the asset that created the sequential SMT. So if you can see the asset that you're looking at, NQ, ran out the low. It says ES here. That means ES was the failure swing. Okay. Now low time frame asset, you can also have it show mid time frame asset and mid time frame lines. So this will again show the 90-minute cycle and also the daily cycle. Okay. Now, as you can see, the daily cycle is more of like a dash line. You change it down here, customize it. So if you wanted to show one cycle above, you can have both. You can have that one like green, for example. So you know this is one cycle above sequential SMT. I personally don't have it show, just because I don't want too many lines on my chart. I just want to keep it nice and simple. Just, the cycle that I'm viewing, I know that I've got, the sequential SMT there essentially. Okay. So these all on the 5 minutes. So these are all 90-minute cycle sequential SMTs. Now a great filter is delete failed sequential SMTs. I have this on. If we turn it off, as you guys can see, it will look a lot messier. Okay. Give it a few seconds to load up. Maybe it won't look too messy here. Yeah, so you can see a few more lines got added. Essentially what this does is it'll show all the sequential SMTs, even if they've failed, okay? So obviously failed means, ran below, ran above, whatever. I'd keep it on, again, just to clear up my chart and just have it show me sequential SMTs that I should only care about, not the ones that have failed. To view the ones that have failed, it's good for backtesting. I'm not backtesting currently, so I have that turned on. Lower time frame SMT start, mid time frame SMT start. This just puts a little diamond sort of symbol above the candle where the sequential SMT was first formed. Okay, as you guys can see right there. Now this is what I used to use before we coded the tCISD indicator to identify the tCISD candle, but I no longer use that anymore. Okay, so I turn that off. Dividers and labels, self-explanatory. Just marks out the dividers for you. You can change the colors of those. Dotted, dash, whatever. True opens, again, pretty self-explanatory. It shows low time frame, which is the cycle that you're viewing. Mid time frame is one directly above. So I keep them both on so I can see stacked opens. So true session is above the true day. I know that we have bearish stacked opens right there. Okay. Let's keep it going. Change the color of those, dotted, dashed, etc. Previous cycle range lines, and you can delete those as well. I personally just have those on. Essentially, I'll just mark the previous cycles high and low and equilibrium. I personally don't use it. Defining range, pretty solid. Again, I just don't use it though. Turn it on and show you guys kind of how it looks. It does look pretty clean, to be fair. Defining range is Q1s split into 3, and then the final 2/3 it will mark the defining range from, essentially. Okay. So as you guys can see, Q1 here, split into thirds, ignore the first third, and then pull a fib from the high to the low, and it anchors it for you. So then all you need to do now is pull out your fib tool, right? Fib retracement, pull it from the high to the low, obviously the low. Obviously make sure you have the fib settings on, which I do not have currently, and they are standard deviations, high to the low. And there we go. As you can see, just easily like that, plotted my defining range. Okay, so pretty cool if you guys use the defining range. I personally don't, so I do not have that on. So I can turn this off. Standard deviations. So this uses the previous cycle, previous quarter, I believe it is. I'm not too sure. I don't use this one either. And it essentially plots the standard deviation for you on that previous quarter or the cycle. Now, high probability gaps is something that more or less I discovered myself. So this is not specifically quality theory, but they involve gaps that form with quality theory concepts. Okay, the ones that I used to use is gap after PSP, gap overlapping with true open. Okay, this is gap plus precision swing point and gap plus precision candle. Now, if we turn this on, you guys can see it does mark some very powerful gaps. So as you can see, red is bearish, right? And also green is obviously bullish. Okay, there isn't actually any bullish ones that I can see. Hasn't been any for a while, it seems like, right? But you guys can see how powerful these gaps are. You know, these are essentially high probability gaps. Go for entry points, go for like reversals, etc., etc. And if they get inversed, they then become quite high probability inversion gaps. Okay, you can see this one held up top. This one more or less held as well. This one not as clean. It got inversed, closed back down below. But then as you guys can see, once we did eventually get back above it, look how nicely it held off that retest right there. Okay, so there's that. You guys can experiment with that if you would like to. Like I said, I personally don't use that anymore though. More or less just because I don't want too much on my chart. I like to keep it nice and simple, because obviously I'm live trading every single day to my Discord, you know, creating content for you guys. So I don't want too much clutter on my chart. If I weren't doing all that, I probably would still use them, to be honest. They are very powerful. Precision candles, as you guys can see, just, you know, marks out the precision candles on the chart for you. So if it loads up a second, oh wait, I need to hold up, because we need to, you can actually have it just show like just the border, for example, just the wick. So if we turn this on, turn border off, turn this one off too, it will just mark out the wicks as purple essentially. Okay, so when that loads up, give it a second. As you guys can see, very subtle, but the wicks are actually purple. So yeah, you can just have it kind of, you know, show the wicks. It's very subtle right there, but as you can see, purple wicks right there. If you wanted it a bit more obvious, you could make them red or something like that right there. Okay, again, pretty cool. I just don't use precision candles personally. Now, precision swing points, you turn this on, filter by true open, filter by sequential SMT, TPD, and show unfiltered precision swing points. Okay, so this unfiltered one is if you use filters, it will show them as the colors you have selected here. So green and red, for example. And if you have filters, green and red will be the ones that follow the filters. If you want it to show unfiltered ones, turn this on, and then these are the unfiltered ones here. Okay, so these are the ones that don't follow the filters you have selected, right? So click OK. So green and red ones follow the filters. So red, as you can see, pretty much marks so many highs. Like PSPs are really powerful, super clean. Obviously the green ones as well just mark the bullish ones, and then like the cyan blue color is a PSP that doesn't follow a filter, and you can see these ones are a lot more prone to failing right there. Whereas if you filter them out correctly, they will hold a lot more. Okay, so there's the PSPs. Again, I don't use them personally because PSP isn't a part of my model, but they are great for people that do use PSPs. Now, first fair value gap after sequential SMT, very powerful. Turn this on, customize the colors right there. And essentially what this will do is after a sequential SMT has taken place, it will then mark out the first gap that forms and the first inversion gap. So inversions are marked via the lines, and normal gaps are marked via the candle, like whole painted color. And look how clean it is, guys. Like I've spoken on this in a YouTube video before. The first presented gap after a sequential SMT is a very powerful entry point. So as you guys can see, holding just very cleanly all the way down the lows. Bearish one didn't really work too much there. Bullish one here, super clean. Bearish one there at the top. Very clean stuff. Okay, so yeah, I would recommend this one. Again, I just don't use it just because it is cluttering my chart a little bit. But if you guys don't mind it as much, it is very powerful. Okay, and then last but not least, we have the watermark, which is in the top right here. Shows the asset, the trade that you're looking at, the time frame, and then QT toolkit. You can have it show what you want as well. So if you put hello, it will change it to that as well. Okay, if we click on custom phrase, give it a second, see if it loads up here. It's custom phrase on, and it should show it here when it loads. Give it a second. Yep, there you go. So you guys can have that if you want to have, you know, maybe your username or your social media handle, whatever it may be. Okay, you can have it show where you want. You can make it larger, you can make it huge. As you can see, we can have a massive watermark. I personally just have mine on small, I think it is, or normal, I'm not too sure. Let's give it a second. I think it might be the small one. Oh no, I think it's normal, but I do like it on small actually. We'll keep it on small for now. So yeah, that's essentially the Quarterly Theory Toolkit Oracle Plus at oracleindicators.com. You can grab access to it. This is probably the best indicator out of the suite. Okay, and now the third indicator that I use is the tCISD Oracle Plus. Again, this is part of the premium suite. This one is what I use for my entry technique. So a lot of you guys may know that I use a true change in the state of delivery to enter my trades from. And this indicator right here essentially marks it out on my chart for me, so I don't need to do any of the hard work. Okay, so it shows true change in the state of deliveries. It shows inverse true change in the state of deliveries, sequential SMT, and also quarter dividers. Okay, and with the tCISD indicator too, you can set filters. So you can have it show one stage sequential SMT must occur before a tCISD appears, 2 stage premium and discount, and true opens. So for example, if you're below a true open, a bullish tCISD will only show when you're below that true open. Okay. Now again, you can identify both tCISDs and iTCISDs. Very customizable, fast loading times with good performance, auto mode for multiple asset classes, so the auto triad feature, and alerts for preset conditions, so you can have it alert you when, for example, a bullish tCISD below the true open in a discount occurs. So let's jump into the chart now and I'll show you guys exactly how I have mine set up. So now guys, we have our third indicator here on the charts, which is the true change in the state of delivery, the tCISD. So now this is my entry technique. This is my entry model. So this indicator is a must have for me. Again, if you want access, go to indicators, tCISD, Oracle Plus, like that, click on my name and you can see the script on there, or you can go to oracleindicators.com and grab access on there. Free trial. If you don't like it, you don't need to buy it. It's very cheap. I think this one's around $15 per month. So very, very affordable. Okay. So what are my settings? Okay. These are my settings, text color. Now, if you have the Quarterly Theory Toolkit, you want to make the text color white and opacity 0, okay? Because what this indicator does, it requires you to have the show sequential SMT and text box turned on to see the tCISDs. If you turn it off, you'll see the tCISDs will go. And the reason behind this is obviously the tCISD must form if a sequential SMT takes place. So this has to be on. Now, if you have the text color turned on, it will show it in the bottom right, exactly as the QT toolkit does. Okay, so if you have it shown the QT toolkit and you also have the tCISD indicator, best case scenario is that you just turn the opacity to 0, therefore it won't show an overlap in the bottom right. Okay, if you don't have the toolkit one, then that's fine, you can have it show if you would like to. Okay, so yeah, that's all those settings there. Dividers and labels, again, if you've got the toolkit or you've got, the Quarterly Theory cycles, you don't need the dividers again, but if you've only got the tCISD, feel free to turn them on. It's an option. You can use them if you guys want. Okay, true CISD. These are the main filters now. So obviously show true CISD, show the label. So this, actually says tCISD right next to it. Show unfiltered tCISDs is if you guys use the filters and you want it to, the ones that follow the filters will be the colors here, green and red for me, and then unfiltered will be whatever color you select. So it'll show tCISDs that don't align with the filters right there that you have selected. Me personally, I don't use any filters with it. Okay, so I have this turned off. I could turn it on. It doesn't really matter. Every single tCISD for me essentially is technically unfiltered, so that doesn't matter for me. Delete inverse tCISDs. So this is deleting tCISDs that have failed, and then you want to have show inverse true CISD on if you guys want to see the inversion tCISDs too. If you don't like inversion ones, that's fine. Just have this turned off, and that way it will just show only regular tCISDs. So as you can see, updates removes that one there. Okay, but I like to use both, so I have both. Okay, now these are the filters, so you can have it show only tCISDs that occur after 2-stage sequential SMT or 1 stage. Filter by true open, and it can be stacked true opens as well, and filter by premium and discount. Okay, this also has a watermark, so you can turn it on. Again, if you've already got like the toolkit one, for example, then you don't need 2 at once, so you can just turn 1 off on one of the indicators. Okay, so those are my exact settings. Again, very customizable. You guys can play around with those and fit those exactly to your liking. Okay, and now obviously, if you go back in the charts, you guys can see sort of how powerful the tCISD concept really is marked by the indicator. Okay, inversion tCISDs for those continuations, tCISDs to mark the highs and the lows. Okay, generally, if you can get yourself in line with the direction of price, if you get good at reading price action, every single tCISD that forms in line with that direction is probably going to work. I mean, entry, short entry, start pending, then we get a bullish one, then we get a quick little short one, and then again a few more short ones here, a bullish one there. Like, you guys can see truly when indicators are displayed on your chart how powerful the concepts that I speak about really are, honestly. And it's great to have them marked for you, so you don't have to do anything. You can just sit back, just trade your time window. Oh, there's a tCISD, I'm bullish on the day, let me take a long. It's as simple as that. And now the fourth indicator of today's video is going to be the SMT-Fill Oracle. So this is part of our free suite, so you guys can search this right up on TradingView and get access to this one immediately. Now an SMT-Fill will essentially show you a divergence across closely correlated asset classes between gaps. Okay, one asset trades into a gap, one asset fails to trade into a gap. Now this SMT-Fill indicator has all the SMT-Fill variants. So variant 1, 2, 3, one asset trades into a gap, one doesn't. One asset trades below 50% of a gap, one doesn't. One asset fills a gap completely, and the other asset doesn't. it will alert you of all of the 3 variants. It also shows you live SMT fill detections. So as the SMT fills are occurring in real time, it will mark those out on your chart directly. You can preview past SMT fills as well. So you can look back upon, what did the previous 4 hour do? Oh, we got an SMT fill down on the low. Cool, I can frame an entry off that. Customizable watermark as well, so you can have it show the asset, the time frame, and also the SMT-Fill oracle. So with that being said, let's go ahead and jump into the charts again, and I'll show you guys how to grab this indicator and exactly how I have mine set up. Now let's move on to our fourth indicator of today's video, another completely free one. So let's jump into that right now. So here is the SMT-Fill indicator on the charts. Already you guys can see how powerful SMT fills really are. Look at this. Beautiful long, beautiful short from there as well. Okay, how do you get access? This one's completely free, completely free. Okay, SMT Fill Oracle, boom, get access. Click book our trades. You guys can view it there. Or you can favorite it and add it to your indicators from this page here. Okay, so super simple. Then settings. How do I have mine set up? Auto triad turned on. You guys can customize it. Maximum gaps. This is how many gaps it will show previously. Okay, so if you only want it to show the last 3, that's fine. If we turn this on, you guys can see if we click OK, give it time to update here, then it will remove a couple of these here and it'll show just that one there. If we go to the 1 minute, for example, you'll see it'll only show sort of three SMT fills here. All right, come back to it. So you guys can have it show just 3, 5, whatever it may be, 10, 15, whatever you guys prefer. Okay, you may only want to see the past 2 or 3. Then just click 3. Okay, we'll keep it on 50 for now. Bullish gaps, bearish gaps, color customization, pretty self-explanatory, pretty clean. Gap borders, so this is, if you want it to essentially show a border around the gap. So right now you can see there's no outline in it. If you guys do want an outline sort of around it, then you guys can turn that on just like that. Okay, I have that turned off. I think it's clean without, but you guys can have the choice for that. SMT fill divergence line. So this shows you what type of variant it is. Okay, you can have it dotted, dashed, straight, whatever you want. Okay, so as you can see, there's a dotted line here right at the very start of the gap. So this means the SMT fill was from one asset filling the gap completely and one asset didn't even trade into the gap at all. Okay, as you can see down here, there's a dotted line in the middle. So this means one asset, in this case NQ, did not trade below 50, whereas ES did trade below 50. Okay, so it kind of shows you what variant it is just from the dashed line. It's pretty clean. Labels and text, self-explanatory. This is just, the name of it, etc., etc. Only show active gaps. So you can only have it show gaps that are kind of forming in real time if you guys would prefer to have that show. Again, another nice little watermark right there, which you guys can, have it show in the top right. If, for example, this is the only indicator of ours that you use, you can have it show the SMT fill. Custom phrase in the top right. So if you give it a second, we actually got this one set to the center right now. You can have it, wherever you want. But as you guys can see, it shows right there. If you turn the text color and opacity to 100, then it will show the triad, the time frame, and also the asset that we are viewing currently. Okay, so again, another completely free indicator. SMT fill. You can use SMT fills to build that higher time frame bias. You can use them for entries. It's a very nice sort of concept to use and incorporate into your trading. Literally no downside, no negative effect to it at all. It's just an extra confluence. Okay. And now finally, last but not least, we have the statistical bias oracle indicator. Again, this is another completely free indicator, and this is one that I use to gauge my daily bias. Okay, you can have it show you the 4 hour bias, the 1 hour, 15, 5 minute, hell, even the 1 minute. This essentially uses the candle closure methodology that I speak on. I'm not saying that I invented it, but I use it and I've spoken on it before on my channel. So essentially what it does is it looks back upon the previous candle closure, depending on the time frame that you set it on. So if you set it on the daily, look back upon the previous day's close, and depending on how that candle closed across the triad, it will give you a percentage of how likely that bias is to play out. So the features of this indicator is a bias time frame, the draws on liquidity. You can have it mark the draw for you, the previous candle high or low. Bias table mode, so you can have different kind of modes to show the table, smaller or more of an advanced, bigger one. Asset bias validation, auto triad, and also custom triads. Okay, and again, it's an all-in-one indicator, less indicators to manage, very customizable, fast loading times with good performance, auto mode for multiple asset classes, and alerts for preset conditions. So now for the last time of this video, let's go ahead and jump into the charts and break down exactly how to grab this indicator and how I have mine set up. So now with that being said, let's go ahead and jump into our fifth and final indicator of Oracle. Again, another completely free one. How do we grab it? Indicators, statistical bias, Oracle, boom. Favorite it there. If it shows up, click on my name, whatever, drop a boost, drop a comment, help support the indicators. Okay, so how do I have mine set up and what do the settings actually look like? So auto triad, turn that on. I don't know why mine's not turned on. I've already got the assets set, I guess, anyway, so it doesn't really matter. But you guys can turn that on. Again, it just detects the triad that you're looking at based on the asset. Bias time frame, so custom bias time frame, turn that on, and you guys can see that you can then customize the bias candle. You guys can then see that you can customize the exact bias for the candle that you want here. So if you want to see the 4-hour candle closure and the bias built upon the triad, click on 4-hour. And what it'll do here in the table is it'll show the time frame that you selected and also one above. So the 4-hour to the daily. So you can see NQ, ES, and YM gave a bullish candle closure to the upside on the 4-hour on NQ, ES, YM. Also, in the daily candle closure was a bullish one, NQ, ES, and YM. So the overall rating for the triad is bullish bias, okay? Then you can have it show the drawn liquidity. So you can see here, it's actually marking out the previous 4-hour candle high. So what you can do on the lower time frame, you can have that marked for you. So right now on the 5-minute, you can see it showing the sort of drawn liquidity right there for the 4-hour candle closure on the 5-minute. So you guys can look for a 5-minute entry technique and trade it up towards the 4-hour candle closure, essentially drawn liquidity. Okay, so super clean stuff. Asset bias validation, so it can be, lower time frame plus higher time frame with the overall rating, or it can be lower time frame plus higher time frame, and also triad bias rule. You can have it all three, majority, all the current asset, okay? So current asset, it just, shows you the bias based on the current asset NQ that you're on, or you can have it show majority, the overall bias based on if there's maybe 4 bullish closures for the overall trade and maybe 3 bearish ones, the overall bias will be bullish. All three it'll take into account all the assets that you're viewing and generate a bias based on the average of the candle closure, bullish or bearish, okay? Bullish color, bearish color. So this is just, if it's bearish, it'll say bear and it'll be in red. Bullish, it'll say bull and be in green, okay? Drawn liquidity line, you can change the colors of these. Drawn liquidity text, again, change the color of it, whatever you guys want to do, okay? Now, a cool feature as well is any time frame, if you've got the drawn liquidity marked, it will show it for you. So I can go to the 1 minute and it'll still show me the drawn liquidity for the 4-hour on the 1 minute. Super clean, super cool. We'll look for a 1 minute entry up to the 4-hour high, for example. But the time frame that we selected, which is the 4-hour, is that main one. If we go actually to the 4-hour, it will then give us a percentage based on the candle closure. So it's a bit different now because, so as you can see, we're in replay mode. So it's obviously a little bit glitchy here, but this candle is printing currently. It's got 1 hour, 4 minutes left. How did the previous candle to this one close? Okay, this was a bearish continuation candle signature. So as you can see, the 4-hour is bearish on NQ, ES, and YM. However, the daily is bullish on NQ, ES, and YM. So what it does is calculates an overall percentage of historical data. By the way, this is going back and it's collecting all the historical data. So there's a chance that the bias, so if you guys come back into settings here, selected here, asset bias validation, low time frame only. So we've got the 4-hour, this will show us the 4-hour overall bias, okay? So it's bearish on NQ, ES, and YM. So statistically, when NQ, ES, and YM all print a bearish 4-hour candle closure, you have a 64, almost 65% chance that the following 4-hour candle will print as bearish and at least hit that previous 4-hour low. Okay, so you got the percentage. If you go to the specific time frame, if you go to the 1 hour, right, and we go to the 1 hour time frame, and here it will then show us the percentage. 66.72% chance that the whole triad is bearish and will trade towards that previous 1 hour low based on this candle closure when the new candle opens up. Okay, actually, to be fair, I think it may have been based off this candle closure over here. As you can see, it was a bearish reversal one, and this one did indeed trade down to that previous 1 hour low, so it did play out perfectly. Okay, so with that being said, guys, that's going to go ahead and wrap up today's video. If you guys did enjoy it, I'd appreciate a like, subscription, comment down below any questions you've got about the indicators at all. If you guys have faced any problems, spot any bugs with them, any updates you want to see, drop them all in the comments down below. We're always continuously working hard on our indicators, and we have a lot more planned coming for the future as well, okay? So if you guys do want any of the indicators we spoke about in today's video, go to oracleindicators.com. You guys can see all of the indicators that we've got. You can bundle them up together so you can get access to all the indicators for a reduced price. So if you guys do want that, oracleindicators.com, or if you just want the free ones, you can just search them directly up on TradingView, okay? Drop a boost, drop a comment on the indicators. That shows support to us, and shows me that you guys want me to continue dropping more indicators. Okay, again, like I said, I've used these indicators to generate thousands of dollars in profits, and also my students as well, thousands of dollars in verified profits. It's 3 a.m. out here in town right now. I'm just going to be 100% raw, or 100% real, 100% myself, authentic. I just want to have a chat with you guys, okay? No course, nothing like that. Just a one-to-one talk about this one thing that changed my trading, right? And this is not going to be any act or anything like that. Like, speaking honest truth right here, okay? And I'm sure that you're all going to want to hear this. It changed my trading completely. It allowed me to live this lifestyle that I've always dreamed of having. And I'm not here to like try and sell you guys on anything, but just listen up, okay? So the one thing is understanding that within trading, less is more, right? You may have heard that, you know, thrown around quite a lot in the trading space, have like a simple model, all that type of stuff, but it is true, but only to a certain extent, okay? There are things that I would specifically focus on inside the charts, in terms of going into more detail and making things a little bit more intricate. Where the simplicity needs to come in is through the entry model, in my opinion, right? For the entry model, you know, 2 to 3 concepts maximum. That's all you need to get yourself into a trade. I mean, hell, you don't even need a singular concept to get yourself into a trade, right? And this brings me into my point of the intricate things that you should be studying, the things that you should be going into detail within and spending most of your time within is the ability to read price action, okay? The ability to know where the next candle is likely to go. The ability to know where the day that you're trading is likely to go. The ability to know even where the session that you're trading, even the next 5, the 15, the hourly candle, where is that likely to go? Okay, that's what you should be putting all of your time, your energy and focus into. Because once you know where price is going in that certain amount of time, you can enter off anything, right? You can just enter straight away. As long as you know where price is going, you can get into a trade, okay? Obviously, it's not as easy as that, right? Unless you was to just sort of, you know, enter with like pretty minimal risk, have a large stop loss target, like negative 1-to-1 RR and whatnot, right? But yeah, I would put all my focus, you know, if I was to start again, into the ability of reading price action, right? Obviously, I trade, you know, quality theory, just like goes hand in hand with ICT. So if you're an ICT quality theory trader, I would say you've probably got it a little bit better than other traders. But again, like, I'm not here to discriminate, you know, other sort of strategies and stuff could give you that same analysis as well. But yeah, honestly, you know, once you know where price is going, that's the easy part, right? And then collect data on that, you know, have the data backing it up, which days are going to be bullish, which not, you know, et cetera, right? Then this is where the simplicity comes into play. This is then when you want to find a simple model that resonates with you, okay? And how do you do that? Well, first of all, I would recommend to study the ICT concepts, right? The main specific ones would be SMT, fair value gaps, obviously, order blocks, and just like liquidity sweeps, basically. That realistically is all you need. Inversion gaps as well, to be fair, they're also pretty good. And just pick, you know, 1 to 2, or just pick 1 and just have that as your entry model, right? Just have that as your entry model. So you enter from a fair value gap, you enter from an order block, you enter after a liquidity sweep, after like, you know, rejection, after the high has been taken, for example, okay? Once you've found that, you can apply 2 as well, like a sweep and then a gap, or a sweep then an order block. Or if you really wanted like a fair value gap overlapping with an order block, right? Once you've found what resonates with you, you know, open up your charts, just see what do your eyes glued to? Like, what do you get magnetized to, right? Like, can you spot gaps easily? Can you spot order blocks easily? Just zoom out. What do you see price rejecting from most of the time? And once you've figured that out, once you've found that one concept that really resonates with you, for me, it was SMT, obviously more specifically sequential SMT, time-based SMT, which is obviously quarterly theory, okay? Yeah, once you find that concept, really study it, right? Put all your time, your effort into studying that one specific concept, backtest it, collect data on it, you know, what does price do once it trades into the PD array that you're studying? How can you get an entry after price tags into it, for example? Are you going to wait for a rejection? Are you going to drop to a lower time frame? Wait for, you know, a nice candle rejecting away from it, or something like that, okay? Find that, right? Find that, make that your entry model. And that's the simple part. That's the easy part within trading, right? Now, that leads me on to what the intricate, the hard part should be. And like I said earlier, it's the ability to read price action, okay? So put all your time, your effort into the ability of reading price action. Now, how can you study this? How can you backtest it? How can you build on your ability to read price action? For me, it's just going through the markets, right? Open up all the assets, open up every single marketplace, and sort of just see what happens, right? What happens when a daily candle closes above the previous day's high, okay? What happens once we violate or close above a higher time frame fair value up? What happens once we tag into a higher time frame order block, for example, okay? And once you've got that figured out, for me, I'll give you a little bit of source here. For me, the way that I like to read the narrative and the higher time frame sort of direction, price action, is a sequential SMT. So if you guys are new around here, just like an SMT essentially, okay? An SMT concept. Once that happens on the higher time frame, there is usually a shift in momentum, right? Like price, if it forms a bullish SMT, it will shift obviously back to the upside, okay? And then once you've done that, I like to use candle closures. So like a continuation candle is where a daily candle would close above the previous day's high, or a reversal candle would be where, for example, it takes previous day low, but it fails to close below it. It closes back up into that previous day's range. So it takes it out the low, but it doesn't close below it specifically. That's like an indication of a reversal, essentially. So once you've found those things that allow you to read that higher time frame price action, like I said, for me, sequential SMT candle closures, okay? Once you've got that down, then you have the ability to know what the next daily candle is going to do or likely to do. Obviously, nothing's 100% within trading, but once you know what that next daily candle is likely to do, all you're doing then is, again, coming down to that simplicity topic, is you're then finding a specific window each day that you're going to be on the charts. Okay, so keep it simple, right? Don't be, going to bed super late, waking up early one day, and then waking up late one day, and just open up the charts and just seeing, oh, this looks good, I'm gonna take it. This looks good, I'm gonna take it. This looks good, I'm take it again, like whatever, right? Okay, whatever. So find a window that works for you. Obviously, again, less is more, right? Less is more. The simplicity, just being on the charts for just an hour to like 90 minutes, 2 hours maximum per day is all you really need. For me, 90 minutes per day maximum. So that's 1 hour 30 that I'm on the charts. Okay, really not a long time at all compared to like a regular 9 to 5 work day, right? You're looking at 7-8 hours per day of work. For me, just 90 minutes, and I don't really even see it as work. For me, I really enjoy what I do. I enjoy opening the charts every single day, not in like an emotional perspective, but just more or less like feeling blessed that I'm able to do this, right? As like a full-time job, essentially. But don't get me wrong, it wasn't easy to get to this position by any means. It's 3 years of my life gone that I'll never get back of just pure study, hard work. But I am obviously grateful that I now get to, reap the rewards of my hard work. But yeah, that brings me back anyway to the point. Find a specific window. So what's your schedule looking like? Okay, I don't know, let's say you're in New York time. Let's say you finish work at 10 a.m. Okay, 10 a.m. So you can then be on the charts from 11 to 1 p.m., right? Once you know that, once you know your schedule, once you've found that 2 hours maximum window, ideally 90 minutes is what I like to do. You can find 90 minutes window based on your schedule as well. Once you've found that out, just stick to it, okay? Don't even open up the charts a minute before. Don't open up the charts a minute after. If you're inside of a trade within the window and it keeps running, then fair enough. You can obviously manage that trade, but just make it a rule where you don't execute before and you don't execute after, right? So now you've got the ability to read price action. Ignore the car. You've got the ability to read price action. Damn, can you guys hear that? But yeah, anyway, you've got the ability to read price action. You've got a super simple, like 1 to 2 concept entry model, and you've got a time window, right? Now, all of that combined is very simple, okay? Very, very simple. You open up the charts at a specific time every single day. You do your high time frame analysis. Are you bullish on the day? Are you bearish on the day? You're trading within that small little window, and you're looking for your singular entry model, the concept, okay? And if once they all align, you take the trade. And whatever the result is, so be it, right? So be it. Win, cool. Loss, cool. Who cares, right? And that's it. That's how simple trading should be. There's no need to overcomplicate it. There's no need to be on the charts at different times every single day, different concepts as entry models every single day, different sort of methodologies to read that higher time frame price action every single day. Like, don't switch it up. Keep it the same. Keep it simple. And trust me, you'll find the best results. And also a thing to note as well is a lot of people, when I stream my training sessions to my Discord, they'll say to me, right, so I'll be, I don't know, let's say I've established a bearish bias in the day, I'm looking for a short. Okay, I'm waiting for my entry model to the downside. Price will then start going higher and higher and higher and higher, and it will present my entry model to the upside in the bullish scenario, right? And they're asking me, why aren't you taking this trade? Why aren't you in this position right now? You said it was going to go higher. Why aren't you taking it? Okay. This, in my opinion, is what separates a good trader or a bad trader from like a very, very good trader, like a very high level trader, is their ability to remain patient and disciplined, not to take a trade, even though it's their model, but it just doesn't align with what they're expecting, like where they're expecting price to go in the bigger picture, like on the higher time frame, right? That to me separates a good trader from like a very, very good trader. Because yes, don't get me wrong, you can still take these trades that oppose your bias on the day. Can they still play out? Yes, absolutely. It's happened to me loads, but I just watch them go by. That's all I do. Just watch them go by. And I'm just purely waiting for my entry model in line with that bias that I formulated on the day. And until it happens, I don't do anything. So for example, today I was streaming to my Discord. I had a bearish bias, right? I've got my entry model. Everyone knows what my entry model is inside my Discord, right? And all I was doing, specific window, 9 to 10:30 a.m. I was just literally sat there waiting, 20, 30 minutes gone by. We're just going higher and higher and higher, right? And then we form my entry model to the upside. They're like, Booker, why aren't you taking this? Why aren't you taking this? You said it's going to go up. You've got an entry model. Why aren't you taking it? Right? But like, why would I? Why would I? If I think we're going to go lower on the day, but price is trading higher, what does that mean the price is doing? That would be a retrace, right? In the bigger picture. Like in the bigger picture, we're going lower, but like lower time frame, we're going higher. So all that is just a lower time frame reversal to the upside, but all it is a higher time frame retracement. Okay, so why am I going to opt to trade the retracement compared to the actual real move that I think will happen? Because the retracement might be like that, but then the real move is going to be like that. Okay, so why would I not try and get myself in line with that bigger move? Not that I need to catch the whole entire move, but the bigger move is more likely to play out because it aligns with my direction. Okay. So I'm bearish, price is going higher. Cool, right? Cool. Entry model might be there. I'm not going to take it. So, but not only that as well, yes, it might play out. Yes, it might give a retrace. You could have caught, I don't know, a little long move, let's say, for example. But if I'm bearish, even if you see price going higher a little bit, that could just be very short-lived. It could just last like, it could go up for like 5 minutes and then just drop lower. So you might look to take that retrace move higher, a little long position if your model's there. But it could just be a quick little spike up, little wick higher, and then straight back lower. So it might not even be a retrace. So that way you just kind of trading based off pure emotion, based off FOMO, based off, you're trying to hit a trade on the day, you're trying to make some money on the day, your model's there, just take it, right? Because if I did that, I would be in hundreds of trades every single day, okay? I'm a 1 minute trader. My entry model is super simple. It's based on a true chain in the state of delivery, which is like formulated from like a quality theory concept, basically, that I found myself. And there's hundreds of them on the 1 minute chart every single day. And there's probably about 5 or 6 every single day within my 90-minute window as well. But do you think I take every single one of those trades? No, I filter them out. Say I'm bearish, going back to earlier, say I'm bearish on the day. And let's say there's 2 bearish entry models that appear within my window. And the 4 that aren't bearish, they're all bullish, right? But those bullish ones, those could be very short, 2-minute lived moves, just like one candle higher and then it drops back lower, okay? Whereas if I was to wait for the bearish ones, and just take those ones, it's almost like you're trying to chase that dopamine, you're trying to get that spike of dopamine, you want to enter a trade because the model's there, it looks like it's going to go higher, but just don't, man, just don't. Just remain patient, just wait for it to align with your bias, right? And again, it comes down to the simplicity thing that we mentioned earlier. Just make it easier on yourself. Don't try and trade every single model that appears within your time window. Just wait for the one that aligns with your bias and take it, right? Like, just take it. Like, it happened to me today. Price was trading higher. My entry model's there. It gave a nice move higher. Like, it was a good long move higher. But then once that long move had happened, the retrace was over. My bearish model appeared.
and the move lower was so much better. I'd hit TP in literally 2 minutes, as opposed to if I would have taken the long, yeah, it might have played out, but I would have been in the trade like 20, 30 minutes, right? Whereas I want to be in the cleanest possible trades, and the cleanest trades are going to appear the ones that align with the order flow, right? The retracement trades, they're okay, but why would you choose to trade a retracement compared to a huge expansion to the downside, you know? So just make it easy. Just make it easy. Just wait, practice patience, practice discipline, practice waiting for your model that aligns with your bias. And that's where real simplicity, real trading, real confidence comes into play. And it just gives you that peace of mind, you know? It just gives you that peace of mind. Like, you're not thinking in the back of your head, oh, I missed out on this trade here, I missed out on this trade here. No, you didn't miss out on the trade because it didn't align with what you expect on the day. You know, are you trying to follow your model religiously and so you can consistently bring in money every month, every week? Or are you just trying to chase like quick dopamine hits, just quick trades, up higher, down lower, down lower? You know what I mean? Like, just wait for the real move, bro. Just wait for the real move. And yeah, that's kind of all I've got for you guys for the charts. But then simplicity in real life as well is create a routine, guys. Like, create an actual routine, a simple routine that you can follow every single day. That's going to help keep you accountable. It's going to help keep you disciplined, staying locked in the whole entire time. It's like on the charts as well. The more things that you know, the more things that you do, the more room for error there is, right? Same with real life. You know, the more things you're doing in your day, the more messy it's going to be. You're not going to be on time for things. You're going to be stressed out. Cortisol levels are going to be high. We don't want them high. We need them low. That guy ragging his car about's probably got pretty low cortisol. But yeah, either way, just, you know, keep your life as well simple, like on the charts. You know, 2 to 3 concepts for that entry model. Same thing in real life. Just, you know, 3 to 4 things that you do in your everyday life. Whether that's, you know, one thing could be going for a walk, doing some sort of exercise like hitting the gym, eating your meals at like specific times, eating well, waking up at a specific time as well. Just super simple, you know, have a wake up time, make sure you're awake a good few hours before your actual trading window, get some good food down you, go for a walk, hit the charts up, do your job on the charts, hop off the charts, and then just kind of relax, wind down a bit towards the evening time. And that's a simple life. That's the life that you guys should be striving for, the one that you want to be working towards, you know, because obviously if you guys are still in your jobs, which I'm sure a lot of you guys are still working 9 to 5s as well, while trying to make trading work on the side, obviously it can be a lot harder. You know, you're still working for like 7-8 hours a day and then you're hopping on the charts. It can be a lot harder. It just means you've got to lock in the charts a lot more. But once you get to that point of profitability, then that life of simplicity does come a lot easier, you know, because you don't have an alarm, you don't have a time that you need to wake up for, which kind of contradicts what I just said, but obviously you do, you know, but it's not like super strict. You don't need to be up at 7 a.m. on the dot. You don't need to be out the door by 8 a.m., go to your job, whatever, eat at this time, blah, 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 you know. You can kind of be a bit more chill about it, just relax and just take it a lot more easier and stress-free, you know. And then I guess one final thing as well is your trading environment, your setup, your room matters as well. Obviously, this doesn't really tie to simplicity, but it's more or less about keeping everything clean. That should be what the main focus is here. Keeping everything clean. Keep the setups clean. Keep the model clean. The ability to read price action clean. Your day nice and clean. Not rush. Not stressed out. None of this stuff. But yeah, your trading setup, whether that's your bedroom, your trading setup is in your PC. Make sure it's nice and clean. Your monitors, give the screen a wipe. Your sort of desk space as well. Don't have it all cluttered. Just keep it nice and clean. So if that's you right now after this video, go and sort that out. Trust me, having a clean setup makes a world of difference. Like when you've got stuff cluttered all over the place, your bed's not made, your whole desk space is messy, you can barely even move your mouse around. It does affect you. You might not think it does, but it really does, you know. Imagine walking into a clean, nice room, your setup's there, you know, you're sitting down, you're locking in on the chart time, and everything's just clean. You know, you've got that peace of mind. That's more or less what everything's about, the peace of mind, like the simple model, the simple ability to read price action, the simple life that you live in, you know, the simple setup, nice and clean. Everything just needs to be clean, okay? It doesn't need to be perfect, just clean, okay? You don't need to have the best setup ever. Just make sure you tidy it up, right? And now with a combination of everything that I just mentioned inside of this video, there's no way that you guys don't see results. Like genuinely, just you obviously have to put in the work as well, okay? So before you get to the stage where you can just be on the charts for that 90 minutes per day and then live your life, you know, following the routine, obviously to put in hours and hours and hours and hours and probably endless, you know, late nights, not much sleep, getting to the point where you've got a model that you can trust, you've got the data for it. But once you're at that point, you then don't need to be backtesting every single day, all that type of stuff, You've got your journal ready, you've got your backtested data, your model, you know how to do price action. All you're doing now is waiting for your window and executing, right? And that's it. Obviously, a lot easier said than done, but that is genuinely it. Yeah, and that's how my life looks right now, and that's how my life's looked for the past just over a year now. Completely full-time trading. It's just time. It's just timings. Everything is timing. I wake up at a specific time. I hit the gym at a specific time. I eat the same foods every day. I'm on the charts for a specific time. I journal straight after. I look for the model in line with the bias that I've got in the day. Like, nothing stress-free at all. It's just nice and easy, just following the system day to day, following the system on the charts. And that is ultimately how you're going to get to that position of being that full-time profitable trader you've always aspired to be and that you're working towards right now, okay? But yeah, right now, as you can see, 3 a.m. right now. I'm out here in Thailand, and I've been out here for like 3 or 4 weeks now. I'm out here for like another 4 weeks as well. But this is what can happen if you lock in. Genuinely, just make sure the next month, 3 months, 6 months, you're applying the things that I spoke about in this video. And this could be you in a year's time from now, And again, like I said, I'm not here to sell a lifestyle or flex or anything, because I don't care about flexing, right? I've just got this nice place in Thailand. I've got a pool. It's got a gym. And that's all I'm doing. I'm not going out partying every single day. I'm not drinking. I'm not smoking. I'm not doing any of that. I'm just relaxing, just enjoying the views, enjoying my time here, doing what I need to do on the charts, and making money. Like, what I've realized as well is, about the whole environment stuff that affects your trading that I just mentioned before. Like, I'm trading to such a high ability right now, and it's so simple. It's so simple. I'm on the charts 90 minutes a day. I take my model once a day, and that's me done. And I think while I've been out here for now, like 3 coming up 4 weeks, I think I've gotten about 4 or 5 payouts in that time span. And all of that money has covered this trip away, this lifestyle that I'm living right now, and more on top, obviously, right? And I just couldn't be more grateful. And it just goes to show what can really happen if you just lock in. Like I said, it took me around about a year and 8 months of just pure hard work. And then obviously all the time after that as well, still putting in the work. But it just slows down a bit. Your training slows down a bit once you get to that specific point of profitability or almost cracking profitability, getting consistent and whatnot. So please, 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 if you take anything away from this video, simple model, ability to do price action, you can study that quite hard, specific time window, live, the simple lifestyle, just hit the gym, open up the charts, rewind towards the end of the day, get some exercise in, hit the gym up. And that is genuinely the key to profitability, guys. But yeah, with that being said,
yo, what's good, guys? Hope that you're all doing well. Welcome back to a new video. Today's video is going to be a more personal video again. I asked people on my Instagram story just a few days ago to send in some questions, more personal questions, psychology type of questions, and just things about my journey that you guys want to know, basically. And you guys can actually learn from someone that is a profitable trader, the journey that I have been through, the things that I had to conquer, etc, etc. So the first question here from Enrique was, what was the breaking point in which you became a profitable trader? So I would say the thing that really separated me from a non-profitable trader from turning actually into a profitable trader is understanding market narrative, right? It's one thing knowing an entry model and knowing loads of concepts, but if you don't actually know when and why to apply those, then it's just going to be useless, So understanding that market narrative, and also a big game changer for me was incorporating the time element within my trading. Because if you go back into your charts, you'll find out that during a certain time of day, certain day of the week, certain time of the month, certain things will happen. For example, I trade 9 to 10:30 a.m. and pretty much within that time window, there's almost at least one setup every single day within that window. So that already separates my trading window from just a random window within Asia session, for example. There's not always going to be a setup every single day. So finding that specific time window that works best for you, and also just incorporating time in general. So time-based liquidity, time-based SMTs, and then applying that with actual market narrative and a good understanding of the bias and the draws on liquidity. So the next question here from Shankar was, what were you learning before QT, which is quarterly theory? What's your view on QT and how QT changed your trading? So the first one, what was I learning before QT? I was basically just learning basic ICT concepts essentially. First of all, I started with TJR's Bootcamp. I'm sure that a lot of you guys know who TJR is. Pretty big name inside of the trading industry. And I think it's how a lot of people started that sort of came into trading in like the past 3 years or so. So another thing about me is I've only been trading for around 2.5 years yet. So still definitely a solid amount of experience, but yeah, I'm really looking forward to the upcoming few years and really how much I can grow in that space as well. So yeah, TJR's Bootcamp, I watched all of that. That way I got a basic understanding of liquidity, order blocks, fair value gaps, etc. And then from there, I went to the ICT 2022 mentorship. I learned, I watched that whole entire mentorship, took notes, etc. Just basically learning more in depth of what I already knew, just expanding on top of that. And then that's when a friend of mine told me about Trade a Day. I watched his, YouTube video, the quarterly theory one, understood about the time windows, AMD, X, etc. And then that's when I saw he released his mentorship. So I signed up and thought that I'd just give it a try because I'd never tried anything new. I just watched a few YouTube videos, wasn't really getting anywhere with it. And then what's my view on QT, which again is quarterly theory for anyone that doesn't know. That is the strategy that I do trade. My view on QT is, I've got nothing bad to say about it, right? It's what transformed my trading from becoming unprofitable to a profitable trader. Again, like I said, incorporating that time element within my trading. I don't use all of the concepts from quarterly theory. The main one that I do use is Sequential SMT though, which as you guys know is a part of my 90-minute tCISD model. I require one Sequential SMT followed by my tCISD concept, and then I take a trade essentially. So I learned everything that there is to know about QT, but then understanding that you really just need to simplify your trading is one of the main things, right? Like you can know thousands, well not thousands, but 10, 20 concepts, but realistically, if you're going to try and apply them into every single trade that you take, the trades that you're going to get are going to be very limited, and you're going to be waiting a very, very long time. But I do like to use PSPs and SMT-Fills for more or less my higher time frame bias and understanding the narrative and whatnot. If we get like a daily or a weekly SMT-Fill or a daily PSP, I know what the third day is going to do from that, but I don't specifically enter off the PSP itself, So yeah, QT, amazing. I obviously would recommend it to anyone. If one of my friends came up to me, I would tell them to watch ICT concepts and whatnot, and then go straight to quarterly theory from there. And then finally, the third one that you asked was how QT changed your trading. Again, kind of mentioned that within the first question that we did have, just really incorporating that time element. And the main, the game changer for me, from what I learned from quarterly theory, was Sequential SMT. So yeah, we all know, well, if you don't know, go back in charts, it's always going to be an SMT there before pretty much every single price movement. So if you incorporate that time element with that SMT, which is the Sequential SMT, it's just going to be so much higher probability. So yeah, that's the questions answered from Shankar. Now let's jump into the next question from 4D3DER. Probably said that wrong, but yeah. So he said, how long did it take you to become profitable? So like I mentioned at the start of the video, I have only been trading for around about 2.5 years now. And I joined Dave's mentorship. It was the start of 2024, like January, February time. And it wasn't until around about 6 or 7 months into that mentorship when I really started to see consistency. So, what's that? Let's say I joined in February. I had 6 months on top of that. March, April, May, June, July, August. So around August 2024. So it's coming up in around about a year now. But obviously, August 2024, I wasn't like this insanely hugely profitable trader. But by that time, I was, consistently passing accounts and getting the more smaller payouts. And then from there, it's just basically been scaling up and up and up. And then, yeah, I'm really looking forward to next year, to be honest. I'm going to really, that's my main focus now within trading. It's just scaling, basically, getting more capital and whatnot. So yeah, that is that question answered. Another one from the same guy, 4D3DER. He said, what's your winning rate? My win rate is not really like static because my model is more discretionary in terms of it's not mechanical to the point where I can backtest and see, okay, 90-minute sequential SMT, 5-minute tCISD, I enter. Because it's not always going to be a 90-minute sequential SMT. It's going to be any sequential SMT, right? So it can be a micro, a 90, or a daily. As you guys know, if you watched my tCISD model video, that is my own personal trading model. But
But yeah, I mean, I wouldn't say that I lose very often, to be honest. You know, inside of my Discord where I'm training live every single day, everyone in there knows that I don't particularly go on losing streak necessarily. Maybe I'll take, you know, 1 or 2 losses per week. But it's very rare that I close out the week red, to be honest. You know, obviously it's not always hugely green, but for the most part, it's at least, you know, break even on the week, or a little bit green, or big green basically, or just like a small loss whenever I do take a losing week. But yeah, to answer the question, around about like 60-70% ish is what I would say for sure. We've got another question here from David Robin, basically just asking about the win rate of my tCISD model, the one that I trade. Again, like I said, it's not purely mechanical to the point where everyone's going to have the same entries every single day and the same win rate. It's more based upon the trader, you know, how they can handle themselves after taking losses, how many trades are actually going to take within inside of the window. I just take one singular trade between 9 to 10:30 window. So yeah, the win rate is going to vary for everyone, but I could say I personally target 1 to 3 RR most of the time, and like I said, with that 60-70% win rate. So I'd say if you're starting out with it, you know, go for like a 1 to 2 RR, and I reckon you could easily achieve like the 60-70% win rate that I get as well, but just slightly lower RR. But once you get more comfortable with it and you backtest it more and you get better at reading price action and whatnot, then you can hold the trades for as long as you want, you know. But I'd say 60-70% is definitely very, very achievable with the model. And then again, another question from Robin. The first part that he asked was how QT has changed your trading journey, which I kind of already answered earlier on. But then he said, before that, have you tried any other model? So I'll answer that one specifically, which I did kind of touch on earlier as well. But yeah, I was basically just trading like simple ICT concepts, mainly just a 2022 model. So it'd be like a liquidity sweep, a breaker structure, and then just like a regular fair value up entry from there. But yeah, that was essentially just the model that I was using, you know, incorporating inverse fair value ups and whatnot as well. But yeah, wasn't anything complicated then, and my model isn't complicated now. So if you take anything away from this video, then that it should be that the model that you train should be very, very simple, right? Definitely don't want to make it confusing. Need it to be simple, easy, and repeatable. So we got a different question here from Pano.c1. He said, can you talk about what props you use / recommend and how to make money in the business? So this is a more unique question. I like this one a lot. So the prop firms that I use and recommend, will always recommend to everyone, and I still do recommend to everyone inside of my Discord and whatnot, is always going to be Top Step. Top Step to me has never really failed me, never denied any payouts, never any issues with them guys at all. And also they've been in the game for one of the longest in terms of futures trading, right? So realistically, if anything bad happens to those guys, the whole futures industry is just going to go down with them as well, you know. So I feel like they're a solid one that you can trust. And I really actually like the Top Step X feature that they have, which is the platform in which you can select when you check out. Because what I do is I copy trade on there as well. So for example, you can buy 3 50k accounts all on the Top Step X platform, and then you can connect them very simply on their dashboard, and then whenever you take a trade on one account, it will copy it on all 3 accounts basically, which is essentially what I'm doing at the moment. But I did touch earlier that I do want to focus on scaling myself as well, so I'm going to be branching out and maybe trying other prop firms as well. I have tried others. My Fun and Futures is also a pretty good recommendation from me as well. I haven't actually used Apex. I know that Apex is obviously killer for people that are really looking to scale. For me, I've just seen people using it and a few complaints, and the rules to me just, I don't know. I don't like the rules personally, like the intraday trailing drawdown, although it probably wouldn't be a problem for me because I'm usually in and out of trades very quickly, and I also take like 1 trade a day anyway. But yeah, I just don't really like the sound of it, but something that I could maybe experiment with in the future. And then in terms of forex as well, I am with Alpha Capital Group at the moment as well. Requested a few payouts on that account that I've got with those guys as well. So I would recommend Alpha Capital as well. Obviously, you know, FTMO is going to be one of the main ones for forex as well. And then how to actually make money using prop firms, pretty simple. You know, you want to, if you can afford to, just buy as many challenges as possible and aim to try and get them passed as fast as possible as well. Don't want to be wasting time on the evaluation phases. And then once you've actually got those accounts passed, remember, you don't need to go for home runs on those accounts. You know, large payouts, just very, very small accumulate the accounts, you know, $500 win, $500 win, $500 win, and then before you know it, you'll hit your trading days and you'll have, you know, 2-3K balance in the account. And if you've got one account, let's say you request $1,000, right? $1,000, sure, you know, it might last you a couple of weeks or something like that, but you're not going to be able to actually live on it. And the question here is actually how to make actual money in this business, right? So the goal should be to get as many accounts as possible, copy trading, and then the payouts that you get, you can still go for small base hits, but it's going to add up a lot more, right? So $1,000 payout on one account can potentially equate to a $10,000 account if you've got 10 accounts, right? So that's why it's so important to actually focus on getting more capital within this game instead of just trying to get insanely high payouts just on small size accounts, right? So yeah, the ultimate answer would be try to get the evaluations passed as fast as possible, then pull back on the risk when you're actually funded, and just focus on stacking up those funded accounts as well. So yeah, hopefully that answers your question. And then we've got another question here from wa_.iria, if that's correct. I do apologize if it's not. He said, what are the habits both personally and market-wise did you change or would change for consistency? So I'll get into some of my personal habits. Before, when I was starting out trading, I didn't really do too much outside of the charts. I was basically just like locked inside my room, just study, which I do think that everyone needs to go through that phase when they're actually first starting out. But once you've got past that point, you've got all the data you need, you're confident in your model and whatnot, then I do think that you need to focus on your personal life a lot more as well. So, you know, building those healthy habits outside of the charts. So I'd recommend, you know, getting into a sport, make sure you go into the gym, make sure you walk in, you know, using your actual body how it's supposed to be used, being active and whatnot. Another good one as well is sleep. Like the sleep quality and the amount of sleep that you get is very, very important. You don't want to be coming to the markets feeling groggy every single day. But yeah, in terms of anything else, like, you know, you might hear that you need to like meditate and get cold showers, ice baths every single day and whatnot. I mean, I've done it before, but did it turn me into a profitable trader? No, not really. What actually turned me into it is just sort of thinking like one, right? You need to put yourself in the shoes of a profitable trader. And when you come onto the charts, you just need to make sure you're just really locked in and focused, right? Which obviously the things outside that you do in your personal life will equate to how locked in you are actually on the charts as well. So yeah, those are like the personal habits that I did outside of the markets. And then the ones that I did actually on the markets was, I mean, like I said, you know, I only take one trade per day, unless there are certain times when I'll take a trade with half my usual risk, which is right before 9:30 open and also on Mondays and Fridays. So if I go into a trade with half risk and I get stopped out, but my idea is still valid, I can then go back in with the remaining half risk to take up the full risk for the day. That will be the only time when I ever take more than one trade per day, and that'll be two. But most of the time, on average, it's just one trade per day. So that's one of the habits that I create for myself. Also having a specific trading window, for me that 90-minute window, 9 to 10:30 a.m. The less time that you're on the charts, the less time you have to actually make mistakes and slip up and whatnot. And then of course as well, make sure you have that model that you can rely on, the one that you trust and have full confidence within. And then from there, that is essentially all the framework that you need. Obviously, be good at reading price action as well. Pair that with a solid entry model. You don't need to top tick and bottom tick every single move. As long as you can capture a piece of the move, once you've got that bias, that is all that matters. And then one trade per day within that specific 90-minute trading window. And then the same guy as well, Warrior, actually asked, which books have you read or would you recommend? I actually haven't read particularly a complete trading book. I do have Trade in the Zone and another one, I believe, the one that's similar to that one, but I didn't actually end up getting through it all. But I've read some of it, like 20-30% of the book. But again, yeah, it can maybe change your perspective on things. I mean, I personally don't know because I haven't really spent much time reading trading books and whatnot. So they could be a help to you, but for me personally, it doesn't really change much. Like, I already know what I need to be doing. So potentially reading the books could push you over the edge and get you in that mindset as well. But for me personally, you know, like I said, I don't really read any books and haven't really read any books at all, to be honest. But yeah, I think Trading in the Zone is definitely a solid one for most traders. I know that's what most traders do recommend as well. And then again, we got another question from Warrior, and this is going to be the final question of the video as well. Don't want it to be too long, but if you guys did enjoy this video, then I will definitely do a part 2. So do let me know in the comments down below. But yeah, he said, did you go to college or university? And if so, how did you manage trading? So this is also another great question as well. So for me, I did go to college. It's a little bit different in the UK, England, which is where I'm from, if you guys couldn't tell by the accent. I went to college, but while I was in college, you actually finish when you turn 18 or like 18-ish, I believe. So I wasn't even trading in college, actually. It was a little bit after college when I actually started. So I started when I was around 18. I'm like 21 now. So yeah, so I didn't actually have to deal with trading inside of college, and I didn't go to university either, which is the thing that you go to if you want extra education for an extra 3 years after college. For me, I just got a part-time job. So I guess you could tie this into the question. Didn't specifically go to college, but I was working a part-time job while trying to juggle trading at the same time as well. But for me, it was fine. I actually had very, very early shifts. Started at 3 o'clock in the morning. So that actually aligned perfectly with me trading the AM session, that 9 to 10:30 window. Because I'd hop on the charts. It'd be 2 p.m., 9 o'clock. Eastern Standard Time is when I start trading. So 2 p.m. for me in UK time. And I'd finish work around 10:30 in the morning. And then from there, I'd go straight to the gym, come home, make my food. And then by the time I'd done all that, it was sort of around that 2 p.m. mark anyway. So it all kind of aligned perfect for me. So not really any complaints there. But I mean, I guess having that job kind of motivated me to just go even harder with trading, basically. Because I knew that that's not what I wanted to do for the rest of my life at all, and that wasn't the goal anyway. Like, I only got that job to build up the initial capital. I worked there for around about 2 years, and during that whole entire 2 years I was still trading as well. Not the whole entire time, but for most of it I was, trying to juggle trading. And then yeah, after that 2 years I just basically quit once I saw consistent payouts and be able to pass accounts easily and whatnot. Then that's kind of when I was like, okay, I've got enough money saved up now, let me just try go full time with this. And little did I know that'd be the best decision I'd ever make in my life. So yeah, I hope that answers your question. For anyone else that is in college or university, same thing, you just got to do it, get it out of the way, the college and university work, and then focus on trading. But that's why it's so important having that specific trading window as well, because again, it's only 90 minutes per day that I'm on the chart. So I could easily do anything else. I could work a job right now if I wanted to. I could go to college, university. It wouldn't really affect anything. Maybe it'd be a little bit weird with the time window. For me, it'd be 2 p.m. So if I had class or something then it could maybe intervene with it. But again, you can find another 90-minute window. The one that I trade is the highest probability one though, so potentially that may affect my trading. But yeah, I do not think so. So yeah, that is good, guys. Welcome back to another case study video. Today I'm here with Connor. Nice to meet you, Connor. Well, not nice to meet you, but nice to finally have you here, kind of over video. How long have you been in my Discord for now, if you don't mind? Around about like a year or so, right? Just over a year.
Yeah, actually, I think yesterday literally hit my 1 year mark.
Right,
so I just renewed.
Perfect, man, perfect. And the reason why I wanted to get Connor on the video today is because I've seen Connor, a lot inside of the Discord, super active, joins the live sessions, always typing in chat, etc. And he's recently hit a very huge milestone in his trading journey. So he's actually being moved to a live account on Apex. So he's roughly pulled in around about $30,000 with Apex alone as a prop firm. And obviously once you hit a certain milestone with Apex, they do move you to a live account. And that, is an achievement that Connor's recently just reached. So first of all, congratulations for hitting that milestone. Super impressive. Of course, man. So what we're going to do is ask you a couple of questions here today. Just kind of get a bit more about your story, kind of how you got to the position where you're at now, and how the people watching at home can, get to that position as well, basically. Okay?
Yeah, of course, man. Let's
all right. Sounds good, bro. So first of all, take me back to where this all started. How long have you been trading for yourself? How did you come across my Discord, Quarterly Theory? How did that all come about, bro?
Yeah, of course, man. I think I early got into trading kind of around COVID time. Just kind of had a buddy that was doing some forex trading, kind of got me into it. met some people through him who eventually introduced me into like ICT concepts. Really kind of went down the rabbit hole, as kind of we all do with ICT for a while. But with your concepts, with your Discord group, like we said to start, I've been member for a little over a year. And it's just been like a phenomenal journey ever since.
Nice, man. So obviously I obviously personally trade quarterly theory. Did you come across quarterly theory through my Discord itself, or like did you find me on YouTube or like a different like social media platform beforehand, or like one of your friends told you about it, or was it join the Discord? Oh, I've never like seen quarterly theory before, now let me learn it all from the Discord, basically. Like how was that for you?
Yeah, for sure. So I originally started with Dave's mentorship. I did his for a few months. Nice. I really could see like kind of the gems and the kind of the truth behind quarterly theory, like really breaking down time like as granularly as he does. I personally just wasn't a huge fan of just the 1 or 2 videos a week. Definitely want some of those a little bit more hands-on, a little bit more of like a coachable environment, want a little bit more of like a community, so to speak. I think I found you honestly like through like Instagram or YouTube algorithm, whatever it might have been. And I saw how hands-on you were with your students. I saw that you were trading live Monday through Friday. And I was just like, this is exactly what I'm looking for. Want to have like that live support, and pretty much immediately joined.
Yeah, beautiful, man. Beautiful, bro. I appreciate that. And obviously in terms of like the Discord itself, what would you say like the main things that helped you learn quarterly theory and like craft this system of yours that you trade, day to day now? Like, was it through the lectures, the live trading, any sort of one-to-one calls that we had? Like, what would you say were the main things were for that?
Yeah, I think it's definitely a combination of all those aspects you just mentioned. I think the biggest thing with like us traders, that especially like with ICT, we know he rambles and his videos are hours and hours long. And it's really, it's really hard to like consistently kind of keep in focus when those videos are, an hour and a half plus, 2 hours plus. You're putting out content every single day. It's very digestible. Like you're very much just straight to the point. You're not rambling about nonsense. You're very much like, this is what our trading was for the day. This is what I see coming on tomorrow. And it's just very easy to follow along, and it's easy to stay consistent with the content that you put out. Because again, like you're just straight to the point.
Yep. Beautiful, man. Beautiful. Yeah, and I appreciate that, bro. And that's what I try to focus on as well is, because a lot of people out in the space, they'll try to be cryptic with it and, let you try and like figure things out, which I think is good to an extent. Like obviously, give someone a concept, let them kind of go into the charts. And that's what I'd always tell everyone, I'll give them the concept, but obviously they've got to do a bit of digging, they've got to put in some work, back test, see it working with their own eyes. And obviously that's what you've done. But, I'll straight up tell you guys how the concept works, how I use it. And then if you just go back in your chart and see it happening with your own eyes, you're going to build that confidence and, ultimately be able to trade that yourself, So yeah, that's great, bro. And in terms of like your trading journey, obviously like ICT to quarterly theory, what do you think like the one shift was that, turned you from unprofitable to this profitable trader now? Like, was it like the timing element, would you say? Was it like a certain concept within quarterly theory itself? Like, what were the main things for you?
Yeah, there's definitely a couple of factors involved. I think the biggest one really was just dialing back the risk. I think like the moment that I cut back the risk, I immediately started seeing some different results.
Nice.
And just the idea of not feeling that I need to be integrated into the market every single day.
Yeah.
There's going to be opportunities all the time. You don't have to be glued to the screen every single day in order to be successful. It's really just kind of filtering out the noise from the model that we build and that you've kind of helped us build. And just being able to kind of hone in on just, higher quality setups. That certainly helps immensely. And then I think, again, like to your point, like just really developing that model and making it as mechanical as possible, and making it very much just, step 1, step 2, step 3. These are the things you're looking for. If they're not present, just don't engage, don't entertain. And really kind of keeping yourself out of days where it's just low probability conditions.
Yeah, beautiful, bro. 100%, man. And your like system itself as well is like you've made it your own system, right? You don't trade like one of my systems to the T. You'll take some concepts, like sequential SMT, maybe PSPs, SMT-Fill, etc. But I know that you've added a few of your own concepts to it as well. I see you mentioning like the first percentage gap quite a lot as well. So that's the beauty of like quarterly theory. Like you said, you can have that element of mechanicalness, so it's like the sequential SMT. there's only one way it can happen. It's either there or it's not there. You know what I mean? And then like the entry technique itself, you know, for you, whatever it may be, it could be like the first percentage gap after 9:30, etc., etc. But you found what works for you and added the elements of the, you know, mechanicalness from quarterly theory, combine it into one, and now you've got that system that's either there or it's not there. You know, a specific time window, you're on the charts at a specific time every single day. If your model's there, you're going to take it. If it's not, then you don't, you know. And if it's there, you're now managing that risk really, really well, to the point that if you take a loss, it's like, you know, whatever, like $100, $200 loss. Whereas the win can be, you know, on the bigger end, it can be, you know, a $700, $800 win. And obviously yourself, you've got a lot of accounts. So those smaller, like $600, $700, $800 wins, if you're trading with 3 accounts, 4 accounts, 5 accounts, they're obviously going to add up pretty quick. And like I said, the loss, you know, you barely even see it if it's only a couple $100 or so. So yeah, that's really great, bro. That's really, really great. Now the second question, the third question here, sorry, is how did your relationship with money kind of change from, you know, being this unprofitable to profitable trader now, like making these thousands of dollars through prop firms, you know, potentially making thousands of dollars in a single day, you know, these 5-figure months? Like, how did that affect your relationship with money itself? Would you say you've still been the same? You say like you go out and spend money more now? Like how is that for you?
Yeah, it's a great question, man. I think it's ironic, you know, finally like pulling in some more money from trading. I'm definitely more meticulous, more responsible with kind of the outputs per se.
Nice.
I think the biggest kind of like mental shift for me was once I stopped overly depending on the success of trading, and once I stopped depending on like needing to fund this account, needing to pass this account, this, that, the other thing, that's when success started flowing in. And it's that idea of, you know, not rushing this. And that's, I can guarantee it's plenty of other people out there, they're struggling with this. They want to, you know, they see CPI news and they want to pass all these accounts and make all this money. There's no rush to it. Because the thing is, you know, and I've had plenty of times too where I've built up 10, 12, 14 accounts and blew it all in one day. And then starting from scratch all the way that far forward, it takes you that much longer to build it back up. So it's really just taking base hits. And you don't need to pass an account in a day or 2 days. You know, it might take me 3 to 4 weeks to pass an account. That's totally fine. Because I've got other funded accounts already in the background that are bringing me money on the side. So it's the idea of just, you know, focusing on one account, work it, you know, and be very strategic and manage your risk about it. Pass your one, and then the one turns into 2. You take profits, the 2 then turn to 4, and then you stack them up that way.
Nice.
But the biggest thing really to your question is just like cutting that rush back and just taking your time on it. Literally night and day difference in my trading.
100%, man, 100%. Yeah, and that's the thing with a lot of traders as well. They'll come into, you know, trading as a whole like undercapitalized. Like you need to have some sort of other income coming in as you're beginning trading, you know, because I'll have people message me saying like, hey Bucko, can you send me $20 so I can buy a funded account? Can you do this so I can buy a funded account? My answer is always no. It's always the same, because I was in that position once. You know, I was this 18-year-old just starting out. I was working like a part-time job or whatever, and that's what you've got to do to get the money to then fund these, you know, funded accounts. Like if you have no money to your name whatsoever and you're starting out trading and you buy your funded account, like that funded account is everything to you, you know. So that way you're so much more emotionally like attached to the account. You're so much more emotionally attached to like the outcome. Like you've got to win every single trade. You've got to get that payout. And if that's your mindset trading these accounts, like it's never going to end well, you know, realistically. Like maybe you can pass it, maybe you can get lucky, maybe you can get a payout, but realistically, like how long can you keep that up for, you know? So to begin with, you've always got to have that income coming in the background. But once you get to that stage where you can pass that one account and then, like you said, get 2 and then 4, then 6, then 8, and, you know, so on and so forth. And you've got these payouts coming in, you know, every single month. And because you've got so many accounts, the payouts could potentially be, you know, a few months wage, for example, you know, if it's a 5-10k payout. And if you can get that 5-10k payout, then, you know, you can afford to, you know, lose these accounts. You can afford to blow through more accounts. You're not going to be emotionally attached to the accounts. Like you said, you can take your time with it. You don't need to rush. You don't need to force a trade every single day thinking, oh, I've got a bill that I've got to pay next week or whatever it may be. Like you take your time, and, you know, when the payout comes, it comes. The more accounts you've got, the bigger it's going to be, you know. So yeah, that's beautiful, bro. I really like the way that you described that, bro. So yeah, great stuff. Now we got the fourth question here. and that is, what do you understand about how prop firms work now that you didn't before? Like, have you ever like struggled with prop firms? I mean, I guess you kind of just touched on that now, from what we just said. Obviously, you know, you was at a point before where you was like rushing these accounts and trying to pass them fast. But what was it that like create that shift for you? You went from like rushing the accounts to then slowing down and taking your time with the accounts and just not being as attached to them. Like, what was that sort of thing for you?
Yeah, so I guess like starting out, you know, my trading starting out was definitely more on like forex, anything like foreign exchange. Before I started trading futures, what happened was like for me being a U.S. client, like a lot of the forex firms that were supported from MP4, MP5, they eventually like shut off support for U.S. clients. So that issue for me, unfortunately, was poorly timed to the point where like I was finally starting to see some success trading all of those forex firms. And unfortunately they like went dark overnight. You know, a couple of those firms, you know, I probably had a couple of between $15,000 to $20,000 in payouts that I was expecting to get. And they just closed their doors, shut their business, nothing I could do about it. And for me, like mentally finally getting to that point of, okay, like, you know, this is enough where I can make this a full-time living. And then just basically being denied it overnight and there's something I can do about it. That hurt my mental, my psychology more than I can describe, honestly.
I can imagine, bro.
It took me a really long time to kind of climb back and kind of like regain confidence that, okay, like, you know, this isn't maybe, you know, the entire industry like isn't as much of a scam. Like there are quality companies out there. There are quality firms out there that like actually do pay their traders out, that do, you know, hold themselves to a higher standard. And I really think just like within futures, like there's just a higher standard. Versus the foreign exchange.
Definitely.
A little bit more, you know, discrepancies kind of in the background per se. But I think like once I started trading futures, the trading became like a lot cleaner. Really just sticking a NASDAQ like we always do, and just not having to worry about, you know, 3, 4, 5 different pairs and bounce between different charts and I mean, different trades going on at the same time. Like it's just you're just cutting out a lot of noise. You know, focusing just on the one pair, cutting out the distractions, cutting out the noise, like not having social media up while you're trading and seeing other people making this and making that, like just staying in your own lane. That's where the growth happens. It really is.
100%. I like that part that you mentioned as well about like not checking like social media, because it's so easy nowadays to just like open up social media and scroll like, oh, this is how I made 10k, this is how I made 12k today, you know, blah blah blah. But I mean, realistically, most of it's fake. You know, you can't trust everything that you see online. Like, you don't know how much money those guys spent. Someone that made a 10k payout, or, you know, passed 20 accounts in one day, they might have blown through 40 accounts in that one day alone. But you'll never see that, you know. Exactly. So that's why you can't really trust everything you see online. And like, even if you see it online, you just need to understand that everyone's got a different timeline. You know, like some people are going to be ahead of you. Some people are going to begin when you began trading, but still be ahead of you. Like some people are just faster learners. I'm sure some of it comes down to luck as well, you know, like depending on like which prop firm they've chose to begin with, you know, how lucky they've been in terms of like the scaling, etc. So yeah, like truly you don't need to, you know, believe everything you see online, and even if it is true, just, you know, like I said, understand that everyone's in their own lane and you'll get to the goal that you've set ultimately by following your rules. You know, if you've got a system in play, you've got the rules in play, the risk management down, you have just got to laser focus in on that and just stick to that like 100% of the time, no matter if someone else is taking out. And that happens a lot. Like you said, I live stream every single day inside the Discord of my actual trading, and there'll be days where you take a win and I take a loss, and there'll be days where I take a win and you take a loss, you know, because our systems are slightly different. We're not always going to be taking the same trades, but that's completely fine, you know. I'll see you taking a win and I'll take a loss and I'll be like, damn, like at least someone else took a win today. Like that in my opinion, like that's a W for me, you know, seeing other people in the community like hitting W's and stuff.
Exactly.
Yeah, you just got to see it in a good way as well, you know.
Exactly.
But yeah, that's just how it goes. And then we got a fifth question here, and then we got one more right after this. What does a normal trading day look like for you now from start to finish? So like, how long are you on the charts for? Is it just one system that you are following, and like what assets you trade in?
Yeah, absolutely. So kind of like I said earlier, it's really just trading NASDAQ, ENQ, obviously keeping like the triad up and just kind of keep taking a look at the other assets and seeing how everything is moving in tandem with one another. But I think like really it's, you know, we hop on at 9 9 a.m. Eastern time. There's some days where I'm done at 9:32 and I'm like done for the day.
Yeah.
I'll close my charts down. I won't even like entertain myself like looking at it again, because that was the big thing that I had to overcome for a while, was just the overtrading. Was the idea of like, I might have had like a winning day, and then 5 minutes later, I thought, oh, I know where the price is going to go now, and I enter again, lost everything I just made. So it's really just like, it's just being content and being satisfied with, whatever you won for the day, or whatever, your managed loss for the day. And it's just shut it down. It's just go outside. It's just, step away from the charts, and just to not even tempt yourself with that advice by any means. But I mean, like, at the absolute most, like we just said, like, I'm probably not on the charts past like 10:30 in the morning. Again, anything kind of beyond that is outside of my personal model, the model you've kind of helped to show us, and that I've kind of helped to build as well. It's like really nothing more than an hour and a half. Like I said, there's some days where like 9:40, 9:45, like I've made my profit, I made my money on the day. Very content, like shut everything down, and then get myself outside, take the dog for a walk, like whatever it might be, get my day going. That's the point of trading. We want to trade our time for freedom, and that's all this. So there's no point of me, like, if I've made good money on the day, why do I need to be on the chart for another 30, 45 minutes? Like, that's the point of this, is to have my freedom.
100%. Yeah, that's beautiful, bro. That's beautiful. And that's what I always try to preach as well. 90 minutes, 9 to 10:30, 90 minutes per day. People will hear that and they like literally won't even believe it, because not a lot of people are on the charts for that little amount of time per day. And for us, that's like maximum, that's very rare that we're on the charts for that 90 minutes. If anything, most of the time it's less. Like you said, sometimes we can be done like 30 minutes, into our window, like 9:30 just opened up, boom, we've just hit our TP, now we're off, So yeah, that's amazing. And that's what will help a lot of people. I know that for a fact, is less is more within trading, The less time you're on the charts, the less time you have to make errors, the less time you have to overtrade, over risk. If you sat at the charts all day, you're going to be thinking like, oh, this is a decent setup, this doesn't look bad, and you're just going to be taking setup after setup. Whereas if you're on the on the charts for a specific amount of time, you know what you're looking for, you know if it's high quality or not, and you take it, and once you've taken it, you're done. And what you said as well about taking the loss or taking the win and just being content with it, that is an absolute game changer as well, in my opinion. A lot of people will come to me and they'll be like, oh, I've taken like 3 losses today, or I've taken a W, but like, does this trade look good? And I'm like, why are you even looking to take another trade when you've just made money at the markets, Like, the statistic, like what, like 95% of traders fail? And the fact that you've been able to pull money from the markets on this specific day, why would you even try and potentially give that money back, Like, you've got your winning day, you've made your money on the day, whatever it may be. Just get off, bro, and come back the next day, because, why would you even risk those profits? It makes no sense to me. So I'm glad that you incorporate that in your trading as well. And I'm sure that you've noticed like a huge difference as well. Like you said, like a night and day difference between doing that.
100%.
So like, being on the charts for as little time as possible, just taking that 1, potentially 2 trades per day. Once, if it's a win, then that's you done. Log off the charts and, like you said, get on with your day. That's what we've got. That's why we trade for this freedom. If we're on the charts from London session to Asia, AM, PM, whatever it is, like, we might as well be working a 9-to-5 job at that point. You know what I mean? So, yeah, that's beautiful, bro. That's beautiful, man. And then final question here to wrap things up is what would you tell somebody who's exactly where you were 6 to 12 months ago? So imagine someone in your position 1 year, 1 year back in the past, and they want to now get to that position where you're at. The consistent payouts, multiple 5-figure payouts, moving to live accounts with prop firms as well. Like, what was the biggest change that you made, or what would you tell this person if they want to get to that position that you're in now? I guess we kind of touched on most things, but like, just quick summary, like, what are the main points would you say?
Yeah, I think the biggest thing is keep working. Like, just keep working towards your goals. I promise you, like, if you quit, you're never going to hit those goals, and you're going to live with regret the rest of your life. I know, again, for us as traders, like, when we first started getting into trading, it's every single night you're dreaming of, what's the new car I'm going to buy? What's the new house I'm going to buy? Like, once you move on from those externals and like you really hone in on, like with my story of, like, I really want to retire my dad, who's doing, 70 years old and still doing drywall work, like getting my mother into a better living situation, like being able to, help my family get in better situations. Those like intrinsic values, like that's the driver that keeps me consistent and keeps me like focusing on this work day in and day out. You know, and even myself and yourself as well. Like to your point, like, we have negative days, we have losing days.
100%.
Don't let losing days turn into losing weeks, turn into losing months, and then just like retracting all of that progress that you've made. It's just take everything day by day, but the point is work every single day.
Nice.
Work towards your goals. Like, you know, mark up your charts every single day. Just whatever content you need to, you know, either continue to digest or whatever content you need to get out of your head. Like I said, maybe cut some social media out for a little bit if you're getting distracted. You find you're following stories of, again, the guys that claim that they're making 10, 15, 20 grand a day, whatever. Like, cut that noise out. Cut the distractions out. Just stay in your lane. Focus on what you're doing. I promise you, if you stay diligent enough, long enough for this, you're going to accomplish everything that you've been dreaming of for however long you've been in trading for. Promise you. And I'm still working on my goals. You know, I'm nowhere near the point of where I want to be. I'm definitely, to your point, I'm definitely a lot further than what I was 6 to 12 months ago. I'm just getting started.
That's it. Same here, bro. And that's a beautiful story, bro. Honestly, like, you know, wanting to retire like family and just help your family out. And that's what it's all about realistically, you know. Like, if you come into the trading and your only goals is, oh, I want a Lamborghini, I want a mansion, I want a blah blah blah, like, you've got it all wrong, bro. Like, you can get to that point and, you know, obviously, but that's not why you should be starting, bro. Like, you should be starting to help out the people around you, you know, help out your family, buy them nice things, you know, whether they're at jobs, working, stressed out, whatever. Like, do what you can to help them out. And, like, there's no way you can fail by doing that. You know, if you've got those goals that you want to help people around you, if you truly care about them that much, like, you won't break your rules. You know, you're going to stick to the plan, whatever it is, stick to the goals, and just like you said, every single day, relentlessly just working towards it. Just know that less is more. You know, spend it back testing. I don't mean just sit on the charts all day long and just place a load of trades, but, you know, consume that information, like you said, cut out the social media, formulate a plan, collect data on the, you know, the system that you trade in, whatever it may be, journal. And, you know, like you said, you will get to that point, you know, like where we're at right now, for example. But even me and you right now, like, we're not content, you know, because we know that we can do better. We know that we can scale more. We know we can get more accounts. And that's a goal, you know, obviously moving forward. Like, we still have these goals that we need to set and, you know, follow and reach. And that's what we're working towards, bro. So, yeah, that's absolutely beautiful, bro. I do appreciate you hopping on. You know, last few words before we do wrap it up here, in terms of anyone that's kind of like on the fence of joining the Discord or the mentorship, whatever it may be, like, what would you say to those guys that are like, oh, I don't know if I trust Booker, or I don't know if it's going to be valuable to me, etc., etc. Like, what would you say? Like, truthfully speaking, you know, no like BS or anything like that. Like, how do you think the Discord can actually help them out to potentially become this profitable trader? You know, pass the first account, get the first payout, reach consistency, like whatever it may be. Like, truthfully, what do you think? You know, how I can help them?
Yeah, no, of course, man. You know, I highly recommend your Discord group mentorship really to anyone. It's not the amount of money that you can make in a day or in a week. It's going back to like the repetition of hearing your point of view and hearing what you're seeing and hearing what you're analyzing every single day. I learned so much about the markets and how they move and the time elements involved as well. I've learned so much more than I ever thought that I would just by hearing your like live thoughts every single day. You know, even on like lower probability condition days, like the way that you analyze, the way that you explain on a daily basis, and again, like live versus just sending out a text to Discord. It truly makes more of a difference than people might think. You know, when I first got into trading, I definitely was one of those suckers who would sign up for Signal chat here, Signal group here. But like being able to be live with you at 9 to 10:30, being able to, you know, converse and have conversations with you, with the other community members live, seeing like what we're seeing, analyzing it live. You learn so much more and so much faster than people think. So having that just live support from you, is really incredibly valuable. And again, I'll hone in on, like, I highly recommend mentorship. Highly recommend the Discord group.
Thank
to anyone who's debating it. Of course, bro. Of course.
Thank you, bro. The actual live training itself, like, 100%, bro. Like, it's going to help you out so much. Because anyone can go off and watch content, they can watch YouTube videos, they can learn a concept, but it's about how and when to apply it. Like, someone can learn sequential SMT And I'm sure so many people would just purely trade it like a pattern, whereas in the live sessions, I may see a sequential SMT, but there's always some sort of scenario that I'm thinking of as to why I'm not going to take it, or why I'm going to stay away, or why potentially I am going to take it if X, Y, and Z happens. You know what I mean? And you don't learn that from a video, unless the video is like 10 hours long of just going over like example of that concept, which there isn't much of that out there on the internet. You know what I mean? So you can learn the concept, great. And one way to go about it is just put in like countless hours of just pure backtesting and learning it yourself and in real markets. Or you can, for example, come to someone that's put in that work. I've been trading quarterly theory for over 2 years now, so I know what works, I know what doesn't work, I know when a specific concept should work, etc. And seeing that live is just going to be night and day difference compared to like learning it, because like you said, I learned from Day as well. I was in Day's mentorship and it was amazing. Obviously I would not be where I am without Day, so obviously shout out to Day like hugely. Sure. But I learned the concepts and I did put in countless and countless hours of work. Like I said, I've been studying this content now for not studying that content specifically, but when I first learned it for like a year straight, like sleepless nights, whatever it may be. So why would you not want to speed up your process from joining someone that's put in those sleepless nights, all those hours, and now know what works well and what doesn't work as well, and has a system around it, and see how they put it to work live in action on the charts, Exactly. So yeah, I appreciate that massively, bro. Thank you for hopping on. Any last words before we call it there? Have you got any like social medias that you're trying to grow at the moment, or that you want to like shout out, or are you just kind of stick into your own lane?
If you want to tag me, if you want to tag me on Instagram, you can. Like it's, I'm not really much on social media that much. Cool. I've always thought about, again, like once I get to a certain point kind of success wise with this, like I would, I'd love to be able to help out as many people as I can as well. Just get content, stuff like that going on as well.
Yeah, we need to get you. We need to get you inside the Discord, bro. As like a mentor or like a coach or something like that, because that's definitely something that I've thought of. Like the students that I've taught in the past, like I've got a lot of students that have done very, very well for themselves. I'd say you're one of the best ones as well. So who knows? Potentially in the future, we can get you on as a coach and help out other people as well, because we trade very similar. So that could be definitely something that we can do in the future. But either way, I'll drop your Instagram handle in the description. So if anyone wants to check out Connor's Instagram, he doesn't post too much at the moment about like training stuff, but who knows, in the future, you might be able to do it. You can drop him maybe a few questions about his journey and stuff like that. But yeah, aside from that, bro, I appreciate you massively for hopping on. And for everyone that's watching at home, don't forget to drop a like, subscribe, comment, all the rest. If you do want to join the Discord or the mentorship, links to apply for that will be in the description. Yo, what's good, guys? Welcome back to a new video. Today we got another case study with another mentorship student of mine. It's called Vinny. How old are you again, Vinny?
24.
24, from the UK as well, right? Same as me. Same accent, if you guys couldn't tell. But yeah, basically what we're going to be doing is I'm going to be asking Vinny a few questions about his experience inside of the mentorship and sort of his journey. You've been inside for around about like 2 to 3 months now, right?
2 months today.
2 months today, perfect. Before Vinny joined, he obviously going to speak on his situation himself, but a quick little breakdown. I don't think you got a single payout before joining, right? Never got a payout before?
I passed a few accounts, but never actually got a payout.
Okay, so passed a few accounts, never got a payout, struggling, with that consistency, getting the payout. And just in 2 months, he's now passed his 5th top step account today. So that's 250k in footed capital, and managed to get 3 payouts as well. Okay, so yeah, obviously huge congrats before we get started. It's obviously a great achievement. So now I'm going to go ahead and ask you a few questions about your experience. Just answer truthfully, and we'll go from there. Okay, so first of all, first question is, where were you in your trading journey before joining? So obviously no payouts, all that type of stuff. What was you struggling with? And yeah.
I'd say my main struggle was probably my psychology.
Okay.
And then maybe like a decent entry model.
Mm-hmm. Okay.
In terms of trading, like I had a decent like grasp on trading in general, but I feel like when it comes to the markets, I've probably got a bit ahead of myself sometimes, or let emotions take over, sort of thing.
Mm-hmm.
I don't know. Some people say it's a quick get rich quick scheme, if you know what I'm saying. So then, I feel like once I've done 2 or 3, maybe I just chase it then, and then that's why I end up like failing. But since joining, I've learned to like take a step back and assess and just look at the markets more, sort of thing, and know when to stay out. I feel like that was my biggest problem, not knowing when to not take a trade, if you know what I mean.
Yeah, 100%, man, 100%. It's like the things that you do between the model appearing and not appearing, just like learning to stay still and remain patient. And obviously as well, since joining, you've now got a solid entry model that you sort of trade every single day that you can trust. So that sort of feeling of wanting to enter just based on intuition or chase trades is kind of gone, because you've now got a solid foundation to follow every single day, right?
Yeah.
So that's obviously amazing. Next question is, had you joined any mentorships prior to joining my one, and what was the experience like if you did?
No, I've not joined any mentorships. I mean, I've followed people and like obviously done some sort of boot camps and stuff like TGRs and whatnot, but I've never joined any mentorships.
Okay.
No.
Okay, no problem. That's all good. And then again, what was your biggest hesitation before joining the program? If you even had any, or was it just you saw me sort of mention it, and did you think in your head straight away, okay, I want to join this mentorship right now? Or was there any hesitations before like pulling the trigger and, you know, making that investment in yourself basically?
Yeah. I'd say there's hesitation. I'll be lying if I say there wasn't, because obviously you're invested, aren't you, really? Like it's so that was like probably like my main worry. But obviously watched your previous video with Erwin, and that kind of gave me a nudge. And as well, I don't think you flex the way the other traders do, like material in like Rolex and cars and stuff. Like I followed you for a while, and the proof's in the pudding. You showed results and stuff like that, and also you flex. Well, no flex, but like you show like financial freedom and just do your 90 minutes and then do something else. So I feel like
exactly, man.
After like the 3 years I've been trading and I look at people, I don't know, I just trusted that I'd do well with you. So
I mean, you can kind of tell, like you can differentiate who's really telling the truth and who's lying. Like if you see someone that's classing themselves as a trader, but every single video they post on social media is them driving a sports car or taking trips here, there, and everywhere, rather than the content I post itself is just like 99% of purely trading, right? Just executions, student results for myself as well. Like, so 100%, man. So I guess, the only hesitation that you really had was kind of like if it would work for you. But it wasn't like a huge hesitation, because you saw prior to like the videos that I posted that, you know, I was pretty trustworthy, obviously, judging from the videos alone without joining before. Fire. So now, more or less the experience. So what was your experience like in the first few weeks after joining? So I know that Erwin was more or less like learning, like studying the content first, or did you do that and jump straight into executing, or how was that for you?
Yeah, I mean, the first week or two I was learning, and then obviously I passed an account, and then I told you, like, the first day I took a win, then the next day I blew the account, and then I said to you, I've blown the account, and then that's when you held me accountable and said, look, mate, you shouldn't be blowing your account like that anyway. So like after the first 2 weeks of learning, I feel like the learning process for me was just taking it steady and like obviously one foot in front of the other sort of thing.
100%, man. I like that a lot. I guess maybe you tried to, you know, rushing a little bit too quick, try to like hit that home run, get that big payout like straight away. But once you then slow down a little bit, you know, one step in front of the other, like you said, then, you know, stacking accounts, get one account and then maybe focus on getting another account and then just building up those small winning days. And at the end of the day, all adds up, all adds up, right? So, you know, you definitely took the right approach, which is amazing. So that's great. And now, what part of the program itself helped you the most and why? So obviously we've got many different features. You know, we've got the group calls, we've got the one-to-ones, we've got the live trading, just the education. Like, what would you say helped the most and also why?
I would say the live calls. They helped me the most, and just also having like you to message and just get hold of it sort of thing. Just, you know what I mean? Having you there. Obviously, excuses sounds good to the person that's made them. I feel like a lot of my trading journey, I've been making excuses and whatnot. So then when I've had to come and tell you if I've done something, and then you wrong, then that's like, do you know what I mean? Kind of feel like I've invested in this now, and I can't be letting you down and myself down in a sense. So I take the live calls and just having you there to just get hold of sort of thing.
100%, man, 100%. Yeah, because obviously that's what a lot of people lack as well, is just having as well is just having someone to help keep them accountable, right? Because trading can be, you know, lonely. You can make these impulses, and when you're on your own, you're more likely to do it rather than having someone there side by side, essentially telling you like, look, like why have you just done this? Like this shouldn't be happening, right? Whereas you could have blown that account that you know blew at the start, and if nobody told you about it, you could have just gone back in the same day, tried to pass it, and try hit that big payout again, and just repeat the cycle over and over and over, right? And then obviously the live trading, you know, I don't just teach you the model and the concepts. You get to see me execute it live and sort of the thought process that goes behind it as well, right? Because it's one thing watching videos and learning the concepts, but it's another thing actually applying it in real time, right? Like you don't learn that from a YouTube video or anything. So yeah, man. Next question is, was anything different? Oh, sorry. Was there anything different than what you expected coming into the mentorship itself? Like, did you think you get anything different, or would you say maybe it's a little bit better than what you expected?
But yeah, I'm pleased with, considering I've only been in there 2 months and I've been trading for 3 years. Like the step I took is a massive step. So
100%. Yeah,
I can't say I'm not pleased with it, but I don't know. I wouldn't say it's like different or anything. Like it's a good community and everything sounds so.
Yeah, it's kind of what you expected. You know, we obviously went through what you'd get in our first call that we had together before getting started with the mentorship. And yeah, everything, you know, that I said we would do, we did basically. And you've, you know, hitting these goals step by step, day by day, basically. So yeah, that's perfect, man. Now we just got around about like 3 or so more questions left, nothing crazy. So now I want to ask, obviously this could be a little bit personal, but what is the biggest win that you've had so far? And it doesn't need to be in terms of a number amount, but maybe it could be, you know, hitting that first payout or getting max allocation on the top step. Like what would you say is the biggest win, something that you're proud of the most that you've done so far?
Yeah, obviously everyone's first payout is a lovely thing, but I think like the max allocation thing came around fast. I didn't even have time to prepare for it. I mean, I'm in a good situation now, so I feel like that's probably like my biggest goal.
Yep. Fire, man, fire. And that should definitely be a goal for everyone, because that's more long term as well, right? You know, getting that first payout, obviously, like you said, is great, but now you've kind of set yourself up for like the next few weeks, few months or something like that to repeat these payouts over and over and over, right? With having more of that capital, and also having more capital just helps with everything in general, right? Like the losses can be a lot smaller, the wins can be a lot bigger. So that is something that, you know, most people should definitely focus on for sure. So yeah, I mean, amazing stuff. Congrats again, bro. Definitely been killing it. And now, how long did it take you to get to that win? So how long did it take you to get max allocation? I think you hit it today, right? You passed out final fifth account.
Yeah.
And you said so 2 months, right?
2 months I've been in the mentorship, and then I've hit max allocation today.
Nice. Fire, bro. And when did you get that first payout as well? I think that was pretty early on, like a month or so, right? In something like that.
Yeah, it must have been just past a month, I think.
Okay, fire, bro, fire. That's really, really good. And now, how does trading actually feel now compared to before you actually joined? Like, what would the main differences be?
It feels more mechanical, if you know what I mean. Or I was in my head a bit and just. Do you know what I mean? You see it go up and then you want to buy, or you see it go down. But now I've got my bias, I've got my setup, like my entry model, and if it's there, it's there. If it's not, it's not. So
there you go. Yeah, there we go, man. That's great, man. So just overall, just like would you say like a lot more confident and just a lot more confident, a lot more like laid back sort of thing. Yeah. Fire, man, fire. That's obviously the goal within trading, right? It shouldn't be this complicated thing. Like, you shouldn't be second guessing the trades that you're taking every day. Like, it should just be open up the chart, certain time, execute the model. If it's there, you take it. If it's not, you don't. You know, simple as that, basically. So yeah, that's great, man. So yeah, last couple of questions now. Do you feel that you could have achieved what you've achieved now without my guidance? And also, let's just say like within sort of like the same time span, because I'm sure with enough years in the game, you know, you could have got to this position, but within the time frame that you did it within, do you think that could have been achievable without the mentorship, or what would you say?
Probably not. I mean, I'd say I did need your guidance in a sense. I mean, the thing that I'd done in the first 2 weeks, I mean, like pass account and then blow it within the first 2 days is something that I had done for a long period of time. So the fact that I had to bring that up to you and you called me out on it, obviously with me investing in it and then you telling me that I should change, then I realised I had to change. So yeah, I would say I needed need the guidance.
Fire, man, fire, 100%, bro. All right, cool. And then we got literally last two questions here, and this is just straight up. Would you say that the investment that you made for the mentorship was worth it for you? Would you say it was worth it?
Yeah, I'd definitely say it's worth it. I mean, it won't be long until I make that investment back. You know what I mean?
Yeah, true, man, true, literally. And that's what I'll say to a lot of people that are kind of on the fence as well. Like, you need to think of this as an investment within your future, right? And you could potentially make this investment back within, you know, a few months, maybe 3 to 4 months. And then from there, it's just about building, you know, anything you make on top of that is just pure profit. And yeah, so that's amazing, bro. And then literally the final question here is, what would you say to someone that's on the fence, potentially like you were at the start, that's maybe hesitating a little bit? What would you say to them, and sort of how like the mentorship would help them, you know, reach their goals that they've been trying to hit for a while now?
I'd say if you're an hour in, then I'd do it.
Yep.
I was an hour in, and I don't regret it at all. I mean, it's probably the best decision I've made in terms of trading.
Yep. Yeah.
100%.
I like that, bro. I like that. And yeah, obviously that's pretty much everything. So yeah, I guess I appreciate you for, you know, hopping on and doing this little call as well. And obviously a big congrats to you as well for achieving what you've achieved. Obviously, you know, this is very, very good results you've seen in a short amount of time, but it's not only from my help, but it's down to you as well, you know, because I can tell you everything in the world, but if you can't bring yourself to follow the model, follow the rules, then there's not really too much I can do. So the fact that you've listened to what I've said, you know, taken it on board, and you're sticking to the rules, and it's working out, and you've seen these results, it just goes to show like what you can achieve by, you know, having the right guidance and following the right path and whatnot. Okay. So yeah, again, you know, huge congrats, and I appreciate you for hopping on.
And there we have it, guys. That is going to be a wrap of the full 10+ hour complete A to Z guide on quarterly theory. You are now completely equipped to make money from these markets and become a full-time consistent trader. If you guys did enjoy the video and appreciate the work that I put into it, took me absolute weeks to make this video for you guys, and I'm assuming so many profitable traders are going to come from it. To show your appreciation, I'd appreciate a like. Comment down below if you have any questions at all. Also comment down below the words locked in if you made it this far to the end, so I know which of you guys are completely locked in and are going to change your lives. Also, don't forget to subscribe. Check out all my links in the description down below. Specifically, if you need more help, you can apply to work with me and be mentored with me one-to-one. You can join the live trader sessions every single day inside of the premium membership link. You can also find the best deals and discounts at prop firms using code BUCKO at propfirmio.com. Grab access to all the indicators that I use. We have now a library of over 6+ indicators. Join the free Discord community down below of over 8,000 traders, primarily quarterly theory like you guys, looking to grow, help each other out, post analysis, and all of that good stuff. Check out all my other social medias as well. Bucko Trades on Twitter, Instagram, and TikTok. And with that being said, I'll see you guys in the next video.